you can either use one of those drivers to drive you back home,
Okay.
or you can sit in one of our cars and go back home.
Okay.
Just go back home safe, because it's in my interest, to not let you bang your car
Yeah.
when you're drunk.
Yeah.
And we call it Acco Safe Drop, and it's receiving a lot of love. This is in our territory. It's good for the customer. Like, hey, have a drink, but we'll drop you home.
Yeah.
We'll drop you home safe. I've insured your car. You better not bang it, and you'll be safe, right?
Yeah.
But this is, or buying our own tow trucks, right? And they're painted green. They look lovely. They're like, they catch attention on the road. So I think we keep doing these things, and we'll continue to scale these things, because I do believe this is better marketing than maybe running an ad on IPL or something.
You're not really looking at doing this at scale.
No, we will. I think top 8, 10 cities, we will scale this. We're seeing how it runs in Bangalore.
Okay.
But yeah, so some of this is really fun to do, because it's good for the customer, it's good for the brand, in both ways.
Well, Varun, here's wishing you and Acco the very best of luck. We hope that you continue to build on the momentum that you've generated so far, and may you have many more micro moments that you capitalize on. But thanks very much for dropping in and giving us a rundown of the journey so far, but more importantly, the road ahead for Acco. Thanks very much for your time.
Thank you so much.
Well, with that, it is time for us to wrap up this edition of Young Turks Reloaded. As always, we like to hear from you. Do send us your feedback and your comments. We'll be back again next week with another startup founder. Till then, from all of us here, goodbye and many thanks for watching.
Weight loss drugs are no longer just a health trend. They are one of the biggest disruptions in global pharma, and in India, we're at a critical inflection point.
India already has over 100 million people living with diabetes and over 250 million people with obesity, underscoring the rise of diabesity and its link to other diseases.
But globally, the GLP-1 market is estimated to exceed $100 billion annually this decade in India, and the shift is already visible. The weight loss GLP-1 market has more than doubled in a year, with drugs like Mounjaro, Wegovy and Ozempic driving that surge.
And now comes the big trigger. Semaglutide, or Wegovy, Ozempic, goes off patent in India later this month and across 80 emerging markets in this particular year itself. Indian pharmaceutical companies, they're lining up, whether for domestic launches, exports, manufacturing or distribution partnerships.
So what does this mean for investors? Will competition compress margins? Which companies are best positioned to gain scale? And how should markets price in all of these newer drugs?
That's exactly what we discuss over the next hour. We deep dive into the weight loss drug opportunity to assess whether India is ready for a structural shift in obesity and diabetes care, and what that means for stocks, investors and patients alike.
Welcome to this special show, Weight Loss Drugs, the Market Opportunity. Let's begin the show with an MNC perspective. We have with us Novo Nordisk's Vikrant Shrotriya. Mr. Shrotriya, thank you very much for joining in. If you could come, have a seat and take us through some key details about the company.
Thank you very much. Thanks a lot, Ekta and Mangalam. And fantastic to see that a healthcare subject comes into the market perspective that used to be completely rare, in India. Now we are talking about diabetes, obesity, not only for health, but also for the business. So that's a big change.
Yes, absolutely. And one of the key things that Mr. Shrotriya, I want to start with is that we're going to see that competition come in for semaglutide. Just in the next 2 weeks odd, we're going to see maybe even 50 companies launch generic versions of the drug that you all currently have patents on. Tell us how you're preparing for that competition.
Yeah, we welcome actually, and it's a party, but it's a serious party.
Right.
It's a serious party, why I say, because it's about a disease. It requires something which we call it's not about the patents, which is getting expired, but it actually talks about the purpose. And the purpose is not very short-lived. It has to be very, very long. The commitment, the passion, the kind of work which one has to do, that is very, very important. And I personally feel that expiry of a patent is like one injunction, which happens in the life cycle of a drug. For any drug, it will happen. But what is more important is who enters. And any company which enter with a serious intent, I think that is very, very critical. Alone, we can never do this job. I think, Mangalam, you talked about 250 million people with obesity, 100 million people with diabetes. Alone, a single company, 2 companies or 3 companies cannot do it. But of course, it is not also a thing where 50 or 100 companies can participate. We require serious players, and I personally believe that over a period of time, serious players will survive and they will do the justice to the market, and more important is to the patients, and that's a very important and critical point.
Do we have any historic parallel where, this drug is such an unprecedented drug? Do we have any historic parallel where a drug that took the world by storm like this and then went off patent, what was the impact of that on the market, the industry, and obviously overall patient health as well?
Yeah, we have seen that, drugs like sildenafil citrate, in terms of, Viagra, which was there, it went off patent. And then, of course, many of the players who came into the market. But remember, here we are talking about protein chemistry. We are talking about peptides.
Exactly.
We are talking about injectables. We are talking about septic conditions. We are talking about precision device and an rDNA technology. We are talking about a serious manufacturing process. We are talking about serious supply chain. And we have at least seen in insulin market, which is also largely quite big, that despite being many of the players who are there, and they still serve a purpose, we still have got half the share. Every second patient actually is on Novo Nordisk insulin, whether it is in India or across the globe. And that's because our commitment is not today and tomorrow. It's not about an opportunity. It's about a serious concern for those patients. And patient is at the center of heart in terms of Novo Nordisk philosophy. And here also, we are talking about a long chain protein. It's called peptides. And in this, again, many of the serious players will survive, and they will also do the justice in terms of the market.
So you're not expecting those 50 players to continue selling. You're expecting maybe some consolidation to take place in terms of market share, where maybe the top tier companies or certain companies hold the share because it's a complicated peptide drug that you're selling?
You always see that. You have recently seen a gold rush. Right? And by the time somebody buys and it comes down, right, it's also a rush of semaglutide, which is rushing in, right, with the patents going out, or, So you will find many of the players who see it as an opportunity. They will soon realize that while entering can be easy, to survive can be very difficult.
So that brings us the obvious question, right? What would it take for a company to survive in this market? And at the same time, what differentiates the winners in this versus the ones who will not make it?
I think players who have got a serious commitment, who have got a purpose to continue, players who have got an intention that when they enter, they will go in a long, long journey to be there with the patient, who work along with science, who work along with innovation, who don't only work along only on commercialization and market cap. This should be a byproduct. I think when it comes to the money, it should be a byproduct. But the first is a purpose and a commitment to go long, which is driven by deep science, is very, very important. Somebody who work and share education along in the journey and lead it, I think they will survive.
Okay. Well, Novo Nordisk has taken a steep price cut of almost around 37% in the month of November. Has that shored up sales at all for you all post the price cut? And do you think you'll need to cut prices further, because there's an expectation that prices could be as low as 50 to 60% once other companies launch?
Yeah, and there I would say, first my job was to bring the innovation here in the country. And then we are very concerned. In fact, I'm an Indian myself, right? So I wanted that it should be actually adjusted to the Indian prices. And that's where 37% cut, you ask somebody to cut 37% of their salary, that's the kind of a cut which we actually took. And I think that was required for access and access for care. That's very important. It's not only access for care. And with that kind of a cut, we have seen that accessibility of the medication across in India has increased. Many more people could able to afford it. And not only that, we also did the partnership with Emcure Pharma in terms of getting the wide reach across the country, because that's also again very important. We have to also see that it is available across India. So we partnered with Emcure. We have also partnered recently with Abbott India also in terms of making sure that it is available for the cause of diabetes, which is again 100 million population which is there.
But just on that partnership that you have with Emcure, how is that partnership doing? Because the feedback is that, you know, people don't recognize the Emcure brand as Novo Nordisk's manufacturing. They recognize it as a separate brand and they'd rather still buy your brand. So is that, you know, sort of cannibalizing?
Many of the Indian companies who are there 20 years back, they were not even there. But now they are the large companies. So as I said, this is the start. This is sowing the seed. You have to see these kind of start of the journey after 5 years and 10 years, and then see what kind of an impact they will make. I have been there in this journey with insulin, where we used to have only hundreds and thousands of patients only on insulin. Today, there are 6 million people who are actually taking insulin. So this journey is for a long haul. It's for chronic, and it is a chronic journey. It's a chronic disease. It doesn't require an acute mindset. It requires a chronic mindset to operate. And that has to be there in the mind.
You know, there was this Delhi High Court judgment where they reserved the judgment, just took place today. And that means that Dr. Reddy's is allowed to manufacture, export semaglutide to countries without patent protection. Your thoughts on that? It is already a case which is, you know, which has gone against you all.
See, there I cannot comment, because I can only say that, you know, we will have to go through this judgment. And I think we have a very, you know, qualified legal team in terms of taking forward these kind of sub judice matters. And we will have to learn this verdict, which has possibly come by the time I am actually sitting here.
All right, you take that point. You spoke about scratching the surface of the market right now, but the important part is we are also just scratching the surface of this conversation. So there's not you know, just one, but the start of many that we have. In fact, we've heard from Novo Nordisk, the manufacturer of Ozempic and Wegovy. But as we head into this short break on the show, let's also listen in to what Eli Lilly's India head had to tell us when we spoke to him just a few weeks ago.
Semaglutide is going generic. There's not a generic for tirzepatide. And tirzepatide has a very different profile. We are a dual agonist, GIP and GLP. We know that that has proven as a mechanism to show superiority over semaglutide alone, both in weight reduction in SURMOUNT-5, but also in glucose control and weight reduction in SURPASS-2 as well. And so from that perspective, we feel like the value of tirzepatide differentiates it in the marketplace. We price our product based on the value that it brings.
Welcome back to this special weight loss drugs town hall. Let's now get in a more granular perspective from various Indian companies and how they benefit from weight loss drugs.
We do have Neeraj Sharma, who's the MD and CEO, OneSource, Amit Bakshi, who's the CMD, Eris Life Sciences, and Amit Sanghvi, who is the MD, Shelly Engineering Plastics, joining us on this special coverage as well. Thanks a lot, gentlemen, for joining in. You know, a lot has been spoken about the opportunity. A lot has been spoken about what happens and all these things. The question is, how prepared is the ecosystem for it? Because on the one hand, yes, there is this opportunity, but on the other, you know, there are other things that are required along with all of this as well. So where are we in our preparedness for this, and how far are we to go from here on?
Yeah, thank you, Mangalam. Yes, we heard, you know, it's a really great opportunity. More than anything else, it's the opportunity to get the Indian patients treat obesity for the very first time. So in terms of preparedness, I can talk about you know, ourselves as OneSource CDMO. So from a point of view of having capacities in place, from the point of view of having all the required regulatory approvals in place, we are set. We are set. We have scaled capacities. We continue to scale capacities. We are set.
The war in West Asia rages. A wave of drone and rocket attacks target the U.S. embassy in Baghdad, while the Iranian missiles attack was intercepted over Tel Aviv. European and NATO allies reject Trump's demand for assistance to reopen the Strait of Hormuz. U.S. President Donald Trump again offers vague timelines for the duration of the war with Iran, saying it will be wrapped up soon. Also says that we'll have to delay the China trip for about a month due to the war. Brent crude prices continue to hold above $100 a barrel mark on worries about supply, with the Strait of Hormuz mostly shut and U.S. allies rebuffing calls to send warships to help the tankers move through the vital waterway. Meanwhile, U.S. Treasury Secretary Scott Bessent tells CNBC that the U.S. is allowing tankers to sail through the Strait of Hormuz in order to allow supply flow to the rest of the world. Stocks on Wall Street closed Monday's trading session higher as a major averages rebound on easing oil prices after the U.S. said that it would be fine with some Iranian and Indian Chinese ships moving through the Strait of Hormuz. Investors now look ahead to the Federal Reserve's two-day policy meeting, which begins today. Asian markets open higher, tracking gains on Wall Street. The GIFT Nifty is also indicating a positive start for the Indian markets. Hello, good morning. You've tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. While the tensions in West Asia still continue, we're seeing that Indian markets, yesterday we managed to close with some bit of a gain. Today, the Indian markets are indicating a bit of a positive start that we could say as well, given that Asian markets too are indicating a positive start right now. Asian markets, look at what they've opened up in. Hang Seng opened up with gains. We're seeing Taiwan index that's opened up with a slight bit of a gain as well. Actually 2% almost gain that we're seeing for the Taiwan index. The Australian index that's opened up with gains of almost 0.1%. Nikkei is trading with gains of 0.3% as well. Shanghai holding on to gains of 0.05%. So most of the Asian markets have opened up on the positive side following the cues from the Wall Street as well. So we're seeing some bit of a gain that is coming in the markets after the last couple of weeks that we were seeing a bit of a red. Indian markets today, 25-point uptick, 38-point uptick now that we're seeing for the Nifty implied open as an indication for the Indian markets. So let's watch out for whether this sustains going forward as well, whether we cross some key levels will be key to watch out for. But in terms of the latest update, let's start the show with that as well. The ongoing war in West Asia, a wave of drone attacks as well as rocket attacks targeted the U.S. embassy in Baghdad early on Tuesday. The most intense assault, the U.S.-Israel war with Iran, began with at least 5 drones that were used. On the other hand, the Israeli military is saying that missiles were launched at Israel from Iran and that defense systems were operating to intercept the missiles. Iran stepped up the attacks on energy infrastructure around the Persian Gulf and set a massive gas field ablaze, adding to the pressure to the global fuel supply situation. The UAE had announced temporary closure of the country's airspace for a brief period early this morning as well, which has now been reopened. So that's the latest update that we have coming in on the West Asia war that's been going on. Now let's get you some of the latest updates that's come in on commentary from Trump as well as Trump-related developments as well. And speaking to reporters at the White House, President Donald Trump offered an optimistic but a vague timeline for the end of the conflict, which is already in its 3rd week. President Donald Trump said that the war with Iran could end soon, though suggested that the conflict is unlikely to wrap up within the current weeks. Listen in. Okay.
British experts, nobody thought they were going to hit. They were, I wouldn't say friendly countries, they were like neutral. They lived with them for years. Peter, they were going to take over the Middle East. They were going to knock out Israel with their nuclear weapon. But after we knocked out their nuclear potential weapon, they started building missiles, thousands and thousands of missiles, and they were going to do it with missiles while they developed. These are sick people. While they developed nuclear, somehow they were going to start at a different site, because that site was, you saw the site, the mountain. They were going to go into a certain area, which we know exactly where it is, and they were going to do that. And it's incredible what we've done.
Like you heard him just say, right, that if he hadn't attacked, there would be a nuclear war, is what he's suggesting. So more on that front. Trump also addressed these retaliatory attacks across West Asia following the February 28th US-Israel strikes that started. He said the intelligence officials did not anticipate such attacks on the Middle East front. And he said the greatest experts, nobody thought that they were going to hit the Middle East, the UAE, the Kuwait, Qatar, nothing that he expected over there, adding that several of the countries struck had maintained relatively neutral relations with Iran as well. Okay, moving on. We also had commentary that came in from Donald Trump, and he reiterated his appeals for help from other nations to secure the Strait of Hormuz, saying that Iran was nearly obliterated even as the war keeps rolling oil markets and global shipping. The president expressed his frustration with other nations that have so far been publicly non-committal on his calls to help ensure vessels can transit the strait. Trump also called out NATO and other allies and claiming that they had leaned on the US for tens of billions of dollars in protection, yet they failed to act when asked. Listen in.
And we strongly encourage the other nations to get involved with us and get involved quickly and with great enthusiasm. I have that from a number of them, and I'd like to say their names, but frankly, I don't know if they would want me to or not, because maybe they don't want to be targeted. But I say, wouldn't matter if you're targeted or not, because this is a paper tiger that we're dealing with now. It wasn't a paper tiger 2 weeks ago. It's a paper tiger now.
Commenting on his visit to China, President Donald Trump says that he had requested China to delay the summit with the Chinese counterpart Xi Jinping for about a month, citing that the need because of the overseas issues that are going on in Iran. So delay in this meeting would be something that would be apt. Listen in.
We're speaking to China. I'd love to, but because of the war, I want to be here. I have to be here, I feel. And so we've requested that we delay it a month or so, and I'm looking forward to being with them. We have a very good relationship, but because of the war, there's no tricks to it either. It's not like, oh, gee, I'm waiting. It's very simple. We got a war going on. I think it's important that I be here. You know? So it could be that we delay it a little bit. Not much.
Tariffs, saying that the Supreme Court decision would not change the tariffs, and he would start tariffs over again a different way after this decision that came in. Now, lastly, the U.S. Securities and Exchange Commission, that's the SEC, is preparing a proposal to scrap the requirement for companies to report their earnings every quarter and giving them the option to share results twice a year. The Wall Street Journal reported this on Monday. So that's the latest update that we have on the Trump-related developments. But meanwhile, the U.S. Treasury Secretary Scott Bessent tells CNBC that more and more ships are now going through the Strait of Hormuz, and many countries, including India, are using oil. Adds that the administration is not in favor of further easing of sanctions against Russia. Listen in.
We are seeing more and more the fuel ships start to go through. The Iranian ships have been getting out already, and we've let that happen to supply the rest of the world. We've seen Indian ships go out now, so the Indians who rely very heavily on Gulf oil. We believe some Chinese ships have gone out. So that should start ramping up before there are any the flotillas or protective armadas in the Gulf. So we think that there will be a natural opening that the Iranians are letting out, and for now we're fine with that. We want the world to be well supplied.
Now, in a major diplomatic development, the Indian-flagged LPG ship Shivalik has arrived safely at the Mundra port, carrying about 40,000 metric tons of LPG, enough to fill roughly 28 lakh domestic cylinders. This comes amid the disruption in the global oil supply caused by the ongoing Iran war and blockages in the Strait of Hormuz. The Ministry of Port confirms that 24 Indian-flagged vessels with 668 seafarers are currently operating in the Persian Gulf. The coordinating, continuing with the DG shipping and ship owners, and as well as Indian missions to ensure this safety as well and their safety as well. But on that note, we're going to slip into a very short break. We'll come back with the trade setup for the day. Stay tuned. Welcome back to Power Breakfast on CNBC TV 18. And in the US markets, what we saw is that all three major indices were in the positive territory after oil pulled back. Nasdaq and S&P 500 were up over 1%. Dow Jones gained over 0.5% as well. Tensions between the US and Iran continue to escalate. But how are all these global market actions going to impact our Indian market? We have a team of research joining in now to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, let's go across to Hormuz, who's here to tell us the important cues that we should be keeping an eye out on today. Good morning, Hormuz.
Good morning, Winnie. And the big question today is that the recovery that we saw yesterday, is it just a technical bounce or is it a start of a more sustained up move from the lows? Now, it was a 450-point recovery from the lows of the day yesterday, although today the challenge is that the oil prices are still higher. They fell overnight, but they are seeing a bit of a rebound today. The Dow futures are down. Today is also the weekly expiry of the Nifty. So there are multiple things that you need to watch out for. But is there more upside in store? Now on the charts, despite the rebound yesterday, the Nifty is still in oversold territory. The oversold being the fact that RSI on the Nifty is still at 29.7. Now, and RSI reading below 30 means that the index or the stock is oversold. So it's still in oversold territories despite the rebound, because on Friday, the RSI was at 24. So now the bulls would be hoping that 23,000 becomes a very firm base for the index, but 23,500 still remains a bit of a supply zone. That remains the challenge. That remains the first hurdle to cross for the bulls on the upside. What bulls would also be hoping for is that yesterday's low 22,955, that is not retested again, even if the rallies that take place subsequently get sold into. That is one thing. The Nifty Bank, for the Nifty Bank, 55 55,000 is the first level to watch on the upside. And on the downside, though, is the low that you made yesterday, 53,258, is still 1,200 points above those levels. So we need to keep an eye out on that. Now, we mentioned yesterday that for the selling in these heavyweight banks need to stop for any form of recovery, and that happened yesterday in HDFC Bank and in ICICI Bank both. So we need to see some follow-up buying here today, some stability in the broader markets. The bulls will see some confidence if we see a close similar to yesterday's, at the day's high or near the day's high. But for now, the GIFT Nifty is extremely choppy. It's the weekly expiry today. That brings itself a fair share of volatility. It'll be interesting to see how the day shapes up.
Okay, thank you so much for that, Hormuz. Nifty weekly expiry is also something that is important for the markets. But let's move on and now go across to Ria to tell us which are the important stocks to watch out for in the trading session. Good morning, Ria.
Well, good morning. Let's start off with Reliance Industries first. They have signed a 15-year green ammonia supply deal with Samsung C&T for over $3 billion, and this will be commencing in the second half of FY29. For Tata Motors, they have announced price increases of up to 1.5% for commercial vehicles with effect from the 1st of April this year due to rising commodity prices and input costs. For Reddington, the step-down subsidiary Reddington Gulf FCE's operations in the Gulf area have been restricted due to the ongoing war, but the financial impact of this is yet to be assessed by the company. Sagar Cements is going to be selling up to 7.24% stake in Andhra Cement via an OFS on the 17th and 18th of March to meet minimum public shareholding guidelines. Alkemenes has suspended the production of key products due to ammonia shortage as suppliers invoke force majeure. For Sun Pharma, they have announced the US FDA's acceptance of the supplemental biologics license application for a product called Illumia. Moving on, a lot of other stocks will also be in focus on the back of orders and projects. Leela Palaces has bought a 71 villa resort in Coorg for rupees 560 crores with the potential revenue of roughly 165 to 175 crores.
Okay, thank you so much for that, Ria. And in the final update, let's go across to Sudarshan, who's here to tell us the important cues in the world of F&O. Good morning, Sudarshan.
Good morning, Vinny. So it's weekly expiry today, as you have said, and ahead of expiry yesterday, we saw big buying returning from the oversold zone, and that was reflecting in the options data. Also, a huge put writing we have seen between the range of 22,900 to 23,300, and that's the reason Nifty PCR has moved over the level of 1 versus the earlier level of 0.74. But one concern for market is crude is holding above the levels of $100 per BBL. Now coming to the flows in the both index futures and in the stock futures, we have seen FIs buying. Even they have added long positions of more than 6,200 contracts. They have reduced short positions of more than 5,500 contracts. And as I told you in the options data, 22,900 and 23,300 on the put side were the most active ones, where there is a sharp drop in the premium. While on the call side, 24,000 and 23,500, both these call options have seen an increase in the premium. So support, I'll see around yesterday's low of 22,955. Resistance would be 23,800. Two stocks remain in the band. Those are SAIL and Samant Capital. Some of the stocks that have seen fresh long, those are Maruti, Bajaj Auto and MCX. And on the short side, those stocks are KPIT, Lodha and Hindustan Zinc.
Okay, thank you so much for that, Sudarshan. But on that note, we're going to slip into a very short break. We'll get your cues in the world of commodities. Post the break, stay tuned there. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates from the world of tech in our new offering, the AI Pulse. Rachna is here as always to take us through all of that. Good morning, Rachna.
Good morning. Leading the headlines was NVIDIA at its annual GTC Developer Conference, where CEO Jensen Huang said demand for the company's next-gen AI chips could reach $1 trillion by 2027. It's interesting because in October 2025, he had said the spending on the new platform would be around $500 billion. And now the projection is $1 trillion. Of course, the projection covers NVIDIA's Blackwell and the Vera Rubin platform, which is the upcoming one. Now, both are expected to power the next wave of AI applications, from advanced enterprise systems to autonomous machines. NVIDIA also unveiled NemoClaw, which is a new software platform designed to help companies build and control autonomous AI agents. This is built on OpenClaw, and it's capable of performing complex tasks independently while maintaining enterprise-level security and privacy controls. Jensen Huang also called it a Linux moment for agentic AI. And in one of the more futuristic announcements, NVIDIA revealed it is working on an AI computing platform designed for orbital data centers, partnering with space infrastructure companies like Axiom Space and satellite operator Planet Labs. The concept here is simple. Servers in orbit could run on solar energy and require far less cooling, potentially addressing one of the biggest constraints in the global AI infrastructure race, which is power. Meanwhile, the competition in AI is also intensifying. Reports suggest that OpenAI is now preparing a strategic shift toward coding tools and enterprise software as it faces growing pressure from rival Anthropic and positions itself for a potential IPO. Now, the scale of AI infrastructure race is also becoming more and more clear by the day, because AI cloud provider Nebius Group has signed a 5-year agreement worth up to $27 billion with Meta Platforms to supply large-scale AI computing capacity built around NVIDIA's upcoming Vera Rubin chips. In another deal, Apple has also acquired visual effects startup Motion VFX, strengthening its ecosystem of tools for creators using its video editing platform, Final Cut Pro. But the rapid rise of AI is also triggering legal battles. Publishers Encyclopedia, Britannica and Merriam-Webster have filed a lawsuit against OpenAI, alleging that the company used thousands of copyrighted articles to train its artificial intelligence models. And finally, in India's fast-growing AI startup ecosystem, Google and venture firm Accel reviewed more than 4,000 applications for the new AI accelerator, but rejected nearly 70% as so-called AI wrappers. Just 5 startups made the cut, each receiving up to $2 million in funding and cloud credits, as the tech giant looks to build a pipeline of real-world AI applications feeding back into its research arm, Google DeepMind. Taken together, the announcements show that the expansion of global AI race is thriving. So we're just here to look forward to it.
Okay, thank you so much for that, Rachna. But let's get an update what's happening in the world of commodities as well. We have Manisha joining in with us. Good morning, Manisha.
Morning, Vinny, and thank you for that. Well, I'll start with the crude oil prices, where the Brent fell 3% and WTI declined 5% overnight. But if you look at the Asian markets right now, we are 3% apiece on the higher side. Well, the decline came in after there were reports of several tankers safely navigating Strait of Hormuz. Even India is negotiating 6 more vessels via the strait. And then there are several countries pursuing back-channel talks with Iran to ensure safe passage for their ships. Also, there are statements from US and Japan that the release of the first tranche of emergency crude reserves will happen this week itself. So markets did see some easing in concerns therein. But then again, there are statements again coming in from various countries which have brought the risk aversion back into the markets there. It is only the energy markets which seem to be trading firm, because everything else in the metal space is trading in the negative in Asia. Gold is trading at the lowest in 1 month. Silver prices have fallen below $80 an ounce. Copper continues to see a decline for a 3rd straight week, by the way. And we also are looking at some pressure coming in now for steel and iron ore. Steel and iron ore actually gained in the last couple of weeks, but this week seems to be getting negative for this as well.
Okay, thank you so much for that, Manisha. But with that, we're absolutely out of time. Actually, we have a quick update that's come in because of the heavy casualties that we've seen and are feared in Kabul after a hospital was hit by airstrikes, which Afghanistan blamed on Pakistan's military. Afghanistan's deputy government spokesman said that the death toll has reached 400 people, even as Pakistan dismissed the accusation. accusations as well as the alleged attack came hours after Afghan officials said that two sides had exchanged fire along their common borders, killing 4 people in Afghanistan as the fighting between the neighbors entered the 3rd week as well. But yes, that's the latest update coming in there from Afghanistan, Pakistan. But with that, we're absolutely out of time on this edition of Power Breakfast. Today's Nifty weekly expiry. Keep an eye out on where the market is headed. But up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live from the CNBC TV 18 Moti Roswal studios. Markets looking a little better sometimes, look a little worse off. That's the kind of phase we are in. What after yesterday's 200-point bump today, of course, is also weekly expiry. So a fair bit of action-packed next few hours coming up. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi. Morning.
Hi, morning. The only thing is that crude is again inching back, right? Yesterday it was at $100 per barrel. Today, this morning, it's at $103 per barrel. But Asia is firm. Across the board, you've got gains of 1.5% to 2%.
Well, that's right, guys. And we're going to be tracking the market action all through the day. But for me, it's a special day because it's my wife's birthday. And we talk about buying the dip. I'm happy that, I'm lucky to have my life partner who's been buying me on the dip for very, very long. And in good, bad times. So happy birthday, Navneet, and wishing you a cracker. We'll join you later today. So we get back to the market action, but need to take advantage of where you're sitting today.
Enjoy the day.
Thank you so much.
Well, let's just quickly take a quick look at what you need to know as we begin this session. You've got oil, which is basically back above the $102 barrel mark. In Asia. And I say it's back above because it was back under $100 last night. I mean, actually, oil prices sold off 3%. By US market close time, but it's back above 102. Now, last night, S&P was up 1% and the NASDAQ was up about 1.25%. This is a big deal because, I think the S&P is down for about 6 out of the last 8 trading sessions or something. So, even a 1% pop is being noticed. Market breadth was strong. It was not as if it was led by this or that. 75% of S&P 500 finishing in the green last night. And some of the things which went one way went the other way last night. So the 10-year yield has been continuously inching higher. Bond yields across the developed market have inched higher. Inflation fears. So the 10-year was down 5 basis points. Dollar index was down 0.5%. It's inched up a little bit this morning to about, I think, back above 99.9 plus. But, this is the setup, what US kind of sort of reacted to last night. Now, you'd wonder if things have changed, if things are looking a little bit better. And the short answer is not really. And I'll tell you why, just a couple of reasons. So estimated oil flows through the Strait of Hormuz is still down 97% compared to normal. That is point number one. So very little oil is passing through the strait. The market is seemingly focused on the start of these IEA strategic oil releases, right? The IEA said they're going to push out 400 million barrels of oil. Timeline was unclear, but more and more demand that this be done immediately because there is a physical shortage which has to be met. Iran also signaled some willingness to permit some carriers, some tankers through the Strait of Hormuz, specifically India and China. Right? If you look at who buys the maximum amount of oil which comes out of there, comes through the Strait of Hormuz, China single-handedly is about 35% of the oil. Number 2 is India. And of course, there's other countries in Asia which also are dependent on that. And it looks like Iran is willing to sort of, let some of these tankers pass through, specifically Indian and Chinese. Will that make a difference to the price of oil is the question, and that we can come to a little later. Now, statements from President Trump, lots of statements, will play out some sound bites, but they are largely sort of, focused on trying to get the Strait of Hormuz going once again, operational once again. He's requesting other countries to join the effort, but so far what we've heard, of course, is it's a no. Lots of countries, 5-6 large countries have all basically declined. Some are saying we're considering, but no one has said yes, that we're going to join a US naval effort to escort these tankers through the strait. And I think that is quite telling. Now, Trump essentially has requested China to delay the meeting with Chinese President Xi. He says, well, he wants to stay in Washington to oversee the war effort. So that was something else. Now, NVIDIA's annual GPU technology conference happened last night. And Jensen Huang, the CEO of NVIDIA, essentially says that he expects revenues for NVIDIA to double to $1 trillion by 2027. That's a big number. It's I think 99% of the time at these conferences, Mr. Huang and, of course, NVIDIA have always sounded extremely exuberant. Look at the stock. It was about 1.5% higher. So it was not as if it ripped higher. I think that is largely because the market expected them to sort of post a very, very rosy kind of a picture out there. I'll just leave you with some levels here. So we are in a downward sloping channel. I mean, we'll try and put that chart up, which tells you visually what's happening, right? It's a, you go, and we bounced around in that downward sloping channel for a while. At the upper end, the lower end, the upper end, the lower end, and now we are moving back up again. So the upper end of the channel resistance is 23,590. That's the first level which the Nifty's got to take out. And then we'll talk about the levels like 24,000. If this fails, if you're not able to get to 23,590, then you basically fall back down to the lower end of the channel, and that comes in at about 22,500 or so. So that, to my mind, are the two numbers to watch out for. 22,550 on the downside, 23,590 on the upside as far as the Nifty is concerned. Nifty Bank, we can talk a little later. Today, as I said, is also expiry. Remember one thing, and I said this yesterday morning as well, because the market is so light, it's, these rips higher, these rips lower, these gaps higher, these gaps lower are going to come very easy. And they're going to be a little indiscriminate. That's the kind of trading environment we're in. Too much news flow. No one knows what's really going on. No one knows what's the end going to look like to this war. So it's going to happen. And I think we saw a trailer of that yesterday. Starting 220 yesterday afternoon, the market actually went up almost about 300 points. By close, it gave up a little bit of those gains. The GIFT Nifty is indicative of what the kind of open that we're in. There perhaps will be some covering ahead of that expiry today, but we'll see if these gains last as we begin a fresh new trading session. The F&O positioning, how is it looking like? Nigel has walked across to the wall. Nigel, take it away.
Well, that's right. The GIFT Nifty suggesting an 80-point bump up, and put that together with yesterday's bounce. If we can end with the 80 to around 100-point rally by the end of today on weekly expiry, the bulls will be very, very happy. Well, there was the bounce that came about yesterday, but it came about from oversold levels. So the risk to the downside is still very much alive. Going by the data points, since there is no de-escalation as of now. A short covering bounce, though, was evident. The key indices, they rallied big time from the lows of the day, and the open interest on both of them was actually lower. Another positive was that the India VIX, that's facing some kind of resistance at around the 23-odd mark. And the bulls will hope that this 25-odd mark is not breached. Yesterday, even at the low point of the day, the India VIX was more or less flattish, or it was trading in the red. Normally, that's a sign that things could actually be reversing, just in terms of an intraday basis, and we had spotted that at around 10:30 a.m. yesterday. So you don't want the VIX to get to around that 25-odd mark. Though we did see a bit of a bounce, the FIs, they continue the aggressive selling ways. While there were some signs of a bit of, a covering on index futures. So in the cash market, they sold. There was covering that we saw on index futures. Well, there was some long addition that we saw on stock futures as well. So the FI, the action in the F&O market should come up for you. Clearly covering on index and some long addition is what we saw on stock futures. The short positioning, though, is very, very aggressive still. 88% of the positioning on the short side. In absolute terms, it's around 2.5 lakh contracts. While there were some calls that were written earlier, well, yesterday, those call writers, they packed up their bags. So there was some unwinding that we saw on those calls that were written earlier. And, well, there was some put writing that we saw in trade yesterday. Moving to the options data, though, there was writing at two strikes. 23,500 call, 23,100 put. So on weekly expiry, you'll want the Nifty and you'll want the Nifty Bank to make a higher high as well as a higher low. So by the end of today, you'll actually want a higher high and you'll want the low of the day to get defended. Similar is the case with the Nifty Bank, and I think this holds the key. If you can get gradually to around that 55,000 odd mark, the bulls will feel that from these oversold levels, that bounce can extend a little bit. So the risk to the downside is still alive, but I think a relief rally is something that we could still be bracing for, provided yesterday's low does hold out. Another data point came in from Samco Securities that, normally when you see a 5% pullback on the Nifty in a particular week, the next week actually isn't that bad. That's what history suggests. So you'll be hoping for something like that to play out this time around as well. That's the data point coming in from Samco Securities. Whenever the markets have corrected by 5% in a single week, probability of a bounce back in the following week is there. So just want to clutch onto that. But Brent crude prices not going to that $110, $120 per barrel mark, that's the risk out there. So we'll have to keep an eye out on that front.
Well, at least the week started off well, with the markets gaining over 1% on Monday and a sharp 450-point recovery from the intraday lows. But let's get to the latest Trump-related developments. Speaking to reporters at the White House, Trump offered an optimistic but vague timeline for the end of the conflict, which is already in its third week. President Donald Trump said the war with Iran could end soon. But he also addressed Iran's retaliatory attacks across West Asia following February 28th U.S.-Israeli strikes. He said intelligence officials did not anticipate such retaliatory attacks across the neighbors. Trump also reiterated his appeals for help from other nations to secure the Strait of Hormuz, saying that Iran was nearly obliterated even as the war kept roiling oil markets and global shipping. Listen in.
Greatest experts. Nobody thought they were going to hit. They were, I wouldn't say friendly countries. They were like neutral. They lived with them for years. Peter, they were going to take over the Middle East. They were going to knock out Israel with their nuclear weapon. But after we knocked out their nuclear potential weapon, they started building missiles, thousands and thousands of missiles. And they were going to do it with missiles while they developed. These are sick people. While they developed nuclear, somehow they were going to start at a different site, because that site was, you saw the site, the mountain. They were going to go into a certain area, which we know exactly where it is, and they were going to do that. And it's incredible what we've done. We strongly encourage the other nations to get involved with us and get involved quickly and with great enthusiasm. I have that from a number of them, and I'd like to say their names, but frankly, I don't know if they would want me to or not, because maybe they don't want to be targeted. But I say, wouldn't matter if you're targeted or not, because this is a paper tiger that we're dealing with now. It wasn't a paper tiger 2 weeks ago. It's a paper tiger now.
Okay, well, the other one, of course, was his proposed visit to China to meet President Xi in China, and Trump essentially saying that he's requested to delay the summit with his counterpart for about a month or so, citing the need to oversee the Iran war and sort of stay in Washington for now. Listen in.
We're speaking to China. I'd love to, but because of the war, I want to be here. I have to be here, I feel. And so we've requested that we delay it a month or so, and I'm looking forward to being with them. We have a very good relationship, but because of the war, there's no tricks to it either. It's not like, oh, gee, I'm waiting. It's very simple. We got a war going on. I think it's important that I be here. You know? So it could be that we delay it a little bit. Not much.
Well, meanwhile, the U.S. Treasury Secretary Scott Bessent tells CNBC that more and more ships are going through the Strait of Hormuz, and many countries, including India, are using the oil. Adds that the administration is not in favor of further easing of sanctions against Russia. Let's listen in.
We are seeing more and more the fuel ships start to go through. The Iranian ships have been getting out already, and we've let that happen to supply the rest of the world. We've seen Indian ships go out now, so the Indians who rely very heavily on Gulf oil. We believe some Chinese ships have gone out. So that should start ramping up before there are any flotillas or protective armadas in the Gulf. So we think that there will be a natural opening that the Iranians are letting out, and for now we're fine with that. We want the world to be well supplied. Which is more, if oil spiked to $150, but Putin was getting 70% of that, or oil stays at 95 to 100, where's he getting more money? If it spikes to 150, so roughly his coffers are unchanged, and that whether a couple of billion more, a lot of money in the real world, but in terms of the Russian Federation, costs him about $2 billion a day to run the government. Mm-hmm. So the idea is, as soon as the conflict is over, and the markets are well supplied, to go back. And again, it is a short-term window for oil on the water. We believe that will be consumed very quickly. And Brent, the other important thing to know is that oil was going to China. They were going to consume it anyway. It was just backed up. Yep. And so by unsanctioning it, it can go to Malaysia, Singapore, India. The Indians have bought quite a bit.
Let's just get a quick check on Asia this morning. The markets which are flying off the shelves are the Korean markets. That's up 2.5%, 3%. Taiwan is super strong, up 2%. You've got green, 1.3% up on Hang Seng too. Shanghai's opened up in the green. But the big driver for Taiwan and Kospi are the memory makers, SK Hynix, Samsung Electronics. They've gained 3-4%. Taiwan's TSMC also in focus. This is after NVIDIA CEO Jensen Huang yesterday spoke about a $1 trillion of an AI opportunity. And what's even more incredible, that he went on to say that even at this scale, we are going to be short. So that's powering the gains in Taiwan and Kospi this morning. GIFT Nifty is suggesting an implied positive open. David Chow, Global Market Strategist, Asia Pacific at Invesco, is now joining in. David, great to have you. Thank you very much for joining in. First, about markets and economies. Oil prices still stubbornly above that $100 per barrel mark. How severe do you see the current risks from the Iran conflict, the Gulf disruptions with respect to Strait of Hormuz on the Asian economies, inflation and markets? Have you changed your assessment for this year?
Well, I'd like to say that it's impossible to predict the geopolitical outcome. But what we can do is run scenario analysis, and we look at current supply demand dynamics and also global inventories as well. So if I assume that the current Strait of Hormuz is closed, but still around half of the supply of oil out of the Middle East it still flows either through the east-west line in Saudi Arabia or Iranian oil or the G7 increase in output. Let's just say half of that oil is disrupted, and I look at global inventory levels. If the Strait of Hormuz is closed until the end of March, I think oil is likely to rise to $120 a barrel. And if it's closed until the end of April, oil is likely to rise to $150 a barrel.
Okay, and this is still assuming this $120 and $150 per barrel by March end and April end, assuming that still half of the Middle East oil production continues to flow through alternate sources.
Yes, that's right.
Considering how dependent North Asian economies are on imported oil, if we do have scenario number one, $120 per barrel on crude, and scenario number two, $150 per barrel, what happens to the growth prospects, inflation? Have you worked out the numbers?
I think near term, it will be an inflationary impact. I don't think it'll have that big of an impact on growth for the rest of Asia. Even if you look at India, when we see spikes in oil prices in the past, we haven't seen GDP estimates to be meaningfully impacted. And so I think the impact around Asia over the next few months, if the Strait of Hormuz is closed, will be on the inflationary side. We have a bunch of central banks that are meeting this week. I think it's likely that central banks that were looking to ease policies are likely to be on hold. Including India, Indonesia, Thailand, China, while they kind of wait things out.
Got that. Just a quick word, if I can. So the maximum amount of oil which goes through the strait is consumed by China. China alone is about a third. Number two is India. If these two countries can get their oil through the strait, why should oil prices go up?
Well, I don't think that just because China is the biggest importer of Middle East oil and they're able to get their oil through, that it has that significant impact on the price of Brent crude. And that's because many other Southeast Asian countries that have very low inventory levels are likely to continue to start ramping up their purchases of oils to restock their inventories. So I don't think that there's going to be that big of an impact if India and China are able to get their oil supplies through the Middle East.
Because that'll be about what? I don't know. China is about 35%, say India is about 15%, right? That's about 50% of the oil is to these two countries. I mean, yes, there are other large Asian countries which get their oil, but this is the bulk of it, right?
That's right.
Yeah.
That's right. But I think that we're going to see more demand buying as Asian countries that have low levels of inventory step up their buying for global oil inventories.
All right. Hi, David. Good to see you. When we last spoke, you were sounding relatively more optimistic on emerging markets, and India was the pick of the pack. Obviously, plenty has changed since then. But equity as an asset class could struggle this year. That said, if you had to put some money into equity, looking at the global markets, where would it be? And where does India feature now with this big spike that we've seen on Brent crude prices, which obviously India is very, very sensitive to?
Well, let me just say that whenever there's a geopolitical shock, we should take a pause and take a step back and look at historical analysis. And so every time there's been a geopolitical shock, we've seen that markets perform well 12 months later. And so while there could be a bit of near-term headwinds as the volatility picks up due to market uncertainties, I would say that markets are likely to do well 12 months from now. And that's especially the case because India's economy is getting stronger. Prior to this geopolitical incident with Iran, India's economic growth was improving. The U.S. economy was also improving. Global growth was likely to improve this year relative to last year. So I'd say that markets are still likely to outperform over the next 12 months. And I think that for now, there could be a wrench that's thrown into the EM outperformance argument that I made earlier this year. But I think a lot of it depends on how quickly this geopolitical incident can be resolved.
Thank you. David, great to chat with you this morning. Look forward to more conversations. For now, let's tell our viewers what's lined up on the show today. So coming up at 8:35, the management of Jupiter Lifeline will discuss the impact of the LPG shortages. At 9 a.m., we'll be joined by Jyoti Gupta of Nirmal Bang to discuss and focus on the cement sector. 9:20, Anand Shah of ICICI Pru AMC will be our market master for the day. We'll talk all things market. 9:35, we'll be chatting with Morgan Stanley's Jonathan Garner on the geopolitical risks and markets. Following that, the management of JK Cement will join in to discuss the impact of the war in West Asia, demand trends. And towards the end of the show, in our special Indianomics, Lata discusses why the IDBI divestment is flopping with former RBI DG SS Mundra, former Bain senior partner Harsh Vardhan, and founder of Neostrat Advisors, Abhizir Divaji.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. But we're looking at Reliance, Tata Motors, Leela Palaces. We have Sagar Cements, Oberoi Rail Team, Railtel Corp, Power Mech Projects, and RVNL. All of them will be reacting to positive news flow, while Reddington and Alkyla Means will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time to talk stocks. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. The big one is going to be Reliance Industries. Sonal, they've inked a deal, a large $3 billion deal.
Oh, it is a large deal and very important strategic move for Reliance Industries as well. To give you the news first, it's a $3 billion deal for green ammonia offtake, which they've signed with Samsung C&T Crop. The commencement will begin from second half of calendar year 2029, and it is for a period of 15 years. Now, it provides long-term visibility for Reliance Industries' gigafactory or the green or hydrogen ammonia platform. So the impact, of course, is that it is an important move. It gives demand visibility for their upcoming gigafactory. And this is the first kind of an offtake that we'll see from an Indian company. Yes, of course, the financial impact will not come before FY30, but ICICI Securities says this validates Reliance Industries' integrated green hydrogen approach and also creates anchor demand for green hydrogen, also confidence of financing the project capex. It's a huge capex that the company announced 3 years back, and it is a significant milestone because now they are starting to see buyers for green ammonia, and that is very important for the company, for the green energy vertical.
All right, that big boy does well. It'll be good for the markets as well, given its weightage on the Nifty. Thanks a lot for that, Sonal. Hopping across to Sudarshan. Sudarshan, tell us about Tata Motors.
Commercial vehicle demand has been strong for the last few months, and most of the analysts believe that commercial vehicle segment has been in the up cycle, and it's just the beginning of that 12 to 18 month cycle. But one concern that has been for the industry is the rising commodity prices. If you take a look at all commodities, whether it's aluminum, copper, steel, all these commodities have seen a rise in the prices by more than 10% in the last 2 to 3 months, and that's leading to a price increase by most companies. Same day last year, Tata Motors commercial vehicle had increased prices by 2%. Now again for FY27, that price increase would be effective 1st of April. Tata Motors commercial vehicle has increased prices by up to 1.5%, and companies saying it's to partially offset the impact of rising input costs and commodity prices. So that might help in reducing the margin impact because of increasing the commodity prices. That's the reason I'm going with green.
All right, so thanks very much for that. Well, more stocks with news flow. Vinny is here with that list. Vinny, good morning.
Good morning. First up, we have Leela Palace that's going to be in focus. We'll expect green here after they've entered into a binding agreement, and they'll be developing 71 luxury villas, ultra luxury villa resorts, and this is going to be in Kurg area. Purchase consideration 560 crores. What is the estimated revenue that one could see? The company has highlighted that they could expect revenue at a stabilized level of 165 to 175 crores with a margin profile of 50+% or similar to that Leela is seeing as of now as well. So positive here. Redington, we're expecting red here after its wholly owned subsidiary, which is in the Gulf region, said that the Gulf operations of the company are impacted because of the ongoing geopolitical tensions. Mainly they've seen increase in transit time, increase in working capital, as well as delayed payments. Customers have requested that if they could make delayed payments, so they're receiving receivables have been delayed as well. Increased freight costs, insurance costs, logistics costs is something that is impacting them. Financial impact overall is not a number that they've given for it right now, but do not forget the revenue contribution that comes in from the rest of the world regions for the company. That's Middle East, Turkey, Africa is around 48%. This was as on 9-month FY26. Lastly, Sagar Cements and Andhra Cements, both these stocks is what we'll keep an eye out on after Sagar Cement is going to be offloading around 7.2% stake in Andhra Cements today and tomorrow. This is via OFS. This is mainly to meet the minimum public shareholding. So we'll watch out for both these names as well in the trading session. The floor price for this is fixed at 52 rupees. Andhra Cements yesterday was trading at around 51, so not much of a difference from the floor price as well.
Got it. Thanks a lot for that, Vinny. Hopping across to Ria. She's got some more stocks in the news. Hey, Ria. Morning.
Well, good morning. Let's start off with Oberoi Realty first. They have backed redevelopment projects in Andheri with a free sale area of roughly 17 lakh square feet. Alkalamines will also remain in focus today. They have suspended the production of key products which require ammonia due to a shortage of ammonia as suppliers have invoked force majeure. The financial impact of this is yet to be assessed by the company, but they've also highlighted that the production of other products that do not require ammonia will continue normally. Apart from this, 3 stocks will be in focus on the back of order wins. The first one is Power Mech Projects. They have bagged an order worth roughly 710 crore rupees. This is an O&M and overhauling order from Adani Group, and the execution will be completed by March 2031. RVNL has received an order worth roughly 95 crores. This is a 36-month contract from NMDC, and RailTel has also received an order worth roughly 43 crores from NICS, and the execution period for this will be 12 months.
All right. Thanks very much, Ria, for that. Well, just a quick recap of things as we've put them out this morning. So news stocks with positive news flow are Reliance, Tata Motors, Leela Palace Hotels, Sagar Cements, Oberoi Realty, RailTel Corp, Power Mesh, and RVNL. Well, stocks with negative news flow are Reddington and Alkyl Amines.
Well, let's turn away from the equity markets a little bit. Manisha Gupta joins us to tell us what's going on in the commodity markets. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, overnight we did see some decline coming in for the crude prices. Brent fell 3%, WTI was down 5% on reports of several tankers safely navigating Strait of Hormuz. Several countries also are pursuing back-channel talks with Iran to ensure safe passage for their ships. And then apart from that, the US and Japan have said that they will release first tranche of emergency crude reserves in this week itself. It also has to do with the potential multinational naval coalition that could escort the commercial shipping via Strait of Hormuz. But as we start yet another day, there are concerns and some more attacks in various Gulf countries, and that has brought the crude prices back to around 3 to 4% of gains in the Asian markets right now. But apart from crude, there's very less that is trading in the positive because you have gold at a one-month lows. Silver continues to hold around that $80 an ounce mark. Copper has continued to decline for a third straight week. It also is pressure that we've seen come in for steel and iron ore, which were gaining in the previous week. Declines also have come in for the aluminum prices, that is off its 4-year highs as well. So apart from energy, not so much green.
Okay, all right. Thank you very much for that, Manisha. So that's commodities and focus. We'll take a break. We are back. We connect with the management of Jupiter Lifeline to discuss the impact of LPG shortage and more. We also have the our market team with us. Mayuresh Joshi is going to be talking to us about fundamentals and where markets are at in just a bit.
Welcome back. Yesterday, there was an article in the Hindu that hospital canteens in Kochi, I should correct, struggling amid the LPG crisis. It's mainly impacting the hospitals, the sterilization, pharma production, and many fear that hospitals may soon be forced to scale back or perhaps even suspend certain operations if the situation persists. Ankit Thakkar, CEO of Jupiter Lifeline Hospitals, is joining in, and we'll talk to him about the impact of the West Asia, if it's impacted supplies, the hospitals, the canteens there, the current occupancies and the RPOPs and the capex outlook. Ankit, thank you very much for joining in. Now, you're predominantly in West India. Have you faced shortages of any kind on account of LPG, which is impacting operations, maybe in your canteen, etc., or even in terms of medical supplies?
Good morning. Fortunately, so far, the hospitals in the regions that we operate have not been very adversely affected. However, we are beginning to see some signs of shortages. We do not face any disruptions as of now, as we speak.
So you said you're beginning to see some kind of shortages. Can you elaborate on what kind and at what point will it hurt?
So there have been some feelers about being conservative on the consumption, and looking at the current situation, we are just trying to be responsible around that. But as I said, as far as hospital operations are concerned and our kitchens are concerned for the patient use, fortunately, so far we have been largely insulated.
But you've got feelers about a potential LPG shortage, which could be directed even to the hospitals.
Yeah, I mean, depending on how bad the situation happens, hopefully we don't get there.
Okay, and where have you got these feelers from? I mean, has it come from the government?
Well, not directly to me. I've been hearing it from my team.
You've been here. Okay. Let's talk about the quarter then. How has the quarter been for you? Because I remember in the prior quarter, the volume growth was just about 2%. The growth was largely driven by your RPOPs, the average revenue per occupied bed. How has Q4 shaped in terms of the average revenue per occupied bed and a pickup in volumes? What's the number that we're looking at?
So typically, Q1 and Q3 are a couple of points lower in terms of occupancy as compared to Q2 and 4. Q2 being the highest because of the infection prevalence in Western India where we operate. So not too much of variation year on year. If you look at Q4, we should be pretty much in line with how we have done in the past.
Okay, got that. So what's the volume number we're looking at?
So I would not really be tracking volume numbers currently, but as I said, we are continuing to witness good growth in occupancy in Indore, where we have added new beds. So we should see a little bit of improved volume coming out of there. And similarly for Pune, where we added some beds, we should see some better utilization coming out of there. In the middle of this quarter, third week of February, we also started our new hospital in Dombivli, which is a little ahead of schedule. So in this last 6 weeks of this year, we'll also see some volumes coming out of Dombivli.
So occupancy in Q4 should be higher than what it was in Q3? Can it cross, say, 65%?
Yeah, it should be marginally higher than Q3. Okay.
What about capex? Because you all have the commission, the Dombivli facility, the 500-bed facility that happened on the 15th of February. So that capex with 425 crore, I presume, was spent. But you have plans for Pune South, Bibewadi, and the Mira Bhayandar, which comes up in the next couple of years. What's the total capex number, and any more additions that you've outlined?
So you're right. We have these two projects underway. The Pune South construction has started. We are still underground in the basement. We are guiding for calendar year 28 launch. I don't see a reason why we should miss that. The capex for that, excluding land, we had said should be in the zip code of 500 crores. Similarly, the Mira Bhayandar hospital is in planning and regulatory stage now. As soon as we receive regulatory approvals for that project, we would begin construction there as well. So besides Dombivli, these are the two projects underway. We hope to maybe add another project soon. And once we have some clarity on that, I'll be happy to share that with you.
Okay, we'll come to you on the third project. What about medical tourism? Has that been impacted for you or for the industry?
So honestly, we have very little reliance on medical tourism. We are largely local service providers. So we have been insulated from that shock.
We'll talk again soon. Thank you very much for joining us, Ankit. And thank you for being here. Mayuresh Joshi is with us. He's Director of Research at Mark Smith India. Mayuresh, good to have you with us here. Good morning. Thanks for joining us. So, you know, yesterday we got a bit of a relief rally from the lows, a sharp one. How would you treat it? With trepidation. The first one is always treated with trepidation, whether this is, you know, a false one which will get sold into eventually, etc., etc. But it's also undeniable that many, even as perhaps you can make the case for more downside at an index level, many stocks are coming into buyable zones. You know, I think 3 days back, somebody came on and said, well, stocks offering 20% earnings growth now available at 13, 14, 15 times. I was talking about something like a Mahindra and Mahindra yesterday, available at 20 times, trailing earnings now, Mayuresh. And that's a large cap, right? Near 4 lakh crore market cap company, but many others. Go on.
Morning, Prashant. No, you're absolutely right. I think two things. One, I think how long will this escalation in the Middle East linger is something that the street is really not sure about. And therefore, these intermittent bounces in the market based on certain news flows will keep on coming through. But unless there is some element of surety that the market gets in terms of news flow specifically related to this geopolitical issue, I think the markets might not make a structural move on the upside. Also, let's not forget on the technical side, as my team was indicating, it was in an oversold territory. So I think some element of a bounce back was warranted. On the other part of your question, Prashant, you're absolutely right. I think there is some trepidation in the market still in terms of the second order effects if this lingers on longer, in terms of what probably happens in terms of input costs, what happens to demand, and therefore earnings that probably play out in the first half. But if it corrects further at the main index level and the broader markets as well, I think stocks or sectors where earnings growth is expected to hold up comparative to certain sectors which are sensitive probably to input costs, specifically crude and crude derivatives, might continue doing well. Case in point, as an example, I think banks. I think the case being laid out is if there is some element of global inflation rearing its head back, imported inflation coming back, inflation in our own context heading higher, rate cuts are probably out of the window, but rate hike is probably a possibility. What happens to bond yields, etc., is something that is impacting these sector and the stocks as well. But in my opinion, I think if the headline index and the sector corrects further for some reason or the other, I think it becomes a good opportunity. I think banks like State Bank of India, the rating rankings, and if it consolidates and makes a good pace as we see it in Mark Smith India at lower levels, becomes a plausible bet within the large private names, ICICI Bank, and even the mid-cap names, Karur Vysya Bank, as an example, have delivered solid set of numbers. Auto stocks, again, I think the entire trepidation is auto parts might be more costlier and the supply chain might be longer if this lingers. That is what is creating a lot of issues related to the sector as a whole. In our own opinion, I think two-wheelers possibly a tad bit better placed as we speak. Again, I think the entire universe will probably get affected. And a few auto ancillary stocks where I think the entire play in terms of both servicing the entire ecosystem right now and the entire EV agnostic platforms that they're probably creating are steps in the right direction without creating too much of leverage. A few consumer-facing stocks probably might also do that. So some of these sectors, in our opinion, can do well, where earnings might hold up.
Hi, Mayuresh. Good morning. Good to see you. It's getting hot here in Mumbai, and in the coming year, expectations are that power demand will come back. This year, for the country on the whole, the power demand is likely to be more or less flattish because the first 9 months were soft. But for this year, it could be 5 to 6%. I was speaking to Nikhil Nigania of Bernstein yesterday on Finding Alpha, and he made a couple of important points. He said the focus on power is going to be even more now, particularly post this geopolitical headwind that we have seen. And I was looking at a couple of names that he was bullish on. NTPC, case in point. We're talking about the markets pulling back. The stock actually is flattish in the last 1 month when the markets have corrected close to around 10%. What's your view on some of these names? How would you play the power theme? There's NTPC from the large cap names. You have Coal India. You have Power Grid. Various parts in terms of transmission generation. What do you like?
Morning, Nigel. I think that entire ecosystem might do well. The expectations in terms of peak power demand is expected to be significantly higher as we head into summer. Now, specifically coming to your point, I think NTPC probably looks like a very interesting case. Rating rankings look extremely strong at markets with India. They are adding 6.5 gigawatts in terms of thermal. They're expected to add around 20 gigawatts in terms of renewables as well. The receivable days from discounts has actually come down in the last quarter to 28 days from 34 odd days. The capex is well laid out at 56 odd thousand crores. And the regulated ROEs should be relatively stable going forward as well, with the capex to capitalization ratio expected to be pretty strong and stable. Again, I think in terms of the yield that it probably gives out at 2.26, and in terms of the price to book, I think reasonably placed. So I think this is one good solid story out of the large cap names. With the mid cap names, Nigel, NLC India is something that we're keeping on our watch list and radar. Our own sense is that the lion's share in terms of lignite production as far as power is concerned. And therefore, I think with the expectations and the plan and the vision that they probably got from a 2030 perspective, both in terms of adding thermal and renewable capacities, the margins are expected to trend significantly higher. 38% as they ended FY25, but expected to be 45 as they end FY27. And the exit run rate is expected to be 50% when they probably exit FY30 as well. They're getting into the rare earth expectations as well in terms of the entire theme. And therefore, I think both from a valuation perspective and from an earnings perspective, I think these two stocks probably will be the large cap or mid cap probably look solid.
Mayuresh, request you to stay on. We need to slip into a very short break. We'll come back and focus on some volume buzzers. We'll also connect with Sudarshan Sukhani and Mitesh Thakkar for some technical trading ideas. Stay tuned.
Welcome back and hope you're having a good morning. For the time being, the GIFT Nifty is suggesting at least we'll have a positive start, but a positive close is what will be eyed. Let's get in Hormuz. He joins in as always to tell us about all the big movers in trade yesterday. And some of them, Hormuz, saw a good amount of delivery. Take it away.
Good morning, Nigel. And yes, indeed, they saw a lot of delivery in yesterday's session. Indian Oil Corporation, one of them, the oil marketing company, is not doing well in this month itself. Today, another bearish call coming in for all of them. But Indian Oil Corporation was the big underperformer among the three, fell almost 5% yesterday. And since the war began at the start of the month, it has gained only twice, has the stock. And even in yesterday's session, the volumes yesterday were the second highest volume seen in the last 5 months for Indian Oil. Close to 3.5 crore shares were traded. The 20-day average is less than 2 crore shares. 45% of those were marked for delivery. The delivery volumes in absolute numbers were the highest in a month, and close to 1.6 crore shares were marked for delivery. The 20-day average of around 93 lakh. And incidentally, just before the war began, on the 27th of February, the stock had hit a 52-week high, and it's down almost 20% from those levels. The other one that outperformed the yesterday's session was MRPL. It was the biggest single-day gain since February of 24. Volumes were the highest on record for the stock. 14.5 crore shares were traded yesterday. The 20-day average of just over a crore, and only 5% of the number of shares traded were marked for delivery. Of course, that's because of the number of shares were very high. 80 lakh shares marked for delivery. The 20-day average is around 21 lakh shares, so 4x of the 20-day average. The turnover on Monday, close to 2,900 crore, almost 80% of its free float market cap, and it was the most traded non-Nifty 50 name on the Nifty 500 in yesterday's session. And the last one, the key trigger behind yesterday's recovery on the Nifty, was HDFC Bank. The stock recovered almost 3% from the lows of the day, and it snapped a 3-day losing streak. And in the last 15 sessions, this is only the 4th instance in which the stock has gained. Volumes on Monday were the 3rd highest this year, and over 5 crore shares were traded. 20-day average of 3 crore shares. 55% of those marked for delivery, 3 crore shares for delivery, the 20-day average being around 2 crore shares. And the stock had recently fallen to a 52-week low of 812, recovering from those levels.
All right, Hormuz, thanks very much for that. Interesting numbers and interesting levels there. Mayuresh is still with us. Mayuresh, Hormuz mentioned MRPL, but there was also Chennai Petro, which went up sharply, right? I mean, there is a refinery shortage, etc., which is coming through as well. But I saw some headlines yesterday that the government may actually cap. Essentially, I mean, the government will not allow refiners to profit from this unusual situation. That is, I think, it came through in the afternoon. Didn't get too much attention. I was surprised by the very sharp moves. Any thoughts, Mayuresh, on this one?
No, so I think it's moved significantly. And I mean, the GRMs have moved significantly, what I meant to say. And therefore, I think the delta spreads in terms of the refining margins, and therefore the expectations in terms of how the numbers will play out will be significantly higher as we head into Q4. Again, Q3 numbers were phenomenal for all these companies. Again, as the news flash you're saying, Prashant, if that properly plays out, that does cap the earnings expectations for these companies in general.
Mayuresh, if I can come in there, sorry. I'm being told in real time by our colleague Sudarshan that the government came out with a clarification last night. It denied it. It was a news report, and the government denied it last night that they have no plans to curb. And that's just Sudarshan is just telling us that right now. So yeah, there's no fear of that. So given that the government has denied any such move, would you look at these companies? I mean, the standalone refiners, but even names like Reliance.
I think it will have a good number game. Again, Q4 numbers will be phenomenally better, Prashant, in that sense. And therefore, I think from a swing perspective or from a tactical perspective, it does make sense that Q4 numbers will be significantly higher. For Reliance as well, Prashant, I think the kind of feedstock that Reliance probably has, we've always seen that Reliance always produces GRMs which are $2 or $3 more than Singapore GRMs. And therefore, at this juncture, it tends us to believe that the numbers on the refining front will be better. The retail businesses are holding up on its own, specifically in terms of both Jio as well as Reliance Retail in terms of the EBIT contribution. And therefore, as we head into Q4, I think Reliance numbers should also hold up. So anybody holding Reliance should hold on. MRPL Chennai can absolutely be taken as swing or tactical plays from a Q4 perspective.
All right. Fair enough. Mayuresh, thank you for joining in. Good speaking with you. Always a pleasure. We'll take a quick commercial break here. There's news for Kalpataru projects. They've backed an order for an underground metro rail project worth about 2,500 crores. So that is an order coming through for Kalpataru projects. 5 minutes away from the pre-open session, Jyoti Gupta of Nirmal Bang will focus on the cement sector when we come back. That's in just a bit. Okay, 2 minutes away from the pre-open session. Sudarshan Sukhani is with us. He's joined by Mitesh Thakkar, who's with us as well, with trading strategies and stocks that they'd like you to pick up or sell. Gentlemen, morning. Great to have both of you here. Sudarshan, you go first. We got a rip higher yesterday. Today is weekly expiry. What's the setup looking like, and what are the trades to take?
Yeah, good morning. Well, yesterday I suggested if the market stabilizes after the first hour, 2 hours, we should buy above 23,150. Now that trade continues. If you are long, I think you should be long in this market or sell and then buy. The trade today is buy on a dip towards 23,350. So wait for a 100-point correction intraday, which could easily happen, and then go long. You know, the first signs, it's not just India, all world markets are giving the first signs that maybe at least temporarily a low is coming in place. So we really want to be on the long side of the market, keep a wide stop, give some room for breathing, buy around 23,350, and then hope for the best.
Mitesh, what would the approach be? Are you getting a sense that there is fresh conviction buying or just some selling exhaustion that crept in yesterday's trade?
Yeah. Good morning. So, I've been saying that it's a combination of two things. Basically, one, we are extremely oversold on the short-term charts. Two, we were at very important pivot supports on both the Bank Nifty and the Nifty and many of the heavyweight stocks. So I think a pullback is what I was looking at. It can be a slightly stronger pullback. We'll figure that out in the next few days. But for the timing, I think, as Sudarshan also highlighted, chances of a temporary low being made are quite high, given the fact that we are at historical oversold levels on indicator basis. And therefore, I think next few days could be spent with volatility, but with mild upward bias that basically the pullback will play out and it will be slightly volatile. So in the short term, I think, people, and this is what I said yesterday also before the market opened, that people who have short positions on the indices, good time to take at least 60-65% off the table, book profits and see how the pullback pans out.
Okay, let's talk stocks then. Perhaps markets have made just an immediate near-term bottom. So Mitesh, is the approach buy stocks now? Are you going more long?
For the timing, I have mix of buys and sells. A couple of days back, it was only on the sell side. Today, I have 2 buys and 2 sells. On the buying side is CG Power. It's done well in this falling market and now given a pullback to its 20-day, 30-day averages. So buy here with the stop at 687 for a target of 720. Could go trying to find a base around this 170 odd zone. So buy with a stop at 168.5. Look for targets of 179. On the selling side is Oberoi Realty. It broke a very critical support of 1450. So if you get it around 1425, 1430 in the early morning trades, 1452 being a stop loss, shots can be taken for targets of around 1370. And sell on Jindal Steel around 1145, 1150 zones can be sold with a stop at 1170 for targets of around 11.
All right. Those are some trading ideas. Sudarshan, what would you go with?
Well, I have mainly a long list. Buying is more. ICICI Bank is a buy with a stop under 1248. Tata Steel is a buying opportunity, so I have 2 large caps with a stop under 183. Worry Engineering is a buy, and Worry Energy is a buy with a stop under 2735. My only short is Godrej Properties with a stop over 1585.
Okay, all right. Sudarshan and Mitesh, thanks very much, both of you, for that. The pre-open, by the way, is kicked off. The rupee is opened slightly stronger. Nifty is up 100. The Sensex is up about 400, 450 odd points at this stage. Jyoti Gupta, Senior Research Analyst at Nirmal Bang Institutional Equities. Jyoti, good morning. Great to have you with us here. Thanks for joining in. Nigel will come in on cement in just a bit. I just wanted a quick word on defense, if I can ask you, Jyoti. You have coverage, right? Defense?
Yes, I do.
Yeah. I mean, it's the one defense, offense. That's the whole gamut of things right now, right, in the world. Anywhere you look, that's basically all these conflicts, etc., driving at all-time high the level of conflicts. So just your thoughts on the space, and thematically, I'm assuming that it's pretty easy to push defense stocks to clients. Maybe valuations are a pushback, but just your thoughts, Jyoti.
So defense, of course, even for the next 5 years looks very lucrative to me, but of course the valuations are rich. But I think the sector kicked in mainly because of high order book, but now the execution is what is going to, the industry will observe massive execution over the next 3-4 years. I think that's very positive. So overall, and the order flows is not a worry at all in this sector at all. So the space definitely looks very, very good.
Which is the topic? From companies that you've spoken with and you're in touch with, any feedback of any disruptions in production because of all these gas issues, etc.?
No, not till now. What I have understood is possibly we'll see major, deliveries in the month of March. So, typically where we saw was certifications, nothing to do with gas disruptions and all. So the sector is quite good, well placed.
And who is best placed on the defense pack?
My top picks are HAL, BEML. Data Patterns, which has already run up quite a bit, but still looks very good, and Solar Industries. Otherwise, I think BL is a long-term compounder.
Okay, all right. So let's keep defense at the side then, and let's focus on the cement sector. Jyoti, what's the feedback you've received on ground? Is there any dependence on gas, first of all? Have you, in your interactions with the companies, have you heard of any kind of production scale back? A broad feedback that you've got since the outbreak of this war?
Good morning, Nigel, and thank you for having me on the show. So basically, the sector is far more exposed to petcoke and coal prices, which accounts for almost 85 to 90%. So the gas shocks basically impact the fertilizer and tiles industry. So this industry will have minimal impact because it's less than 1 to 2% of the entire fuel is gas. So roughly no.
Okay, so let's talk about that then. Petcoke prices as well as coal prices, they have scaled up. I think the negative impact, though, will be seen only in the second half of the first quarter or maybe in the second quarter, because for the time being, there'll be some inventory that they're sitting on. Could you tell us what is the feedback in terms of the raw material basket? How much is it up? And who gets hit the hardest? You know, if you're looking geographically, some of the players will be importing a higher percentage or using a higher percentage of a particular product. So who could get negatively impacted?
See, petcoke has increased by 17%, so has your imported coal. There has been some relief on the domestic coal prices, but that would not offset the increase in prices. I think the hardest hit, if you look at the mines, placement of mines, it is actually east. So eastern regions will be well off in terms of the coal prices, but hardest hit would be the plants in the north side and the south, and to some extent the west. Depending if you're grinding units, it's not a trouble. It's basically the integrated units which are in the north, south, and some in the west would be more hard hit. But in fact, the impact of if I look at the overall industry, how it looks to how I see it, that first half demand we were close to around 8.5%. Say for 9 months we did almost like 9.5%. But this time volume, first 2 months, Jan and for Feb, we were close to almost like double digit. High single digit to double digit, but March is going to be slightly lukewarm, mainly because of the two things. One is your non-trade would be impacted because the shift in government spending could be temporary from infrastructure towards from infrastructure towards subsidy amid fiscal pressures arising from Iran-Israel conflict. This may have a spillover in your first quarter as well of FY27. So we expected full year demand to be high of double digit, but I think we closed the year to somewhere around 8 to 9%. In terms of cost, in fact, realizations also, while we've seen increase in prices in the non-trade and trade prices, and they have stayed as well, but because of the lack of demand in the non-trade side, I think the increase in trade prices, despite the unavailability of bags, will offset the improvement in realizations per ton as well for the overall industry. So we had expected around 5 to 6% improvement in prices on a year-year basis, but now we're going to taper it to some tone down to maybe 2 to 3% in the realization per ton. Overall fuel costs, we believe, will have an impact of 6 to 7%, while the fixed cost absorption may be higher, but that will not be able to offset it. So, and we earlier estimated almost like a 20-25% improvement in beta per ton on a YOY basis by FY26, but I think we'll see somewhere around maybe 12 to 15% improvement.
Okay, all right. Jyoti, actually, the cement space that we track very closely would have been bracing for a very, very good quarter. Unfortunately, this war broke out and, things have got a little bit muddled actually in March itself. Otherwise, Jan and February were good. Price increases, demand was strong as well. And unfortunately, this has really spoiled the mood. And if you wanted to play something that was not related to the trade agreement, then it was cement. But that said, I think you are quite bullish on a couple of stocks. So what is your top two picks, if you could help us out with the target prices?
See, in the current scenario, if I see, I would rather have my core allocation on large caps, be more tactical on the mid caps, and avoid any weak regional players with high debt. So in that scenario, I would actually look at, be more positive on Ambuja, then Ultratech, JK Cement, and Shree, but the valuations are quite rich for them. So yeah, my top picks would still be Ambuja. I'm looking at something like 702 rupee. RTP is almost around 700, and for Ultratech we're looking at something like a 12,526 is our TP for 256 is our TP for Ultratech. Ramco does look good, but again, the petcoke prices, we're not sure how much would be the impact, but I'm still very positive on Ramco Cements. And Novoco, because of the best, geographical placement in the east, and then again, north plants could be impacted by petcoke. But overall, I think these four companies do look quite good to me at this point of time.
Jyoti, always a pleasure speaking to you. And what I appreciate is always you have your ear to the ground. You're very, very close to the ground reality. So it's a pleasure to have you on the show. Thanks for giving us a bit of a preview into the defense companies as well as cement. We'll touch base soon.
Thank you so much.
All right, let's welcome Sudarshan Sukhani back on the show for the 9:10 call. Sudarshan, tell us, what's it?
It's Tata Steel. Buy Tata Steel with a stop under 183.
Interesting one. Domestic prices at a bit of a discount in comparison to imported steel as well. So let's see how that one goes. It's pulled back from the top, but Sudarshan is positive on that one. Mitesh, what about you?
I'll go with a sell on overall reality around 1425, 1430 zones.
All right, thank you very much for that. Let's talk about oil marketing companies because today Kotak Institutional Equities has sharply cut the target price on all three, IOC, BPCL and HPCL. So now take it away.
This is the second target price cut that is coming. Yesterday we saw one, and today Kotak Institutional Equities have increased their assumption on oil prices to $85 per barrel for FY27, 75 for FY28. They say the Hormuz disruption has skewed this on the upside. With limited retail pricing freedom, the oil marketing companies, they will not be able to hike prices, and that is something that will continue to hit their marketing margins. LPG shortages, that has also created a negative sentiment. However, for household, remember, it continues to be at the levels which are required. OMCs benefited from the elevated marketing margins in the recent years, but that is expected to continue, and that's the reason there's a target price cut. However, they expect LPG capex to continue and production to increase from here on. They say that IOC's target price is cut to 100, for BPCL it's cut to 240, and HPCL it's cut to 235. That is where the sharpest cut has come, because remember, HPCL has the highest exposure to the marketing segment. Now, if you look at some of the delivery stats for BPCL, the total traded turnover yesterday was around 570 crore rupees, but only 55% was marked for delivery. The stock is down around 19% in last 1 month. For HPCL, the total traded turnover was around 518 crore rupees. Again, only 53% marked for delivery. The stock is down 22% in last 1 month. For IOCL, the turnover was 533 crore rupees, but 45% only marked for delivery, and the stock is down around 16% in last 1 month. So a lot of positions taken on the downside for these stocks, so keep an eye out on them.
Thank you very much for that. Let's talk about EMS companies. Syrma, Amber, they've all fallen 20% plus from the recent 52-week highs. Upasana joins in with what JP Morgan advises investors to do.
Well, JP Morgan has put the focus light on EMS sector, and it has gone ahead and upgraded 3 stocks in the sector. Cyan DLM, it has upgraded to overweight from neutral with a target price of 400. Amber Enterprises again upgraded to overweight from neutral with a target price of 9,000. And it has identified Syrma SGS as the top pick within the sector with an overweight rating and the target price of 1,050. Now, the brokerage says that the EMS stock underperformance has led to investors question whether the sector story is over or not. But overall, the brokerage rejects this thesis and believes that it sees every stock, barring Dixon, delivering more than 20% of the revenue growth over FY26 to FY28. Further, it also sees the sector upping its value addition, evolving from finished products assembly to component and PCB manufacturing. In terms of valuation, it believes that the valuations have eased out after the underperformance, but it remains at risk at levels of 32 to 60 times FY27 estimates for the stocks that have missed expectations. And overall, it has also placed emphasis on 2 stocks, that is Syrma and Amber, as it believes that it is most likely to beat the street expectations going forward. So all in all, this is what the JP Morgan thesis is on EMS sector.
Okay, all right. Let's just quickly recap the list of stocks that we've covered since the morning today. And they'll come up on your screen. Reliance is up about 0.25%. Tata Motors is up about 1.6%. Leela Palace Hotels is absolutely flat. Sagar Cements, Oberoi Realty, Railtel Corp, etc. are up on your screen, 1% each. Power Mech is up 5%. RVNL is up about 1.25%. Reddington, Alkyl Amines are some of the other names which are flattish to slightly lower, sideways, etc. So 84 points, 23,500 is where the Nifty is at. 75,826 is where the Sensex is at this point in time. The first rates will start to come up. We'll look at them and then we will move forward. What do we have? 23,493 on the Nifty. So, 60 points on the Nifty. And you got the Nifty Bank, which is up about 0.25%, 54,550. So it's a higher start. It's a decent start. Let's see if this can become bigger or stays here through the course of the day. Okay, coming off a little bit at 0.14, 0.15%, 23,430, 23,440 or so is where we're at. I mean, the market breadth is positive, over 2:1 in favor of advances to declines. And that's the heat map. It's a more normal kind of a day with lots of stuff up, lots of stuff down, at least on the Nifty. Tata Steel, BEL, Max Health, etc. are starting in the green. Infosys, HCL Tech, Wipro are starting in the red at this point in time. Markets now flatlining, just about 7 points left on the index. Rima.
Well, indeed, markets are attempting a comeback, but there is still caution in the air. Remember, Brent crude prices have crossed $103 per barrel in today's trading session, which compares with a little more than $100 per barrel that it was in yesterday's trade. The Nifty and the Sensex, after opening up higher, have now dipped into the red. Sensex down 35 points, Nifty lower by 15 points. Yesterday, we gained 250 points on the Nifty. This morning, unable to build on that upward momentum, at least in early trade. So let's start with the loser, since the index is flashing red. It's I think the biggest loser today are the IT names. Infosys, HCL Tech, Wipro, they're down nearly 1%. Asia's in the green, but the big gainers there are the ones related to AI, the NVIDIA beneficiaries like SK Hynix, TSMC. So India doesn't really have that play, and you can see the softness in IT names. Top three Nifty losers are the IT stocks. Then you've got Adani Ports under pressure, Eicher Motors on the back foot, HUL, Titan, consumption names are weak. L&T is under pressure, that's down close to about 0.5%. On the way up, metals are doing well. You've got Tata Steel with a gain of about 0.75 of a percentage point. BEL, defense continues to see buying. Asian Paints in focus. Many of the paint companies had announced price hikes following the rise in crude prices, so that's supporting the strength in Asian Paints. ICICI Bank, in fact, banks too are in the red. Yesterday, banks made a comeback. There was buying visible in many of these large cap banks. But today, there is green when it comes only to an ICICI Bank. HDFC Bank currently is in the red, and that's dragging its feet with a cut of nearly 0.5%. Reliance Industries should come up for you on your screen because they made that big announcement, a $3 billion deal with Samsung C&T for a 15-year supply of green ammonia. Reliance Industries is on the flatter side. All in all, the Nifty is just a shade below 23,400, unable to add to yesterday's gains.
Well, this 23,500 has become an important resistance mark. Even today's gap up, the high of the day is around 23,493. Yesterday's high was around 23,500 or thereabouts. So a higher high is something that you're hoping for. But that's not happened in today's trading session. So that's something that we'll track. Even on the Nifty Bank, yesterday's high was at around 54,664. So you'll want that number to get breached. Individual stocks, that we're looking at. Kalpataru, that stock, in fact, is up close to around 8%. There was an auto bin out there, so that one is bucking the trend. Bajaj Electrical, fundamental positive news coming in there. That stock is well up close to around 5% as we speak. So good move is what we're seeing on that name. ITI, yesterday the stock moved on high volumes. Today as well, it's seeing some follow through. So good move on that particular name. Big move is what we're seeing out there, and some bit of a follow up. Jindal saw as well up close to 100%. On the flip side, MRPL that spiked up yesterday big time. That's come in for profit taking. In the final hour, you saw Ola Electric that spiked up. That as well has come in for profit taking. And Redington, just a month or so ago, the stock was close to 300 rupees. That's corrected to around 220 rupees. So a flattish start. The good news is number of stocks advancing, at least equaling the number of stocks declining just for now.
All right. I think we've got, things flattish now. By the way, silver Bs once again, right? I mean, I can see spot a lot of these silver ETFs which are up 3%, 4%. International silver prices are back above $80. So that is something. I mean, silver has been a huge area of trading activity all through this year, all through this. This 2026. Well, I think just a few other names. GMDC is up 3%. It's the number 3 largest volume-led gainer. Amber is up about 2%. Bajal Products, I think it was coming up 2.5% on this one, 172. It's coming up with very large volumes. So yeah, I mean, there is some stuff. GE Shipping is coming up with about a 3% pop, but volumes volumes are low. I mean, the volumes are there for about 10 stocks. I'm talking about NSE 500, and then volumes taper off completely, at least right now. Coforge is coming up with a 3.5% cut, 1,045 on Coforge. It's got volumes on it on the downside. So keep an eye on that. Hindustan Copper is down about 2%. So NTPC Green is down about 2%. Again, I mean, 10 stocks have got volumes on the downside, and then things taper off completely. So 23,378 or so on the Nifty. Anand Shah is with us, CIO of PMS and AI at ICICI Prudential AMC. Anand, good to have you with us here. Thanks for joining us. For viewers who are watching, Anand, what's their advice really? Those who have been able to create some cash at higher levels, is this time to go back in, deploy in what way, shape or form? Like an ETF or large caps, a small cap fund? I mean, what would you recommend really?
Hey, hi, good morning, Prashant, and thanks for having me. So, yeah, I mean, we all along maintain that asset allocation is way to go, and one needs to be keeping an eye on asset allocation. As far as the situation that we are in today, I believe we don't have yet the end game here, and to that extent, it would be too premature to say that we have seen a bottom of a market, and to that extent, one should deploy all the cash that you have or all the cash that you might have raised to redeploy in the market. But I think we have some comfort that markets have become more reasonably priced through the last year. So it's not only this last 2 months, but otherwise also India has been one of a large underperformer through the calendar year last year. And to that extent, the relative valuations of India relative to the emerging markets in the world have become reasonable. And to that extent, I see it's a time to keep on adding a little bit on the equity at this point of time.
In what way will you do it? I mean, what's the instrument to do it?
No, I think, look, it's much more complicated than where we were a few years back, especially at least 18 months back. Very clearly, some things remain constant, which is India's demographics and the very
Anand,
stable macro.
Anand, what I mean is, should you go and buy in a systematic way? No one knows. No one rings the bell at the bottom or the top. With that realization in mind, how would you sort of slowly start to go back in? And because you can't perfectly time the bottom, it may be 1,000 points lower from here, it may be 500 points, who knows, right? But you got to start to do sensible things. But what's the way to do it? Is it through exposure to through an ETF? Is it through a diversified equity fund? I mean, a single stock? That's my question.
I think now the products are time tested. ETFs give you passive exposure, mutual funds give you active exposure. You get an advantage of having a fund manager doing stock picking to you in mutual funds. So either routes, or a combination of a passive and active. But what I was trying to say that the markets have become far more complicated to go directly into equity. And that's why I'm saying a professional use or a passive fund is a far better choice for an investor at this point of time than doing an actual bottom fishing on individual stocks.
Equity diversified or a small cap? I mean, an experienced small cap. You'd go with an experienced small cap fund manager. Given the damage we've seen, that's my next level question, Anand.
Indeed, I think the small caps again, like Indian equity markets, have underperformed significantly, and valuations is not that big a challenge as it was maybe in September 2024. But that again, one has to understand what is changing. While some things are constant, a lot of things have changed, and one of them is inflation. The outlook on inflation. And this current energy crisis only complicates it. But even before we reach this current energy crisis, we had tariffs, I think, and in a way, we are moving more toward the globalized world to deglobalize more local manufacturing. So it has implications on inflation as it is. Interest rates were expected to inch up. Now there's additional burden of a higher energy prices across the value chain of gas, oil, coal, and everything. That complicates the matter further. We need to see how long this stays and whether it has a permanent impact on the inflation outlook, because that has then implications on the stocks, which stocks would do well, which stocks would underperform, and which would have been very different 18 months back.
So the mid-teens earnings growth expectation, Anand, for this year, is that at risk? And has your team told you which sectors, themes, where we could see cuts in earnings on account of the conflict, higher inflation? They may not be able to pass on the entire burden.
Indeed. So look, while India or at a NSE 500 level, we might have still a double-digit earnings growth rate, but the contributors to those earnings would actually shift. What are the higher commodity prices, higher inflation means that the asset-heavy businesses, the commodity producers versus commodity consumers. So commodity consumers can suffer, but the commodity producers, be it oil producing, coal producing, even metals manufacturer, those are the businesses which will actually might have a certain more than expected jump on the earnings, while to counter that, there would be the commodity consumers like autos and others might have some bit of lower profits or maybe a degrowth in profits because of this combination. So I think from the investments perspective, I think few things have changed. I think from our perspective, preference for value over growth, preference for profits today versus profits 5 years out, preference for more asset-heavy business or asset-light business is something which we have been continuously monitoring. And while we are doing stock picking and individual stocks matter more than sectors, but we are cognizant that a higher inflation means a segment of the market will outperform the other segment of the market, which would have been completely opposite 18 months back.
IT down now 25% from the start of the year, Anand. Do you think the potential derating is done or there is more to go? I'm not talking about numbers. Usually valuations get adjusted well before we see it in the actual numbers. But just purely in terms of the valuation right now, do you think there could be more pain?
Sorry, I missed the initial part. Is it the
IT, the Nifty.
So yeah, again, immediate threat to the EPS is small compared to what the stock price has fallen. What actually people are still trying to figure out, and that includes us, that what would be its implications on the terminal growth rate, and that means what would be implications for a PE multiples for this sector. Do we see that the AI sustainably disrupts the total pricing power and it leads to a significant deflation to the pricing of the IT services? Then obviously things have changed. So again, we remain cautious on the sector and we continue to monitor it very closely. Again, I am repeating, they're high quality businesses, the cash generation is very strong, and the near-term risk to the earnings is much lower than what the stock price reflects.
Hi, Anand. Good to see you. And Anand, there is some kind of nervousness that's coming about from the mature retail audience because they haven't seen a big correction. In the last few years, it's been pretty okay. Buy the dip and you make some money. So in terms of top-ups, in terms of putting incremental money to equities, someone had, say, 100 rupees or thereabouts. How much should they start dipping in post this recent correction? And given the fact that we're a couple of weeks into the war already.
No, again, look, if you have first and foremost, very important that
a long-term investor
in any environment as it is, you should have a long-term horizon. And more so importantly, while our outlook on the Indian economy and the markets might be again normalized, say end of June and July, we might not be discussing these risks because Strait of Hormuz would have somewhere settled and the flow of energy would have moved, maybe at a higher elevated price, but it will be still normalized. And to that extent, we'll go back to stock picking. So what we are telling our investors and our advisors that, look, it's a time, if you have a room to increase allocation to equity, you should do it over a 2-3 month period, because at some point of time, either the energy prices go up significantly and that leads to a demand destruction in energy, or alternative energy supplies took over, or basically there is some bit of thaw and there is a 20% of crude that moves through Strait of Hormuz starts moving, maybe albeit at a lower capacity, but it starts moving and things go back to normal.
Anand, that long-term thing, right, is that you should buy for the long term, and you should, I guess. But you would completely, I'm assuming you would agree that the pace of disruption also feels like it's at all-time high, right? At least perceptions of disruption or actual disruption, we don't know, but it looks like everything is getting, we don't know the terminal. It's tough to kind of put a terminal value to anything at this point.
Very interesting that you raised this point.
Yeah, let me, and I'll ask you to come in. But my point was, and tie this to the fact that what you said in the beginning, right? Because it's so volatile, better to give money to a professional fund manager, right? And they'll have to sort of go in, go out, and long term, short term. And so it's, but then it's also an environment where the skill level of the fund manager also matters a lot more, right? Compared to 10 years back. Not that it didn't matter, it always mattered. But I'm just saying that if the first part is true, the second part is also true in that sense, right? So makes a lot of difference who you give and where you invest now.
No, indeed, I think good you raised this point. But again, as much we all sort of discussing AI and its implications on various industries, it's good to remind ourselves that it's not the first time that there is some innovation, some new technologies coming through and which is disrupting certain businesses. It happened in the Industrial Revolution, it happened in the Digital Revolution. What it leads to, it obviously leads to a certain industries taking a much larger knock because they get disrupted. And invariably, these are the businesses which are high ROE, high profit-making businesses, which in turn gets disrupted. But it also leads to an evolution or an emergence of new businesses. Just case in point, as the 4G sort of got fairly penetrated in this country, we had emergence of quick commerce businesses and so many new age businesses which are now recently getting listed. They would not have been possible. They would not have been there in the absence of that 4G technology. So every technology evolution will also lead to emergence of new businesses. At the same time, certain old age businesses which might get disrupted and might actually become a low growth or a no growth businesses as we go forward.
Yeah, no, that's absolutely true. But and eventually maybe it'll lead to abundance and everyone will be better off. But you got to get from point A to point B, right? And that's the problem. And that is 5 years, 10 years, who knows? And you got to be okay, all right, to come out all right on the other side. And
absolutely.
Yeah.
Absolutely. And as Nigel said, we haven't seen very sharp and long corrections in almost last 15 odd years. And to that extent, one should not forget, but we can actually have a low growth or a low earnings growth rate. Luckily for India, we have seen that between almost 2010 and 2020, we had abysmally low earnings growth rate while the economy was still doing okay. And we sort of survived that. The profitability was shade below 2% for almost 5 years between 2015 and 2020. So yeah, I mean, there's no doubt in my mind that a certain change in the environment can lead to a very low earnings growth rate. And that's why we, beginning of the year, stated that from here on it will be more stock picking. We'll need to stress test every company to the emerging macro risks and even macro opportunities for that matter, and see which of your companies are adapting to the changes, be it the new challenge being the higher energy prices to the AI challenges that we have.
Okay, all right, Anand, we'll leave it there. And thank you very much for joining us. It's a pleasure having you here on CNBC TV 18. Well, I think what we're going to do is just look at the market, which is down 8 points. 23,400 is where we're at. Which means, let me just take a look at what we've done so far, right? I mean, I think, so we started, the market went to about almost 300. Then there was a very sharp sell-off and we got to about 22,980. A very sharp, sorry, beg your pardon, I'm looking at yesterday's session. Okay, we basically got to start higher, right? 23,500 was the high today, almost 23,500. and we've given that up, but we're off the lows as well. The low for the day has been made at about 23,360. So about 30 points off the day's low. So yeah, I mean, contained for now. Yesterday, of course, was much bigger, much wilder swings in that sense. Well, Tata Power is in focus. Vivek is here to tell us why. Vivek, take it away.
Well, that's right. This is a verdict that could have an impact, especially as far as consumers are concerned. You may now be able to choose, who will be your power supplier. Now, what's actually transpired is that there has been a verdict that has been declared at APTEL, which is the Appellate Tribunal for Electricity. That APTEL has gone ahead and dismissed BEST, which is Brihan Mumbai Electric Supply and Transport Undertakings appeal against a past Maharashtra Electricity Regulatory Commission verdict as far as parallel licensing is concerned. APTEL has gone ahead and ruled in favor of Tata Power for Tata Power to go ahead and do a phased parallel rollout as far as distribution network in the state of Maharashtra is concerned. Now, what is the background for this particular case? Remember, multiple companies had applied for parallel licenses for various areas across Maharashtra in FY23 as well as FY25, and post a 2-year period, the commission, which is MERC, had gone ahead and accepted as well as admitted applicants in June 25 that qualified for a grant of parallel licenses. Now, BST had gone ahead and appeal against the MERC decision, saying that they had undertaken significant capex and they do not want competition in areas where there was existing infrastructure on which they had done the capex. Now, JM Financial today has written on this particular development. They say that this particular move has implications on electricity amendment bill's proposal for carrier as well as content separation. They're saying that the likely passage of the bill during Parliament's monsoon session opens up huge opportunities as far as the distribution space in India is concerned. And they say that the likely beneficiaries include Tata Power, Adani Energy Solutions, CESC, as well as Torrent Power.
Thank you very much for that. Jonathan Garner, Chief Asia Emerging Equity Strategist at Morgan Stanley, is now joining in. Thank you very much for joining in. This is Reema here. Now, you downgraded India to an equal weight very recently. This happened in the early part of March. The question is, why now? India has already gone through 1.5 years of a time correction, price correction, and a very steep underperformance versus the rest of the emerging markets, Asian peers. So why now? Question number one. And two, with now an equal weight, what should we expect from India, say, in the next 12 to 18 months? No returns or very muted returns?
Yeah, so we made a number of changes to our recommendations about 10 days ago, and it's really all to do with the framework that we're in right now in relation to oil and gas supply. It is unfortunate for India because in January, the manufacturing and services PMIs moved up. And we obviously have had significant policy easing in India, and we had been cautiously optimistic about the business cycle turning and running a small overweight. But unfortunately, India is one of the countries in our coverage that has the most sensitivity to oil and gas imports within GDP. It's actually the third highest after Thailand and Korea. And so the prospects for the economy are dimming in this environment. It's also the case that India has relatively low reserves, strategic reserves of key commodities. They're significantly higher in the case of Japan and China. In terms of the second part of your question, we're emphasizing very wide bear to bull outcomes here. And in fact, this predates what's going on in the Gulf. We'd felt that geopolitical risk was high going into this year, and AI disruption was also high as a theme. And so I wouldn't want to put any firm estimates on likely returns for markets at this point. It's really a case of scenario analysis and very wide ranges on potential outcomes.
Jonathan, morning. Prashant here. So would you want to give us those, those ranges on both sides? I mean, you said they're very wide.
But broadly for Asia Pacific, we are in the world where if we do sustain interruptions to product flowing through the Straits, and you can proxy that through the Brent oil price going to $120 to $130, but obviously some regional benchmarks are well above that, and there's quantity issues as well as price issues. In that world, we would see around 15 to 20% further downside. Broadly, Asia has declined around Asian equities around 8% so far. to return back to base cases, were the oil price to fall back to $60 to $70 a barrel and product flows to resume quite quickly, you would maybe have something like 10% upside. So it's actually somewhat adverse from a risk-adjusted perspective.
Okay.
And I think some investors sort of view this as similar to last April, when there was a very rapid V-shaped recovery in markets, but that was caused by a significant and rapid de-escalation in trade tensions between the US and China in particular. And that's not what we appear to be looking at currently.
Jonathan, just to, so you're saying that MSCI Asia Pacific ex-Japan, that's the index we're talking about, has got another 15% downside if the disruption persists?
Broad MSCI Asia, including Japan, is down around 8%, and we would have 15 to 20% downside in the adverse scenario where you'd be heading to a recessionary outcome across Asia. In the adverse scenario, that's not yet the case. We're trading obviously around $100 on Brent, which is our intermediate scenario currently.
Okay, and this is and what would it take for a recessionary kind of environment? Over 100 for an extended period of time?
No, $120 to $130, and the associated interruption of product flows. It's quantities that matter, not just on oil, but on gas, and then the downstream effect of that on industrial production throughout Asia, production of things like fertilizers, for example, which are very important for India. It's that adverse scenario that would cause a more significant adjustment in equities.
One is, of course, we're going to ask you market outcomes and what you think of markets and what looks good or bad, but you know, what is Morgan Stanley's sort of team, say, in Washington telling you with regards to the war itself? What's the base case? How long will this go on, and what are the likely, what's the likely shape of this over the coming weeks and months?
I can't comment on that question. I'm not a military analyst or strategist. I'm an equity strategist.
Okay, but okay, fair enough. So there's no base case in that sense. I mean, I spoke with somebody at Fitch who said yesterday on the sovereign side, they said maybe a month is what they think this kind of goes on for. So I thought maybe internally there is a base case on this one.
Our framing of this is in relation for Asian equities and economies to the oil price. So $60 to $70 would be the positive scenario, which will only happen if there's a relatively rapid resumption of flows through the Straits. That's the positive scenario. The intermediate scenario where we are right now is $90 to $100 on Brent, and the adverse scenario is $120 to $130. So we frame it in terms of the Brent price for oil because that's relatively easily recognizable to clients, but there's all sorts of complexities around downstream effects on the economies, particularly in Asia, from the general environment that we're now in. And again, at a high level, Asia is far more negatively impacted across the board than Europe or the US, which is relatively resilient. So in the intermediate scenario and the adverse scenario, the US outperforms in equities. We've been very clear on that with clients.
I mean, I think US produces about 20 million barrels of oil, consumes 20 million barrels of oil a day. Europe, of course, is dependent, and Asia perhaps a lot more, China, India, etc. Just a quick word on India, you said. I mean, India's been sideways for 2 years, is down from the highs and has underperformed generally. Jonathan, is that some buffer if the worst case plays out?
No, it's not. In terms of valuations, India is still trading at a valuation premium to the rest of Asia. And as I mentioned earlier, there are 3 markets that have a large oil and gas import dependencies to GDP: Thailand, Korea, and India. The fact that the market has underperformed is not really relevant for the situation we find ourselves in now.
So currently the base case is that Brent crude is at $90 to $100 per barrel. That's the intermediate scenario. If it were to go to the adverse scenario where Brent crude prices surge to $120, $130, is there a case for a further downgrade on India given its sensitivity?
I couldn't talk about that in a live TV interview.
I thought you were working on various scenarios.
Yeah, obviously, we downgraded India along with other changes that we made to our markets at the first moment of what's now going on in the Gulf, and we'll continually review the situation. What I would emphasize is that it's really important not to anchor too much on base cases and to respect the wide degree of uncertainty that exists on this topic. But there are other topics as well, like AI disruption, for example, that have very profound impacts on on Asia. One of the reasons that the Indian market has struggled is the outperformance of upstream semiconductor exposed markets in Asia, like Korea and Taiwan. And for the time being, the semiconductor plants, continue to function broadly as normal.
Jensen Huang said yesterday that the AI demand is exploding and he sees a $1 trillion opportunity. So at least as of now, Jonathan, no signs of peaking of the AI cycle. So Korea, Taiwan will continue to do well and attract capital from the foreign flows, because the hope was that perhaps if the AI cycle peaks out, then money will be redirected. India is sort of a hedge, a counter to the AI upcycle.
Yes, indeed. I mean, we're actually equal weight on Korea and Taiwan as well, because the valuation re-rating of some of the stocks has been dramatic. Obviously, it is not unknown that the semiconductor industry is doing well. But for the time being, whenever our team in New York comes back and looks at this in relation to AI CapEx, they keep on pushing up the numbers and pushing out the period before which CapEx might actually start to move back down again, may peak and move back down again. That's now probably a 2028 story, if that. So it's certainly part of the issue that the Indian market has faced, that you have this potential disruption downstream from some of the software services firms that exist in India, whilst the upstream area of semiconductors in Korea, Taiwan, and also Japan is doing very well.
So what are you overweight on right now and underweight on?
We have small overweights on Brazil, Japan, and Singapore.
Okay. Just to take that point on IT services in India, you think what's the thinking, Jonathan? Is there, because the debate is still on, how much disrupted, whether there's an opportunity, and how far out will that materialize? In the interim, will there be a fair bit of pain? Just your thoughts?
Well, we've been cautious on this sector for some considerable time in our regional allocations. And again, I know that it's underperformed within the market, as have some of the software and services names globally. Again, I think there's a very wide range of potential outcomes here for this sector. For now, business seems to be sort of busy. There's a lot of AI implementation projects that are underway, but obviously equity markets discount the future, and the sum of those net present values is much more uncertain than it was before.
Jonathan, I'm paraphrasing you, but correct me if I'm wrong. What you're saying is, say, if this war ends tomorrow, some of the themes which worked before this war started, I mean, we basically go back to that same kind of environment, those same markets, those same trades, those same themes. Is that correct?
Yeah, so at Morgan Stanley, we have a number of core global themes. So one of them, for example, is multipolar world, which includes geopolitical risk, but also there are sectors that flow from that, like defense spending and capital goods and general industrial spending. Then there's AI and tech disruption and CapEx, which benefits not just semiconductors, but some of the upstream energy names, particularly in the United States itself, where the CapEx is significant. We do have Asia reform, things like career value up, Japanese corporate governance to some extent, China SOE reform. And then we have sort of longevity, which is a fascinating theme, very playable in parts of the Asian equity market. So these are all core themes, which we've organized our thinking about for several years now.
One theme we've heard from many over the last few years is hard assets, right? And I think, I think this the shortage of oil has kind of put the focus once again on that theme. Hard assets, not just oil, but maybe a lot of other stuff, the metals, etc. But even lesser talked about things. I mean, helium, for example, is gotten discussed because of its uses in so many areas, including chips, semiconductors, etc. Is that one of the big global themes which continue to play out well, Jonathan? Hard assets?
So that's sort of linked. That's linked between sort of multipolar world and AI tech capex sort of / disruption. So again, if you think about copper, for example, that we're structurally bullish on, that's very important in data center build out, but it's also important for industrial processes generally. And then there's other metals that are involved in defense production, where we have very tight supply demand situations right now. Yeah.
Okay. Got that. Just last word, gold and silver, is there a view, Jonathan?
So for the time being, gold is sort of range trading, having had a spectacular year last year. I think it's important to remember that some of the major markets for gold are arguably in somewhat of a situation where the retail investor is not able to participate right now in the Gulf. But also, again, in the case of India, and I'm not close to this on the ground, but if you're in an environment where there's increased macro uncertainty, higher energy prices, potentially higher food prices, then discretionary demand for gold may be somewhat less than we've seen before. And in fact, as a theme across our coverage, we've removed almost all of our consumer discretionary stocks at this point. So we have been making that move more to energy materials and telcos. But gold is certainly a solid hold, let's put it that way, at the moment in the portfolio.
Jonathan, just one last question. In India, and those who are watching you, those perhaps who are focused on India and not around the world who can't, how should they think about this? Now, there is AI, so maybe focus on things which can't be coded away. Again, I come back to hard assets and real physical assets, things like, I don't know, hospitals and infrastructure or
defensive franchises. Yeah, so to be specific, we have 3 India stocks remaining in our emerging markets focus list: Reliance Industries, ICICI Bank, and Bharti Airtel. So those 3 represent what we view as a sort of a core holding in India currently.
ICICI Bank, Reliance Industries, and Bharti Airtel. These are 3 Indian stocks in the MSCI.
Our global emerging market focus list. Yeah.
Okay.
And Maruti, you're recently downgraded. Do you want to take us through that?
I can't comment on that.
Okay.
All right.
All right. I think we'll leave it there, Jonathan. Appreciate you coming on.
Very much. Thanks for having me on. Thank you.
Thank you for joining us. Thank you.
Bye-bye.
All right. Well, that's Morgan Stanley's view, and coming in from their top emerging market strategist. We'll take a break. We are back in just a bit, and we have the management of J.K. Simmons joining us to talk about the impact of course, the Iran war and whether there's supply disruption, what's happening with prices. Anuj Khandelwal coming up next.
Welcome back. This is Corporate Radar. Let's welcome Anuj Khandelwal, the business head, J.K. Cement, who joins us on the show. Hi, Anuj. Thanks a lot for joining in. Coming to you in just a bit. For the time being, just highlighting the 3 top discussion points that we're looking at. What's the impact of the Iran war on the input cost? What about cement price hikes? How much is needed to offset this current raw material price inflation? And what about demand on ground? It was supposedly good. Is it as strong? Anuj, thanks a lot for joining in. First, let's focus on the raw material basket. Could you tell us how much of your mix is towards petcoke, how much of it is towards coal, and within coal, how much is imported and how much do you get domestically? Please go ahead.
Okay, Nigel, firstly, many thanks for having me on the segment. Quite interesting times, to say the least. Basically, in our basket, look, it depends across regions. In southern region, around 75% of our fuel requirement comes from petcoke. In the central region, 90% actually comes from Indian coal. So it's quite varied. And in north, it's around 65 to 70% comes from petcoke, while 10-15% comes from Indian coal. So it's a wide variety across the regions, depending on where we have Indian coal supply, where we are dependent on imports.
Okay, all right. And this higher raw material cost will start hurting you from when? What I mean is, you normally would be sitting on some inventory, right? So you would get some benefit of lower cost raw material for at least quarter 4. Would that be fair to estimate? And from when does it start hitting? Second half of the first quarter, or will it be in the second quarter of next fiscal?
Yeah, so basically, yes, Q4 will not have that impact because you rightly said that, everyone does carry inventories, and in the current scenario, they do seem lower cost inventories for sure. Basically, it will start impacting us from second half of the first quarter, give or take, and it will depend plant by plant and it will depend player by player. But we will see the impact of higher fuel costs coming in sometime from mid-May to mid-June, depending on which player has how much stock of old prices left.
All right. There's a rough estimate that's coming from an MK note that I'm looking at, and various other brokerages as well have written. They are saying at current cost, the way the spike up you're seeing in petcoke as well as coal, the cost basket could go up around 200 rupees per ton. Would that be a fair estimate, assuming that they stay at these elevated levels?
If you are looking at the current fuel cost as a barometer to judge it, the cost on the fuel side will increase by around 125 to 200 rupee per ton for various players, depending on the region they operate in, depending on the kind of product mix they operate with.
Okay.
So on an average, the industry will have a hit of 150 rupee per ton just on fuel. In addition, we are also seeing a short-term impact on bags cost, which is around 100 rupees per ton or so. So overall, I would say that the cost impact, if we just take today's prices of various materials, will be around 225 to 250 rupee per ton.
That is fuel as well as bags together.
Yes, and of course,
by bags, I'm assuming it's polypropylene bags, the PP bags, is it?
Yes, absolutely. Polypropylene is the inherent material for the bags, and it comes from refineries. And we have, for obvious reasons, prioritized gas production, right? LNG. So basically, from that perspective, the production of polypropylene does get deprioritized, which causes a bit of a shortage in the markets, which is driving the prices up. So as of now, the bags cost is also 100 rupee per ton up. So that we'll have to see how long the impact is. But if you take the fuel and the bags cost both combined, it'll average hit us by 225 to 250 rupee per ton.
And availability of the PP bags are there? Or availability is also an issue?
Yeah, it's challenging. There's no two ways about it. It's challenging, but I think we are still getting supplies so far, but we have to keep an eye out on how things pan out in future.
All right, Anuj, let's talk about demand. Y'all were bracing for a very good quarter. I understand that in northern as well as central India, demand was strong actually, January as well as February. And there has been some softness in March. So could you help us out with how our demand trends been? And in March, how soft is it in comparison to the previous month? And given that sort of a backdrop, can you push through price increases since raw material costs have moved up?
Okay, let me take the easier question first, which is the demand.
Yeah.
Right. Look, December was bumper, truly bumper. We had not even expected that kind of December. Jan, Feb were also quite robust, and on a pan-India basis and even region-wide, I would say the industry would have grown by 8 to 10%. March, to start with, is soft simply because we had, the timing of Holi between this year and the last year has been different. Having said that, I still believe that in March this year, the industry will end up at a growth rate of 5% or so, which is still, I would say, robust because last March was really good. So as far as I think, the Q4 demand for the industry will end up at around 7 to 8% or so versus Q4 of last year, which I believe is quite strong and good, given how good the last Q4 was.
Okay.
So at present, slight softness seen in demand, but not so much to worry at present. So overall, but in Q4, the demand, I would rate as being quite good.
All right, yeah, on a high base, it's pretty good. 7 to 8% growth is what you're talking about. Just a quick question. Have you all scaled back production a little bit? Or are you all going as much as you all would have liked to, or as much as you all were, say, 20 days or so ago?
So basically, we've not scale back of production. We've not done because it depends on the amount of demand which is there. Demand, I would still say, is robust. We've not had a challenge so far as demand goes.
Okay.
But you have to also remember this is March. So basically, this is what we were even expecting, that the demand would be good. So it's broadly okay. We have not scaled back on production. The numbers are quite good. But how things pan out in future is something we are keeping an eye out very actively on.
And since you wanted an easier question, what about pricing? How much higher are pricing on an average in Q4 in comparison to Q3?
So in Q4, look, non-trade prices, because that's a segment where the price volatility is far higher, and it is in a way, depending a lot on demand. I would say on non-trade per se, across regions, we've had a 10 to 15 rupee kind of a jump in Q3 versus Q4. 10 rupee should be the average. And in trade, we've hardly seen any changes. Some regions have seen 5 odd rupee changes. Some regions have remained constant. So overall, trade is 0 to 5 rupees, while non-trade is 10 to 15 rupees.
So back of an envelope calculation suggests that you have pricing benefit, you have operating leverage that will play out, and input cost should be subdued. So EBITDA per ton improves by around 150 to 200 rupees in Q4 in comparison to Q3. Is that a fair estimate?
I don't want to comment on it because the results will be, we'll be very soon entering into a silent period. So I would want to stay away from that question. But overall, various factors which you mentioned are in place.
Okay, Anuj, very quickly, I know you all have operations in UAE, you're in charge, and you have, better insight on the India operations. But given the kind of uncertainty in the Middle East, are operations functioning as normal, or has there been some kind of scale back out there? What have you heard from your counterparts there?
No, see, there are challenges as you all have heard, but we are looking at the situation very clearly and very, very carefully, and things are too fluid for me to comment on it.
All right, we'll leave it there. Thank you very much. Good luck, and we will look to speak with you soon again. Thank you. From the last time that we looked at the markets, it's a complete U-turn which we've seen. We are at, we are above yesterday's high. Yesterday's high was about 23,500, 505 or so, and we've crossed that level. Look at that. And bulk of that move has materialized in a fairly short time span. If you look at it, I think the one-way move started at about 950 or so, and we're at about what? So in the last 10 minutes, we've moved about 100 points. Not 100, maybe a little less than that, but about 60, 70 odd points or so. The low, of course, was made at about 928, which was about 23,346. 23,590 is the upper end of the channel. So let's see. That is the level we put out in the morning. Let's see if you're able to cross it. If you're able to cross it, then you perhaps are looking at 24,000 kind of levels. If you fail, then you basically are coming down once again. So not very far. We'll find out if there is enough here for the market to test those levels. That is about 23,590. Just a quick word on the IT index, which is exceptionally weak today.
Well, it's recovered. It was down 2.5%. Now it's down 1.5%. So from the lows, it's up about 1%, but still down 1.5%. Actually, the recovery is coming in the auto names. The Nifty Auto Index is right on top. It's a near 2% gain on the Nifty Auto Index, with M&M, Maruti, Eicher Motors, Bajaj Auto all gaining between 2 to 3%. Eternal has moved up smartly. That's up about 3.5%. And metals.
Incremental recovery in the market is IT.
IT. That's a 1% recovery from lows.
Auto index was strong. It has become stronger. But the IT, and let's just put the intraday up, that is where that turn has come from the day's lowest point. So about a 1% pop from the lows for the Nifty IT Services Index. Chandan Taparia is with us at Motilal Oswal Financial Services. Chandan, good morning. Good to have you here. Just a quick word on the price action as you're seeing, and where would, what are the pivots you're watching closely, and what would confirm upside or, a reversal once again here?
Yeah, good morning, Prashant and Nigel. Thanks for having me. So yesterday, Nifty formed the bottom near 23,000, witnessed some recovery led by some short covering and improvement in the put-call ratio. Today, after the opening, it's holding the key support of 23,333. So for me, the hold of 23,333 is very important, because what we noticed in last couple of days when market was declining, it never witnessed the follow-up for second days. So if 23,333 is being respected for the day, then I believe this recovery can extend some more bounce towards 23,750 to 24,000. So on intraday point of view, 23,333. For positional point of view, 23,000 could be the key support, and looking for some more bounce in the market. But we need to keep in mind that about 24,200 to 24,440, the major trend will change. But till then, we are looking for some recovery or bounce setup in the market. Now, talking about Bank Nifty, here we witness a bullish engulfing pattern on the daily chart. Major support on immediate basis at 54,000. Looking for a recovery towards 55,000 to 55,555.
Okay. Any stocks, Chandan, that you'd like to bring to our notice?
Yeah, Rima, so positive on the capital market infra theme. MSEX is our first trade. We are quite positive on the same. The good part is that even after the market corrective move, the counter is holding well above 50-day exponential moving average. Major trend of the counter is positive. Longs are intact with put writing activity. Rollovers were also positive. So most of the data set, whether we talk about the technical derivatives or the quantitative, we are getting the positive stance. So recommending to buy with support of 25.50 for an upside target towards 27.20. Again, second idea, buy on BSE, resilience, positive on the capital market infra theme, recommending to buy with support of 28.60. And this time this counter can head towards 3,050 kind of level. And third trading idea, that is on metal. Nifty metal index is now bottoming out. And Tata Steel is now taking support at the previous hurdle. So role reversal pattern is visible on the daily chart. And after the correction of last 2 weeks, we are witnessing some put writing and support-based buying at the counter. So one can buy with support of 186 for an upside target towards 203 levels.
Thank you very much for that. Scient DLM is a big mover today, 14% up. This is after JP Morgan upgraded the stock to an overweight, raised the target price to 400. So that stock is surging. Current market price 340. So they still see a lot more upside. The other upgrade they did was an amber, but here the gains are more muted, up to 3%. We will slip into a break on that note. On the other side, Manisha Gupta will come back and focus on commodities. Stay tuned. Welcome back. It's time for our commodity check. Manisha joins in as always, and she's watching the rise in aluminium prices today.
Well, that's just a couple of commodities that actually have continued to rise consistently. One is energy and the other is aluminum. So when you look at the prices therein, we are trading at a 4-year highs onto this one. On a monthly basis, we have gained by 12%. And for this year, it's outperforming various other commodities as well. So in last 12 months, we've seen 26% of gains come in for the aluminum prices. Interestingly, when you look at the cash trades, they are trading at a premium rather than the 3-month contracts. Well, actually, I was looking at the December 2027. That's trading at a $3,000 a ton. The current price is at around $3,500 a ton. So we're looking at these very strong premiums that the producers seems to be charging, or smelting countries seem to be charging right now in Japan, in US and Europe as well. Japan actually seems to be charging nearly $300 a ton of a premium to its Asian consumers right now. All of this really comes in after the Persian Gulf, which accounts for nearly 9% of global aluminum output, is looking or is tied in with this conflict therein. There also are reports of closure of Strait of Hormuz, interrupting a lot of shipments when it comes to aluminum as well. And there are certain reports which suggest that nearly 564,000 tons per annum of a capacity, which is 0.8% of global capacity, is in process of shutting down in West Asia there. 2 major smelters within the area, whether it's about Qatar or Bahrain, already have taken a hit and have been forced to suspend deliveries. There are a couple of smelters which also have done a force majeure out of there. If you look at Rio Tinto, that has been offering aluminum to Japanese buyers at a premium of $350 a ton therein. But the latest news, of course, comes in from Bahrain, where Bahrain's Alba, which is the world's largest single-site producer, has shut 3 production lines there, which together accounts for nearly 19% of its capacity, which, by the way, is at around 1.6 million tons. So those are the kind of shutdowns, the huge ones that we are looking at in the international markets. Apart from Middle East as well, it is about China, which is the world's largest aluminum producer. Well, there are concerns of production into this one as well. The government has put a curb of 45 million tons, which China hit in the previous year itself. So China perhaps is not looking at any more production growth going forward. We actually could be looking at a decline to curb overcapacity, is what seems to have been bothering the markets in any case. Aluminum inventories, when you look at that, those have continued to decline in London and in Shanghai as well. An interesting report from ING says that the supply shortfall for 2026 is estimated at around 600,000 tons right now. So apart from Middle East as well, aluminum had been doing quite well. This just adds further premium in case of prices there. Take a look at Indonesia, which is also a high in case of smelting, but they also are struggling to build new plants due to high energy costs and, of course, local regulations as well. The production challenges in Mozambique also have been supporting the aluminum prices. When you look at the various reports on where the aluminum prices could go from here, well, that's a lot of bullishness continuing. We are trading at around $3,500 a ton right now. Citi says that $3,600 is their near came base scenario, but $4,000 is what they're talking about in a very bull case scenario as well. It's a similar report that has come in from Goldman Sachs as well. $3,600 is what they are dealing with if the production in West Asia is lost for more than a month. A latest report from Morgan Stanley also has come, and they also say that their base case scenario when it comes to aluminum stands at $3,700. Not too far away. It's $200 away from where we are trading right now. So aluminum continues to be an outperformer on a week-on-week, month-on-month and year-on-year basis.
Right, Manisha, thank you very much for that. Well, it's commodities in focus. More later. We are going to take a break. We are back on the other side in a special Indianomics program. Lata discusses why the IDBI divestment is flopping with former RBI Deputy Governor S.S. Mundra, former Bain Senior Partner Harshvardhan, and founder of Neostrat Advisors Abhizar Devanji. Conversation follows in just a bit.
Welcome to Genomics. The IDBI Bank divestment was actually flagged off in the February 2016 budget speech of Finance Minister Arun Jaitley. Yes, 2016. And the latest we hear 10 years later is that even the couple of bids we got this month are likely to be rejected as they are below the government's reserve price. Why is the government unable to divest from IDBI Bank even after 10 years of debate and processes, while RBL Bank could sell a fresh 60% stake to Emirates NBD Bank for a whopping 26,850 crore? And Yes Bank's 8 shareholders could sell a 20% stake to SMBC for 15,880 crore. Foreign buyers appear to be ready to pay, but government is not able to cash in. Why? That's the question we're asking today. And joining me are Mr. S.S. Mundra, former Deputy Governor of Reserve Bank of India and former Chairman of Bank of Baroda, Chairman of BSE as well. Also joining me, Harshvardhan, the banking expert and former senior partner at Bain & Company, and Abhizar Devanji, also banking expert, founder of Neostrat Advisors. Gentlemen, good morning, and thank you very much for your time. Mr. Harshvardhan, if I may start with you, what accounts for this failure of the government to click in when private guys are doing so well and getting buyers easily?
Yeah, Sunata, I was saying that, look, you have to keep the broader context in mind. This is the first time the government is trying to sell a very large financial sector entity. This has never happened before. So there is no experience in the government to go by. IDBI is over 80,000 crore market cap company. So if we have to sell even 50%, this is a 40,000 crore plus transaction. This is a very large transaction. And so obviously both sides, the buyer and the seller, would be extremely careful in a transaction like this. Even in private sector, when such large transactions happen, your investment banking friends will tell you a lot of energy and mind space gets spent in something called representations and warranties and indemnities, when the buyer essentially protects the seller from any unforeseen eventualities that might arise post the sale that happens. So my sense there is, and this is entirely based on public domain information, I have no private information, is that one, given that there has been a dramatic turnaround in the performance of public sector banks, the government's valuation expectation may have gone up. That's where your comment about reserve price not being met would have come in. And secondly, any buyer, private sector buyer, investor who's going to deploy so much capital would expect an unconstrained transfer of management control. And that in a government entity could always pose a challenge. There could have been employment contracts, there could be other sorts of constraints on the way the bank will be managed post-acquisition. So my guess is those are the two main areas which could hold the government from pursuing the transaction, just based on public information.
Okay, Mr. Mundra, you have seen all formats, private and public sector, as well as you've made policy. What is your sense? I personally thought the government got everything right. First of all, it is under the Companies Act. IDBI, unlike the other PSU banks, is not under the Banking Companies Act, which is a more difficult act, where government appoints CEO. In IDBI Bank, because it's Companies Act, the NRC, the board appoints the CEO. So it looked clean as well. Axis Bank was under LIC, and it was very easy to treat it as a private sector bank. So that is why they did this LIC routing. They seem to have done everything right. Why do you think it's flopping so badly and taking so much time?
Okay, interesting, Lata. First, you mentioned about the private banks are in a position to easily and why we are facing so much of difficulty here. Let's understand one thing. In most of those cases, the investors have chosen to pick up a strategic stake, not necessarily the majority control. And basically, you have to look at the transaction from 4 or 5, I would say, broad criteria. One is the transaction structure. Other is the regulatory framework which is likely to come. What is the valuation expectation? What is about the governance and any legacy concerns are there? And finally, the bureaucratic framework. If we look at it, I would initially touch upon two things. Number one, transaction structure. I think in case of IDBI Bank is a very complex transaction structure in the sense that government is holding something like 45.5%, LIC is holding 49.2%. Put together, they want to divest 60.7%, and both the owners would have their own expectation. Government would have the policy issues and the fiscal targets. LIC has to think about the return to the policyholders' interest and return on investment, more so now when it is listed. So I think in this complexity, an investor would probably have a very clear transaction, clean transaction, where the transaction structure complexity are minimum. It is driven by the market valuation, and the regulatory framework is much easier. I think these are the points. And as Mr. Harshvardhan also mentioned, what we understand from that, probably the mismatch has come in valuation expectation. So I think the requirement would be to put a simple transaction structure, maybe sequencing the divestment by both the owners, and be prepared to accept the market valuation.
Because the market valuation would depend on the asset quality, the future growth possibilities, how much the integration would be complex. So these are the kind of things which, would determine. I know both the things are difficult, but I think they are imperative. They would need to be done.
Okay. Actually, we are playing out, as you spoke, the ROA of the three banks, RBL, Yes Bank and IDBI Bank. And IDBI has a higher ROA. But, both those banks went for like 1.1 times price to book, and Yes Bank at 1.4x. In IDBI's case, if you take a book value of, I think, about 60 rupees they had, or 55 to 60 rupees, as of December, Abizar, it was trading at 100 rupees. I mean, the market price was asking for something like 1.8x. Do you think that it was the market price which spoiled the whole thing? What according to you is going wrong over here?
I personally think, assuming it is spoiled, because we don't really have the government answer to it as yet. Assuming it is spoiled, I really think that the larger issue is only about price. Because while, we had Mr. Mundra as well as Harsh talk about the fact that, the deal is complex, etc., the complexity was known. I think every bidder knew what they are getting into. They're getting into a more or less pari passu stake with the government plus LIC. They're getting in, not stake, voting power, as the two of them. The multiple was what it was. I think the real issue is around price and the way the price has kind of gone up. And frankly, this deal at 70-ish, I think, was a very doable deal, because it would have been comparable with the valuations of, say, a Yes Bank or a Yes Bank at 1.2 and RBL at around 1.06 times book. So that is really where the valuations would have been at. And I think it's only a valuation issue as of now. Not really a deal structure and complexity issue, because those complexities are known.
Okay, Mr. Mundra, to come back to you on this point, when I was preparing for this and I spoke to a lot of former government officials, one of the points that came from everyone is that bureaucracy or IAS officers worry about the CVC. If they sell it for probably, 1.1 time, and later on the price is trading at 1.7 time or 2 times book, then somewhere down the line, a CVC questions, did you sell the family silver very cheap? Is that a very important problem? For Subramania Kumar at RBL or, for the group of banks that sold Yes Bank, they just want to get on with business. They won't have so much of a CVC issue. Is that the big difference between private and public?
See, there are concerns. There have been historical cases, but I don't think that can only be the overpowering thought if a case is well made out. And now there is a whole history. I mean to say, even the current round is now 4 years old, and the stock is going on for 12 years. So there is enough history available that what are the impediments and how to move forward. But as I mentioned earlier, it's a difficult decision on both the sides. Those concerns will be there. But let's understand one thing. And sorry to say that, but if you look from various criteria, IDBI Bank is neither here nor there. Is smaller than many private banks. It has not a great retail franchise. There would continue to be concern, true or wrong, I don't know, but about the legacy book. So if that is the profile of the bank, then obviously, as I mentioned, that any investor would look at the future growth possibilities, that there are no asset quality risks, what kind of capital they would be required to commit, and how difficult would be integration, both from the viewpoint of manpower as well as technology. So all these things are factored into pricing. And so if all these factors are taken into account, a case is well made out. I think it will require a determination and a political will probably to sell it through. It's high time. This has been a work in progress for very, very long. And I think it's time to move on.
Oh, absolutely. Abhisar, what is your sense? Were they wrong, in fact, to have gone with government, LIC? Because there were some people who said that the guy who came with that, who would buy that 60% stake would still have only 26% voting rights. And the balance, if you make LIC and government look like the same entity, then you are still not having control. So the whole idea was wrong because the person who bids won't feel like he's under control. Is that the problem?
Absolutely right. That is one of the issues, but that would have been baked into the price. Okay. So that's why whenever somebody said that, oh, because you're acquiring a 60.5% stake, you should be paying a control premium. There is no control. Because if you work the mathematics of the voting rights, 46% voting right will remain with the new incumbent. 45% combined voting right would remain between the government and LIC in terms of 100%, and the balance 9.5% would remain with the shareholders. So actually demanding a premium was clearly not a proposition here because there was no control premium. That's one. So everything, all the nuances that you spoke about, whether it is the government control, whether it is the fact that you need to toil to turn around IDBI, was all factored into the price. Now, if you look at other comparable transactions, they happen at around one-time book.
Yes.
Now there is a reason for that, and frankly, a justifiable reason even for IDBI, because IDBI over the years has not only cleaned up, but collected a lot of their NPLs. So a lot of profitability and return ROE comes in because of NPL write-backs.
Yes.
Plus, there is a very stable mortgage business that they have built. So from a business point of view, at one-time book, it was a perfect buy, given the franchise, as Mr. Mundra also spoke about.
It has improved.
There is a franchise that is there, which demands a 1.5 times. Somebody would have had to come and rebuild on that franchise. Clearly, there was value. The other thing one has to say, as you rightly said, that Mr. Arun Jaitley flagged it off in 2016 and we are where we are today. There is this concept on investment banking called deal fatigue. And what really happens is that when a deal carries on a protracted manner, with multiple news coming in saying, oh, the bids are being invited today and tomorrow and day after, the cry wolf kind of comes into the system.
Fair enough.
And and lastly, above everything else, we talk about fair market price and the government has to justify a fair market price. We have a 5% float, for God's sake.
Okay.
How is that even a fair market price? The fair market price has to be discovered through a bidding process.
Okay, fair enough. I take your point. We have to take a quick break, but I'm coming back with more questions on what is the way forward. Should they pursue it at all? All those questions after the break.
Shares of Bajaj Electricals leap following the news that the company has acquired intellectual property and brand rights for Morphe Richards in South Asia for a sum of 141 crores. The execution was announced already, which is why the stock is off the morning highs.
Omax advances its project pipeline with fresh regulatory clearances, paving the way for new launches in both Haryana and Punjab markets. Subsidiary secure RERA approvals for 2 projects scheduled for launch this month.
Chennai-based Apple distributor Reddington limits its operations in the Gulf region as conflict disrupts shipments. The company says they've undertaken restrictions to preserve working capital amid regional tensions, but the financial impact of restricted operations are yet to be assessed.
The best way to play the electronics manufacturing theme is through shares of Syrma SGS and Amber Enterprises, says JP Morgan. Brokerage sees scope of increased value addition in the space. Barring Dixon, they expect a 20% top-line growth over FY26 and 28.
You're watching us here on Chartbusters. Good morning. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me is Ekta Batra. And it's a decent day of trade so far. Recovery from yesterday, the second half continues into today as well. And from yesterday's low, we've seen a recovery of nearly 500 points on the Nifty. Yes, at higher levels, there is a smidge of selling, but after the kind of recovery that we've seen, after the fall that we've seen earlier, it's only fair that this sort of volatility continues. The good part, however, is the broader market's doing a lot better. We have 2 stocks advancing for every stock which is declining. Hi, Ekta. Good morning.
Hi, Mangla. Morning. Well, it is definitely good to see this green come in through the screen, and also not to mention that it is follow-on buying after what we saw last afternoon. But one thing which also stands out is the Nifty IT index, which is down around 1.5% at this point in time. So that seems to be a point of concern. So the likes of Wipro, Infosys, TCS, all of these stocks are down and out in today's trading session. In fact, Wipro sitting with a cut of around 2.5% at this point in time. But good time then to get in Rajesh Palvia of Axis Securities for a technical check on the markets. Rajesh, hi, welcome to the show. Well, we are seeing some amount of green, some incremental buying which is coming through. Would you think that this is a confidence signal for the markets, or would you be in wait and watch?
Good morning. So after a one-way correction of almost 3,000 points for Nifty, now some recovery is taking place from the lower level. Though Nifty was in oversold trajectory, most of the large cap stocks was in oversold trajectory. So some technical pullback is happening in the market. But still, if we look at the data as well as the setup, still until the Nifty not able to take out about 23,700, 800 zone, structure is likely to exhibit on the sell on rise kind of structure only. As we have already broken all the crucial important moving averages. Looking at the derivative data also, the call writers are still confident at 23,600 to 23,800 strikes. So these levels may act as a supply zone for any kind of minor pullback action. So volatility is likely to be there in the market. But looking at the near-term perspective, at this juncture, the put writers are now taking some position at 23,400, 500 strikes. So these levels may act as a support zone. But today, again, it's a weekly option expiry. So maybe volatility would be there. And Nifty will likely to consolidate in range of 23,400 to 23,550. This could be the possible range. But Bank Nifty is still not able to take out its immediate supply zone, which is placed at 54,700 zone. So until these levels are not taken out by Bank Nifty, we are likely to remain under pressure for Bank Nifty for any minor pullback action. But some of the pockets where continuity of uptrend is there. So I think for trading point of view, one can focus on the stocks where, outperformance is there and able to hold their near-term, short-term breakout levels. So some of the themes like, capital market theme is looking attractive. MCX, BSE is showing sign of strength. So from that pocket, I think MCX one can continue to remain on the long side of trade. Here we could see continuity of uptrend and possible upside for MCX. We are projecting around 2,700 to 2,740. One can buy with stop loss of 2,580. Another theme where we are observing that continuity of uptrend is power space. So power stocks are showing sign of strength. So Tata Power is looking attractive after a long consolidation. Now Tata Power is negotiating with its neckline supply zone. I think any breakout above 405 could take this stock further higher to 425 to 430 zone. So one can buy Tata Power also in this range. On the downside, 390 needs to keep as a stop loss.
Okay, all right, Rajesh. Thanks very much for bringing us all of that perspective on the technicals. We need to take a short break, but we'll get you a lot more on the markets and stocks once we're back. Stay tuned.
Welcome back. You're watching us here on Chartbusters on CNBC TV 18. A bunch of stocks which are selling off from the highs this morning. We do have HUL, SBI, both of them at the low point of trade. We're also seeing some bit of sell-off on Tata Consumer. Yesterday, the FMCG stocks actually did well, but now they're coming in for a wee bit of selling. Even though, you know, the IT pack is selling a lot, Birlasoft is one that really stands out. It's the top F&O gainer right now this morning, up nearly 4% on that counter. But the stock on our radar right now is Fino Payments Bank. There is a news piece around that, and what exactly that is, along with the impact of that, is something that our colleague Furkan is joining in to tell us that. He's saying that the issues out there may not be as bad as they appear. Remember, they took a beating on Monday as the markets buzzed with speculation that the bank may be in for more trouble with the Enforcement Directorate.
You know, the thing that rattled the stock on Monday was the buzz that DGGI may recommend an investigation by the Enforcement Directorate into the online gaming transactions linked to the bank. While that's still in the air, what we have picked up from the sources is that the arrest of the Fino Payments Bank CEO Rishi Gupta under the GST Act is not likely to have any material impact on the bank itself, especially its banking license. So that business will not be heard directly. In addition, sources say that the Reserve Bank of India is not likely to ask Gupta to step aside unless it's proven that he is guilty of the allegations leveled against him. We are also picking up that the large portion of industry believes that the allegations against Gupta may not hold water. The argument a couple of veteran industry players made was that such things are hard to miss when the RBI runs its fit and proper criteria test on the candidates who are running for the post like that of Gupta's. Also remember that in December 2025, Fino Payments Bank got its in-principle approval from the Reserve Bank of India to transition into a small finance bank. Now this will help the bank set up a lending practice which Payments Bank could not do. And also we are picking up that this latest string of controversies surrounding the bank will not affect this process. The fact that the Payments Bank got this license is also being seen as an indication that the Reserve Bank of India has clearly not found any systemic issue with the Fino Payments Bank. We have also learned that the Indian Bankers Association, which is an industry body comprising of Indian banks and financial institutions, has written to the Finance Ministry seeking clarity on the matter. So we'll have to wait and see if there is any response from that, and of course how other things in this matter finally pan out. Back to you.
Okay, all right, Furqan. Thanks very much for bringing us that update. Remember that yesterday, Fino Payments clarified on exchanges that the DGGI probe relates to program managers and merchants associated with multiple banks. But let's move on now. There's strong moves, in fact, coming into EMS companies today on the back of a bullish JP Morgan note. Let's go across to Upasna to understand the rationale and what the JP Morgan note says. Upasna, over to you.
Well, certainly, JP Morgan has put the spotlight on the EMS sector and has upgraded 3 stocks within the sector. Now, let us see the first one. Now, it has upgraded Cyan DLM to overweight from neutral with a target price of 400, upgraded Amber Enterprises, even this stock is in focus, to overweight from neutral with a target price raised to 9,000 per share. And lastly, it has identified Syrma SGS as one of the top pick within the sector with an overweight rating and a target price of 1,050. It believes that the EMS stock underperformance has led investors to question whether the sector story is over or not. But overall, it believes and rejects this thesis and is pretty positive on the sector. It sees every stock barring Dixon delivering a revenue growth of over 20% from FY26 to FY28 is what they have highlighted. And they have also said that it further sees sector upping its valuation assembly to component and PCB manufacturing. In terms of valuation, it believes that all these stocks have eased post underperformance, but the key risk remains at the levels of 32 to 60 times FY27 estimates for the stocks that have missed its overall earning expectation. Overall, it believes that the Syrma, SGS and Amber are most likely to beat the street expectations. So all in all, it's certainly a positive note from JP Morgan on EMS sector.
Positive note indeed. Syrma up around 1.6%. A big move is on Cyan DLM up in double digits as we speak. But the flip side, under pressure is Redington after the company's Gulf subsidiary has restricted operations on the back of war-led disruptions to shipments. Let's go across to Vinny for the details. Vinny.
Hi, yes, so in terms of Redington, we are seeing red on the screen because it's wholly owned subsidiary, like you mentioned, in the Gulf, has actually said that the Gulf West Asia war that has been going on is impacting its Gulf operations. Geopolitical tensions are the major region. So because of that, what has happened? There's an increase in transit time. There's an increase in working capital. And some of the customers have requested to make payments on a delayed basis. So receivables will also be a problem for them. Apart from that, freight costs, that's seen an increase. Insurance costs, logistic costs, all of that as well also has seen an increase. So overall increase in terms of cost is a concern that comes in for the company. As of now, the company has said they have not quantified this financial impact, or it's not possible for them to quantify the impact is what they are highlighting. So we do not have a number there. But as on 9-month FY26, the revenue contribution that came payment from the rest of the world, which includes obviously West Asia, which is Turkey, Africa. All these regions are included in this ROW, rest of the world segment of theirs. That's 48% of the contribution comes in from this region. So will be key to watch out for.
All right, take that point, Vinny. Thanks a lot for that. Meanwhile, just keep an eye out on Fino Payments Bank, where the government sources say that the Indian Banks Association has written to the Finance Ministry raising concerns about the CEO's arrest. What we understand is that the CEO's arrest will not impact the company's banking license, and that's not all. In fact, if that were to happen, there is no systemic issue out there. If Arishi Gupta is proven guilty, the RBI will just ask him to step aside. So no impact on the entity, the listed entity, because it's not a systemic issue and it won't affect their banking license. And that's something that has caused the stock to spike a little from the lows. This is also a story coming in from our colleague Furkan, who joined us earlier on the show. We'll try and get a fresh perspective on this news from him once again. The arrest is unlikely to impact the banking license, and if found guilty, he will only be asked to step away and not impact the overall performance of the bank. Not a systemic issue is something that he's picking up, and that means that the stock has seen a bit of a relief. But another bunch of stocks which are doing well in today's trading session after taking a beating in the last couple of weeks on account of higher crude prices are the paint stocks. And you pull up Asian Paints up around 1%. You pull up Berger Paints as well. That's higher, along with Kansai Nerolac. Berger Paints actually up 3%. And that's because Macquarie has written on the stocks this morning. They've said that the companies have announced a 2 to 3% sort of price hike coming in, and they will be effective March 25th, with Berger indicating that a two-phase price hike is likely in April as well. All of this on account of the near-term concerns with regards to margins, on account of the spike that we've seen in crude, coupled with the weakness in the rupee. So all of that increases their overall cost of materials, and as a result of which these companies have taken the price hikes. Asian Paints, they have an outperform rating, a target of 3,100 rupees. Berger Paints, they have an underperform rating with a target of 410 rupees, and Kansai Nerolac is 220 rupees. The fact that they've taken price hikes and may not impact volumes as much, they're able to do so, is a positive, and that's why these stocks are higher today.
Okay, all right. Buzzing around the paint stocks at this point in time. Just watch out for the Nifty Bank, which is now higher by around 0.2%. So definitely a lot of volatility that you can see on an intraday basis coming in for the Nifty Bank, because when we started the show, it was marginally in the red. So there is some amount of buying at lower levels, which is coming through for a couple of these heavyweight banks. We'll take a short break. A lot more on the other side. Stay tuned. Welcome back. You're still tuned into Chartbusters on CNBC TV 18. Well, for the markets, the Nifty is holding up with a gain of around 0.5%, but just watch out for specific stocks. MRPL, for example, is down around 6% at this point in time. It's still holding with a gain of around 28% for the year. We have IDBI Bank down around another 2% today. Remember, it did see that 15% crash in yesterday's trading session after the divestment plans have been put on the back burner. So a little bit more of profit selling coming in. And the other one is OneSource Specialty, which has already lost 20% this year, is down another 2% in today's trading session. But shifting focus to the commodities space, let's go across to Manisha. She has a roundup of all of what's taking place in the crude market today, as well as metals. Manisha, over to you.
Well, thank you so much for that. It has been a volatile market, but there are a couple of things that continue to trade firmer. One is crude and the other is aluminum. I'll start with crude first. And even as overnight was 3 to 5% of a decline, and this was after various statements and reports of several tankers safely navigating Strait of Hormuz and perhaps a coalition which will ease the naval transit of many of these ships. That is what led to some profit taking. Having said that, it is the Brent prices still holding above $100 a barrel. We've not seen that breach on the lower side for the last 4 sessions now. It's what continues to support the markets. Also, there are some fresh incidents of attacks and statements from various partner countries and US, which seems to be adding premium back in case of prices there. It's not just the crude prices, but gasoline, gas prices, heating oil, all of that seems to be surging higher in the Asian markets right now. When it comes to metals, it's only aluminum which is standing tall because nearly 9 to 10% of aluminum, global aluminum, comes in from Middle East. And the expectation is that nearly 1% of that is shut down, and the rest, of course, is not even coming out. We also are looking at smelter shutdowns, not just in the Middle East, but in China, problems of producing aluminum in Mozambique, in Indonesia as well. And we have seen LME inventories continue to decline, and that in turn has been supportive for the aluminum prices. Gold and silver, in the meanwhile, have continued to be very, very flat in the trade.
All right, take that point, Manisha. Thanks a lot for that. Meanwhile, the Fino Payments Bank story has seemed to have impacted the stock fairly sharply, as we can see at the bottom of your screen. In fact, right now on the screen as well, the stock up around 2.5% from the lows. There is a recovery of nearly 4.5–5%. But with that, we're completely out of time on this edition of Chartbusters. You stay tuned to CNBC TV 18. Trading Hour, the team of Trading Hour takes the market action forward. As you can see at the top of your screen, a big surge is what we've seen on all the 4 indices in the last 15 minutes from the lows. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio, and the markets are doing extremely well. 23,500 for the Nifty. It's a recovery of over 500 points from yesterday's low. The Nifty Bank holding with a gain of almost 100 points as well. And what has you a lot more excited today is the health of your portfolio. 2 stocks in the green for every stock which is in the red. So despite the up move that we saw yesterday in the last hour, it didn't reflect in the portfolios because we did have the market breadth, which was still favoring declines. But this morning, straight off the bat, the advances doing a lot better. I'm Manglam Malu. With me, as always, Hormas Fatakia and Ritu Singh. Good morning, Ritu. Looks like we've woken up with better news today and moves on the market than what we've seen earlier.
Good morning, Manglam, and let's hope that continues. There is buying on top of the kind of session that we saw yesterday. So yes, it is good news. Looking good on the screen today. You have the Bank Nifty that is also recovered from the volatile start. Today at the start of the trading day, now up about 110 points as we speak, with both the frontline indices now trading with gains of almost 0.5%. So it's looking good on the screen. The IT pack has also made a bit of a recovery, although it is the top loser sectorally. If you look at the packs, auto is doing very well today, as are metals, realty. These are all up and about in trade today, whereas the PSU Bank Index, FMCG, these are some of the names that will be in the red. But in the top losers, you have the likes of Wipro and State Bank of India and Infosys. But in the gainers, if you look at them, Eternal, Tata Steel, M&M, these are some of the names that are looking good. But let's go across to Hormaz, who will, as always, put the spotlight on the top movers. Hormaz, good morning.
Morning, Ritu. And the big takeaway, or can you say, if you can summarize the first couple of hours in today's session, you could say it's been extremely choppy. The Nifty made a high of the day, then that high got sold into, and now we are seeing a recovery again from the dip that has come from the highs. That has been the case with the market. There you can see the intraday high close to 23,600, then that fall below the 23,500 mark, and now we are seeing that little bit of recovery that you're seeing, and a similar move playing out on the Nifty Bank as well. The Nifty Bank saw a recovery of almost 1,200 points from the lows of yesterday, where we moved towards that 55,000 mark. That remains the most important level to watch on the upside for the index, on the banking index. But the theme of today in terms of the sectoral picture has been the beaten down indices are the ones that are making a comeback. The auto index was smashed last week. That's among the top sectoral gainers today. The metals index was beaten down. That's up 2%. And the realty index too is doing fairly okay for itself, seeing some choppy moves though. But the metal names, speaking of those, some top movers within the metals, the Lloyd's Metals has been one. It's getting some favorable analyst coverage recently. SAIL, NALCO, all of them doing well, 5% higher for both of these names. There are some sharp moves seen in the renewable energy names as well. Premier, Vari doing well for itself, and a CNBC TV 18 story impact of Fino Payments Bank, the recovery that the stock has seen from the lows of the day, now still doing fairly okay for itself. Among the newsmakers, Bajaj Electricals, of course, off the highs of the day. Reddington, of course, the disruptions in West Asia, and Andhra Cements as well, doing after the OFS that came in. The EMS companies, though, that is the big talking point after the upgrade that has come in from JP Morgan. The Cyient DLM trading with almost double-digit gains, with off the highs of the day, 8%. Sirma SGS doing okay. Amber as well, getting an upgrade and a price target raise as well from JP Morgan. So EMS stocks doing well. The index is off the highs of the day, but seeing some bit of recovery from the lows as of now.
All right, Hormaz, thanks very much for setting us up for this hour of trading action. Let's also get you an important market voice following the geopolitical uncertainties and consequent risks to the macros and equities. Morgan Stanley has downgraded India to equal weight. In an exclusive conversation earlier today with us, Jonathan Garner told us that India is most sensitive to oil and gas imports, and prospects for India are dimming in this environment. Take a look.
Made a number of changes to our recommendations about 10 days ago, and it's really all to do with the framework that we're in right now in relation to oil and gas supply. It is unfortunate for India because in January, the manufacturing and services PMIs moved up. And we obviously have had significant policy easing in India, and we had been cautiously optimistic about the business cycle turning and running a small overweight. But unfortunately, India is one of the countries in our coverage that has the most sensitivity to oil and gas imports within GDP. It's actually the third highest after Thailand and Korea. And so the prospects for the economy are dimming in this environment. So broadly for Asia Pacific, we are in the world where if we do sustain interruptions to product flowing through the Straits, and you can proxy that through the Brent oil price going to $120 to $130, but obviously some regional benchmarks are well above that, and there's quantity issues as well as price issues. In that world, we would see around 15 to 20% further downside. Broadly, Asia has declined around Asian equities around 8%.
All right, after a 116-point up move today, a big move in yesterday's trading session as well. What stood out was the domestic institutional investor buying yesterday, over 12,000 crores in the cash market. They acted as a counterweight to FII selling. Early in the day, what's the buzz in the dealing room? Nimesh joins in. Nimesh, what brings you so early in the morning in, speaking about dealing room? Because the kind of move that happened from yesterday to now, it's sustaining.
It's sustaining, so I'll talk about the big DI number, which has been a big talking point in a bit. But just to give a sense on today's market, the sense I'm getting is that maybe today the FIs are better buyers. So maybe that explains that the Nifty has recovered almost 110, 115 points, or maybe 150 points from the day's low. If you exclude the IT fall, the Nifty would have gained more than 200 points. So this momentum from yesterday is just picking up even in today's market. And I guess for a change, today the FI seems to be better buyers. And where are they buying? They're buying largely into the power names. So power as a sector is standing out. And of course, some of the large cap beaten down names where you're seeing a bit of a combination of both short covering as well as a bit of buying as well. If you just analyze yesterday's data, I'll talk about the DI number. But even from an FI positioning point of view, the short positions have got covered a bit in yesterday's trading. So they were net short 90%. That came down to 88%. So clearly, some bit of short covering the large cap was clearly visible. Now coming to that big talking point, which is the DI number. The net provisional number yesterday was upwards of 12,500 crores. That's a big DI buy number which came in yesterday's trading session. I've just looked at some. So the buzz on the street was that maybe that EPFO was a big buyer in yesterday's market. The anticipation is that maybe they've bought between 5,000 crores to 7,500 crores only in yesterday's trading session. So which is why that big DI number of 12,500 crores. Now I'll just put down. So essentially, what these EPFOs do. They do not buy direct stocks. They only invest into ETFs, whether it's a Nifty ETF or a CPSE or a Bharat 22 ETF. So I've just looked at the volume data of all the three major indices in terms of ETFs. The first is the Nifty ETF, and look at the volumes there. Typically, what happens is this EPFO money normally inflows comes in by the 7th of every month. So they invest between 8th to the 10th or 13th of every month. So typically, that's the time when you will see the volumes picking up. As far as the EPFO contribution is concerned. And that's why if you look at the Nifty ETF, the charts will come up. The volumes have picked up on the 9th, on the 13th, as well as on the 16th as well, across Nifty ETF, Bharat 22 ETF, as well as the CPSE ETF. So just to reiterate, while there was a lot of chatter about who bought yesterday, looks like there is a bit of EPFO activity for the last couple of days. And that explains that there is a sharp surge in the DI number yesterday. It looks like it's backed by the EPFO buying. Bharat 22 ETF also similar kind of trends. The volumes have picked up in the last couple of days, and so is in the CPSE ETF. So just to reiterate, what we saw yesterday was a big number from the DIs, but looks like half of it, a major part of the flow, has come in from the EPFO.
Interesting. That explains the big DI number, and that also explains the surge seen in some of the PSU stocks as well over the last couple of trading sessions. Nimesh, thank you for summarizing that for us. Now, the index, though, still extremely choppy. Now 85 points higher, at now below the mark of 23,500. So that is still turning out to be a bit of a barrier, at least in the first couple of hours of the trading session. Take a short break. Focus on the bond markets on the other side with Manisha Gupta.
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. The index still cooling off from those highs now, 75 points higher as we speak. 23,485 is where we stand. So there's still some bit of resistance coming in at that 23,500 mark. But shifting focus to the bond markets, then Manisha Gupta is here with the latest. Manisha.
Thank you so much for that. Well, if you look at the overall bond as a performance, we have seen a bit of a decline come in for this one. This is really ahead of the large supply of state government bonds at auction today. 21 states are trying to look at raising 584 billion. This is vis-a-vis 438 billion announcement that we saw earlier for the March quarter. So we're looking at like a higher quantum, higher supplies into the market. And because of this, you have had traders kind of avoid building positions. If you look at the overall markets therein, well, the fall in the space has been limited because of the liquidity infusion that we've seen come in via the variable rate repo auction. The RBI has approximately put out or announced rather a 1.5 trillion variable repo rate auction of a 7-day tenure therein. There is also, meanwhile, in the market demand for long-term state bonds. It seems robust coming in, especially from insurance and pension funds as well. Well, apart from that as well, there are big names that have been into the market there. NABARD, for one, has set coupon for 7.44% on 3-year and 3-month bonds maturing on 17th of July 2029. And NABARD has accepted bids aggregating to rupees nearly 72.65 billion. They had actually targeted 80 billion therein. And then you have Exim Bank, which set a coupon of 7.23% on bonds maturing. This is for 5 years at March 18, 2031. The accepted bids from Exim Bank are aggregating somewhere around 40 billion. And third and the final one on my list is Vedanta. They allotted NCDs worth 25.7 billion. This is on a private placement basis. And bonds have a fixed coupon at around 8.95% payable as well.
All right, Manisha, thanks very much for bringing us all the action from Bond Street. In fact, let's continue from there and get you the key macro signals of the day. Markets, in the meanwhile, they're trading higher, but it's been a bit of a volatile session. Now up about 65 points on the Nifty and about 175 points on the Sensex. You have the Bank Nifty, though, that is still in the red. The 10-year yield that Manisha was telling you, that's still at about 6.71% against the previous close of 6.7% because, you know, Brent crude prices on one hand, and of course what Manisha was telling us about this biggest ever state government debt auction for the fiscal coming up, where states will raise about $6.42 billion. That is adding to some pressure on the markets, that the existing demand-supply mismatch could potentially worsen, and that could push the yields higher. So keep an eye out on the 10-year benchmark for today. The rupee, meanwhile, has been extending the downside near the record low levels. There's a bit of a cautious undertone with oil prices rebounding as much as 3% overnight. Now you have the rupee at around 92.44 to the dollar. Higher for longer oil also is a major headwind for the rupee, given we import nearly 90% of our crude requirement. Brent crude, that is trading in a consolidation zone this Tuesday morning as the market attempts to find a flow following yesterday's extremely volatile session. We'd hit that multi-year high of $107 during the Cargo Island panic, but prices have since, of course, cooled down on reports of some breakthrough and a couple of ships passing through the strait. The pull back in oil has come through on the back of that and rising expectations of further strategic stockpile releases by the IEA member nations. So that's as far as the macro setup is concerned. We'll slip into a break, but when we return, we are going to discuss market technicals with Jay Thakkar of ICICI Securities.
Well, there is a decent recovery that has played out over the last couple of days, and right now as well as we speak, the Nifty is doing extremely well. The Nifty Bank marginally in the red right now, facing some supply at higher levels, and that's caused the Nifty's gains to come down from about 70-80 points today to about 35 points as well. The good part is that the mid-cap index is doing a lot better. If you look at the contribution chart, that tells you that, ex-IT, the Nifty is actually doing a lot better in today's trading session, and ex-banks as well, and in particular, SBI, which is dragging the Nifty by about 18 odd points. It is, the expiry day, so you expect some sort of pull and push from the bulls and bears. But the good part is that the India VIX is cooling off. Since yesterday's high of over 22, it's come down to sub 20.5, so that's a positive. Over the last couple of trading sessions, down in double digits. The market breadth is doing a lot better, so that makes you believe that maybe at lower levels there is support for the frontline index. 1900 stocks in the green for about 1000 in the red, and yesterday's low now becomes a very, very important reference point for both the Nifty as well as the Nifty Bank. That becomes the panic low, 22,955 and 53,258 on the Nifty and the Nifty Bank respectively, above which we are trading at with a fair distance right now. Options expiry today, 23,400 put writers very active, 23,500 put writers equally active as well. 23,400 put has a premium of almost what? 61 rupees, 23,500 has about 120 rupees. What does this tell you? That around 23,350 to 23,380 is a very strong support. Though on the way up, as we approach the 23,600 sort of mark, we continue to see some selling, and that's what took place twice in today's trading session. The intraday chart of the Nifty tells you that around 23,550 to around 23,600 is where the supply lies. But amidst all of this, there are a bunch of these stocks which are seeing a lot of long positions being added. Vari Energies and Premier Energies are the ones which, recent entrants in the F&O space, seeing a lot of long positions from lows. Vari is up 4.5%. And Nalco, over the last few trading sessions, metals weren't doing as well. And now 2 trading sessions, metals have come back into fashion. Nalco is seeing a lot of shorts strapped on the wrong side, and that stock's higher by 4.5% with shorts covering their positions.
Very interesting. Vari Energies in one of those buzzing names, 4.5% higher, and is now the third most traded stock on the Nifty 500 as of now, after HDFC Bank and MRPL. By the way, the index has now given up virtually almost all of its gains. It's just 20 points higher as we speak, and that has reflected in a lot of these EMS companies as well that were surging along in today's session earlier on in the day. Particularly so, Cyient DLM at one point was up 11 to 12%. That has cooled off. Now is trading with gains of only 4%, is Cyient DLM, and that is on the back of a bullish note from JP Morgan. Upasana is here to understand what does the note say and what they are saying as to whether the EMS story is over or not. Upasana.
Well, JP Morgan has put the spotlight on the EMS sector, and it has gone ahead and upgraded 3 stocks within the sector. Now, when it comes to Cyient DLM, it has upgraded the stock to overweight from neutral with a target price of 400. Next up is Amber Enterprises, again upgrade from neutral to overweight with the target price raised to 9,000 per share, and it has identified Syrma SGS as the top pick within the sector with an overweight trading and a target price of 1,050. Now, it believes that the EMS stock underperformance has led investors to question whether the sector story is intact or no. But brokerage overall feels that the sector story is still intact and overall has come up with a positive view on EMS sector. Now, it sees every stock barring Dixon delivering a revenue growth of more than 20% from FY26 to FY28 estimates. And it also believes that the sector is upping its value addition and the companies are moving from finished product assembly to PCB manufacturing companies. Now, in terms of valuations, the valuations have eased out after the underperformance seen within the stocks, but it sees a key level that is from 32 to 60 times FY27, a key level for stocks that miss expectations. Overall, the brokerage has highlighted Syrma, SGS and Amber as the most likely to beat the street expectations going forward. So overall, certainly a positive note from JP Morgan on EMS sector.
All right, Upasana, we'll leave it at that. Thanks very much for joining in. Now, we have Jay Thakkar, who is the head of derivative and quant research from ICICI Securities, joining us for a quick technical check of the markets. Jay, welcome to the show. Thanks as always for joining in. You have the Nifty now back in the red. It's been a very volatile day of trade. We're below the 23,500 mark. In fact, well below the 23,500 mark as of now. What are the charts telling you? Where do we go from here? And in this environment, what are your top trading calls? Any specific stocks you could call out?
Good morning to you, Ritu. And Ritu, I would say that definitely, yes, it is quite volatile trading session today. In fact, yesterday too, it was the similar kind of trading session which we had witnessed, wherein Nifty, in fact, broke the 23,000 levels, which has the highest put base for this entire March series as of now. And after breaking those levels, I mean, it in fact jumped by almost 400 to 500 points within an hour from 2 to 3 o'clock. So in the second half of the trading session. And today, similar kind of things have happened. But I would say that with this, the India VIX have in fact declined since last 2 days. Yesterday, too, it was down by 4 to 5%. Today also, it is down by 4 to 5%. The IVs have dropped. So this is clearly indicating that after March 9, there has not been a fresh high in the either in the India VIX or in the implied volatility, despite Nifty breaking the previous lows and making fresh swing lows. So with that, I would say that 23,000 levels, Ritu, still remains quite important for this March series. Until we don't see a close below 23,000 levels on Nifty, the probability of a consolidation to a bounce back or a short covering is much likely. Yesterday, there was some short covering seen by the FIIs. I think that could continue as well going forward until the March series. So my bet is that on this dip, one should be utilizing this as a buying opportunity with a stop loss below 22,900 on a closing basis, a bit below 23,000, targeting around say 23,800 to 24,000 going forward. And the similar case is with the Bank Nifty. I don't think it should be breaking 52,000 on the downside, and on the upside, it can retest the levels of 56,000 to 56,500. Now, having said that, Ritu, the stock recommendations would be a buy on Reliance. I think that Reliance relatively outperformed the market in the recent fall. We have seen some resilience, and 1350 to 1300 has acted as a very critical support for Reliance. In fact, we have seen a good additions out there as well. So 1450 to 1480 could be the target in the near term on Reliance. One should be utilizing today's dip as a buying opportunity out here. And second stock would be Policy Bazaar. As a disclaimer, we have recommended this to our clients as well. But Policy Bazaar, I think, seems to be forming a nice base around the levels of 1400. There has been a good short covering since past 2 weeks here, and since 9th of March, wherein we had seen that India VIX rising and Nifty breaking its crucial lows, we haven't seen Policy Bazaar in fact giving up. Rather, we have seen a short covering out here. So bounce back until the levels of 1550 to 1580 can't be moved out. One can place a stop loss below 1440 and go long on Policy Bazaar, that is PB Fintech as well.
Jay, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. 30 points lower now on the index, so the fall from the highs is continuing, and the principal culprit of that is the Nifty Bank, now 200 points lower on that index. So a substantial correction from the highs of the day for the Nifty Bank, close to 54,700. So it's an almost 500 to 550 point dip that the Nifty Bank has seen from the day's high. Take a short break, continue our conversation on the markets with Nikunj Doshi from Bay Capital Investment Advisors. Stay tuned.
Well, the Nifty is back in the red. It seems like, 23,400 is the fulcrum for today's trading session for the expiry. And even the broader markets, the mid-cap index has come off the highs. Those lines have come closer. Moments ago, when we were talking about, the market breadth in the F&O segment, we saw 1,000 stocks advancing for about 1,800 stocks which were declining. And now those lines have come closer. It's 1,250 stocks which are declining and 1,650 stocks which are advancing. So as a result of which, there has been some bit of moderation from the top in the market itself. Nikunj Doshi of Bay Capital Investments joins us to discuss market fundamentals, his top sectoral picks. Nikunj, the FIs haven't come to the Indian markets. Obviously, over the last year or so, we've underperformed not just the emerging markets, but generally global markets at large. And that's resulted in the exodus of FII money in our markets. And valuations haven't moderated because obviously EPS hasn't grown faster than anticipated either. So in a situation like this, with the kind of geopolitical uncertainty that we're seeing, what's your view on the market and your top sectoral picks?
See, means if we look at the current scenario, obviously it's like everybody's worried about what will happen to the crude oil prices, and that's perhaps the most important factor from the India's economy point of view. So that is the clear worry. But historically also, means I'm in equities for more than 35 years, and we've seen several such cycles in the past where on a day you think that the market is going to crash and everything is going to be over. There's no future left. But again, we've seen markets coming back time and again. So again, this is the time I would say is to buy on dips or perhaps accumulate gradually as per one's appetite. And I think market will rebound as and when the clarity emerges. And long-term future obviously is good from the Indian economy point of view as well as equities point of view. So I think current uncertainty, obviously, there's only one song which reminds me, Ye Lal Rang Kab Mujhe Chhodega. So I don't know when it will vanish or turn into green. But as of now, it's like it seems that everything is going to be over.
Well, it is that was an interesting analogy, Nikunj. But for those who are still having that question and who want to get rid of the lal rang, what are the sectors that you are recommending that they should be nibbling into, considering the correction that you've seen from the highs?
So again, see, one has to focus on the domestic businesses as of now, because these are the ones which are more reliant on the domestic economy or the domestic consumption. So obviously, one is consumption story, which is likely to do well for country. Second, fintech companies again means or financial base or financial sector companies. Again, we have to look at that also with a longer term point of view, because credit demand is going to be there, and the companies which have got good technology and I would say spread of products will do well. So niche product companies also can do well in NBFC sector. So these are the two sectors, as well as means we have been continuously saying on the digital tech companies. So these are the sectors that we are positive as of now. And the ones which are focusing only on the domestic.
Nikunj, hi.
Yeah, hi.
Well, Nikunj, just to pick up on that fintech company thread, yesterday we had the news that PhonePe is deferring its IPO. And on the back of that, we had the Paytm stock run up actually a bit. Maybe some near-term relief from its largest competitor not tapping the market immediately. Just any thoughts on what kind of upside you see for the likes of Paytm, given some of the broader concerns around the business still remain? And secondly, when you talk about, you're bullish on some of these banking names and you're talking about the credit growth story. I know last time you said this credit deposit ratio being high is not a concern. But, crude prices over 100, if at some point it starts to feed into inflation, won't that start to bite in credit and then start to reflect in the financials as well?
So obviously, means as I said, near term obviously looks gloomy. Means one cannot say what's going to happen in the near term. If oil touches 150, 130, we don't know what will happen to the economy, what will be the job loss scenarios, and perhaps that may result into NPAs for the NBFCs. So credit cost may rise. So we don't know the implications or second level implications of the current crude price hike on the economy. So that's why I said it's one has to be buying gradually into this market, and perhaps 3 to 5 years obviously is the better time frame to look at. But once things settle, you may see market bouncing back in next 6 months also. So I think this is the time to accumulate some of these names. And earlier also means, as I said, means companies with better technology, better risk management, and better product spread, or and few of the niche product companies also in NBFCs can really do well going forward. So obviously near term, really difficult to predict.
What is the top pick that you have in your portfolio right now?
So in NBFCs, or rather in the, I would say, NBFC space, we have Five-Star Finance as one of the holdings on our PMS side. It's a niche play on the credit side. Secondly, on the digital tech companies, we have Cartrade, Policybazaar, Ixigo, Delivery, all those names in our portfolio. And again, all this means I'm not recommending to the viewers, but obviously these are the holdings in our PMS, and we have a longer term positive view on these companies.
Now, since you mentioned companies, the domestic oriented names, Bajaj Finance, I have a question on that, because the stock did fairly well in the first half of February, and since then there has been a bit of a downtrend on the stock from levels of around 1050 odd. It's now down to 850. But Nikunj, Bajaj Finance, there have been issues surrounding this, right? There is an issue with regards to succession, there is issues with regards to growth as well. They've already mentioned that the growth for the full year is going to be at the lower end of what they had guided for earlier as well. Now, do you believe that the market is factoring in all of these uncertainties? These are good levels to buy? Or do you believe that the secondary impact that you are referring to might just end up having an impact on Bajaj Finance as well, because it is one of the biggest lenders to consumption-oriented themes?
Yeah. No, so that's what means. I think current worry is more about the second level impact and on the credit cost. So see, we are hearing of if this LPG shortage continues, or if this crude oil price continues to rise. So we are hearing about packaging costs going up. We are hearing of layoffs in sectors which are dependent on LPG as a fuel, so ceramic tiles or some other sectors. So we don't know exactly what is going to the second level impact of this crude oil price on the job losses, on the economy. AI related worries also has implications for the IT services sector and on job losses or new job creations. So all these are current worries, and obviously that's what is keeping investors, I would say, on the back foot or on the hold while taking view on this some of the NBFCs.
Take that point entirely. Thanks a lot, Nikunj, for joining in and giving us your view on the market. These are times to accumulate, but there are also times where investors are on the tenterhooks, and nothing better than how crude has moved defines that right now. This morning when we entered trade, crude was closer to 102. Now it's nearing that 105 mark again. And if you look at the crude movement and you look at Dow futures, both of them have an inverse relationship. Dow futures is actually now down about 230 points. And that reflects on the Nifty falling from the highs as well. Right now, the Nifty is down about 13 points. So if you look at the intraday chart of the Nifty, there have been two humps, so to say, with every subsequent rally being sold into. So let's see where it goes from here on, because crude has spiked and Dow futures are lower as well. What we'll do is take a short break, come back, get you more on the markets and a lot of stock-specific action on the other side.
Welcome back. It's a 13-point cut on the Nifty as we speak. We've come off those highs, obviously, and now below the 23,400 mark. That's where we're at. You have names like State Bank of India, Infosys, HDFC Bank, all of these dragging the markets lower. Some of the top Nifty losers, you have Wipro, Bajaj Finance, Cipla, Infosys. Keep these names in mind. But on the flip side, you have some names like Eternal, Tata Steel, M&M that are still gaining. But let's get in Winnie, who's got a roundup of the key brokerages, notes, and what they're seeing. Starting with crude sensitives, OMCs and pains, and the view from Kotak and Macquarie as well overall on some of the names. Winnie, take us through this list you've compiled on what these brokerages are seeing on some of the key names to keep in mind.
Hi, good morning. Thanks for that. So mainly the reason is the West Asia war started. We saw crude prices go up. A lot of raw materials for other companies also started seeing a uptick. Now on the back of that, we have a note from Kotak Institutional Equities that's on OMCs. Rising oil prices obviously is the main assumption. And if this war continues to go on, then obviously this continues to disrupt the operations for these companies as well. Now OMCs will have to absorb higher crude as well as higher freight as well as insurance costs. So weak earnings is something that they are penciling could come in for these companies, and the buffer that is created for these companies that could go off. So that is why they have reiterated a sell on OMCs. For IOC, they've cut the target price to 100 rupees from previous target price of 125 rupees. BPCL also cut to 240 rupees from previous 300 rupees, and target price for HPCL cut to 235 rupees from previous 335 rupees. Now let's move on to the paint sector. Now obviously raw materials again have gone up here as well. So Macquarie has written a note that given that Berger and Kansai have announced a 2 to 3% price hike, Berger has also indicated that they would take a phase 2 of price hikes that could come in April as well. This is going to be the one they've taken, will be in effect from 25th of March. So on the back of this, there is a certain concern that comes in terms of the headwinds on the margins of these companies. As of now, Asian Paints are maintaining their overweight rating, target price is 3,100. Berger Paints underperformed rating, target price is 410, while Kansai they're maintaining the neutral rating, target price is 220 rupees per share.
Vinny, now that you have mentioned all of these sectors, also highlight a couple of more for us. Cement, industrials, food delivery. What are brokerages saying here?
So absolutely, for cement also the concern is the same, right? Raw material prices are increasing, crude prices are increasing. Now, JP Morgan has done a dealer's check, which is highlighting that some of the price hikes, which are taken mostly, are in the non-trade segment. Weaker than expected demand is also given in the month of March is expected. So maybe usually it's a very strong month for cement volumes, but that is something that they are keeping an eye out on. And given that the prices haven't seen much of a hike so far, demand is a concern that they are keeping an eye out on. Q4 expectations maybe could be a miss for these cement companies. So they're maintaining their cautious stance on the sector, with Ultratech is the only one where they're maintaining an overweight rating. Goldman Sachs similarly, they're maintaining and staying with the buy rating that they have on Ultratech, neutral rating on Shree Cement, Dalmia as well as Ambuja, and JSW Steel as well, and a sell rating on ACC. Now that's about the cement sector. Industrials, that's mainly the pipe segment that we're talking about. Raw material availability is a concern. Slowdown in terms of demand, that's a concern. So in terms the risk that comes in terms of margins, higher oil prices also impacts in terms of the overall performance, and PVC prices also seeing an increase. That's a concern. So overall, still they're saying that pipes could be still a net beneficiary versus other industrials, and the risk reward in cables is turning favorable now is what they are highlighting, despite potential of a near-term challenge that one could see coming in. So they're still positive on the industrial side. Apart from that, when you talk about food delivery apps, we've spoken about those LPG shortages, restaurants, if they shut down, then it becomes a concern for them if this persists, or if there's a major concern on that front. So on the back of that, Kotak Institutional Equities is saying that if this continues, the month-long disruption continues, then there could be an adverse impact that could come in for Swiggy as well as Zomato. So that's the concern that they're highlighting there, and these are some of the stocks that they're concerned about.
All right, take that point. Thanks a lot, Vinny, for that. We'll, take a short break on that. On the other side, we'll get you the latest on all things Trump.
Welcome back. Getting you the latest on the Trump-related developments now. Speaking to reporters at the White House, Trump offered an optimistic but vague timeline for the end of the conflict, which is already in its third week. Trump also addressed Iran's retaliatory attacks across West Asia, saying that intelligence officials did not anticipate such attacks. Listen in.
British experts, nobody thought they were going to hit. They were, I wouldn't say friendly countries, they were like neutral. They lived with them for years. Peter, they were going to take over the Middle East. They were going to knock out Israel with their nuclear weapon. But after we knocked out their nuclear potential weapon, they started building missiles, thousands and thousands of missiles. And they were going to do it with missiles while they developed. These are sick people. While they developed nuclear, somehow they were going to start at a different site, because that site was, you saw the site, the mountain. They were going to go into a certain area, which we know exactly where it is, and they were going to do that. And it's incredible what we've done.
Right-hand President Donald Trump has also reiterated his appeals for help from another nation, or in fact all the other nations, to secure the Strait of Hormuz, saying that Iran was nearly obliterated even as the war keeps rolling, and oil markets as well as global shipping need to be helped. The President expressed his frustration with other nations that have so far publicly been non-committal on his calls to help ensure vessels can transit that strait. Listen in.
We strongly encourage the other nations to get involved with us and get involved quickly and with great enthusiasm. I have that from a number of them, and I'd like to say their names, but frankly, I don't know if they would want me to or not, because maybe they don't want to be targeted. But I say, wouldn't matter if you're targeted or not, because this is a paper tiger that we're dealing with now. It wasn't a paper tiger 2 weeks ago. It's a paper tiger now.
Commenting on his visit to China, Donald Trump said that he had requested China a delay in the summit with his Chinese counterpart Xi Jinping for about a month, citing the need to oversee the Iran war.
All right, and the U.S. Treasury Secretary Scott Bessent has told CNBC that more and more ships are now going through the Strait of Hormuz. Listen to that as well.
We are seeing more and more the fuel ships start to go through. The Iranian ships have been getting out already, and we've let that happen to supply the rest of the world. We've seen Indian ships go out now, so the Indians who rely very heavily on Gulf oil. We believe some Chinese ships have gone out. So that should start ramping up before there are any the flotillas or protective armadas in the Gulf. So we think that there will be a natural opening that the Iranians are letting out, and for now we're fine with that. We want the world to be well supplied.
Okay, that's all the Trump action, and we'll wrap up on that note. It's a goodbye from Mangalam Hormaz and me, but stay with us. More market action will come up next with Halftime Report.
Markets off morning highs. The Sensex and the Nifty see a volatile session, currently trading near the flat line. Metals and autos are the prominent gainers, while IT, FMCG and PSU banks drag.
Reliance Industries has inked a 15-year green ammonia supply deal with Samsung C&T valued at over $3 billion. The agreement sets a new benchmark, with India emerging as an exporter of indigenously produced green fuel.
The Appellate Tribunal for Electricity has dismissed BEST's appeal against rollout of parallel distribution licenses in Maharashtra. A likely passage of the bill in the monsoon session can spell big opportunities for private players.
Sources tell CNBC TV 18 that Fino Payments Bank's small finance bank license is not at risk, as no irregularities were found during RBI's rigorous checks before giving the nod. Bankers also believe the CEO may get a clean chit. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a session which is quite choppy if you have to see an intraday chart. So we have the Nifty, which is currently just about higher by around 18 odd points. Remember, the high point of the day today was 23,577. So we've managed to scale back from those highs today. What also stands out is the Bank Nifty and the volatility that we've seen really in the Bank Nifty. So currently down around 52 odd points. It's been very jagged in terms of the Bank Nifty. And as you can see, just about lower at this point in time. Nifty IT seems to be the big pain point in today's trading session. So we're not seeing much of a recovery there. So down around 1% currently for the Nifty IT index. Overall, let's see how the second half pans out. At this point in time, the Nifty just about holding with a gain of around 18 odd points and the mid caps up around 150 odd points. Hi, girls.
Hey, good afternoon. And you spoke about Nifty IT. That has been one of the laggards. But if we talk about Nifty Metals, that was the laggard in the last couple of trading sessions. It is seeing a pickup today. So that index is the top gainer. The Nifty, yes, down around 160 points from the highs of the day. Absolutely flat with some positive bias. We do have the auto index also, which is making a comeback after those cuts that we saw last week. In fact, the auto index is down around 10% this month itself. Since the time the war has started, we have been talking about the issues that the energy supplies has had on this particular space. PSU banking index, FMCG, which was one of the gainers or at least resilient in a weak market, is losing today. So overall, it continues to be volatile. But we do have the mid-cap index, which was a big laggard yesterday, making a comeback.
Absolutely. That's at least making some bit of a comeback here today in the trading session. While volatility is obviously something that we're keeping an eye on, given that it's the weekly expiry, mid-cap right now is slightly better than what the benchmark indices are doing. Look at the Nifty mid-cap, it's holding out to 0.3% of gains. Also pull up the Nifty small cap as well. That also is managing to see a bit of a better performance versus the benchmark indices. Advanced decline ratio, let's look at that as well, right? Seems like it would be more in the favor of advances versus declines in the trading session. Now that line is, the gap that was there between both of them, that's reducing. So advanced decline ratio as of now surely in the favor of advances versus declines.
Okay, all right. So let's
add just important news, which, we should highlight, is where Zydus and Lupin have signed a pact to go market semaglutide in India, which is basically the generic version of Ozempic and Wegovy. So as the date for semaglutide becoming generic, which is on this Saturday, comes closer, you are going to see a lot of these marketing tie-ups come through. But these are two big heavyweight companies which have come together to market this particular drug, which is Zydus and Lupin. So interesting times which have come in. Let's see what they sell it at, considering that, it is possibly going to be a price reduction of 50 to 70% eventually. And maybe even on the first day, we're going to see a huge price reduction once the generics do step in. So interesting times coming in where Zydus and Lupin, the big heavyweights, have come together to co-market what is going to be a very sought after space eventually.
Okay, all right. So we'll watch out for that. But let's tell you what we have on the show today. We put spotlight on the pharma sector in our What's Trending segment amid the ongoing West Asia tensions. We'll also be speaking with the management of Electronics Mart 2012-15 on the demand trends seen in consumer durables. And in our special segment, Manisha will put the spotlight on cryptocurrencies with Lucy Guzmararian of Token Bay Capital.
Okay, and in our What's Trending segment, we continue to track the West Asia war with tensions around the Strait of Hormuz keeping oil prices on the boil and disrupting supply chains globally. Today, we focus on the pharmaceutical sector. What's the impact here and whether it is beginning to feel the heat? Ekta, could you narrow that down for us as well? We've spoken about across sectors, but in pharma, where is the impact that we're seeing now?
Well, 90 to 99% of pharma feedstocks are linked to petrochemicals or crude. So that's how important crude is to the pharmaceutical space. Now, India, remember, supplies around 20% of global generics and 40 to 50% of the US demand when it comes to generic drugs. India is also very closely linked to API imports. So, for example, we imported APIs worth around 39,000 crores in FY25 and 74% was sourced from China. 40% of India's crude imports, remember, come via the Strait of Hormuz. Now, what we are seeing when it comes to the pharmaceutical space is that air freights have risen by around 15 to 30% already. There are transit delays on when it comes to shipping, which is already, around 10 to 20 days in terms of transit delays is what we are seeing. And that impacts cold chain supplies as well. Now, energy itself is around 20 to 25% of API manufacturing costs. Container costs are up around 2 to 3 times. Input costs such as packaging, etc., have risen around 10 to 15%, say industry watchers. Now, there are early shortages which are also being seen in the inputs which go into key drugs such as ibuprofen, which is a painkiller, which is called IBB. So there are already some amount of shortages that companies are talking about when it comes to this key input. The industry, however, says that as of now, there's no immediate shortage. 2 to 3 months of raw material inventory is what companies have at this point in time. They also have 3 to 6 months of finished stock. Global distributors themselves operate with 30 to 60 days of supply. And remember that if in case this kind of disruption continues, then generic drugs are possibly going to have some kind of disruption or shortages which will be seen. What happens in the US markets, which gets 90% of its prescriptions from generic drugs, is something that the street will watch out for, and 50% or 40-50% is supplied by the Indian markets itself. If in case this disruption continues, then you are talking about, a scenario where there could be some amount of margin compression, price rises, selective supply delays. But that is something that the street will wait and watch. As of now, what we do know is that there are some early shortages seen, but as of now, there is enough inventory which is built up for most of the companies. Maybe the smaller companies could possibly be more impacted. But just want to point out that the Nifty Pharma Index itself, as compared to the other indices, has been quite resilient both on a month-to-date basis as well as on a year-to-date basis. So as you can see, the Nifty Pharma Index is just about flat on a year-to-date basis as compared to all of the other indices except for maybe the Nifty Metals Pact. But we do have Sudarshan Jain, who is the Secretary General at the Indian Pharmaceutical Alliance, joining in to discuss this. Mr. Jain, thank you very much for taking the time out. Well, the key question is that are our exports getting disrupted in any way, considering that we are the largest supplier of generic drugs to the US as well as Europe? And at this point in time, are any kind of supplies being disrupted?
Thank you very much, Ekta, for bringing the context and setting the context. As you rightly said, that there are 3 factors which are impacted because of this situation. One is the energy cost, which has got bearing because many of the pharma products depend on petroleum-based products. Second is the freight cost. And the third is the delayed supply. We have a good track record of managing these issues, and Indian pharma companies demonstrated consistent supplies during the COVID period. COVID lasted for a long period of time, but Indian pharma industry has got a tremendous track record of consistent supplies. Also, I'd like to assure everyone here is that the prices, despite the fact that they are going up, all the pharma companies at the moment have got the inventory of 3 to 6 months. But over a period of time, if the crisis lasts for a longer period of time, it will start impacting, because as Ekta rightly pointed out, that energy cost has gone up 40%, freight cost has gone up around 1.5 to 1.6 times, and there's a delayed supply. So it will have an impact if the crisis continues over a period of time.
Mr. Jain, energy costs and the hike has actually impacted the entire value chain, be it pharma, be it chemicals. And I've had those conversations with energy companies as well. The situation is so uncertain, it is difficult to figure out what next. But in a situation like this, what do you think the next step by the companies could be? The higher price that is coming in on the side of raw materials, are you passing it on to customers, or are there delays in supplies to the customers that is coming by? How is it impacting the business overall?
So I would like to point it out from a industry point of view that we can't take price increases. Prices are governed by the government of India. So even if the price increase is there of the raw materials, it has to be absorbed by the companies. So I would like to assure the patients that the likely price increase from patient point of view will not be there. More important is the consistent availability of medicine. And one of the reasons is, yes, you rightly said that energy and has got a lot of impact on the overall thing. So some of the suggestions which we are seeing, and we are working very closely with the Government of India, Commerce Ministry, Department of Pharmaceuticals, we are saying that medicine should be treated as an essential commodity, and there should be preference for the supplies of LPG and all energy products. We are also requesting the government that if we can have conversation with the Iranian government as well as Qatar and other places, that there should be immunity granted for energy product supplies as far as India is concerned. Good point is that 2 ships have been released, and the same conversation should be continued that given medicines are important, some of the solvents are very important, there should be immunity granted as far as those supplies are concerned. Some early wins in that area, and I think that conversation should continue because medicines will impact all over the world. Medicine is important. Healthcare security is important. And healthcare security is impacting everyone in the world. So very important point. And India has shown that record over a period of time.
So, Mr. Jain, right.
Yeah.
Just wanted to sort of come in on that. I'm a little confused in terms of what takes place when it comes to intermediates and APIs, because they are imported majority into India at this point in time. Are there any kind of disruptions which are taking place when it comes to intermediate supplies, API supplies and imports into the country, which will then eventually impact the final product which is manufactured in the country?
At this particular moment, and our experience during COVID times indicates that there will be volatility in the prices of those products. Even the intermediate prices will go up. There may be delay in the supplies. Delay in the supplies we will take care because of the inventory what we have. We have 3 to 4 months, 5 months inventory. And companies are preparing to further increase the inventory and take care of the supply. But what is required at this particular moment is that we continue maintaining 4 to 5 months inventory, even if there is a higher cost. So in the short-term period, there will be compression of margin. But in the long term, what is important, that consistent supplies of medicine is very important.
Sir, are there any smaller companies, exports, which are already being impacted here? Inventory, you said 4 to 5 months inventory normally should be maintained. But any smaller companies which are facing issues recently?
There may be some smaller companies which is bound to face issues. And in this kind of situation, when there is a war, there will be some people who will be hoarding it. Some people will be increasing the prices. There is a psychological fear which takes place. But the good point is we have experienced this. We have shown it in practice during COVID times. And we are committed, the Indian industry is committed, given the fact that we supply 20% of the world demand, 50% of generic supplies in the US, that consistent supply, consistent track record of supply is very, very important. In the short period, beyond margin, consistency of supply is fundamental.
Okay, all right, Mr. Jain. We'll keep coming back to you because I think this is definitely a story which will keep changing based on what the disruption scenario looks like when it comes to oil. Thanks very much for joining in and giving us all of that clarity. So as of now, inventories are built up to the tune of at least a couple of months, and hence maybe there won't be any kind of disruption except when it comes to, say, prices as well as maybe logistics. We'll take a short break, but we'll connect with the management of Electronics Mart on demand trends in consumer durables. Stay tuned.
Welcome back. You're still tuned into Halftime Report. Let's get in a corporate conversation going now. Premchand Devarakonda, who's the CFO at Electronics Mart, is joining us now, and we'll discuss a lot that's happening in the economy. Of course, the demand impact on microwave and induction cooktop, is the demand rising there for ACs and cooling products as well, and the inventory status for fast-selling products. Mr. Devarakonda, good afternoon. Thank you so much for joining in. The conversation recently has been about the rising demand for induction cooktops, microwaves. Have you seen that impact on your business? How much higher is the demand? What is the contribution from these products? And are you already stocking out? Because that's been the conversation on ground.
Yeah, good afternoon and thank you very much for the opportunity. We did see decent acute spike in demand for the cooktops, mainly that induction cooktops. So as of now, we were not prepared for it. So most of the dealers as well. So we placed orders, and even the manufacturer were also not ready to meet these demand requirements. So that's why, as far as the cooktops is concerned, it will take some more time to get the supplies in place, and then we'll be in a position to cater to the demands of the consumers.
Okay. Sir,
hopefully before that war ends.
Okay. Sir, so as of now, you're completely sold out in most of your stores in terms of the cooktops, and now you're still manufacturing more. How much time does that take also to fill the gap?
See, we don't manufacture, we are just dealers. Yeah. I think there is, in some stores, there is stock out situation, but it's only panic created in the market. So that's the reason why there is demand for this product. But it may not last long because now even the government has taken appropriate measures to make sure the LPG supply is in place very soon.
So, Mr. Premchand, just to put it into perspective, how much of your sales actually come from these induction stove tops as well as, say, microwaves? And hence, how much can you see in terms of an incremental contribution because of this one-time increase that you've seen in your quarter, in your upcoming quarter?
Historically, it is not significant. Of course, microwave has a decent contribution, say 2% of our top line. When it comes to induction stoves, I think there is not much demand because most of these products are sold online. That's the reason why actually people don't walk into stores to buy the induction cooktops. Otherwise, I think in our case, it is insignificant.
Okay, I get that point. So this is insignificant for you. So the rise in demand that we are seeing will not have a bigger positive impact as it is seeing on other electronic consumer durable companies. So let's stick to what you do sell. What is the proportion of sales which come in from ACs, cooling products? Because inquiries are increasing. We are seeing an early summer as well. Are you seeing that in your demand as well?
It is quite evident that this summer is going to be very hot. And also we have seen the trend over the last 15 days of this month. So the AC sale demand has gone up by almost 25%. Hopefully that same demand continues. But unfortunately, there was rain alert in Telangana state. So that is expected sometime in the next week. Otherwise, I think this summer is going to be hotter. And since the base is very low, we can expect at least 25% growth in the air conditioner sales.
And what is our case, what is the contribution?
Yeah, in our case, historically it is 15%, but last year summer was very bad. As a result, actually, that AC sale contribution dropped down to 11%. So, and historically it is 15%. I think we can come back to the same proportion this year.
Mr. Premchand, just wanted to understand what you're anticipating in terms of same-store sales growth then for this quarter, because you've seen this one-time sales increase, you're seeing cooling products as well, which will come into the mix. But overall, we do have, maybe a sentiment which might be a little impacted at this point in time because of the disruptions and the Iran war. Same-store sales growth for you, what might it be in terms of Q4 and what you might end the year with For 9 months, I think it was just about higher by around 0.2%.
See, this quarter was very good. As of now, like touch wood, everything is in place. And see, in all categories, we did witness decent double-digit growth. So ultimately, it will get translated to same-store sales growth. It's going to be more than 6% for this quarter. For the year anyway, because of the loss of air conditioner sale, we may not see the similar SSG. But for this quarter, definitely it will be an encouraging same-store sales growth.
Okay, encouraging same-store sales growth, maybe 6% plus is what we are keeping an eye out on. So, obviously in terms of contribution for large appliances, right, that has come down somewhere in FY19. It was at one point of time 61%, and now around it's at 43%. How does that mix also change? Do you see that moving again to that 60% range for large appliances, or is this an ideal mix that we're keeping an eye out on now?
See, of late, what is happening, the mobile sale has been increasing year on year. So there is decent double-digit growth year on year in the mobiles category. As a result, that our sales mix mainly for these large appliances, it has come down to 50%. I think if we maintain that 50%, and that is good enough for us.
And that margin profile, what's the difference between large appliance margin profile as well as small appliances or mobile phones? And this time, smaller appliances are also going to be higher in terms of sales, given this one-offs that we're seeing.
See, mobile always have the high single-digit margin contribution. So only the margin contributors are the other appliances, like large appliances as well as small appliances. I think that trend will continue in future.
Take that point, Mr. Devarakonda. Thank you so much for joining us with your thoughts and the outlook on demand going forward, specifically for some products which are seeing increased demand because of the West Asia war and some concerns around gas shortages as well. But time for a break now. Sachitana Nutekar of Trade Bulls will join in with some trading strategies on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 23,400, just flip-flopping around that level, right, between the red and the green right now. So we'll watch out for where the Nifty is going to be headed. But let's understand what's going to be happening in the world of FNO. What's the setup looking like as of now, given that it's the Nifty weekly expiry as well? Mangalam is at the FNO desk to take us through all of that. Afternoon, Mangalam.
Afternoon. So you said that the market's been flip-flopping around that 23,400 mark, and that's exactly what the market has been doing. If you look at, the intraday chart of either the Nifty or the Nifty Bank or the mid-cap index, it has been fairly volatile, a double hump sort of structure that has taken place today. Twice the market's moved towards that 25,550, 25,600 sort of mark, and it's seen some sort of supply out there, but at lower levels it is finding support as well. A couple of data points that tell you that the market may have begun consolidating after that up move that we saw yesterday is the advanced decline ratio. So if you look at the advanced decline ratio, it started the day with a fair number of stocks outperforming versus the number of stocks which were underperforming, and then that distance was a lot more. At one point we had 2,000 stocks in the green for about 1,000 stocks in the red, and now as we speak those lines are fairly close to each other, almost an equal number of stocks advancing versus the number of stocks which are declining. We are seeing amidst all of this some pockets doing extremely well. Platform companies are one of them. The top gainer on the Nifty is Eternal. After that big cut that we saw in the last 10 days, Eternal, Swiggy are bouncing back, and then we also in the cash market have Meesho and Lenskart seeing some purchase, so we'll monitor this back as it moves forward. But ahead of expiry, because the market has been flip-flopping around that 23,400 mark, put the 23,400 call and the 23,400 put come up for you on the screen. The 23,400 call has seen a fair amount of writing, and the 23,400 put as well has seen an equal number of positions being added, and these are options that expire this afternoon itself. So 100-150 rupees sort of range around 23,400 is what the street is playing for. So if you look at it at the lower level, it is 23,250 thereabouts where the support comes in, and around 23,550 is where the resistance comes in as well. So this 300-point range between 23,250 to 23,550 is where the expiry is likely to be. Amidst all of this, IT stocks, a couple of names like Coforge and Persistent are seeing a lot of short positions being added, and a bunch of these stocks like SRF, Torrent Power, Fortis are mildly higher in today's trading session with a lot more open interest jump, telling you that some long positions are being formed out there as well.
Okay, all right, Mangalam. Thanks very much for that. So that's what's taking place in the entire FNO space. But let's get full tilt on the markets. We have Sachitanan Utikar joining in to tell us what he's tracking technically today. Sachitanan, well, it's definitely a volatile market. Just wanted to start by asking you about how you're approaching a lot of these banks in today's trading session, because now we have the Bank Nifty, which is down around 0.2%. It's been quite a choppy index.
Good afternoon, Ekta. I think what we are observing here is that both the Nifty and the Nifty Bank are still in a lower top, low bottom sequence. Both are still trending confidently below their 5-day exponential moving average. If you look at today's session itself, I think it's a very significant development on the Nifty, where it did scale towards that 23,555 mark, 570 mark. And it has again, started blending with the major trend. So I think it's very important for both the indices to establish a close above these particular levels, and then probably we can, think about a pullback rally. But as of now, when we look at Nifty Bank and Nifty, the major trend still remains weak. We have already seen a good, pullback because of an oversold condition. Wherein the Nifty has scaled higher by around 600 points. But if you look at the data, I think we are still in that low top, low bottom sequence, and we may see the Nifty again, escalating lower. From a trading perspective, we are positioned for a move towards 23,140. From an intraday perspective, even we are expecting that the expiry could be somewhere close to around 23,280, 300 kind of a zone. When we look at Nifty Bank, the resistance is far clear at around 54,800. Unless we don't see a closing about the same, the major trend still remains weak. So any move towards, say, 54,500, 54,450, I think it will be a good opportunity to create fresh short positions. Even here, we are expecting that the Nifty Bank may again tilt lower towards 54,000, 53,500 zone. So I think it's a classic, sequence which is progressing well. We did have a very extreme oversold condition, but we have seen a bounce back which looks very temporary, and that's why we believe that
that it's better to be on the short side.
Take that point. So better to be on the short side. If you can quickly tell us what are your individual technical picks?
Good afternoon, Sunil. Sunil, the first stock which we have also recommended to our clients is the short call on Lodha. The overall structure has been weak. We have seen a fresh breakdown from a bearish flag formation. The positioning has been right. We are expecting that the 800 support might also be at threat. We may see us move towards 770, and that's why we are recommending building fresh short positions in Lodha, keeping a stop loss at around 862 on closing basis. The second stock is persistent. Now, if you look at the overall development, it is still in a severe downtrend. We did see some bouts of a pullback, reconfirming that support at around 4,500. But if you look at the overall development, it looks like a classic breakdown. We are expecting further weakness in this particular counter unless we don't see a close above 45.80. The trend still remains weak, and hence we are recommending building fresh short positions in persistent systems, keeping a stop loss at 4,580 on closing basis. We may see a swing towards 43.60, eventually turning towards 4,200.
Okay, Sachit, thank you so much for joining us this afternoon, talking to us about the markets as well as your individual stock picks as well. But on that note, we're going to slip into a very short break. After the break, Manisha Gupta will join us. We'll be putting the spotlight on cryptocurrencies as well. Stay tuned in for that conversation.
Welcome back. Joining us now is Lucy Garmiranian of Token Bay Capital. Lucy, hi, thank you so much for joining in. And what an uptick that we've seen across crypto as a sector. Bitcoin is back above 75,000, almost 25% up from the kind of lows that it saw in the month of Feb. And that's exactly what we're looking at for various other altcoins as well. Where do you see, first of all, the support coming from?
I want to be really optimistic, and obviously the rally that we've had, obviously very welcome. It's been a pretty brutal, 4 or 5 months since the markets have steadily sort of grinded down after the October highs. If this is a turnaround in Bitcoin, in Ethereum, and if it is the start of the altcoins beginning to see some strength and rally, then it would be the shortest bear market in history. So I think we have to exercise a bit of caution with this, sort of bear market rally that we've seen in the last few days, which is very welcome, healthy that we're getting this action. But I think we need to see, Bitcoin probably trade around the 80K level with a lot of strength. And meet resistance of sort of 74K. So if that plays out, maybe this will be the shortest bear market on history, but I think exercise caution. We could see another leg lower. Bitcoin will obviously lead the market. So I think be aware, don't get too euphoric at this point, even though the moves have been great.
All right, take that caution, nice. Lucy, how are you looking at the kind of money that seems to be coming back in here? Because when you look at the overall market, it really is derivative-led, or the buying that we've seen come back in case of ETFs.
Yeah, I think, the big excitement on the ETF front was we had the launch of BlackRock's ETH ETF that offers a staking yield to investors. So that's obviously very welcome. The existing ETH ETF that they had did not pay out that staking yield to investors. And I think for institutional investors who do their homework and understand that there is a very compelling yield associated with making an ETH investment, this will really sort of help them to start moving, dollar cost averaging into the market because we're probably about halfway through this bear market. So we've got the staking ETH ETF, and I think that's the big news of this month.
Markets also seem to be looking at the US Fed monetary policy meeting with an expectation that there would not be a rate change. But the comments, of course, could lead the markets either ways. What would you be watching out from the crypto as a segment from this meeting?
I think it's got the potential to take the shine off the recent rally in the last few days. Very likely the Fed is going to be more on the hawkish side, given where oil prices are trading, inflation concerns, and general geopolitical instability at the moment. So it could surprise to the upside, but I'm expecting that actually they're going to maintain a rather hawkish stance. If they start hinting at some rate cuts later in 2026, that would be very welcome. But I'm expecting not too much from the meeting tomorrow.
The other trend that we've seen, Lucy, is the commodities and crypto come together in some sense. The oil coin did quite well. The gold-bagged tokens did quite well as well in sense of trade, in sense of buying from some of these platforms. Would you say that the utility coins and the real-world asset classes seem to be continuing to do well?
Yes, I think the whole real-world asset theme is something that traditional investors can really understand. When we were talking about crypto and Web3 and these sort of consensus mechanism tokens, so these native tokens that were driving any number of different blockchains, was a difficult narrative for investors, traditional investors, to really get their head around. What was powering the value of these tokens? A lot of criticism that it was just driven by speculation and effectively gambling when you're looking at the more esoteric crypto tokens. But now that we see real-world assets that investors can understand being tokenized and moving on blockchains, that's going to be an enormous trend going forwards. And we've seen pretty much broad acceptance of that theme now. I mean, we've got the national stock exchanges making big moves in stock tokenization. And obviously looking at the gold tokens have done incredibly well. Again, a much simpler narrative that investors can get their head around. At a time of uncertainty, they seem to be going for assets they already know and understand. So expecting real-world asset tokenization to be a really big theme going forwards. And, rightly so, the majority of the world's value is captured in real-world assets. So crypto, more esoteric tokens still have a place for experimentation and really seeing how these blockchains and different sort of network states coordinate and work. But real-world assets are very interesting, particularly when coupled with the broad move for fiat currencies to move on blockchains as well. So the stablecoin explosion that we've seen in the US dollar, we can now start to expect other currencies to start having stable coins. For example, the Hong Kong dollar is soon to have licensed participants moving the Hong Kong dollar chain, and that's going to be driven by big institutions. HSBC and Standard Chartered are getting in on the Hong Kong dollar stablecoin game with licenses.
Okay, take that point, Lucy. Interesting times. We've been talking about the war so much. There's quietly, Bitcoin has taken it to a 6-week high figure. Manisha, thank you so much for joining us with this conversation, taking us through that. So that's all about cryptocurrencies, but we'll slip into a short break now. When we come back, we'll talk about more markets and a lot of stocks which are buzzing around in trade.
Welcome back. Still tuned into a halftime report on CNBC TV 18. We have Vivek now joining in to tell us about all the stocks which are moving around in trade today. Vivek, over to you.
Well, a very volatile trading session. You first saw the initial recovery sold into, but once again, there's been a brief attempt at a rebound. Individual stock sectors that we're tracking, first on the list, a couple of smaller defense companies doing very well in the session. Data Patterns, Tech, both of these stocks have been on a tear, especially in this particular week. Aluminium stocks, both Hindalco as well as Nalco, after the initial red that you saw on the screen, both of these stocks have recovered quite sharply. Nalco up almost 4.5%. Oberoi Realty is the other stock, cooled off a little bit from the day's highest point, but getting development rights to a very large land parcel in Andheri West. Analysts estimate close to 17.2 lakh square feet is the kind of development rights that the company will be able to sell. The other stock on the radar is Chennai Petro. That particular stock yesterday saw a very strong up move. Today higher by another 6% on very good volumes. And the entire power equipment, renewable energy space, all of these stocks continue to see higher moves. Tata Power, NLC India, Wari as well as Premier, all of these stocks doing quite well in the session. On the other hand, quite a few laggards as well. Poonawalla FinCorp, the top mid-cap laggard. Bandhan Bank yesterday was down almost 10%. Today has seen further selling pressure. Reddington, news flow regarding operations restricted at Gulf, that particular stock under pressure as well. And IT stocks, especially the mid-cap IT names, you did see significant selling pressure come across Persistent, Coforge, Wipro. And lastly, all of the OMCs, again in the last 1 hour, have slipped to the day's lowest point.
Okay, Vivek, thank you so much for that. But on that note, we're going to slip into a very short break. We'll come back and put the spotlight on MOIL. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. The Nifty again has moved back about the 23,400 mark, up 55 points in the trading session as of now. But we're putting the spotlight on MOIL, that is buzzing in trade as the company has highlighted some robust outlook for 2030. Nigel is joining us to give us more details on this one. Nigel, over to you.
Well, MOIL is guiding for very, very good times in the times to come. My only caution that I'll tell our viewers is they've done this in the past as well. So achieving this guidance is going to be very, very important. To run you through the basic numbers first, the production numbers that they're looking at, in FY21, they actually did only around 1.1 million tons. In the past year, they did close to around 1.8 million tons. And for this year, that is FY26, which will end in the next few days, they are talking about 2.35 million tons. So effectively, 1.8 is going to become 2.35 million tons going by their production guidance. The surprise element is that at the 9-month mark, they've done only around 1.4 million tons, which means that for Q4, they'll have to do around 0.9 million tons to actually get to that number of around 2.35 million tons, which is going to be substantial. To give you a reference point, in Q3, they mined less than 500,000 tons. So effectively, they are talking about Q4 production number being double of what they did in Q3. And that's how they're coming to that number of around 2.35 million tons. They don't stop there. They're saying that in the years to come, that is by 2030, they're looking at the production go to around 3.5 million tons. So the street clearly is excited with this very, very ambitious guidance. Achieving it, though, is going to be very, very important. And going by past instances, the street will still be a little bit cautious whether or not they can achieve even to this 2.35 million tons. So we'll have to wait by for what they record. But otherwise, deriving it, it looks like they're bracing for a very strong showing in terms of production for Q4 at around 0.9 million tons. And they're also talking about increasing their market share from around 20% to around 32%. So clearly, a bit of a booster shot coming in for MOIL.
Okay, all right, Nigel. Thanks very much for that. So as you can see, MOIL is up around 4%. And for the markets, there's been a bit of a recovery which has taken place. So let's see whether that sustains. Need to wrap up on Halftime Report. Business Lunch up next. Thanks for watching.
Markets are volatile ahead of the weekly expiry. Today, the Sensex and the Nifty have come off morning highs and are now seeing some buying at lower levels. Metals and autos are the prominent gainers, while IT, FMCG and PSU banks are the big drags. Reliance Industries has inked a 15-year green ammonia supply deal with Samsung C&T valued at over $3 billion. The agreement sets a new benchmark, with India emerging as an exporter of indigenously produced green fuel. The Appellate Tribunal for Electricity has dismissed BEST's appeal against the rollout of parallel distribution licenses in Maharashtra. A likely passage of the bill in the monsoon session can spell big opportunities for private players. Sources tell CNBC TV 18 that Fino Payments Bank's small finance bank license is not at risk, as no irregularities were found during RBI's rigorous checks before giving them the nod. Bankers also believe that the CEO may get a clean chit. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormas Fatakia. Let's take a look at how the markets are doing this afternoon, and it's been an extremely topsy-turvy session for the index. Every time there has been a recovery, it has gotten sold into, and once that recovery gets sold into, there is some buying that emerges at lower levels. So the trend, the range for the day has been a very narrow 200 odd points. The Nifty now back at that 23,500 mark as we speak. So 80 points higher on the index. Have been very swift. The moves, we've seen 30, 40, 50 point moves in just a matter of minutes. And that's on both sides, whether it be on the upside or it be on the downside. Look at the Nifty Bank. At one point, the Nifty Bank was down almost 200 points during the day a couple of hours ago. And the Nifty Bank is now up almost 150. And the Nifty and the Nifty Bank have been moving in tandem because of what has happened here. And mind you, of course, today being the weekly expiry of the index as well. And there you see the Nifty, when we started the show, was up 80 points. Now it's up 100. So point moves being very sharp on the upside and on the downside as well. Look at the broader markets, and even as the Nifty and the Nifty Bank had recovered in yesterday's session, the broader markets didn't do really well. Today, well, a similar picture, if not better, moving in tandem with the benchmarks, 0.5% higher for the mid-cap index, and that too has been equally choppy, if not more. Pull up the India Wix, that'll give you an idea of how the volatility has been, as a lot of the analysts were also highlighting. It has not made new highs. Now the Wix is at the lows of the day, or nearing the lows of the day now, 6.5% lower at still above levels of 20. But the one big announcement that Reliance Industries made last evening was the signing of that 15-year landmark agreement with Samsung C&T for the supply of green ammonia. Sonal is here with more details on this. Sonal.
Well, yes, it is a strategic announcement which is made by Reliance Industries, an important one at that. No immediate financial impact, but it is a long-term strategy. So if you take you through the news, Reliance has signed a $30 billion green ammonia offtake with Samsung C&T Group. It will begin from second half of calendar year 2029 for a period of 15 years. As I said, this will provide long-term visibility for Reliance's upcoming green hydrogen and ammonia platform as well. There is no immediate financial impact that we will see, but they do have an investment here, and they are seeing some customers which will come by in the new energy business as well. ICICI Securities says that this validates Reliance Industries' integrated green hydrogen approach, and it can create an anchor demand for hydrogen as well. Now, do remember they had announced this massive capex for their gigafactory, which will have the entire supply chain for new energy, and this is a step in that direction. This will give more confidence for financing project capex, according to ICICI Securities, a significant milestone, not from a short-term period but a long-term period, where they will be providing green ammonia, which is also a step towards green energy transition that we have been talking about.
Sonal, thank you very much for that. Reliance Industries, of course, has been a fairly resilient stock as well during this prolonged Nifty sell-off that we have seen in the month of March, recovering from the lows of the day and contributing to the recovery on the Nifty as well. Now, CNBC TV 18 learns that the storm clouds above Fino Payments Bank may not be as bad as they appear. Remember, the shares took a beating on Monday as markets buzzed with speculation that the bank may soon be in for more trouble, this time with the Enforcement Directorate. CNBC TV 18's Furqan Moharkhan has more on this. Furqan, what are you picking up?
You know, the thing that rattled the stock on Monday was the buzz that DGGI may recommend an investigation by the Enforcement Directorate into the online gaming transactions linked to the bank. While that's still in the air, what we have picked up from the sources is that the arrest of the Fino Payments Bank CEO Rishi Gupta under the GST Act is not likely to have any material impact on the bank itself, especially its banking license, so that business will not be hurt directly. In addition, sources say that the Reserve Bank of India is not likely to ask Gupta to step aside unless it's proven that he is guilty of the allegations leveled against him. We are also picking up that the large portion of industry believes that the allegations against Gupta may not hold water. The argument a couple of veteran industry players made was that such things are hard to miss when the RBI runs its fit and proper criteria test on the candidates who are running for the post like that of Gupta's. Also remember that in December 2025, Fino Payments Bank got its in-principle approval from the Reserve Bank of India to transition into a small finance bank. Now this will help the bank set up a lending practice which Payments Bank could not do. And also we are picking up that this latest string of controversies surrounding the bank will not affect this process. The fact that the Payments Bank got this license is also being seen as an indication that the Reserve Bank of India has clearly not found any systemic issue with the Fino Payments Bank. We have also learned that the Indian Bankers Association, which is an industry body comprising of Indian banks and financial institutions, has written to the Finance Ministry seeking clarity on the matter. So we'll have to wait and see if there is any response from that, and of course how other things in this matter finally pan out. Back to you.
Furqan, thank you for that update there. Now remember, yesterday Fino Payments Bank had clarified on the exchanges that the DGGI probe relates to program managers and merchants associated with multiple banks. The stock though has recovered from the lows of the day, but still significantly below its issue price, down almost 40% in the last 1 month. Take a short break. On the other side, we get you the latest updates from West Asia. Stay tuned. Welcome back. Well, you're back near the highs of the day now. So 115 points higher on the index. 23,520 is where we currently stand. 23,577 is the high of the day. Now, the West Asia war has now intensified into one of the most volatile crises in the Middle East in recent years. Iran has launched ballistic missiles and drones targeting Israeli cities as well as US military installations across the Gulf region. Let's now go across to CNBC's Dan Murphy for all the latest updates. Dan, tell us more about the recent turn of events today.
Good morning to you from Dubai. Well, the most important, most critical piece of information we have for you right now is that the UAE has continued to come under Iranian missile and drone attacks today. In the early hours of this morning, residents here received emergency alerts on their phones as the Iranians continued to target critical infrastructure on the ground, in particular energy infrastructure. And in the last 24 hours, we have now seen 2 drone attacks on the Fujairah oil industrial zone. This is one of the UAE's most important oil facilities. What we've seen there is a fire being contained, authorities saying no one has been injured. But what this ultimately shows is that the Iranians are still seeking to target critical infrastructure and in particular disrupt energy flows as well. This also follows what was another attack on the Shah gas facility in Abu Dhabi as well. This is one of the most important gas facilities in the country too, responsible for a huge portion of domestic electricity supply. We have also learned that a fire there is being managed. Again, officials say no one has been injured, but of course this is a real concern for the UAE, which is continuing to come under attack here. At the same time as well, airspace across the country was also closed earlier today as we saw those rocket and drone intercepts continuing. What we also know is that airlines like British Airways, for example, have now cancelled flights in and out of Dubai until June, and the large international carriers are also avoiding airspace here because of the volatile backdrop that continues to impact their operations. At the same time, we also have oil prices maintaining a risk premium in this environment too, as the Strait of Hormuz remains effectively closed. The Treasury Secretary Scott Bessent telling CNBC yesterday that we are now starting to see some tankers actually manage to pass the strait. Iranian tankers first and foremost, but Indian tankers as well. And this is perhaps being viewed as a positive sign, at least for the oil traders out there who are more optimistic that we will see this vital oil choke point eventually being reopened. However, the president's call for a coalition here inside Hormuz, that is bringing international allies on board to guarantee the safety and security of those ships as they pass through the strait, appears to have fallen on deaf ears here. Not a very positive reception across Europe and Asia for the president to bring on board those allies to ensure the safety and security of those ships, with many saying that this is not their war. The UK in particular saying this is not a NATO game that will be played. So the international backdrop also very important to watch as we continue to monitor the impact on risk assets here as well. It's back over to you.
Dan, thank you for that update there live from Dubai for the latest developments taking place in West Asia. Now moving on, speaking to reporters at the White House, Donald Trump offered an optimistic but vague timeline for the end of the conflict, which is already in its 3rd week. He said that the war with Iran could end soon. Also addressed Iran's retaliatory attacks across West Asia following the February 28 US-Israeli strikes. He said that intelligence officials did not anticipate such attacks. Listen in.
Greatest experts, nobody thought they were going to hit. They were, I wouldn't say friendly countries, they were like neutral, they lived with them for years. Peter, they were going to take over the Middle East. They were going to knock out Israel with their nuclear weapon. But after we knocked out their nuclear potential weapon, they started building missiles, thousands and thousands of missiles. And they were going to do it with missiles while they developed. These are sick people. While they developed nuclear, somehow they were going to start at a different site, because that site was, you saw the site, the mountain. They were going to go into a certain area, which we know exactly where it is, and they were going to do that. And it's incredible what we've done.
Trump also reiterated his appeal for help from other nations to secure the Strait of Hormuz, saying that Iran was nearly obliterated even as the war keeps roiling oil markets and global shipping. The president expressed his frustration with other nations that have so far been publicly non-committal on his calls to help ensure vessels can transit that strait. Listening.
We strongly encourage the other nations to get involved with us and get involved quickly and with great enthusiasm. I have that from a number of them, and I'd like to say their names, but frankly, I don't know if they would want me to or not, because maybe they don't want to be targeted. But I say, wouldn't matter if you're targeted or not, because this is a paper tiger that we're dealing with now. It wasn't a paper tiger 2 weeks ago. It's a paper tiger now.
Meanwhile, the European leaders raised concerns around Trump's plan to secure the Strait of Hormuz. They said that any effort to secure the strait will not be a NATO mission. Listening.
We are working with others to come up with a credible plan for the Straits of Hormuz to ensure that we can reopen shipping and passage through the strait. Let me be clear, that won't be, and it's never been envisaged to be, a NATO mission. That'll have to be an alliance of partners, which is why we're working with partners both in Europe, in the Gulf, and with the US.
NATO is a defence alliance, not an intervention alliance. Therefore, I hope we will treat each other with the necessary respect within the alliance. We share the same goal. This Iranian regime must come to an end. It must be replaced by a democratically legitimate government. But based on all the experience we have gained in previous years and decades, bombing it into submission is, in all likelihood, not the right approach.
Any mission in the Strait of Hormuz, will need ease in tensions in the region, because at the moment, with the constant attacks, the constant Iranian attacks on our partners in the Gulf region, it will be very hard to secure the trade routes over there. So once again, as always, the Netherlands will have an open mind to any suggestion, but at the moment, there is not a concrete suggestion on the table yet.
Meanwhile, the U.S. Treasury Secretary Scott Bessent told CNBC that more and more ships are now going through the Strait of Hormuz, and many countries, including India, are using that oil. Listen in.
We are seeing more and more the fuel ships start to go through. The Iranian ships have been getting out already, and we've let that happen to supply the rest of the world. We've seen Indian ships go out now, so the Indians who rely very heavily on Gulf oil, we believe some Chinese ships have gone out. So that should start ramping up before there are any the flotillas or protective armadas in the Gulf. So we think that there will be a natural opening that the Iranians are letting out, and for now we're fine with that. We want the world to be well supplied.
As we take a short break, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV 18's all-new app, where you get instant news, breaking news updates, and financial in-depth articles right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that appears on your screens. So take a short break. Back soon on the other side. Well, just before the world turned on its head in the month of March, there was intense mutual fund activity in the month of February as well. Now, according to JM Financial, there were sectors at which the mutual fund industry was overweight in comparison to the weight on the BSE 200. And those sectors included the likes of pharma, e-commerce, consumer durables, capital goods, and agrochem and petrochem, which have now become the line of fire in the month of March. But take a look at the sectors on which they were underweight on. Now, on the underweight side, you would find private banks, you'd find oil and gas, you'd find metals, consumer staples, IT, of course, considering the hammering that it took in the month of February after the AI related meltdown. So, in these circumstances, they were underweight was the mutual fund industry. Now, if you take a look at the sectors at which they were, the inflows came into, private banks led the party here. Even if they were the industry was underweight, but the flows kept coming, especially considering the weightage. So almost 16,000 crore worth of flows in February. IT saw 12,000 crores. E-commerce saw around 8,000 crores. Flows also came in for retail and for telecom as well. But the sectors where they were seeing buying, look at the top buys here. HDFC Bank was the top buy among the private banks. The top sell was Axis. For IT, Infosys was the top buy. Wipro was the top sell. Of course, mutual funds continue to bet on Eternal despite the stock having corrected significantly from the highs of the day. There were sellers in Nykaa though. On the retail front, Vishal Megamart, one of the few successful IPOs that have still managed to hold above their IPO price. That is one, and Trent continues to see some selling from the mutual fund side, while Bharti Airtel continues to find favor within the telecom space. The selling was seen in Indus Towers among the sectors where the mutual funds were overweight. Now, take a look at the sectors where the underweight stance was and where the selling took place. PSU Banks was one where there were outflows of close to 9,000 crores. There was NBFCs, autos, metals, engineering. So all of them saw outflows of anywhere between 3,000 to 6,000 crore rupees in the month of February. Now, take a look at these sectors. SBI was the top sell within the PSU banking space for the mutual fund industry as the stock hit record highs, so they chose to book some profits here. Canara Bank was the top buy. Bajaj Finance continues to see a correction from the highs. Maruti was a top sell as well. So was Vedanta, and so was Larsen and Toubro, interestingly, and the stock is now down almost 20% in the month of March. Now, take a look at the stocks where the mutual funds bought among the Nifty constituents. Look at HDFC Bank, ICICI Bank, Infosys, Eternal, of course, seeing flows of close to 3,300 crore. The Kotak Mahindra Bank too within the list of buyers. Now, take a look at the stocks where they were selling among the mutual funds. SBI, Larsen and Toubro, Bajaj Finance, Power Grid, BEL, sell flows of anywhere between 1,500 to almost 9,000 crore rupees. Now, move that to the broader markets. PB Fintech was one stock where the mutual funds were buying in the month of February, as was BHEL, Vishal Megamart, Coforge, IndusInd Bank. All of them saw buy flows. IndusInd Bank, of course, no longer a part of the Nifty. But take a look at the stocks in the broader markets where there was selling from the mutual funds. Vedanta, APL Apollo, Godrej Properties Real Estate continues to underperform. Interestingly, BSE forms a part of the list as well, as does Aditya Birla Capital. So, mutual funds continuing to bet on a select few names, but there have been underperformers as well, including the likes of Larsen and Toubro in the month of February, much before this West Asia crisis took effect. Just before we take a leave on this edition of Business Lunch, there has been a significant recovery in the indices as well. The Nifty is now near the highs of the day, 23,540. The Nifty Bank is the one that is leading the recovery. The broader markets too showing some recovery from lower levels. Mid-cap radar on the other side. Thank you so much for watching.
Good afternoon and welcome to Mid-Cap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Vivek Iyer and with me today as usual is Sonal Bothra. Good afternoon Sonal, and what a recovery we've seen, especially in the last half hour of the session. The mid-cap index leading almost up 0.7%, the Nifty above the 23,550 mark, almost nudging the 23,400 mark as well. So overall, it's been a very sharp recovery and mainly led by the banks that has seen a significant recovery from its intraday lows.
You know, we saw something like that yesterday as well, a 200-point recovery in the last couple of minutes during closing bell. We'll see whether this trend continues or not. For now, we'll start the show with the top headlines. Market recovers from day's low ahead of expiry. Metals and autos are prominent gainers, while IT, FMCG and PSU banks drag.
Oberoi Realty shares rise 2% as the company secures Mada land in Mumbai's Andheri West to develop saleable area of 17.18 lakh square feet.
Fino Payments recovers from lows after sources tell CNBC TV 18 that the bank's small finance bank license is not at risk, as no irregularities were found during RBI's rigorous checks before giving the nod. Bankers also believe the CEO may get a clean chit.
IT stocks continue to see weakness and continues its losing streak to 6 consecutive sessions. Amongst key laggards are Persistent Systems, Wipro, Tata Elxsi, as well as Coforge.
And shares of malls see a sharp uptick in trade as the company targets major increase in Q4 production. The company says it will be increasing market share from 20% to 32% by 2030.
Well, like we mentioned, a very sharp recovery, and two stocks that clearly stand out that's leading the recovery are the exchanges. Remember, we are talking in the context and the backdrop of an upcoming NSE IPO, and clearly some rub-off sentiment seen, especially in the share price of BSE up almost 3.7%, and MCX as well. That particular stock up almost 5% in the session today. Along with that, most of the private banks that are languishing in trade earlier have now recovered quite sharply. Most of the names now trading near the day's highest point. But these stocks and a whole host of other names is what Gaurav has on his radar. He's standing by the wall to take us to the mid-caps that are moving around in the session.
Well, yes, if you look at the market, we are seeing sharp recovery, and even in the mid-cap and small-cap segment, we are seeing some stocks which are gaining, not only gaining, but they are also seeing sharp number of volumes in terms of trades if we compare it with 10-day average. So we have got a couple of stocks in the likes of Gokul Agri, Capacite Infra. If you look at Jyoti CNC, Praj Industries, all of these stocks are not only up in trade, but we are also seeing massive volumes here. Let's also not forget about Ellenberry Glass. Yesterday we saw the stock was down, and today we are seeing the stock is up more than 8%. Other than that, let's also not forget about the EMS space, because JP Morgan, they recently actually upgraded stocks in the likes of Cyan DLM, Amber Enterprises and Sirma SGS. All of these stocks are up in trade and also seeing higher volumes in trade today. On the flip side, on the losing side, if you look at Swan Defense, now this stock is locked under its lower circuit, but if you look at the volumes are not that strong though. Let's also not forget about some of the financiers like Poonawalla Finance and Spandana Spurti. They are seeing some kind of fall. And let's also not forget about IDBI Bank. Yesterday, we saw the bank fell almost by 16%. And today also, we are seeing this pressure there in the bank. It's down more than 2.5%. And let's also not forget about the mid-cap index. Now, on the losing side, we have got companies like HPCL. We have already seen this company being one of the losers for the last few days because of the war scenario. But at the same time, we have got companies like Tata Elxsi, Adani Total Gas. Remember, Adani Total Gas has also been one of the stocks which was gaining in trade, but we are seeing some cool off here. And let's also not forget about ITC Hotels and Persistent System. Here also we are seeing some kind of pressure building up in the market today.
Okay, all right, take that point. Thank you so much for joining us. Interesting list of stocks that are buzzing in trade. Moving on now to a big surge that we've seen in Fino Payments Bank. CNBC TV 18 learns that the storm that clouds above Fino Payments Bank may not be as bad as it appears. Remember, shares of Fino Payments Bank took a beating on Monday as market buzzed with speculation that the bank may soon be in for more trouble, this time with the Enforcement Directorate. CNBC TV 18's Furkan Mohorkar has more. Furkan, what are you picking up?
You know, the thing that rattled the stock on Monday was the buzz that DGGI may recommend an investigation by the Enforcement Directorate into the online gaming transactions linked to the bank. While that's still in the air, what we have picked up from the sources is that the arrest of the Fino Payments Bank CEO Rishi Gupta under the GST Act is not likely to have any material impact on the bank itself, especially its banking license, so that the business will not be hurt directly. In addition, sources say that the Reserve Bank of India is not likely to ask Gupta to step aside unless it's proven that he is guilty of the allegations leveled against him. We are also picking up that the large portion of industry believes that the allegations against Gupta may not hold water. The argument a couple of veteran industry players made was that such things are hard to miss when the RBI runs its fit and proper criteria test on the candidates who are running for the post like that of Gupta's. Also remember that in December 2025, Fino Payments Bank got its in-principle approval from the Reserve Bank of India to transition into a small finance bank. Now this will help the bank set up a lending practice which Payments Bank could not do. And also we are picking up that this latest string of controversies surrounding the bank will not affect this process. The fact that the Payments Bank got this license is also being seen as an indication that the Reserve Bank of India has clearly not found any systemic issue with the Fino Payments Bank. We have also learned that the Indian Bankers Association, which is an industry body comprising of Indian banks and financial institutions, has written to the Finance Ministry seeking clarity on the matter. So we'll have to wait and see if there is any response from that, and of course how other things in this matter finally pan out. Back to you.
Well, thank you so much for bringing us that important story and clarity emerging as far as Fino Payments Bank's license is concerned as well. Well, a recovery, especially as far as the realty names are concerned, a couple of names have now reached the day's highest point. Look at a name like DLF, Phoenix Limited, and even Oberoi Realty. All of these stocks from the Realty Pack managing to see a bit of a bounce. But with that, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Okay, above the 23,500 mark for now, but we have sharply come up from the high. So it's been volatile yet again. What happens now? Let's get a technical check going with Shrikant Chauhan, EVP and Head Equity Research at Kotak Securities. Shrikant, good afternoon. Do you think we'll continue to see this volatility till the last 1 hour of trade, considering its expiry as well? And what is the next important level now? We'll continue to stay above 23,500, do you believe?
Good afternoon, Sonal. Good afternoon, Vivek and everyone. So if we go through with the data, option data, then based on that, PCR is very close to its equilibrium level. And whenever we see such type of activity, the market remains in a range and becomes more and more volatile. But for the day, I think the market has already defined its trading range. So till the market is not crossing 23,600, we are going to see market to remain in a range. And on the dismissal of 23,600, we can expect further more upside. In fact, if we see the market is closing about 23,600, then the next level to watch out for would be maybe 24,000. But for the time being, I am of the view that the market is going to remain in a range. And in case on the downside, if it breaks 23,300, then the chances of hitting 23,000 or maybe 22,800 would turn bright. So ideal strategy should be to look for reducing some position if we see the market is again approaching to the levels of 23,600.
Okay, so 23,300 to 23,600 is the kind of range you're expecting the market to be under. Well, Shrikant, what are your individual trading picks for the day?
So while looking at the entire structure of the market and the way there is a performance, I think steel stocks can do well in the near term. But in that specifically, we like Tata Steel, which is around 192, 193 sort of levels. From here, again, the stock can move towards the levels of 200, 202. So it's a tactical play that we are right now trying because the stock reversed from its important support levels and now currently it is trading above its important averages. So it's a buy at current levels with a stop loss at 190 for the target of 200, 202. On the other side, IndusInd Bank still looks weak. And there we are expecting further more weakness. It has broken its important support line at 830. So now the next level to watch out for would be maybe 770 or 780. Currently it is around 810, 815 sort of levels. So look for creating some short positions on IndusInd Bank with a stop loss at 830.
Okay, thank you so much, Shrikant, for joining us, giving us a view on the markets as well as your individual trading bets. Well, one sector that's seeing and doing very well today is the EMS space. This is on the back of a bullish JP Morgan note. Let's go across to Upasna and understand the rationale for their positive stance.
Well, certainly, JP Morgan has put the spotlight on the EMS sector and it has gone ahead and upgraded 3 stocks within the sector. First up is Cyient DLM. It has upgraded from neutral to outweight with a target price of 400, and second one is the Amber Enterprises, again upgraded from neutral to overweight with a target price of 9,000 per share. Now Sirma, it has rectified it as one of the top pick of the sector with the overweight rating and a target price of 1,050. It believes that the EMX stock underperformance has led to investor question whether the sector story is intact or not, but the brokerage believes that the sector story is certainly intact with a positive view overall. It sees stocks barring Dixon delivering more than 20% of the revenue growth over FY26 to FY28, and it also sees that the sector addition is evolving within the space from finished product assembly to a component and a PCB manufacturing that the players are looking at. Now, in terms of valuation has eased out because of the stock underperformance lately, but it has given a key level of 30 to 60 times FY27 estimates as a risk level for the stocks that miss overall street expectations. It has also identified Sirma, SGS and Amber as most likely stocks to beat the street expectations. So overall, certainly a positive note coming from JP Morgan and on EMS sector.
Okay, take that point. Thank you so much for joining us with all those details, Upasna. I'm looking at oil marketing companies. Remember, there was a note which cut target price on these companies yesterday and these stocks yesterday. Today, there's a Kotak note. These stocks continue to be under pressure. There's a Kotak Institutional Equities note where they have raised their oil price assumption to $85 a barrel for the next fiscal, and after that at $75 per barrel. And this upside risk is coming on the back of disruptions that we are seeing in Strait of Hormuz and West Asia crisis as well. There's limited fuel pricing freedom, right? And that is something which could eat into their marketing margins, and hence the cut in target prices. They say LPG shortages, negative public sentiment will limit petrol diesel price hikes because people are already seeing that in gas prices, and that is not something they would like to see in fuel prices as well. OMCs did benefit from high marketing margins in recent years because crude was at a lower level, but now it has sharply increased, and weak earnings may now erode their margins overall, and hence the negative view coming in from Kotak, which reiterates sell on all the three stocks. But they do believe LPG storage capex is likely from the government from here on, so they'll watch out for that. But yes, there's a target price cut that is sharpest for HPCL from 335 to 235 because remember, they have the highest exposure to the marketing segment. And for others as well, it's been a sharp cut, but bearish view coming in across the street for oil marketing companies because of West Asia crisis. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back above that 23,550 mark on the Nifty. So it continues to be a very volatile session and of course expiry. So we'll see what are the levels that it closes at by the end of the trading session. But we do have a lot of stocks from the broader markets which are buzzing around. Tata Power is one of them. There's been a lot happening in the sector, but what is specific to this company?
Well, it's a very important development, especially as far as India's distribution space is concerned. And especially if you're a consumer, you've always been wanting to choose who your operator will be. And one of the decisions or one of the verdicts that's come about from Aptel will ensure that you may now be able to choose an operator and carrier of your choice. So what is the development? Aptel, which is the Appellate Tribunal for Electricity, has dismissed BEST's, which is Brihan Mumbai Electric Supply and Transport Undertaking's appeal against a decision that was taken by the Maharashtra Electricity Regulatory Commission. And this particular verdict was on parallel licensing. So Aptel has now ruled in favor of Tata Power for phased parallel rollout as far as distribution network is concerned. Now, this particular ruling confirms that parallel distribution networks are legally valid. What is the background of this particular case? Well, multiple companies in the state of Maharashtra had applied for parallel licenses across Maharashtra in FY23 and FY25, and finally, in June 25, MERC had admitted applicants that qualified for the grant of parallel licenses. So BST, remember, which is the current operational or current operator of these particular discoms and the areas that we just mentioned, went ahead and filed a complaint against the MERC verdict because they said that they were the ones that owned the infrastructure. Now, JM Financial has written on this particular development. They say that this particular move has implications as far as Electricity Amendment Bill proposal for carrier as well as content separation. Carrier, remember, is the company that brings you the power to your home. The likely passage of the bill during Parliament's monsoon sessions opens up huge opportunities for the power space, and they believe likely beneficiaries include Tata Power, Adani Energy Solutions, CERC, as well as Torrent Power. So an important development coming in, especially as far as the power space is concerned. Tata Power, direct beneficiary, given the fact that it has won this particular case at Aptel. Well, one particular stock from the metal pack that's buzzing today is MOIL. The company highlights a robust outlook for 2030. Nigel joins in with more details.
That's right. MOIL is buzzing in today's trading session because they have put up a very, very ambitious target. We just look at the numbers. In FY21, they did mined around 1.1 million tons. That's of manganese ore production. Now, what they're saying is that, in this year, that is FY26, we just got a few sessions to go, that they'll do around 2.35 million tons. But that's not the surprising element. The surprising element is this, that at the 9-month mark, they did close to around 1.4 million tons. So deriving that number out, which means that in Q4, they'll have to do around 9 lakh tons or 0.9 million tons. Why is that surprising? Because in the previous quarter, that is Q3, they did close to around 0.45 million tons. So effectively, in Q4, the production number that they are guiding for, if we derive that number, that's nearly double of what they did in Q3. Now, achieving this number is going to be very, very important. I've seen it in the past as well. Some of this guidance is normally not met. For the time being, the street likes what they hear with regard to this ambitious guidance. And in 2030, they are talking about going to around 3.5 million tons, which is again very, very ambitious. They also say that the market share will move from around 20% to more than 30%. So put everything together, management guidance is positive, but we'll be tracking achieving this particular guidance because it looks very, very ambitious to do 0.9 million tons in a single quarter. Back to you.
Well, thank you so much, Nigel, for joining in and giving us all of the details as far as the investor presentation and the update from MOIL is concerned. Well, we'll now get you an important market voice. Following the geopolitical uncertainties and consequent risk to macros and equities, Morgan Stanley has downgraded India to equal weight. In an exclusive conversation earlier today, Jonathan Garnett tells CNBC TV18 that India is most sensitive to oil and gas imports and prospects for India are dimming in this environment. Let's listen in.
We made a number of changes to our recommendations about 10 days ago, and it's really all to do with the framework that we're in right now in relation to oil and gas supply. It is unfortunate for India because in January, the manufacturing and services PMIs moved up. And we obviously have had significant policy easing in India, and we had been cautiously optimistic about the business cycle turning and running a small overweight. But unfortunately, India is one of the countries in our coverage that has the most sensitivity to oil and gas imports within GDP. It's actually the third highest after Thailand and Korea. And so the prospects for the economy are dimming in this environment.
Well, a very interesting view coming in from Jonathan Garner there. Well, with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome. You are tuned into MF Corner. I'm Sonal Putra. With me as always is Vinny Motiwala. And today, Vinny, we'll focus on specialized investment funds. A new category by SEBI has an AUM of around 4,000 crore rupees right now. But we'll understand who is this category suited for, what are the risks, and what kind of products can you expect in this in terms of returns and risks as well. And we have a special guest joining us to do that today.
Absolutely. And let's bring on board the special guest for today. We have Vishal Kapoor, CEO at Bandhan AMC, joining us right now. Vishal, good afternoon. Thank you so much for joining us on the show. And let's start by talking about SIF. So we've spoken about it, saying that, you know, this comes right in between mutual funds and PMS. But why should an investor consider SIFs? What are the pros versus mutual funds or a PMS?
Well, firstly, thanks for having me on the show. It's always a pleasure. The point you mentioned about why consider, I think one way to look at it is to think about it as the best of both worlds. The mutual fund category, of course, has so many benefits of being a retail product, which has served the investor so well over so many years. Great governance, great tax efficiency, easy to understand, etc. On the other side, you have the AIF and the world of PMS, etc., which is meant for very sophisticated investors, can employ more complex strategies. And the SIF, sort of sits in between, maybe possibly closer to mutual funds. So has the benefit that mutual funds bring of governance and great product structuring that mutual funds have had over years, but also some more sophistication that we've been able to get from the AIFs, including shorting of equities, which allows a level of product design that is not otherwise possible in a mutual fund structure. So think about it as getting the best of both worlds in this structure.
Okay, take that point. So getting best of both the worlds in this particular structure. So there are different categories. There's equities, there's debt, there's hybrid. Then there are some subcategories here as well. So make us understand, how does long-short SIF help manage risk versus if somebody is investing in a regular equity fund?
Right. So great question, Sonal. As I think most viewers understand that in an equity fund, let's say a 100% equity fund, you are 100% exposed to the market, and which means that the market goes up, let's say 10 units, the fund should go up roughly 10 units plus minus the fund manager's alpha, in a sense, right? So the full beta of the market is what you're exposed to. Now, in a shorting strategy, you're trying to do the reverse, which is you're selling stocks that you really don't like, in a sense. And hopefully there is two things that happen. One is that you can outperform the market a bit more because of this. And second is you can cut your exposure to equity a bit faster, a bit more efficiently than in a long-only fund. So in a long-short fund, therefore, the fund manager, simply put, has other variables now available, which a long-only manager does not have, to be able to manage both risk and volatility in a far more sophisticated manner. Now, in doing that, you can hopefully, and that's the attempt, to bring about more risk-adjusted returns, or better risk-adjusted returns. So it's a more efficient way for you to be able to participate in the market in some sense, but also be able to some extent, get some benefit from the downside, if I can call it that, and also add a layer of alpha, a layer of excess return that the fund manager can spot in selling stocks that are likely going to disappoint the market. So there's an additional source of return for the investment.
Vishal, let's talk a bit more in terms of those 7 strategies that actually come in, whether you talk about equity, whether you have hybrid on the debt side for SIFs as well. So one, if you could help us understand these 7 different categories, as well as what category, which sort of investor is good for which category, or which is suitable for which SIF category.
Right. So firstly, I think the important point is that while SIF is the vehicle, like mutual fund is a vehicle or an AIF is a vehicle, investors should look at the individual strategy that you're getting into if you're considering SIFs. And like you pointed out, there are 7 different types of strategies that the regulators have allowed, largely across 3 buckets. So there are the equity-oriented strategies, there are the hybrid-oriented strategies, and then there are the debt-oriented strategies, right? Now, in the equity strategies, there are 3 types. And these are, again, all of these have the ability to be long and short, which means you can short the underlying asset as well. So that's the fundamental nature of the SIF product, as we just discussed. Now, in equity, there are 3 ranges of strategies that are available, from what is called the equity long short to the X100 to the sectoral strategies. So these are graded levels of risk and underlying investment thesis that one is participating in. So at an aggregate level, I think for now, let's just think about this as very equity-oriented strategies, and therefore likely to be higher risk than the other categories, allows you to get a larger participation in equity, but through 3 different ways of managing the underlying portfolio, either sectoral or focused on mid and small caps, or the large cap oriented largely. So these are the 3 types of strategies.
Okay.
There are 2 under hybrid and there are 3 under debt. So the common theme again is that there are 3 different categories, 3 different asset classes, 7 underlying strategies. Each of them have the ability to go long and short. For an investor, I think you should look at it if you do want to focus on risk-adjusted returns through strategies which are a bit more complicated than the average mutual fund that you are maybe used to participating in.
Vishal, then as of now, when you look at mutual funds, the hybrid side or flexi, multi-cap, where you have a mix of both, is doing well. Does that make sense even for SIFs, and is that something as a trend that could be shaping up if you want just an equal amount of risk and return that you're looking at?
Great point. So I think the hybrid category of mutual funds, let's take balance advantage or multi-asset, may be similar in some sense to how an SIF may work. So taking as an example the equity long-short strategy, one of the products that we're also now offering, the active equity component can go down to about 65%, go up to about 100%. So one may argue that it is in one sense similar to a balance advantage or an aggressive hybrid mutual fund, so which may be largely true in terms of the asset allocation between equity and debt. But where an SIF will differ is that because an SIF can use naked shorts, which is it can use short strategies to actually manage the active equity component more dynamically. And second is that because you can short the market, you can actually squeeze out the extra outperformance from shorting, which is the additional alpha you can generate. You can also employ covered call as an example to enhance your yield. So as you can see, the ways in which a fund manager can actually get better return than the relatively plain vanilla balanced advantage fund may be higher. So yes, it becomes slightly more complicated, but then it offers you the potential for the fund manager to be able to hopefully get additional sources of returns, which can hopefully add up and therefore give you better risk-adjusted returns over the long term. And definitely that will be the endeavor for most of the managers.
Okay, so exactly, the endeavor always is to maximize returns, right? And that's what the idea in terms of introducing a product as well is. But every product also comes with its own risks, right? So if you can tell us, what are the risks with SIFs? Is it similar to what we see in mutual funds or is more like PMS? If you can explain some of the things an investor should be aware of before they're putting that minimum 10 lakh amount here.
Right. So firstly, Sonal, like you mentioned, for an investment manager, it is to try and maximize risk for a given level, maximize return for a given level of risk. So here it is very important to understand that an SIF fundamentally, like I mentioned, if the active risk level is going to be between 65% and 100%, it will not necessarily take higher risk than a long-only mutual fund. Actually, the shorting allows you to buffer or reduce the risk, not necessarily add a lot more risk. So it is more sophisticated, but it is not necessarily adding more risk. Adding more risk would mean that you can take more than 100% equity exposure, which is leverage on the upside, but that's not allowed in an SIF. So in aggregate, it should not have more risk than your regular long-only equity fund that you're used to. Actually, the objective is to buffer the risk, to reduce the risk, and therefore target better risk-adjusted return. Now, coming to the risk, one clearly is that, just the first point, therefore, is that aggregate risk in an SIF need not be higher than the risk in a long-only equity fund. It will actually be lower because you are, in general, going to be lesser exposed to active equity. So where does the risk come from? Firstly, it is sophisticated. So for investors to have the right expectations and having reasonable understanding of the manager and what the strategy is doing, I think is important. So something that you don't understand and you don't feel comfortable with is something you should watch out for. And therefore, understand the strategy before getting it. That may be one. The second is that it's a new category, and therefore, even benchmark for some of these categories may be not as well established right now. So if you have to look at performance for the scheme that you're choosing, at least in the initial years, it may take some time for this to develop. So how do you accurately measure whether this specific SIF that you've chosen has done better than or worse than the benchmark? May take some time because the underlying strategies can be quite diverse. And the benchmark may be relatively simple for now. So over time, I would imagine that peer group performance as well as more sophisticated benchmarks may develop. So that will allow a better, more accurate measurement versus how we measure mutual funds where this is fairly developed now.
Sure, Vishal, point taken there. But on that note, we're actually going to slip into a very short break. We'll come back after the break and continue this conversation as well, viewers. So stay tuned in for that. We'll be back after the break.
Welcome back. You're still tuned into MF Corner. We still have with us Vishal Kapoor, who is the CEO at Bandhan AMC. We're discussing everything about SIFs. It's a new category. So to understand at what investment journey should investors go about it and at the other aspects, we'll be taking that forward. So that's the next question, Vishal. At what investment journey stage should investors consider SIFs in their portfolio? And are they now gaining traction among Indian investors?
So certainly, Sonal, as we look at the first few months of the SIF journey, it is very encouraging to see a lot of investors and distribution partners really, taking to this new category. Now, clearly, there's anticipation. There is some amount of, I think, learning that is happening through the initial investments as well. But clearly, for someone who's experienced mutual funds and maybe also experienced AIFs, like we mentioned earlier, this is a nice sweet spot to be in between. For those who are capital market investors or mutual fund investors, it does offer a level of sophistication and guided risk management in a sense that can add significant value in a portfolio. So for investors who've now felt comfortable with equity mutual funds or hybrid mutual funds, I would say this is an area you could certainly explore, because there are some benefits that sophistication does bring that an SIF can offer to you. Clearly, for a lot of distributors as well, now there's a growing level of certified distributors who are participating and bringing this product to their investors as well. It's important to understand this fully before jumping in, and I think it's good to see the momentum that we have in the market. So clearly, a lot of traction, a lot of excitement about this new product category. Early days as yet in terms of track record and history, but certainly the products now available do add a lot of sophistication and therefore place in an existing portfolio, especially for people who are now more aware of risk. So like we mentioned earlier, a long-only equity mutual fund gives you the benefit of full participation in the equity market, and that clearly works where you are largely long-term and bullish. But in and during phases of volatility, when you're a bit worried about downside risks, that's where an SIF can come and buffer it in a meaningful material way. And that may be an additional advantage that investors could explore through SIFs.
Okay. Vishal, now let's talk about the launch that has come in from Bandhan side, right? Aruda's equity long short fund. This NFO has been launched on March 5th, will go on till March of 18th as well. Could you talk to us about the strategy or more in terms of the long short fund as well, the focus here as well?
Sure. So our equity long short fund, the Aruda Equity Long Short SIF, it's an equity-oriented product. So, like we mentioned, the active equity, the equity portion will be 80 to 100%. But keep in mind that we can go short up to 25%, which means that at 80% equity, if we go short 25, then the true equity exposure on the long side could be between 65 and 100. To that extent, it can be similar to what people understand as between balanced advantage and aggressive hybrid. So that's the natural allocation of the product. Now, the equity portion, we will benchmark to the Nifty 500. So therefore, it can go across the larger companies, but we'll have a concentrated portfolio of about 30 to 50 stocks. Now, so far, the two areas of return that, that a balanced advantage fund, which is allocating between equity and debt and trying to get better stocks and therefore generating alpha on the equity side, that may be similar to a balanced advantage fund. Now, how is this different and what's the exciting part about this? Firstly, from the 25% shorting, you can actually add more alpha, and that can sit on top of whatever a balanced advantage fund can do. And the second thing is that because if it's a long-term portfolio, you can also generate additional yield through covered call strategies. So these become, therefore, two additional points or engines of returns for the fund versus a conventional mutual fund.
Got it.
So in a conventional fund, if you have two ways of earning returns, here you can have four ways of earning returns. And therefore, as a package, when we've tested this across different market cycles and through our quants team, etc., the return to risk ratio becomes very attractive. What we are trying to generate is to give a BAF plus or an equity minus type of return, but at a risk level which is roughly half the market. So on a risk-adjusted basis, this can be significantly attractive as a strategy.
Take that point, Vishal. Always a pleasure speaking with you. Thank you so much for joining us today and breaking down this new category for our investors and how they should go about it in their investment journey. That's all about SIF's new category, but there's been a lot of action from mutual funds in the month of February as well. Our colleague Hormuz is joining us to tell us more. Hormuz.
Well, just before the world turned on its head in the month of March, there was intense mutual fund activity in the month of February as well. Now, according to JM Financial, there were sectors at which the mutual fund industry was overweight in comparison to the weight on the BSE 200. And those sectors included the likes of pharma, e-commerce, consumer durables, capital goods, and agrochem and petrochem, which have now become the line of fire in the month of March. But take a look at the sectors on which they were underweight on. Now, on the underweight side, you'd find private banks, you'd find oil and gas, you'd find metals, consumer staples, IT, of course, considering the hammering that it took in the month of February after the AI-related meltdown. So, in these circumstances, they were underweight, was the mutual fund industry. Now, if you take a look at the sectors at which they were, the inflows came into, private banks led the party here. Even if they were the industry was underweight, but the flows kept coming, especially considering the weightage. So almost 16,000 crore worth of flows in February. IT saw 12,000 crores. E-commerce saw around 8,000 crores. Flows also came in for retail and for telecom as well. But the sectors where they were seeing buying, look at the top buys here. HDFC Bank was the top buy among the private banks. The top sell was Axis. For IT, Infosys was the top buy. Wipro was the top sell. Of course, mutual funds continue to bet on Eternal despite the stock having corrected significantly from the highs of the day. There were sellers in Nykaa though. On the retail front, Vishal Megamart, one of the few successful IPOs that have still managed to hold above their IPO price. That is one. And Trent continues to see some selling from the mutual fund side, while Bharti Airtel continues to find favor within the telecom space. The selling was seen in Indus Towers among the sectors where the mutual funds were overweight. Now, I take a look at the sectors where the underweight stance was and where the selling took place. PSU Banks was one where there were outflows of close to 9,000 crores. There was NBFCs, autos, metals, engineering. All of them saw outflows of anywhere between 3,000 to 6,000 crore rupees in the month of February. Now, take a look at these sectors. SBI was the top sell within the PSU banking space for the mutual fund industry as the stock hit record highs, so they chose to book some profits here. Canara Bank was the top buy. Bajaj Finance continues to see a correction from the highs. Maruti was a top sell as well. So was Vedanta, and so was Larsen and Toubro, interestingly, and the stock is now down almost 20% in the month of March. Now, take a look at the stocks where the mutual funds bought among the Nifty constituents. Look at HDFC Bank, ICICI Bank, Infosys, Eternal, of course, seeing flows of close to 3,300 crore. The Kotak Mahindra Bank too within the list of buyers. Now take a look at the stocks where they were selling among the mutual funds. SBI, Larsen and Toubro, Bajaj Finance, Power Grid, BEL, sell flows of anywhere between 1,500 to almost 9,000 crore rupees. Now move that to the broader markets. PB Fintech was one stock where the mutual funds were buying in the month of February, as was BHEL, Vishal Megamart, Coforge, IndusInd Bank. All of them saw buy flows. IndusInd Bank, of course, no longer a part of the Nifty. But take a look at the stocks in the broader markets where there was selling from the mutual funds. Vedanta, APL Apollo, Godrej Properties Real Estate continues to underperform. Interestingly, BSE forms a part of the list as well, as does Aditya Birla Capital. So mutual funds continuing to bet on a select few names, but there have been underperformers as well, including the likes of Larsen and Toubro in the month of February, much before this West Asia crisis took effect.
Thank you so much for that, Urmas. But on that note, we are absolutely out of time on this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, your closing bell to take you to the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Hang Seng opened up with gains. We're seeing Taiwan index that's opened up with a slight bit of a gain as well.
75% of S&P 500 finishing in the green last night. It's a decent start. Let's see if this can become bigger or stays here through the course of the day.
Unfortunately, India is one of the countries in our coverage that has the most sensitivity to oil and gas imports within GDP.
We are trading at a 4-year highs onto this one. On a monthly basis, we have gained by 12%, and for this year, it's outperforming various other commodities as well.
The arrest of the Fino Payments Bank CEO, Rishi Gupta, under the GST Act is not likely to have any material impact on the bank itself.
Lastly, it is identified Syrma SGS is one of the top pick within the sector with an overweight rating and a target price of 1,050.
Today the FI seems to be better buyers. And where are they buying? They're buying largely into the power names. So power as a sector is standing out.
Well, the most important, most critical piece of information we have for you right now is that the UAE has continued to come under Iranian missile and drone attacks today.
Those sectors included the likes of pharma, e-commerce, consumer durables, capital goods, and agrochem and petrochem, which have now become the line of fire.
The Nifty above the 23,550 mark, almost nudging the 23,400 mark as well. So overall, it's been a very sharp recovery and mainly led by the banks that has seen a significant recovery from its intraday lows.
Well, it's now a 400-point recovery if you add yesterday's gains and today's 150-point up move on the Nifty. They say solid upward momentum. Markets had gotten a bit oversold, and now you are seeing buying emerging in metals, realty, auto, defense. You're watching Closing Bell. We've got 1 hour to go. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Rima Tendulkar. With me is Nigel D'Souza. And Nigel, we've reclaimed that 25,550 mark. You know, if you pull up that intraday chart, it got a bit wobbly mid-session. Markets gave up those gains, but again, we've managed to claw back. There you have it. At between 11:45 and 12:15, markets were flat, but the second half of the trading session, solid buying emerging.
Shireen just written me a mail saying, Nigel, you don't go on leave. I'd like to take part of the credit to be the good luck charm. Markets have bounced back, and in the data point that we put out this morning, Rima, with regard to what Samco Securities said, they said that when the markets pull back close to around 5% in a week, the following week we see a 3% bounce, and that's 70% of the times. Let's see whether or not that record can keep, updated, because yesterday and today you put it together, we are 360 points higher. And I'll tell you what, today is the weekly expiry. So some of those short calls, they're going to be in trouble. This market got oversold, and now we're seeing a bit of a bounce. Maybe a closer to around that 23,590, 23,600 is going to be eyed. We'll analyze the derivative data as well. But pretty good times, in comparison to what we saw last week.
Indeed, 3 consecutive weekly losses for our markets, and this week we've started off strong, and the Nifty is now pushing towards that 23,600 mark. It's a 500-point rally on the Sensex. Mid-caps moving in step. The mid-cap index is up 0.9%, strong advanced decline ratio, and some of the big gainers, at least on the large cap screen, Eternal top mover, 6% higher. We'll talk more about what brokerages have to say about Eternal. After a 15% slide since the start of the year, metal seeing buying. So Tata Steel is the second largest mover today, 4% gain. Autos across the board, whether it's M&M, Tata Motors, passenger vehicles, Maruti Suzuki, Eicher Motors. Lots of buying interest visible there. Tata Motors CV has already announced a price hike of about 1.5% following the increase in following the inflationary pressures that we've seen. HDFC Life, BEL, Bharti Airtel also on the buyer's list. How should you position yourself? 1 hour to go. What trades should you take? Mitesh Thakkar, as always, is back with us with a few closing strategies. Mitesh, would you take heart from the kind of up move that we've had in the last 2 trading sessions? And today the dip was bought into, which is a positive sign. What from here on, and what would the calls be?
Good afternoon. So in the extreme short term, maybe yes, because as I've also been saying that we are extremely oversold. So a choppy pullback is what I think would happen. If you get those intraday dips, you'll also get those buying and short covering bounce. And we could be looking at 23,850 as the first target, possibly even 24,200 to 250 zones. But that will only be a retracement. So for the time being, in the extreme short term, yes, I think the trades should be at least and I said this yesterday as well. The short position should be taken profit at and wait for a bounce back to play. Or if you're a 2-3 day kind of trader, you can even go long. So we have some long side stock conditions right now. PFC is a buy. Keep a stop at about levels of 408.5 and look for target of 425. While there's also a buy on Eternal. I think very strong rebound with good volume. So on a mild pullback around 233, buy with a stop at 228 for targets of 244.5.
Okay. All right. Got that. Thanks a lot for that, Mitesh. Let's focus on a couple of stocks actually that have bounced back in today's trading session. And what such name is Eternal? That stock has seen a big bounce in today's trading session. Mangalam joins us to give us a quick analysis on that particular name. Mangalam.
It's a 6% up move that we're seeing on Eternal right now. It's the top Nifty gainer. But remember, for the last couple of weeks, it has been losing a fair bit of ground. In fact, from its recent peak, the stock is down about 40% as well. So in the pullback that we're seeing in the market, this is one of the bigger buys that we've seen. But the important part is that there is a brokerage note that has come in today as well, and that's from JM Financials. They say that there were 5 reasons, major reasons why the company saw a big decline in its stock price. The one was concerns around leadership changes. Remember, the previous quarter, Deepinder Goyal stepped down with Albinder Dinsar taking a day-to-day CEO leadership role, high competitive intensity in quick commerce, new competition coming in food delivery, and then you had the global concerns, which like the likes of the Middle East or the West Asia conflict and artificial intelligence, whether their moats would be questioned around that as well. Now, on that, JM Financial has said that they strongly believe that the company will emerge stronger once the macros normalize. In fact, as near as this quarter itself, the fourth quarter, they believe that Blinkit's net order value is likely to expand by low double digits quarter on quarter, despite high competitive pressures. And not just that, they will see their margins expand by about 40 basis points as well, or 240 basis points of NOV versus what it was at break-even in the third quarter. More importantly, the food delivery business, they expect the NOV to grow at around 18% in the fourth quarter. And they don't expect a big cut coming in from the LPG crisis. In fact, they've, in their analysis, said that even if 25% of the orders are disrupted in the final weeks of this quarter, that's the month of March, then the NOV will still grow upwards of 15%, and that's a positive. And amidst all of this, the stock correction offers an attractive entry point because it's now trading at just around 35 times March 2028 price to earnings. Their own multiple, if after them having cut it, stands at around 65 times. So their target price is at 400 rupees. They believe that those who are looking at it from a long term, say 15 to 18 months, should be looking at this dip as a buying opportunity. And that's exactly what the street is noticing as well.
Thank you very much for that. Big move seen on that. Dharmesh Kant, Head of Research, Chola Securities, is now joining in. Dharmesh, there were lots of concerns about high valuations, competitive pressures. But after the kind of underperformance that we've seen, the stock price correction, do you think all those, the price currently addresses all the concerns, prices in the concerns that the markets had? And is this an attractive buying opportunity to your mind for the long term?
Yeah, good afternoon, Nima. Thanks for having me for the show. I mean, those concerns are still valid, and I think they are valid for the long term as well. Nothing goes away. It's just a trading opportunity or pop which is there for Eternal. Because, see, but this is a basis point business. I mean, every 5, 10 or 2 basis point you are fighting for to get your margins in place, and the competition is likely to hit up. So as long as they were doing only food delivery business or even the district thing, that was okay as far as the bookings are concerned. But this quick commerce has taken its toll. And I mean, when it crossed 3 lakh crores of market cap, I was that day I was there on your channel, and I clearly said that it's a sell and it should be, not be in your portfolio for a long-term basis. It went up to 340 or so levels, and from there it has corrected. So to my mind, this space is a complete avoid. They may make some profit here and there, but from long-term basis, justification of valuations is very hard to come by.
Got it. Okay. All right. Dharmesh, hi. Good afternoon. Good to see you in. Dharmesh, what about Waaree Energies? I recall you timed that stock pretty well. If I remember correctly, you all were bullish, and then I think in one of the interviews around 3,200 odd, you said take money off the table. What's your view on this particular name? Today it's seeing a bit of a bounce.
Yeah, good afternoon, Nigel. And good to see you back on the screen because the markets have turned around from the day you joined back. And the last week was horrible for the market. So
On a lighter note, I was just telling Rima that...
So very much welcome and keep on wearing the...
I was telling Rima that if that was the case, I would not go for the trip only. But give us the analysis on Bali.
Yeah, please do. So as far as Nigel, Wari was concerned, we have, having a buy rating on this from the IPO days, and we rode it all the way to 3,800. That was the price target. But while we was having a coverage on it, we realized that a lot of big players are venturing into this, like Adani and Ambani's and all, Reliance and everything is coming into the play. And eventually, they will still have orders. The run rate of the profitability will still be there for 1 year or 1.5 years or so. But thereafter, they have already hit us selling for future growth prospect. And that is where we took the money off the table. We gave a profit-taking note on that. And from there onwards, we have not, have any new initiation on this. And the reason is very simple. The capacity for way too higher than what the initial expectation was. At the same time, with big players coming into the play, the margins will definitely erode. And the third factor which has been plaguing this entire solar renewable energy space is you can, generate the power soon, but the transmission lines, the power grid and all, those lines are still not there in place. So uplifting of the power from the generation point to the main grid is becoming a challenge. So, I mean, next year would be a difficult one, FY28 and onwards. And that's the reason why we are not even taking it as a trading bet. So staying away from this entire renewable energies, as far as solar panel manufacturers are concerned, is our call. However, on power generators from the renewable energy space, we still are bullish on NTPC Green Energy. They did lag on capacity addition for some time, but now they are catching up. 9.5 gigawatt is the total installed capacity as we speak, and the pace of installation is catching up faster. So next 1 year, it's expected to do 18 to 19 gigawatt of capacity in place by the end of FY27. And if that happens, then it becomes a very good attractive buy. 140 is the price target which we are having on NTPC Green Energy.
Got it. Okay. All right. So you're optimistic on NTPC Green. I think you have started a bit of a movement though, Dharmesh. I've got a couple of messages from investors. All your leaves are cancelled. They're detrimental for the markets. I need to take care of my family first. But anyway, let's focus on the other stock. The one that's bursting away is MOIL. That's, almost moved to upper circle in today's trading session. Why is that? They have come out with a very, very optimistic production guidance number. Let me explain this to you. For FY21, they did close to around 1.14 million tons. In the last year, they did around 1.8 million tons. But for this year, they are guiding for around 2.35 million tons, which will be a massive growth of more than 20% in terms of production number for FY26 in comparison to FY25. But that's not the surprising part. The surprising part is at the 9-month mark, they've done around 1.4 million tons or thereabouts, which means if you derive that, the derived Q4 production number will be close to around 9 lakh tons. That will be close to around double of what they did in Q3. So because they have guided for such an optimistic number of around 2.35 million tons, which means they do 9 lakh tons of production, the street seems to be very, very excited for now. And just to put that into perspective, in FY21, they did close to 1.1 million tons in the full year. Now, for a single quarter, they're talking about 0.9 million tons. So achieving this guidance is going to be very, very important. For the time being, the street has grabbed onto the opportunity. And also, they're talking about their market share by 2030 going to around 32% from around 20% currently. And they're also saying that in terms of production, they'll do around 3.5 million tons. In addition to that, remember, MOIL has some kind of cushion because cash in the books is nearly around 20% of its market capitalization. So put all of that together, a stock that's seen a big correction from the top. For the time being, the analyst meet and the presentation that they put up seems to have excited investors. Stock up 18%. We at CNBC TV 18 were the first ones to alert you about this. What's your take, Dharmesh, on MOIL?
I mean, stay away is the take. I mean, look at last 4 or 5 years, they have done nothing, hardly any volume growth, and consistent kind of a profitability which they have done. The guidance is very, strong and aggressive, as you have rightly pointed out. You have given all the data tables in place. So if they deliver, then definitely it becomes a good buy. But having my, study of this company over the last 10, 15 years, it seems very ambitious and overarching kind of a target which they have set in place. However, it does fall in line with the capacity expansion which is happening for the steel industry for next 4 or 5 years. It's almost 100 million ton of addition would be there, and in line with aluminum capacity addition as well. So it broadly, thematically, it does fall into place. But the execution challenges will be there. So the proof of the pudding will lie in the Q4 numbers. If they are able to deliver Q4 numbers, then even buying it 10% higher from here will make sense. Otherwise, till that time, let the trade be there. And the other thing is the free float is very less. So again, such news flows trigger a sharp jump where the free float is very less in the liquidity perspective.
We'll take that caution on board, actually, Dharmesh, with regard to them actually achieving what they have set out to do. And I've seen it in the past as well, that sometimes that guidance hasn't been met. And keep in mind, this is a stock that's half from the peak that we saw just 2 years ago. So take all that caution on board. For the time being, they have said 2.35 million tons. By April, we'll know whether or not they have achieved that 2.35 million tons. Let's talk about a couple of other names. There are strong moves being seen on EMS companies today on the back of a JP Morgan note. Let's go across to Upasana. She'll explain that one to us. Upasana?
Well, certainly, JP Morgan has put the focus light on EMS sector, and it has gone ahead and upgraded 3 stocks within the sector. It has upgraded Cyient DLM to overweight from neutral with a target price of 400. Amber Enterprises is the next upgrade, and it has raised the target price to 9,000 per share. It has identified Syrma SGS as one of the top picks for the sector with an overweight rating and a target price of 1,050. Now, it believes that the EMS stock underperformance has led to investors question whether the sector story is over or not. But the brokerage believes that the story is certainly intact and has a positive view overall. It sees every stock barring Dixon delivering more than 20% revenue growth over FY26 to FY28, and it also believes that the sector is upping its value additions, evolving from finished products assembly to a component and a PCB manufacturing companies. Valuations have eased out, seeing the past underperformance seen by various stocks across the sector, but the key risk levels it has identified as 32 to 60 times FY27 estimates for the stocks that miss expectations. It says that the Syrma SGS and Ember are most likely to meet the street expectation. Now, if we look at the consensus rating for all these 3 stocks, it's over 80% of the buy consensus rating which is given. In terms of valuation, Amber trades at 44 times 1 year forward, followed by Syrma SGS at 36 times and Cyient DLM at 24 times. Now, remember, Cyient DLM was at one of the highest points of the day, and it has seen an up move of as high as 11% today, but the stock is still down 40% of its 52-week high. So all in all, certainly the eye on the EMS sector.
Thank you very much for that, Dharmesh. Are you tracking the moves, the recovery, the rebound in EMS stocks, particularly Cyient DLM? Hardest hit, and now it's rebounding the most. Where would you stand now on it?
Yeah, I mean, most of the companies in the EMS space has taken a strong, beating, and they have corrected quite a lot. So valuations have reached to a fair multiples for most of them. But to my mind, I mean, if I have to buy from the space, though we have presently we are not having any recommendation on the entire space. We are watching it from the sidelines. But Dixon stands the best out of the entire pack, given the multi-diversified portfolio it's holding on. They have recently done a deal with the Chinese company, and one more is in the pipeline. So going forward, the margin creative value additions on the product offering which they are having, Dixon stands the best chance out there, and the valuation multiples have softened to 40 times 1 year forward value multiple. And here I tend to differ with the brokerage report which you were just referring to. So to our mind, I mean 35 to 40% is the revenue growth which Dixon is likely to deliver for next 2 consecutive years. So that is there. We are waiting for Q4 numbers and the analyst call after that. And post that, we may be reinitiating our coverage on Dixon Technologies.
Got it. Okay. All right. Thanks a lot, Dharmesh, for joining in and giving us your view on a few of these names. By the way, markets are moving from strength to strength. 23,000, not 25,000. 23,500 is breached, and now we're on the way to around 23,600. Let's see how we end. For the time being, let's slip into a short break. On the other side, we'll have our Alpha Manager of the day, Rahul Veera from Nippon India AIF, will be waiting for us. Welcome back. Well, I think we have some news that's coming out there. NCLT approves Adani resolution plan for Jaiprakash Associates, and they have rejected Vedanta's plea versus Adani Enterprises IBC plan for Jaiprakash Associates. I'll tell you what, this rejection is good for Vedanta shareholders. Vedanta shareholders don't want Vedanta to get very, very ambitious. So that's why I think you'll see that Vedanta stock price actually will not correct on this. It's good news. You know, when the stock was around 400, 450 rupees, we had alerted you that if this goes through, actually, it'll be a bit of a overhang on the stock price because they're going to bite into a large asset which is not really related to their core business. So this rejection, as is the street, is not expecting them to get the Jaiprakash Associates asset. But since, you know, they're actually, it's closing the case with regard to that, and NCLT has rejected their plea as well, it's good. Short point, street doesn't want Jaiprakash Associates to come into Vedanta. They rather go ahead with the core business, the demerger, aluminium business separated, oil and gas business separated, and the street will be happy on that front. And for Adani, well, that business is coming into their fold, which will strengthen part of their cement business as well. So good news for both. Lucky loser for Vedanta and lucky winner for Adani Enterprises as well. That said, let's welcome our next guest. But actually, before that, let's do a quick check onto the F&O markets because, today we have the weekly expiry that will play out as well. One positive that I've been highlighting from yesterday morning itself was that on Friday as well, the Nifty was down 500 points. The India VIX was up only around 4 to around 5%. That told you the VIX is showing signs of peaking out, at least as of now. Yesterday, when we were down 200 points, actually the India VIX didn't shoot up. Normally they move inversely. Now, in today's trading session, there's a substantial cool-off from the high of around 23. That's a big cool-off that we're seeing to sub around 20. India VIX cooling off is a bullish sign. The other positive is, besides the VIX cooling off, is that we have made a higher high and a higher low, both on the Nifty as well as in the Nifty Bank. Thumbs up on that data point as well. Moving to the options data, 23,600 call. The premium out there is quite interesting. Just till a few minutes ago, you were not making any money even if you bought this particular call, because the time value of money is getting eroded. So you've got the direction correct, but that's the strike that we are hovering around currently. Start of today, the premium was around 60 rupees. So the resistance for today is around 23,660. If we can get to that particular level, we can see a further, I think, a 50-100 point bounce from there as well. 23,660 is a crucial resistance mark. And from the word go itself, from the last at least 3 hours or so, we're seeing that 23,500 put is seeing a fair bit of addition, and there is writing being seen at that level. Quickly to run you through a few stocks that are seeing a good amount of movement. On Vari Energies, a stock that's seen a sharp correction, fresh buying is observed out there. It appears as 22,500 rupees. That's the area when people look to build some long positions. That's what's happened today. And KPIT Technologies as well as Nalco, stocks that have got hit in the last few trading sessions, they have come in for a bit of a short covering bounce, and both of them have spurted up. But it's that part of the show when Hormuz joins us. He doesn't want to be kept out of the action. He's going to turn the spotlight on all the top movers at this hour. Hormuz, take it away.
What does not want to be kept out of action definitely is Moil right now. What a move the stock has seen after CNBC TV18 first reported about their ambitious plans for production. Now the stock is up 20%. This is the biggest single day gain that the stock has seen since May of 24. It snapped a 3-day losing streak today. And after the CNBC TV18 news break that happened sometime around about 1 o'clock, the stock had seen a very significant spike in volumes as well. Volumes today are the highest now since July of 24. Over 90 lakh shares have been traded. The 20-day average is just 5.5 lakh shares. And out of those 90 lakh shares, 21% of those so far have been marked for delivery. And incidentally, today was the day when the stock had made a 52-week low. So in a single trading session, the stock has seen a 52-week low and a 20% upper circuit as well. The other one, of course, is Eternal, the top gainer on the Nifty today, the second straight day of gains. Yesterday was more significant for Eternal because it snapped an 18-day losing streak in yesterday's trading session. Now, today's volumes have already crossed that of yesterday's, but they aren't as significantly higher, only around 40% above their 20-day average. We had close to 6 crore shares that have been traded. The 20-day average is around 4.5 crore. The premiums on the F&O side on the 230 rupee call option is up around 130% as of now. On the put option of the same strike, that premium is down around 56% as we speak. Now, the stock recently made a 52-week low here as well, 209 during that 18-day losing streak, and 43% of the shares that have been traded today so far have been marked for delivery. The third one, of course, Chennai Petro. We spoke about MRPL on Bazaar. The other one that's doing well, has moved in tandem with MRPL, is Chennai Petro. It's gained in 3 out of the last 4 sessions. And during this period, the stock has gained 16%. It's 8.5% in today's session itself. Volumes are the second highest in the month of March. Close to 70 lakh shares have been traded so far. The 20-day average around 19, so it's around 3.5 times its 20-day average. Only 17% of the shares that have been traded so far, though, have been marked for delivery. And in the last 1 month, the stock is up 20% and is also nearing a 52-week high, which is close to around 1,100 rupees. And lastly, Vari Energies, you just highlighted this in your F&O as well, Nigel. The stock has gained in 5 of the last 6 sessions now, and in these last 6 sessions, today's volumes are the highest during this phase. The most active options this time around are the 3,000 rupee call option and the 2,900 rupee call put option in today's session. 46 lakh shares have been traded so far. The 20-day average of around 18 lakh shares. 15% of those shares have been marked for delivery, and the percentage of shares that have been marked for delivery so far is the lowest since the 22nd of January. And the stock in the month of March, when most of the stocks are down 10-20%, is up 7. This is the first time in the last 4 months that the stock could end the month with some gains.
Thank you very much for that. Let's invite Rahul Veera, Fund Manager, Equity Investments, Nippon India, AIF, on the show. Rahul, thank you very much for joining in. What we're seeing right now is just a tactical bounce, that there is some selling exhaustion, or do you think there is fresh conviction buying that's taking place? And what are you all doing with the money that you all have? Are you all aggressively allocated?
Sure. Hi, good afternoon. As of now, we are incrementally adding just purely basis of the valuation. There are some technical factors that are playing out, your March end buying that we'll see a little bit here and there from mid-cap, small caps. We are seeing some kind of a pausing from the FIs in terms of the positive news coming from the geopolitical side. So the selling is hopefully going to reduce going further. Incrementally, we are just adding a few names here and there, but remain constructive from a valuation standpoint of view.
All right, just hold on to that thought, Rahul. We have some flashes that are coming in there from Bloomberg. Israel Defense Minister is saying that Iran's security chief, Ali Larijani, is eliminated. There were some reports that were speculating about that. But now on Bloomberg, we have that official comment that's coming in there. Not sure how to read this, but another elimination from Iran's force. And one wonders who exactly is going to be the mediator now. But for the time being, at least, equity markets, they seem to be ignoring these news flows, and they're expecting things actually to de-escalate. And that's why you're seeing global equities itself have done well. So we'll keep an eye out on the bottom of the screen. Do you might want to say something on that front? All right. We'll keep an eye out on that. By the way, just keep an eye out on the Nifty. I just mentioned that 23,660 mark is the important mark, because the premium at the start of today on the 23,600 call was around 60 rupees. And there appears there is some writing out there. So those call writers, they'll be getting a little bit nervous as we are approaching 23,600 plus 60, which is 23,660. Keep an eye out on that mark. Rahul, you must be quite happy with the markets moving up as well. And I think you said that you all were allocating some money as well. Give us 2-3 stocks that you all have added. A simple one.
So I'll be a little bit more on the sector side. We have added some large cap private banks. We prefer these names. Some of them are trading between 1.5 times to 2 times price to book. Given the kind of geopolitical situation, we believe that the whole trade of NBFC to private banks will shift now. Given that the current account deficit, the liquidity system, there will be no further rate cuts. More or less for the private bank going further, the NIMs compression that was taking place will be more or less in 1 or 2 quarters be getting over. And due to the FI selling, there has been decent prices for the private banks that have come. We believe this will be a good entry point for a lot of private banks from here on.
Okay, private banks is one. What about some of these travel and leisure themes? You'll have liked a few of them in the past. For the time being, logically you can't buy into it because of the current uncertainty. But actually, these kind of times, if you get into some of these stocks, whenever the de-escalation takes place, they'll get up and going. How are you all approaching these themes? Hotels, I recall you all did one of those large trades out there, the Taj GVK deal. Are you all adding into travel and leisure stocks?
Yeah, so on the domestic side, right, all the domestic travel and leisure names, we believe are showing a strong growth. Even your RevPAR across the hotel industry continue to remain strong. The debate across the capital markets is whether the RevPARs or the average room rates will continue to grow, or they're going to get stagnated from here on. But we believe that given the demand supply, it's going to continue to move in the upward direction. We are not incrementally allocating, but we have a decent allocation to the some of these names there.
What about auto? The risk is of earnings downgrades on account of inflationary concerns. We've already seen Tata Motors commercial vehicles announcing a price hike, and autos was a sector where we were seeing volume momentum. Ever since the GST cuts in October, the numbers have been very strong. And if you hike too much, then that derails the volume growth story. So where do you stand on autos now?
See, back in 2019, right, when even for two-wheelers, when we moved from BS4 to BS5 and BS6, we saw the very sharp price increases in the two-wheeler segment itself in 2019. So historically, we've seen that once if there is a very sharp price increase, the volume immediately, there is a cliff and which stoops off. And given the valuation that we were standing point, more or less, we believe it could create some negative trigger or the valuation imbalance for the sector. And so we remain a little bit cautious on the auto sector as of now. So volume versus margin play will be a little bit challenging for at this point of time from a valuation standpoint of view.
So cautious across the board on autos?
we remain a little bit cautious there.
Okay, no, I meant that even for commercial vehicles where the narrative was that the CV cycle is just starting and cycles start for 3-4 years. So you're cautious on all passenger vehicles, two-wheelers, CVs, everything?
Absolutely. Given the valuation standpoint of view, we are seeing the volume growth, even if you consider 6% for passenger vehicles, 8 to 10% for two-wheelers, even for commercial vehicles, if you take mid-single digit, we are more or less certain that it is more or less priced in. The sector overall is a little bit on the upper side of the valuation.
Okay, all right. What else? What about metals? Aluminium, you saw a couple of days of profit taking, but the pricing that it's at, $3,400, $3,500 per ton. No one's factoring in a number of $3,100 as well per ton. So it's got a 10% buffer. How are you approaching, say, the ferrous, the non-ferrous names? Even some of these ferrous companies, they have that cushion now. Demand destruction is, I think, an important trigger. For the time being, the street is ignoring that. They're going by pricing and they're expecting things to recover. How do you approach that space?
So we prefer one of the large conglomerate. Plus, there is an incremental trigger there, catalyst. There is a demerger process that is going on for the conglomerate. 50% of the revenues comes from the aluminum side and rest is silver. So, and it has historically it had a very high dividend yield. Given the aluminum cycle, as you rightly mentioned, we prefer that conglomerate is one of the best place to be as of now.
No prizes for guessing. It's Vedanta that you're talking about. The only one that has a little bit of aluminium, a little bit of silver as well. So you'll continue to like that name, right?
Yes.
All right. We appreciate you joining in, Rahul. Thanks a lot for giving us a couple of ideas. Wishing you a good remainder of the day. For the time being, the bulls will be quite happy looking at the screen. Well, markets move in cycles, and for 26 years, we've been tracking them very, very closely. Because in a volatile time, what investors really need is insight, not just information. And above all, perspective, not panic. If you have a question about your investments, we're here to help you with guidance from experienced market experts who understand today's fast-changing market environment. So join our special market editors on Your Stocks and Mutual Fund Corner every day at 2 p.m. and stay one step ahead of the market.
Okay, on the other side of the short break, we'll get to check on dealing rooms. Nimesh joins in with D Street Chatter and a few BTST calls from our experts.
Welcome back. Well, a few stocks actually are doing well. The big boy HDFC Bank, that's moved to the high point of the day. Always helps actually when that big boy gets its form going. But it's that time of the show where we get in Nimesh to tell us what is he picking up in terms of D-Street chatter. Hey Nimesh, what's happening?
Hi Nigel, a good recovery for the second consecutive day. And again, the beaten down sectors like metals and autos are helping the Nifty to recover. And of course, the large cap names. Even yesterday, that was a case that the rally was largely led by the large cap names, and that continues in today's market as well. But what is more interesting is the IT index. All the IT stocks were massively under pressure in the first 1 hour of trade on back of massive selling. Looks like that got absorbed, and after that, we've seen a sharp recovery as well in most of the IT stock. In fact, the IT index has recovered almost 2% from the intraday low. So that's also helping the Nifty to gain almost 200 points in today's market. But what is more heartening is that today's recovery seems to be backed by institutional buying. I said this in the afternoon link as well, that the sense that at least I got in today's market is that it's backed by FI buying. If not very large FI buying, at least the FI selling seems to be much lower in today's market. So that's also helping at the margin for the Nifty and the Bank Nifty to recover very smartly in today's market. And the buying seems to be largely in one particular sector, which is the power sector stock. So all the power names are well bid by large institutions in today's market from a flow perspective. Technically, we are heading into that big resistance of 23,800. If that gets taken out, the feedback is that maybe you'll see further sharp short covering rally, at least in the Nifty name. So that's the next level to watch out for. But two things: one, a decent pullback for second day running, and looks like today's pullback is backed by some bit of institutional buying as well.
Wow, that's good news, Nimesh. Good to hear. What about individual stocks? What are you picking up?
Well, the first stock is Urban Company. There was a large block in the pre-open trade, nearly 2.5% equity got changed hands. I understand the pre-IPO investors were sellers in today's block, and a single domestic mutual fund was a buyer. So if there are any disclosures, could be interesting to track in Urban Company. So that's the first name. The second name is Adani Power. I spoke about buying in power names. Adani Power stands out in today's market. So big delivery-based buying is my sense in Adani Power in today's market. So watch out for delivery volumes there. Same with the power theme. Even NHPC, while not big buying, but there are at least bids been shown, interest been shown from large institutions to buy into NHPC at current level. So that's the third name. The last one is ITC. Within the large cap names, ITC is the only stock which stands out in terms of aggressive selling. So expect high delivery volumes, and there is selling even at these levels in ITC from larger institutions.
Thank you very much for that, Nimesh. Let's get in then some BTST calls then. Mitesh is back with us. Mitesh, we almost crossed that 23,600 mark, went to hit a high of 23,650. Now paired a bid, but still hovering with a gain of about 160, 170 points. Crude prices have come off from the highs, and Brent is now below that $103 per barrel. So that is good news. Global markets have largely been firm today. What trades?
I have a BTST on BSC. I think, that's one stock which was flagged as a buy call yesterday as well. The stock pattern is very good, and the indicator setup is also positive. So keep a stop at 29.15 for a target of around 3,000, maybe more a year. And also a BTST on Federal Bank, which I would recommend buying with a stop at 262 for targets of 267.5 to about 268.
Okay, got it. Thanks a lot for that, Mitesh. Well, oil marketing companies, the likes of HPCL, BPCL and IOC, they continue to remain in the spotlight on the back of higher crude prices that have actually just cooled off as per what our ticker team is telling us. Let's go across to Sonal to understand what Kotak has to say on these stocks. Sonal?
Thank you so much for that. Well, yes, these stocks continue to be in focus earlier because of higher Singapore GRMs. Now those GRMs are in the negative, and now we are getting notes cutting target prices as well. There was one yesterday, and today there's one for Kotak Institutional Equities, where they are targeting, or they are estimating high crude prices going forward, $85 per barrel in this fiscal, and the next one at $75 per barrel, which will be because of disruptions that we are seeing in the Strait of Hormuz and West Asia war as well. And that is something which will continue to impact marketing margins of these companies. They also say that since they do not have any retail price changes or modifications that can be done easily, it will hurt companies' margins. And LPG shortages, there's negative public sentiment as well. So the headroom to increase fuel prices despite high crude prices is very less for these companies. OMC, so far, they have benefited from elevated marketing margins. That is because of low crude prices that we saw. But now most of this premium will be done away with because of high crude oil prices that we are seeing. They reiterate their sell rating and they've cut target prices sharply across all the three stocks, more so on HPCL because remember, HPCL has a higher exposure to marketing segment. So yes, the bearish sentiment continues. Now, even on the refining side, we have negative margins. And because they're not able to increase prices, marketing margins will also be impacted. So a twin impact is what we are seeing on OMCs. And with rupee depreciating to record lows, that is another dampener for these companies.
Okay, all right. Thanks a lot for that, Sonal. By the way, I think we need to keep an eye on a couple of stocks actually, because we're getting some comments that are coming in from the Ministry of Petroleum as well as Gas. And this is the first time I think they're categorically going ahead and saying it, wherever possible, induction cooktops should be used and LPG should be conserved whenever possible. Last week we had a bit of a spurt in stocks like I think TDK Prestige as well as Stovecraft. I think they'll continue to remain in the spotlight, because this is the comments that are coming in from the ministry itself. They are encouraging the use of induction cooktops, and they're saying that LPG actually should be conserved. So I think both these two stocks actually will continue to remain on your radar, both Stovecraft as well as TDK Prestige. We should get actually the line coming up for our viewers on the screen as well. Our ticker team will put that out in just a bit. First time they're actually talking about induction cooktops. Let's welcome Jay Bala, who joins us on the show. Hi, Jay. It's been a while since we spoke. What's the updated call? Are we going down from here, or do you think we made a bit of a bottom at around that 22,900 and we'll, go north from here on?
Hi, Nigel. Good to be speaking to you. See, I believe the markets have two possibilities. Either the low that the market saw yesterday, 22,955, that's either the bottom. That's not my preference. I would like to see the markets to make one more low below that 22,955. If it does that, then we are looking at a very significant move higher. We're going to be speaking next after 2 weeks, Nigel. I'm going to be away for the next two Tuesdays. So we're going to be speaking in April. So when we speak in April, I expect the markets to be more convincingly bullish, and the doubts that are hanging over the markets, I would have expected that to evaporated by the time we speak the first week of April. So the second possibility is is my preference for the markets to make the low below yesterday's low of 22,955. So we have when I look at the Bank Nifty or the Nifty, that's the same picture, or even the Nifty IT. So the next low would be a very important low. In the event that the markets have already bottomed yesterday, that's not an ideal scenario for the longer term case, because the markets could rally all the way up to 24,500 or even 25,000, and then it'll come back one more time to 23,000. But in both of those situations, the medium term is bullish for the markets. So let's see what the markets does. We'll evaluate as the markets unfolds.
Got it. All right. Tell us levels that you're looking at just to revise it. Yesterday's low, 22,900. That would be the first level of support.
Yes, and that support below 22,955 is 22,850 and 22,360. So basically, even if the markets were to tank up to 22,360, that wouldn't change my medium-term bullish outlook. I'm not expecting that to happen. I'm expecting the markets to make a fleeting low below 22,955, the low registered yesterday. So, so from a medium-term perspective, the markets are bullish. The short-term resistance are at 24,194 and 24,572. And when we speak the next 2 weeks, I expect crude to have crashed much closer to the $65 mark, and that would have, I believe, would have changed the scenario for a lot of inflation pressures, growth doubts, and all those things.
If you're saying that crude is going to crash to around $65, the markets will get up and running. The mojo will be back. Let's see whether or not that happens. But as you're saying, our next date is in April. Got that. Couple of trading ideas, individual stocks. Let's get that out of the way.
Yeah, the first is I like the ETF Grow Defense in India ETF. It's trading at about 80 now, a stop loss of 73 there, and it's looking bullish for me from here on. The other pick I have is I'm bullish on Jyoti CNC Automation against the stop loss level of 686. I'm anticipating this to rally to about 860. Maybe it can rally higher. This is a relatively new listing. From the listing low to the all-time high, the stock is pulled back to the recent lows at that's about nearly 50% Fibonacci retracement. And at the low, there's a hammer pattern and there's a positive divergence in the momentum readings. So I anticipate this to at least be a short-term bounce back, if not a change of trend.
Thank you. Jay, we'll come back to you. Just need to get into a break. As we do that, let's also get in an important market voice. Following the geopolitical uncertainty, consequent risk to India's macros and equities, Morgan Stanley, about 10 days back, downgraded India to an equal weight. In an exclusive conversation earlier today, he tells CNBC TV 18 the reason why he downgraded India. He says it's more sensitive to oil and gas imports and therefore prospects for India are dimming in this environment.
We made a number of changes to our recommendations about 10 days ago, and it's really all to do with the framework that we're in right now in relation to oil and gas supply. It is unfortunate for India because in January, the manufacturing and services PMIs moved up. And we obviously have had significant policy easing in India, and we had been cautiously optimistic about the business cycle turning and running a small overweight. But unfortunately, India is one of the countries in our coverage that has the most sensitivity to oil and gas imports within GDP. It's actually the third highest after Thailand and Korea. And so the prospects for the economy are dimming in this environment. So broadly for Asia Pacific, we are in the world where if we do sustain interruptions to product flowing through the Straits, and you can proxy that through the Brent oil price going to $120 to $130, but obviously some regional benchmarks are well above that, and there's quantity issues as well as price issues. In that world, we would see around 15 to 20% further downside. Broadly, Asia has declined around Asian equities around 8%.
Welcome back. 23,550 on the Nifty. It's a good 100 points off from the session highs. But all in all, we've added about 400 points in the last two trading sessions. Mid-caps are outperforming today. The mid-cap index has got a gain of nearly 1% with an advanced decline ratio standing at 3:2. Jay, would you take comfort from the fact that the IT index managed a recovery from the day's low? It's ending in the red, but there was some buying emerging at lower levels.
Yeah, that's true, Rima. It is doing what is expected to do. You know, the final sequence of the Nifty IT's decline, although it's not complete, but what it is doing right now is within the parameters of its expectation. And I pointed out that when it broke 30,900, the next support comes at about 26,000. 26,000 is not a round number or an exact number. If the markets were to get close to that, that's good enough. But the price structure is what is important. And TCS, though, is a little bit disappointing within that, but Infosys is starting to look positive. But you have to wait and watch, even from the current levels of about 28,000 and change. If it were to get to 26,000, that could be still a considerable downside. So it's still not yet time to bottom fish here. Let the market signal that it's turned around, and then we can look at Infosys. But, the downsides could be very limited.
Jay, two factors actually were playing out in our favor, though the Indian markets didn't react that much. In fact, we underperformed. One was the dollar index that had cooled off substantially, and the other was Brent crude prices. Now, the dollar index is creeping up. It went to around, I think, 100.5, and then it cooled off overnight. Do you think that's seeing some resistance at around 101, or do you think the dollar index can return back to be boss? That is, say, move to around 105, 110 odd mark.
Yeah, that's a very important point that you're making. 101 has got multiple resistance out there. If you look at the long-term charts, it's come down from this level of 101 several times. So, it is facing a bit of resistance there. But I think the dollar index on a short-term counter-trend bounce, that could take the dollar index to close to 103. But, that will have a positive impact related to commodities in the sense positive for the equity markets. That will push the commodity complex lower as the dollar index continues its counter-trend move. I expect that to put pressure on precious metals and crude, because most of them are priced in dollars. So it's doing a counter-trend bounce. 101 is a very important resistance. But it's still not done in my opinion. If it were to close below 98.5, then we can revisit this thesis.
Okay, Eternal, big move today. It's a 40% correction from the top. So it's oversold, but does it have more legs to go?
No, not yet. It needs to go down to at least 190s and change for it to complete the correction. The medium to long-term picture, though, is very good. Because it's rallied from its post-listing low to record highs of about 360 in a five-step fashion. So this is undergoing a medium-term correction. So this is a short-term bounce and a counter-trend bounce. I would anticipate Eternal to drop to at least 190s before resuming its long-term uptrend.
Okay, all right, Jay, we appreciate you joining in and giving us your take on the market mood, as well as the calls you're making both on Brent as well as on dollar index. And as you said, see you next in April, the new fiscal year. Hopefully, it'll make you as well as all the investors that watch us a lot of money. Catch you soon. Time to wind down the markets. Another day when the markets ended with solid gains of around 150 points. But I'll tell you what, we came off closer around 80 points in the highs of the day. That said, a few stocks did very, very well in today's trading session. Some of the badly beaten down stocks, they bounced up. Eternal was up 5.5%. Tata Steel, Tisco did the disco, up 4.5%. Mahindra & Mahindra is gradually pulling back post the recent correction. That's up closer to around 3%. And HDFC Life, that is well up 2.5%. What did do well? Well, tech stocks actually did come in for selling. Wipro, Infosys, TCS, all of them were down in trade. But keep in mind, actually they've relatively outperformed for the month of March itself. From the broader markets, a lot of stocks did a thing of their own. Well, in terms of big movers in today's trade from the broader markets, you had stocks like SAIL that was up 6%. Metals actually bounced back. The last 4 trading sessions, I think the index itself was down close to around 8-9%. And now, in fact, you had SAIL, NALCO, MCX as well, another commodity play as well as Tata Steel did well. EMS stocks post the correction, they have bounced up. Whether you look at Amber, that one as well did pretty well. And APL Apollo Tubes, that one as well did do pretty well. Rima, what else?
Well, defense stocks across the board saw a lot of buying. So we had Idea Forge, Data Patterns, MTAR Tech, Mishra Dhatu, Garden Reach, BEL towards the end also saw some order win to the tune of about 1,000 crore. The IT index ultimately ends with a cut of about 1%, but there was still a recovery of 1.5% from the day's low. But you had softness in many mid-cap names like Tata Elxsi, a Persistent, and Oracle Financial, Hexaware. These are stocks ending with cuts of 1.5%. On the way up, though, Birlasoft in the IT pack managed to have a pretty strong close. The bell is gone and the Nifty ends with a gain of exactly of 150 points. 23,550 conquered on the Nifty. Sensex higher by 500 points. Mid-cap index is a gain of over 1%. It's a good follow-on buying today. Didn't close at the session highs, but the second half of the trading session did see some upward momentum. We're going to take your leave on this edition of Closing Bell. Thank you very much for watching. Don't go anywhere. On the other side is Markets Forward.
Markets close higher after a choppy session. The Nifty holds above 23,550, extending gains for a second straight day. Mid-caps bounce back, snapping a 4-day losing streak.
Oil marketing companies remain under pressure after quota cuts target prices for IOC, HPCL, PPCL by about 20%, citing rise in crude oil prices as well as issues linked to LPG shortage amid West Asia conflict.
Eternal and select EMS stocks surge on bullish brokerage calls. JM Financial says Eternal will emerge stronger once macros normalize, while Amber and Sirma are JP Morgan's top EMS picks. Hello, welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Hormas Fatakia. With me is Vinny Motiwala. Vinny, good afternoon.
Good afternoon, Hormas. And it's been a day where we saw volatility, but then in the second half of the trading session, we picked up pace in terms of the Indian markets, closed with gains of more than 172 points. That's what the Nifty did, almost 170 points more than that. About the 23,500 levels, near 23,600 levels. No complaining on that front. Broader end of the market too.
You know, we've been mentioning this in the morning, that the fact that the Nifty bulls would take some confidence if we have a similar close to where we had from either at the highs of the day or close to the highs of the day. We have had that. It's something similar to what happened yesterday as well. We closed close to the highs of the day. Even today, we have closed nearest to the highs of the day, around about 100 points off the highs, but the bulls will take that 170-point gain. Although never can't take away from the fact that it was an extremely choppy session nonetheless. But the other big thing, unlike yesterday when the broader markets ended in the red, the broader markets today have ended in the green. So that's another positive that the bulls will take, and the broader markets in fact have ended at the highs of the day. So that is another confident key for the bulls to take. So as of now, 2 straight days of gains. The Nifty has rebounded almost 600 points now from yesterday's low. So the bulls will take that with both hands.
Okay. Surely bulls will take that with both hands. We'll see that if this continues in tomorrow's trading session will be key to watch out for. But we have a very exciting lineup for you all in store today for the show. We'll start off with the top movers and shakers of the day with Vivek. Then we'll move on, and well, it was largely a brokerage-driven day on the street with OMCs, eternal EMS players moving in trade on the back of brokerage notes. We will get you the details of that in just a bit. Then last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. On that note, let's move on to the first segment of the day. Vivek is joining us from the big world to take us through the top movers and shakers. Over to you, Vivek.
Well, thank you so much for that. Like you mentioned, a choppy trading session, but we managed to end largely with gains, especially in the broad end of the markets where advances far outpaced the declines, especially in the last hour or so of the trading session. In terms of individual stocks and sectors, what is it that we were tracking? Well, the entire metal pack did very well, a very sharp recovery. Look at Nalco up almost 6.5%, Tata Steel almost a 4.5% gain. Moil came out with an investor presentation, very aggressive guidance given for the next couple of years. Street like that, locked in the upper circuit. So the entire metal pack doing quite well. Along with that, exchange stocks, both BSE as well as MCX, in the context of the upcoming NSE IPO, both doing quite well. BSE recovering quite sharply, and MCX continued the up move that it saw yesterday, almost 5% higher today. Data patterns, MTA Tech, 2 names from the broad end of the markets, 2 defense names, continued their up move today. Both of these names, remember, have been doing very well of late, especially post the beginning of the conflict. Both of these stocks up on strong volumes as well. Eternal, 1 name for the broader markets, almost a 30-35% correction that the stock has seen, but today almost a 6% uptick. JM Financial says most of the concerns are overstated, and they suggest to aggressively buy the dip in this particular name. And the Realty pack, after a while, saw a bit of buying emerge. Some of the top traded names today were DLF, Oberoi and Phoenix, so well-bid names across the space today. On the other hand, the IT pack, the underperformance here continued, especially in the mid-cap IT space. Persistent, Tata Elxsi, all of these names ended with deep cashes, especially when you're looking at the markets today. Reddington was another stock. Some negative news were coming in terms of Gulf operations getting impacted. That stock ended lower today. OMCs, HPCL, BPCL, as well as IOCL, all 3 of the oil marketing companies continued to drag further. And lastly, the entire consumer durable pack, after a brief recovery in the last couple of trading sessions, most of these names gave up the gains. Radico Khaitan down over 3%, Dabur too underperforming quite significantly.
Vivek, thank you for that. And as Vivek was highlighting, it was the up day for the markets, but a down day, another down day actually for the oil marketing companies. All of them declined between 1 to 3% after Kotak reiterated its sell recommendation and also cut its price targets on all of these names. Sonal is joining in with more on this. Sonal.
Well, second day coming, there are target price cuts for oil marketing companies. The stocks are lower, and that is on the back of a Kotak institutional note where they say that they expect crude prices to continue to remain at higher levels. For the next fiscal, they are targeting or guiding or expecting an $85 per barrel mark on crude oil prices, $75 per barrel in the next fiscal, and that is because of West Asian crisis and the disturbances we are seeing at Strait of Hormuz as well. Now remember, all this would impact their marketing margins. Remember, Singapore GRMs are already in the negative territory, but because of higher crude oil prices, these companies for now are unable to pass on these high crude prices to customers. Already there have been worries around LPG shortage. The sentiment is not so good at a consumer level, so these companies really cannot go ahead and take a price hike, and that is something which will continue to impact their marketing margins. Now remember, these companies did enjoy higher marketing margins in last couple of months. That is because crude oil prices were at a lower level, but the premium now is something that they will not be able to enjoy, and hence they reiterated their sell call on these stocks. But they do believe that LPG storage, the capex there, will continue to increase from here on, so they are watching out for numbers on that front. The numbers are at the screen for you. There is a sharp cut across all the stocks in terms of target price, a sharper one for HPCL because this company has the highest exposure to the marketing segment. But yes, increasingly there are bearish comments coming in on all oil marketing companies because of high crude prices, which continues to be above that $100 per barrel mark.
Okay. Thank you so much for that, Sonal. But let's take this discussion forward. We have our guest joining us and experts joining us right now. We have Jay Bala from Cash the Chaos as well as Sandeep Bandyopadhyay from Indie Trade Capital Limited joining us to talk to us more in terms of the markets and individual stock names. Jay, let me talk about the markets first, right? Today, we did close more towards those highs of the day. Hurmas was also mentioning at the starting of the show that there's a trend where we're closing towards the higher point of the day. What's your view in terms of the levels for the Nifty? What are we keeping an eye out on for tomorrow's trading session?
We are very close to an important turning point for the markets. There are two possibilities from here on. Either the low registered yesterday already put in a bottom. That's not my preference. I would like to see the market, make one more lower low below 23,955, which was 22,955, which was a low yesterday. That would complete the price structure of the decline from the record highs, and that would put the market on course for record highs. I know the gentleman sitting next to you holds the key to the world economy. Probably he can do something about the Strait of Hormuz. So, but jokes apart, I'm expecting crude to crash from here on to touch something like mid-60s. So I think it can, that can change the inflation pressures that the world is facing, and probably the growth risks the markets are expecting out of the higher crude prices. I think that's going to change, and that's going to change a lot of things for the market, for the global economy. So watch out for it. We are very close to an important low. If the markets have already put in a bottom, that's not my ideal case. The reason for that is I'm anticipating the markets to rally to 25,800 and then come back one more time to 23,000. That's the reason why I don't want yesterday's low to be the important low, because that will delay the medium-term progress to record highs. I would like the markets to have a washout low below yesterday's low, and then it can do much more significant progress in the medium term.
Well, if only the gentleman sitting next to Vinny could have done a lot to ease the tensions, but the gentleman sitting in Washington can definitely do a lot. Sudeep, thank you for joining in as well. You heard Sonal talk about these oil marketing companies. There was this period between 2022 and 2025 when they made hefty profits with oil prices remaining at lows, and all of these stocks incidentally were at 52-week highs before this crisis began. But now with these oil prices rising and margins under threat and so on, do you believe that the best is over for the oil marketing companies, or do you believe that this is okay, this is a temporary phase, and once the crisis dies down sooner or later, then you would get to see a resumption of where things were before the war started?
Well, if the oil prices come back to where they were, which is around $60 per barrel for Brent, they will again be good times for them. But I think in the interim, they are definitely getting affected in a big way. There is no way government will let the bunk prices increase, and there are 4 states which are going to face election in next month. So under these circumstances, they will have to absorb this loss. That erstwhile formula of 3-way sharing of losses, I don't think whether it works or not or will work or not. But as things stand today, the oil marketing companies are going to lose in terms of the margin is concerned. So now definitely tough times for them. So it's definitely avoid as far as these companies are concerned. Now the question of thinking of future opportunity and picking up, I would say let's refrain from doing that. Let's wait and watch the scenario. There will be better times to pick up these stocks.
There will be better times to pick up these stocks. As of now, wait and watch is the word coming in here for these OMCs. But let's move on and talk about Eternal. The stock actually surged in today's trading session, and this came in after a positive note from JM Financials. The brokerage said that it strongly believes that the company will emerge stronger once macros normalize. Let's go across to Mangalam to get in more details on this note as well. Mangalam, over to you.
Well, Eternal was among the top Nifty gainers in today's trading session. Remember, the stock is down about 40% from its 52-week high. So we had a note that came in from JM Financial where they say that the reasons for decline, which included the likes of concerns around leadership changes, high competitive intensity in quick commerce, new competition in food delivery, and some global macros like AI and Middle East sort of conflict as well, they believe that the company will emerge stronger once these macros normalize. In fact, in the fourth quarter of FY26, they believe that Blinkit's net order value is likely to expand by low double-digit quarter-on-quarter despite high competitive pressures, and they expect a decent uptick in their EBITDA margins out there as well to about 0.4% versus break-even that the company saw in the third quarter. Even in the food delivery, they believe that there could be an 18% growth in the net order value, and even if you account for nearly 25% of disruption of orders because of the LPG crisis, they believe that the NOV can still grow at 15%. And the reason why the stock has declined has perhaps, priced in a little more than that already, which is why they believe that at current multiples and at current levels, the stock is trading at 35 times March 28 price to earnings. And it is a buy for the next 15 to 18 months as per them. In fact, they've gone ahead and rolled over their target as well, and it's at around 400 rupees, which is currently unchanged, largely because of the rollover that they've done to the next financial year.
Mangalam, thank you for that update. Top gainer on the Nifty today is Eternal. Sudeep, do you fall into the same camp as GM Financial does when it comes to Eternal? The stock has seen a substantial correction, yes, but do you believe that these competitive intensities and so on and so forth, are all of these concerns overdone?
Well, I won't say it's overdone, but as far as Blinkit is concerned, definitely they are moving very fast and well ahead of competition, in spite of the competitive intensity and the kind of slowdown, probably because of this West Asia conflict, which happened in March. I definitely expect even this fourth quarter to show good growth as far as Blinkit orders value and order numbers are concerned. This is the one piece of the business which was a bit of a concern from an analyst and investor point of view, but I think it's moving in the right direction. As far as food delivery business is concerned, I think it's a steady and stable business now with unlimited potential of growth. So if I'm a long-term investor after this correction where the stock is available, definitely it is a good buy from a long-term perspective. Look, if you believe in those platform companies and the growth prospect in India, I think Eternal is definitely a buy.
Okay. Let's move on and now talk about EMS players as well. JP Morgan remains bullish on Indian EMS companies, and this is despite the recent underperformance. And the brokerage firm expects 20% growth rate for FY26 to FY28 in terms of the industry, excluding Dixon Tech. More details, let's go across to Upasana for that. Upasana, over to you.
Well, certainly JP Morgan has put the spotlight on the EMS sector and has gone ahead and upgraded 3 stocks. That is Cyient DLM from neutral to overweight with a target price of 400 per share, upgraded Amber Enterprises to overweight with a target price raised to 9,000 per share, and has also identified Syrma SGS as one of the top pick of the sector with a target price of 1,050. Well, it believes that the EMS stock underperformance has led to investors question whether the sector story is over or not. It rejects this thesis and has a positive view on the sector and certainly believes that the long-term story for the sector is intact. It sees every stock barring Dixon delivering more than 20% of the revenue growth over FY26 to FY28, and it also sees the sector upping in terms of its value addition, evolving from finished products assembly to component and PCB manufacturing. In terms of valuation, the valuations have certainly eased out, seeing the current underperformance of the companies, but the key risk levels identified by the brokerage is at a valuation of 32 to 60 times 1 year forward PE for stocks that miss expectations. Overall, it believes that the Syrma SGS and Amber Enterprises are the most likely to beat the street expectations. Now, in terms of consensus rating also, if we look for all the three stocks, it has a over 80% buy, and in terms of valuation, if I see, Amber stands at 44 times 1 year forward, followed by Syrma SGS at 36 times and Cyan DLM at 24 times. So all in all, certainly this sector remained in focus today on the back of this note.
Upasana, thank you for that. Jay, you know, all of these EMS companies, be it Dixon, Keynes, all of them have seen a very, very sharp correction from their highs. Does anything now look attractive to you on the charts within these EMS companies?
Yeah, I would look Cyan DLM very closely. That's the only one that's looking to starting to look like a turnaround candidate. But I'll still wait a bit more. But when it comes to Dixon Technologies, I'll be very cautious. The rallies here could be just a relief rally. I think it could have a little more downsides to work with. But Amber Enterprises is just middling, and it's probably the biggest risk within the space. It could top out and turn lower. So, when I've spoken about Dixon Technologies, when it's trading about 16,000, I projected it to drop to about 11,000. It's come to 10,700, but still, it's still not put in a bottom. So, other than Cyan DLM, be a bit more cautious, and even in Cyan DLM, wait and watch for the turnaround.
Sudeep, what's your view coming in on these EMS players as well? Anything you like here right now in the basket specifically, or right now you're a bit cautious or avoiding them?
I do like, post this sharp correction which we have seen in the markets, all these stocks also have corrected significantly. So apart from the report which I think Upasana was talking about, I do like Dixon as well, because they are not talking about Dixon. I do like Dixon. I think Press Note 3 modification has been a landmark event for this sector. We have seen Dixon has already got one approval, the Vivo approval they are waiting for. And with that approval coming in, hopefully soon, I think they also will move into a between 35 to 40% kind of a growth trajectory. Other companies are well into that kind of a trajectory. Now, if you look at the valuation, I think Cyan DLM valuation definitely does look attractive at current levels. So if somebody is looking at valuation and growth prospect, I would recommend Cyan DLM at current levels.
Right, that was about these EMS companies. But the one stock that made headlines today after 1 o'clock was MOIL. The stock ended at a 20% upper circuit after the production targets that the company laid out earlier in the day for FY27. Also plans to increase its market share to 32% from the current 20% by FY30. Sudeep, do you manage to go through this update from MOIL? The stock was at a 52-week low today, and then from after the release of the update, the stock has seen a very sharp rebound. But does the narrative be enough for a stock to warrant a buy, because execution is something that still needs to happen and it is over a longer time frame? Would you just say that, okay, the stock is at a 52-week high, 52-week low, we may as well go with it?
No, definitely not, Harnas. I think what you're saying is right. Execution is what is critical. I would say it's a very ambitious and a stretch target which they have put out. Let's look at the execution. At least let the numbers come out in April for the fourth quarter, and how they are faring in March. Let us understand that before we get into this stock. Look, the stock has corrected significantly from its all-time highs, but I strongly believe that execution is the key. A business plan is not something based on which I think I will recommend a buy.
Okay. That's a view coming in there on MOIL as well. You would recommend a buy there, Sudeep. But Sudeep, as well as Jay, thank you so much for joining us on the show, as always, helping us understand individual names, as how should we be looking at them going forward as well in terms of trades for individual stocks as well. But on that note, we're going to sip into a very short break. We'll come back with top corporate voices along with key market events to watch out for in tomorrow's trading session. Stay tuned in. Welcome back to Markets Forward on CNBC TV 18. Now, let's go across to some of the top corporate voices that we had through the day as well. First up, we had the management of JK Cement. They told CNBC TV 18 that the rising input costs are set to weigh on the margins, but mid-May and June is where the packaging costs have also risen by nearly 100 rupees per ton. So we could see that impact that could come in that mid-May to June level. On the growth front, the company is expecting growth to rise from 7 to 8% on a year-on-year basis as well in the fourth quarter of FY26. That's the end of this quarter. So they're expecting strong demand despite all these concerns.
Now, the management of Electronic Mart told CNBC TV 18 that AC demand has gone up by 25% in the last 15 days. However, the segment's contribution to revenues remain below historical levels. Now, the company also added that the recent rise in induction cooker demand may not sustain for long once the West Asia conflict simmers down.
And before we wrap up this edition of Markets Forward on CNBC TV 18, let's go across to Upasa, who's here to tell us which are the key events to watch out for in tomorrow's trading session. Over to you, Upasa.
Well, first up, let us look at the global economic cues. US crude oil stock and even PPI data for the month of Feb will be out tomorrow. But the most important will be the FOMC interest rate meeting, which is held on 17th and 18th of March. But the final outcome will be out tomorrow, that is midnight. So we'll be keeping a close track on that as well. In terms of Japan, trade balance data for the month of Feb, and Europe, core CPI data will be out for the month of Feb, so we'll be keeping an eye out on that as well. Now, let us look at some of the key stocks that will be in focus on the back of corporate action. Midani goes ex-dividend tomorrow. Bajaj Healthcare, board meeting is scheduled to consider allotment of equity shares following the conversion of convertible warrants. And lastly, Paisalo Digital will also be in focus as board will consider and approve allotment of NCDs via private placement basis. Now, in terms of IPO, GSP Crop Science, which is a 400 crore issue, closes for subscription tomorrow. And now let us move on to some of the other important events. Mind you that the Japan's Prime Minister, that is Takichi's first official visit to Washington begins tomorrow. So we'll be closely watching out for any updates on that front as well. So all in all, looks like quite an eventful day tomorrow.
What hasn't been an eventful day in the last 2 weeks. Upasana, thank you for that update. We take a leave on this edition of Markets Forward from Vinny and me. Thank you for watching. More news and updates continue on the other side. Stay tuned.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Israel claims to have killed Iran's senior-most security official Ali Larijani as it continues to bomb Tehran and Lebanon. Israel also claims to have killed a senior Hezbollah commander in Iraq. The U.S. embassy in Baghdad comes under attack as a drone strike sparks fire. Crude prices remain above $100 a barrel after fresh attacks on a key oil port in UAE. No movement of oil tankers at the Strait of Hormuz today. President Trump renews a call for a coalition to secure the strait even as allies rebuff his overtures. The Sensex and the Nifty regained some lost ground after a volatile session. Mid-caps outperformed, snapping a 4-day losing streak. The rupee remains above 92 against the dollar. President Trump sets his sights on Cuba after U.S.-imposed oil blockade plunges the country into darkness with a total power blackout. Trump predicts the U.S. will have the honor of taking Cuba and declares he can do anything that he wants. The Afghan government claims at least 400 people are dead and hundreds injured after an alleged airstrike by Pakistan on a hospital. India condemns the attack, calling it a cowardly and unconscionable act of violence. Pakistan denies the claim, saying it only targeted military and terror infrastructure. Reliance Industries signs a 15-year green ammonia supply deal with South Korea's Samsung Group, valued at over $3 billion. This is one of the largest long-term green ammonia deals as India emerges as a key exporter of indigenously produced green fuel. NVIDIA CEO Jensen Huang projects $1 trillion in semiconductor sales by the end of 2027, releases new products designed for AI inference, which is the form of computing that allows models to respond to user queries. Well, the big global story. It is day 18 now of the war in West Asia and the big developments of today. Israel's defense minister has made a big claim. Now, they claim that Iran's security chief Ali Larijani has been eliminated. Officials from Iran are yet to confirm or deny Israel's claim. The 67-year-old Larijani is a long-time political insider who served as secretary of the powerful National Security Council. In 2009, the Time magazine called Larijani the Kennedys of Iran. Larijani's father was a prominent religious scholar and his brothers held powerful positions in the country. Larijani has been a vocal critic of the U.S. since the start of the conflict. Now, last week, he had marched through streets of Tehran, daring the U.S. and Israel to kill him. He's repeatedly claimed that President Trump launched the war to distract from allegations in the Epstein files. Remember, just after that claim that came in from Israel, Larijani's Twitter handle has posted what is allegedly a handwritten note by Ali Larijani. Of course, as we pointed out, there is no official statement that has come in from Iran in response to Israel's claim. Now, the Israeli military has also hit dozens of targets across Iranian cities of Tehran, Shiraz and Tabriz. Apart from defense infrastructure, Iran's Space Research Center was also targeted. The Iranian government has not provided any details of military losses or damage. Explosions rocked the Lebanese capital of Beirut. The Israeli military has started what it calls limited ground operations against militant group Hezbollah. According to Lebanese officials, around 850 people have been killed since the start of the conflict. Meanwhile, Iranian missiles continue to be intercepted in Tel Aviv as sirens blared, warning people to stay indoors. No immediate casualties have been reported. However, residential buildings across Tel Aviv and East Jerusalem were damaged on account of shrapnel from Iranian missiles, which fell on the roofs of those buildings. Now, several drone and rocket attacks targeting the U.S. embassy in Iraq. The strike on the embassy came after militant group Hezbollah announced that its senior security commander had been killed in Baghdad. This marked the third attack on the U.S. embassy in the Iraqi capital since the last week. Speaking to the media at the White House, President Trump has said he was shocked by the scale of Iran's retaliation, especially the attacks on Gulf countries. Trump said, and I quote, "No expert told him that Iran was going to attack its Gulf neighbors. That's not quite true because Iran itself had threatened that if there was to be an attack by the U.S. or Israel, it would result in a regional conflict." Take a look.
You were talking about Iran a couple times today and what they did after Epic Fury began. You said they hit Qatar, Saudi Arabia, UAE, Bahrain, Kuwait. Nobody expected that. We were shocked. Are you surprised that nobody briefed you ahead of time that that might be their retaliation?
Nobody, no. The greatest experts, nobody thought they were going to hit. They were, I wouldn't say friendly countries. They were like neutral. They lived with them for years. I heard they were sending missiles to UAE. I said, that's strange. You know, UAE is like the banker for Iran. They're like the banker. Qatar, their neighbors, they got along okay. Saudi Arabia. All of a sudden, Kuwait is getting hit. Bahrain is getting, all these countries are getting hit. There was no expert that would say that was going to happen. It's not a question of like, gee, should you have known? And if we did know, big deal. I mean, we have to do what we have to do.
Well, that is President Trump speaking in the White House. Moving on to crude prices remain above the $100 mark after top NATO countries shrugged off Trump's demand to escort ships in the Strait of Hormuz. President Trump expressing frustration that some nations were reluctant to participate in renewed calls for allies to help restore shipping at the crucial choke point. No oil tankers crossed the strait today. The visuals on your screen is from marine traffic. This is a time lapse of the last 1 hour, which shows no movement of ships at the strait. Shipping analysts say that 250 petroleum tankers in the Persian Gulf remain anchored at sea, and the backlog will take weeks to clear even after the waterway is safe to pass. The ships that are currently anchored near the strait are also coming under sporadic attacks. An unknown projectile struck a tanker that was anchored near a key oil port in the United Arab Emirates. This is the third attack on the port since Saturday. More than 24 commercial vessels have been attacked so far this month. Oil and ship tracking firm Kepler says 17 oil tankers have sailed through the strait from the 1st of March until Sunday. 7 of them flew the Iranian flag and were most likely headed to China, as it buys most of Iran's US-sanctioned crude. Maritime analysts say vessels broadcasting their destinations as Chinese affiliates have been allowed to pass. 3 tankers made it through the strait over the weekend compared to 40 in a 2-day period before the war. 2 of these tankers are loaded with LPG that was headed to India. 1 LPG tanker, Shivalik, docked in Gujarat's Mundra port yesterday. A second LPG carrier, Nanda Devi, also arrived at the Badinar port in Gujarat. The vessel is carrying 46,500 metric tons of gas. These are the only 2 LPG tankers to have arrived in India since the start of the war. Here's President Trump renewing his call for allies and other nations to secure the Strait of Hormuz.
We strongly encourage the other nations to get involved with us and get involved quickly and with great enthusiasm. I have that from a number of them, and I'd like to say their names, but frankly, I don't know if they would want me to or not, because maybe they don't want to be targeted. But I say, wouldn't matter if you're targeted or not, because this is a paper tiger that we're dealing with now. It wasn't a paper tiger 2 weeks ago. It's a paper tiger now.
Well, that's President Trump there. Now, the United Arab Emirates continues to bear the maximum brunt of Iran's attack on the Gulf nations. Tehran has reportedly fired over 1,800 missiles and drones that target the Arab nations since the war began. Now, the country has reopened its airspace shortly after a brief shutdown. However, Dubai civil aviation authorities indefinitely barred foreign airlines from landing at the 2 airports in the city. The authorities have already issued notices to foreign carriers. Numerous flights between India and Dubai have been cancelled. Indigo and SpiceJet have confirmed that landing permissions have been suspended until further notice. 2 energy facilities in the UAE have also come under attack from Iranian drones overnight. Dan Murphy joins us with the latest from Dubai. Dan.
The UAE has continued to come under Iranian missile and drone attacks today. In the early hours of this morning, residents here received emergency alerts on their phones as the Iranians continued to target critical infrastructure on the ground, in particular energy infrastructure. And in the last 24 hours, we have now seen 2 drone attacks on the Fujairah oil industrial zone. This is one of the UAE's most important oil facilities. What we've seen there is a fire being contained, authorities saying no one has been injured. But what this ultimately shows is that the Iranians are still seeking to target critical infrastructure and in particular disrupt energy flows as well. This also follows what was another attack on the Shah gas facility in Abu Dhabi as well. This is one of the most important gas facilities in the country too, responsible for a huge portion of domestic electricity supply. We have also learned that a fire there is being managed. Again, officials say no one has been injured, but of course this is a real concern for the UAE.
Dan Murphy there reporting from Dubai. And President Trump has now set his sights on Cuba as the national electric grid has collapsed there, leaving millions without electricity. This is the latest in a series of widespread power outages that have hit the country. A recent U.S. blockade on oil shipments to the island has worsened chronic fuel shortages. Trump has said he believes, and I quote, "I have the honor of taking Cuba." He also claimed he can do, and I quote again, anything he wants, even as the U.S. engaged in negotiations with Cuban officials.
All my life I've been hearing about the United States and Cuba. When will the United States do it? I do believe I'll be having the honor of taking Cuba. That'd be good. That's a big honor.
Taking Cuba.
Taking Cuba in some form, yeah. Taking Cuba. I mean, whether I free it, take it, I think I could do anything I want with it. You want to know the truth? They're a very weakened nation.
I can do anything I want with it. That is President Trump on Cuba. And staying with Trump, he's claimed that a former U.S. president told him in private that he regretted not taking military action against Iran. Trump refused to reveal the identity of the former president. However, the claim has been strongly disputed. NBC reports that representatives for all 4 living former U.S. presidents have said none of them had spoken with President Trump recently. Their responses shared through their aides directly contradict Trump's assertion of a private conversation. And here's President Trump making that comment.
I spoke to one of the former presidents who I actually like. I actually speak to some. I do like some people, be shocking. And he said, I wish I did what you did. Could have done it. Other presidents, somebody should have done it. 47 years this went on. They call Iran the bully of the Middle East. And you could have never had the Abraham Accords. You could never have had peace in the Middle East. Now you're going to have peace. You could never do it with the dark cloud of a nuclear Iran.
Well, President Trump with his claims back home, the Sensex and the Nifty regained some lost ground after a volatile session. The Nifty closing above the 23,500 mark. All benchmark indices closed higher today for the second straight session. So 170 points higher on the Nifty. The Sensex up 570 points, 462 higher on the Nifty Bank. And the IT index was actually up by, the auto index was up by about 2%. Remember, that had taken a beating last week. Mid-caps outperforming, snapping a 4-day losing streak. The price of Bitcoin, by the way, has surged to a 6-week high, close to the $74,000 mark. The rally coming as a wave of short liquidations forced bearish traders to close positions, pushing prices higher across the digital asset market. $330 million in short positions were liquidated across the crypto derivatives market. Returns of consistent inflows into spot Bitcoin ETFs also supported prices. Now, the Indian and global pharma sector continue to grapple with supply chain constraints. Nearly 100% of pharma feedstocks are linked to oil, making it difficult for companies to procure raw material to manufacture medicines. Ekta standing by to explain to us how difficult the situation is both for India's pharmaceutical industry domestically as well as India's pharmaceutical industry as it looks to continue to export to the US. Ekta.
The ripple effects of the West Asia tensions may not end with oil. They could extend all the way to the medicine cabinet. A large share of commonly used medicines, from paracetamol and ibuprofen to one of the world's most widely used diabetes drugs, metformin, are derived from oil. Industry estimates suggest 90 to 99% of pharmaceutical feedstocks are linked to oil, creating a direct dependency on energy supply chains. India sits at the core of this ecosystem. It accounts for around 20% of global generic drug supply and nearly 40 to 50% of US generic prescriptions, while also being heavily dependent on imports for inputs. For example, 39,000 crores worth of APIs and intermediates were imported in FY25, and majority from China. The vulnerability stems from energy exposure. India imports roughly 40% of its crude via the Strait of Hormuz, and many pharma inputs are directly derived from these feedstocks. For now, companies maintain that the situation is stable. Larger Indian pharma companies typically hold 2 to 3 months of raw material inventory and 3 to 6 months of finished stock, while global distributors operate with 30 to 60 days of supply. However, cost pressures are beginning to emerge at the margin. Air freight rates used for exports to the US, for example, are up around 15 to 30%, say industry watchers. Shipping rerouting is adding 10 to 20 days to transit times, increasing cost and cold chain risks. Power and energy account for 20 to 25% of API manufacturing costs. Container costs have risen 2 to 3 times, while intermediates and packaging inputs are up around 10 to 15%. There are also early signs of supply tightness. Some companies are seeing shortages of IBB, which is a key raw material for ibuprofen, which is produced using LPG-linked feedstocks. The concern is if, in case these disruptions persist, generic drugs account for 90% of prescriptions in the US and majority are from India, making them highly sensitive to sustained input and logistic cost disruptions. If current disruptions extend beyond these existing buffers, the likely sequence, analysts say, is, for example, margin compression, price increases, and eventually maybe some selective supply delays in high-volume therapies. For now, there is no immediate shortage, but it is clearly a space to monitor.
Prices, despite the fact that they are going up, all the pharma companies at the moment have got the inventory of 3 to 6 months. But over a period of time, if the crisis lasts for a longer period of time, it will start impacting, because as Ekta rightly pointed out, that energy cost has gone up 40%, freight cost has gone up around 1.5 to 1.6 times, and there's a delayed supply. So it will have an impact if the crisis continues over a period of time.
And staying with the pharma sector, Indian pharma giant Zydus and Lupin will co-market a semaglutide injection in India. In separate filings, the companies have announced a licensing and supply agreement to co-market the injection. This will be aimed at expanding access to advanced therapies for diabetes and weight management. The arrest of Fino Payments Bank MD and CEO Rishi Gupta is unlikely to impact its banking license. Sources say no irregularities were found during RBI's rigorous checks before the license was granted. Bankers also believe the CEO may get a clean sheet eventually. The Telangana High Court has deferred the pronouncement of its orders in the case of the MD and CEO's arrest to the 20th of March under provisions of the GST Act. The arrest was made under the GST Act provisions. The order was expected today, will now be out on the 20th. Reliance Industries has inked a 15-year green ammonia supply deal with South Korea's Samsung Group, valued at over $3 billion. Sonal standing by with more on the significance of this deal and its contours.
Well, yes, it is a strategic announcement which is made by Reliance Industries, an important one at that. No immediate financial impact, but it is a long-term strategy. So if you take you through the news, Reliance has signed a $30 billion green ammonia offtake with Samsung C&T Group. It will begin from second half of calendar year 2029 for a period of 15 years. As I said, this will provide long-term visibility for Reliance's upcoming green hydrogen and ammonia platform as well. There is no immediate financial impact that we will see, but they do have an investment here, and they are seeing some customers which will come by in the new energy business as well. ICICI Securities says that this validates Reliance Industries' integrated green hydrogen approach, and it can create an anchor demand for hydrogen as well. Now, do remember they had announced this massive capex for their gigafactory, which will have the entire supply chain for new energy, and this is a step in that direction. This will give more confidence for financing project capex, according to ICICI Securities, a significant milestone. Not from a short-term period, but a long-term period where they will be providing green ammonia, which is also a step towards green energy transition that we have been talking about.
All right, so many thanks. Up next, NVIDIA CEO Jensen Huang projects $1 trillion in semiconductor sales by the end of 2027. That and more when we return. Well, news from the aviation space. Airlines have sought the government's approval for fewer flights in the upcoming summer schedule, which runs between April to October. This as per sources to our sister channel CNBC Awaaz. We learn airlines are proposing a 20% reduction in flights. Last year saw 25,600 weekly flights. This year likely to have 23,000 weekly flights. The aviation regulator, the DGCA, has yet to sign off on the summer schedule, which will be released soon. This could be on account of the fact that there are, of course, airspace closures, etc. But more importantly, the flight duty time regulations which have kicked in could perhaps have led to this kind of recheck and a reorientation. Several startup airlines that received the government's green signal almost a year ago are still nowhere close to taking off. Sources tell CNBC TV 18 none of the aspiring airlines have got a no objection certificate from the Civil Aviation Ministry, have progressed to the next stage, which is securing the air operator certificate from the DGCA. Madhiya is standing by to tell us what is keeping these airlines away from the runway. So Madhiya, a whole bunch of startups waiting in the wings, quite literally. No one even close to the tarmac, forget the runway.
Right, Shireen. 4 players actually who got NOC from the Civil Aviation Ministry. The biggest hurdle right now is unavailability of aircraft. Startups such as Air Kerala, Al Hind Air, Shank Air and Fly Express had received approval to start airlines, but they're struggling to secure aircraft leases from global lessors. And here's the key issue. Lessors want to see clear financial backing before they hand over an expensive asset like an aircraft to completely new players. Industry sources say that startups are typically expected to show at least 50 to 100 crores in bank balances or financial guarantees before any lease agreement moves forward. In fact, industry players say even if promoters are financially strong, that alone is not enough for lessors who look for 3 key things: proof of funds, a solid business plan, and experienced management team. There's also another expectation that a startup airline should ideally have a plan to scale up at least 3 aircraft within the first year of operations to be able to make the business sustainable and convince the lessors. So the takeaway really is this: getting government approval is just the first step. The real challenge for startup airlines is convincing aircraft lessors that they have the money, the plan and the management to sustain operations successfully and profitably.
All right, Madhiya, many thanks for joining us. So no takeoff yet for India's startup airlines. NVIDIA CEO Jensen Huang has projected $1 trillion in semiconductor sales by the end of 2027. Speaking at the NVIDIA GTC conference, Huang also released new products designed for AI inference. Rachna joins us now with the key highlights from what Huang had to say. Rachna.
Well, NVIDIA has laid out its boldest vision yet for AI at its annual GTC, which is a tech conference that they do every year. They've signaled that the AI boom is now entering infrastructure-led phase. CEO Jensen Huang told investors that demand for NVIDIA's next-gen AI chips could reach $1 trillion by 2027. That's nearly double the company's previous projections, which in October was at $500 billion. Now, that demand will be driven by its upcoming Vera Rubin, along with their existing Blackwell chips and platforms. Now, these are designed not just to train AI models. To put it in context, what H100 could do was process 2 million tokens per second. But Vera Rubin can process up to 700 million per second. That's a 350x jump. So it will help scale efficiently and at significantly lower cost. And that is important because the industry is now shifting from building models to actually deploying them. Now, NVIDIA is betting heavily on agentic AI systems as well that can act independently and complete tasks. Its new platform, Nemo Claw, built using OpenClaw's open source, but is aimed at enterprises looking to deploy these agents securely with built-in controls around how data is accessed, processed, and shared. At the same time, NVIDIA is expanding into physical AI as well, with automakers including Nissan, BYD, Hyundai developing 4 autonomous vehicles powered by NVIDIA systems. But perhaps the most striking signal of where the industry is headed is NVIDIA's push into AI infrastructure beyond Earth. The company is working with partners like Axiom Space and Planet Labs to develop orbital data centers where servers can run on solar power and avoid massive cooling and energy constraints faced on the ground. So taken together, the announcements show that AI is moving beyond software into chips, autonomous systems, and large-scale infrastructure. And NVIDIA is positioning itself not just as a chip maker, but as the backbone of global AI by catering into every segment that they can.
Well, yes, all those 5 layers that Jensen Huang talks about when he talks about the AI stack. Rachna, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. Do stay with CNBC TV 18. The news will continue right here. We're back after a very short break.
Hello and welcome. You're watching Commodity Champions. I'm Manisha Gupta. Well, the tensions in West Asia have triggered volatility in the stock markets and kept oil prices elevated. But what about gold? In times of war and crisis, gold is typically seen as a safe haven. Investors turn to yellow metal to protect their assets, driving up demand and in turn, prices. However, during the West Asia war, the gold prices have stabilized in a range of $5,000 to $5,200 an ounce. So instead of benefiting from the uncertainty, gold is trading lower than before the war began. The precious metal had hit an all-time high above $5,600 an ounce in January this year. So why haven't the prices risen? The soaring oil prices are driving up inflation. When that happens, the likelihood of U.S. Federal Reserve keeping interest rates unchanged increases. This makes gold less attractive. Experts also believe that the inflation concerns are outweighing any support from a softer dollar. Investors may have also tapped into gold for a liquidity amid the sharp global equities sell-off. To discuss gold, diamond, gemstones, and of course the global markets, we are now joined by Ankur Daga. He's co-founder Angara. Ankur, hi, thank you so much for joining in. And very, very difficult and uncertain times. One would have said that 2025 is where we left the uncertainty behind, but 2026 has started with some more.
Yeah, I mean, if you look at what's happened in the last 3 months, Maduro was captured in Venezuela, El Mencho was killed in Mexico, February, and Iran started. Cuba may be next, so certainly unprecedented times.
And within all of this, would you say jewelry is perhaps not on everybody's mind, especially when it comes to Middle East?
It's been surprising how resilient jewelry sales have been. So we sell in the US, UK, Australia, Canada, Germany, and so forth. All of those markets have been performing just fine. We launched in the UAE and Saudi Arabia in October of last year. Until February, growth was solid. As you can imagine, that's at a standstill now. So certainly we're seeing on the demand side, no demand coming from the GCC countries.
I was talking to some jewelers in Dubai and they tell me that the sales have been next to zero, especially in last 15, 16 days. Today is the 18th day now. Would you say the same has been the case for you?
Yeah, absolutely. Just a couple of sales here and there, but it's been very, very slow. Interestingly, on the supply side for diamonds, so 2/3 of diamonds being exported into India or imported in the form of rough come from Dubai. So that is a structural problem that we're facing now. And even in terms of the export market, GCC countries tend to be the second highest export from India, and that's going to be a problem as well.
Everybody doesn't know and everybody's been second guessing on how long perhaps this could go on. But this is a question we've been asking various sectors really. If this goes on for next 2 weeks or 2 months, who knows? How long do you think that the sector can hold on? And is there something that, the sectors or the industry is asking of the regulators or the ministry?
So I think if it's a prolonged war, we are certainly likely to see a slowdown. Jewelry is generally the canary in the coal mine. It's a pure disposable asset in the sense that you don't have to purchase it. And so from that perspective, it would be the first to slow down. We have not seen that luckily yet. And certainly if the war is prolonged, gold prices will rise, and that will also be a further headwind.
But that's about Middle East. And how would you look at the other countries? I mean, as you said, you are in various countries. We've seen a bit of a slowdown in China, as was the case last year. US started to pick up a bit, but then again, we have these whole tariff concerns coming in. Yeah. How have many of these major markets been?
So the US last year grew at 5.6% on average. Okay. That being said, the high end does tremendously well. So if you look at LVMH, Kering, Richemont, their highest performing sectors were in the jewelry sector within their brands. So most grew over 10% at the very high end. That being said, at the lower end, growth was between 3 and 4%. So if you look at a Signet or a Pandora in the US context, growth was relatively anemic there. We've been growing at over 50% a year, luckily, and that's continued throughout.
And you're very new to Indian markets, but how has the country treated you till time? You have a factory in Jaipur. You're mostly online, but in India, in case of India, you're offline as well here. I mean, you're in 2 shops.
When we launched in April, we thought that we would be 1,000 crores by 2030. I think we're ahead of that plan slightly. Okay. Run rate of 45 crores just starting off. But I think for us, importantly, product market fit is established, contribution margin positive already. So it gives us great hope. And this is all without retail stores. Once that comes in, that'll be a further catalyst.
But the gold price is doing what they're doing, trading near all-time highs. Of course, they haven't done so well during the war because the money seems to have gone in for cash or for crude, or as I said, into paying on to all of those margins because of equity sell-off. But how are you looking at the gold prices from here on?
I think if the war is prolonged, we're expecting 6,000 plus going forward. I think global economic uncertainty is rising, geopolitical risks are rising. We can see that inflation will rise if oil prices rise. At the same time, there is a chance that the U.S. actually lowers interest rates in the face of, and if that happens, we're likely to see $7,000 an ounce.
All right. How are you also looking at the jewelry demand? Because when you look at the year 2025, even as the gold demand was at record highs, much of that was from investment and not so much from jewelry.
Yeah, so central banks have been buying very strong. Still 25% of gold buying is central banks, but jewelry is still 40% of all gold buying. And that's held steady pretty recently as well.
And how was gemstones doing? Because that is what the area that you excel in.
Yeah, so it's interesting. If I look at the last decade, so IRR on gold has been over 18%. The Sensex has been at 13%. Gemstones, depending on the gemstone, are anywhere between 20 and 25% IRR. So they are doing phenomenally well. And if you look at Christie's, Sotheby's, Bonhams, all the auction houses, what's selling at 2 to 3 times the high estimates are all gemstones. There's supply constraints. At the same time, demand is increasing worldwide.
And how are diamonds doing? Because we do understand that the diamond prices, just as they started to pick up, they've started declining yet again.
Yeah, diamond prices, for example, 1 carat goods are down 10% over the last year. They're down more than half over the last 4 years. Lab-grown has really affected demand for natural diamonds, as you know, and that's playing itself out.
And what are your plans from here on? Keeping the GCC out for some time, what are you looking at the rest of the world with?
We're continuing to expand globally, so we're just going into Italy, France, Spain as well. We'll have most of the EU covered at that point, in addition to Singapore, Hong Kong, Japan, and various other markets. The big market we haven't entered yet is China, but except for that, the rest of the world will have covered by the end of this year.
And why not China?
It's a market we don't yet understand. So I think step by step, I think India for us was much more closer to home. And then thereafter would be China.
Ankur, what are the plans going forward from here? Because the kind of uncertain that market that there is with gold prices, as you yourself said, are only going to go higher from here.
Yeah.
Diamond, not so much. Dubai being the major global hub is kind of shut right now. How are you strategizing, moving your money rotations, inventory for that matter?
So what's been interesting for us is at the high end, people are now migrating from 14 karat gold to 18 karat in the US.
Right.
So kind of counterintuitive, but gold is seen more and more as an asset. People are migrating also from white gold and platinum to yellow gold because it's seen as an asset. There's this whole shift from soft luxury to hard luxury that we're seeing play out. In India, it's been very interesting. So we launched silver in January. That's already 15% of unit volume. 9 carat is already 18% of unit volume, and we've just started that. So I think we're seeing this bifurcation in the market where in the lower price points, we're seeing a lot more silver and 9 carat, and in the higher, we're seeing a lot of 18 plus.
And how would you look at the jewelry markets playing out for the rest of 2026 from now?
Part of it depends on the war and prospects of a recession. Assuming that the war will be short-term, I think growth will be very healthy. I think the U.S. continues to grow at roughly 5% a year, and even faster at the higher end. India now, this year, is very likely to be the largest jewelry market in the world. Last year, the U.S. and India were kind of neck and neck at 85 billion each. I think India can cross 90, 92 billion this year.
And how are you looking at your inventories, etc.? Because a lot of people tell me that they're looking to reduce inventory, looking at the fact that there's not so much demand, especially in GCC.
Yeah, so because we are Colorstone focused, we are not as affected by the supply chain dynamics that diamonds are experiencing. So that's been very healthy from a supply chain perspective. Our inventory turns are over 10 times a year, so we're pretty efficient on that front. And so we're just being cautious in terms of our gold buying, but still assuming that gold will continue to rise.
Ankur, you said the trends were changing and more people are, wearing yellow gold right now, trying to show their hard assets, as you said. Yeah. So is that a change that you're looking to bring in your designs as well?
So we offer most of our designs in white gold and yellow gold already as an option, as well as rose gold. But what's been interesting is, for example, in the US, white gold has been the lion's share historically. That has changed this year. And towards the end of 2025 also, so we love seeing that change. But we offer that flexibility to the customer regardless.
Ankur, when you're telling people or if they're asking you for advice on what to buy, I'm assuming gold is going to be one thing that you've already said is going to 6,000 and 7,000. Of course, depending on market forces therein. Yeah. But when it comes to gemstones and Diamonds, what would you usually advise?
Rubies followed by emeralds and sapphires are likely to do very well. From an investment standpoint, I wouldn't necessarily invest in diamonds. I am cautious there. And as you said, gold, I think, will continue to thrive, and perhaps platinum as well.
And silver, are you looking at that too?
Silver has shot up. It's tripled over the last year. So there may be a correction that's coming. Long-term supply-demand dynamics, silver is constrained on the supply side. A lot of semiconductor industry and other technology industries have increased their consumption of silver, so it should do well. But I would be more confident about gold and platinum.
Done deal. Noted that down. Ankur, as always, thank you so much for coming by to CNBC TV 18 studios. I appreciate your time.
Thank you for having me.
Thank you so much. Well, that's all about gold and everything that is shining. But with that, it's time for a quick break. Don't go anywhere because we will discuss the war's impact on India's agriculture sector with former Agricultural Secretary Siraj Hussain. Stay tuned for that conversation. Welcome back to Commodity Champions. And cascading effects of the West Asia war are being felt across sectors. And India's agriculture exports have also taken a hit. Shipment delays and soaring insurance and freight costs due to disruption in the Strait of Hormuz have added to the woes of an already vulnerable farm sector. West Asia, by the way, accounts for 20% of India's total exports, and the disruption has created a ripple effect in agriculture. Exports of bananas, meat and certain spices have been hit due to shipment halts. Meanwhile, domestic prices of eggs and watermelons have slipped because of the loss of export markets, further hurting the already distressed sector. Joining us now to take this discussion forward is former Agricultural Secretary Siraj Hussain. Mr. Hussain, hi, thank you so much for joining in. And there is a long list of what India exports in agriculture to the GCC countries, more prominently to Iran, UAE. Rice is one of the major ones here. What is, it's been 18 days now, and we are still counting, with markets basically factoring a long haul onto this one. What's your sense on what is India in for?
I can only hope that the war will come to an end soon, and Israel and US will opt for peace rather than war. As you said, about 22% of India's agricultural exports go to the West Asian countries. And in case of rice alone, you see our export is about $4.5 billion. So a lot of agricultural products go to West Asia, and if the war continues, then obviously they are going to be very badly affected, which will have an impact on farmers' income also.
Mr. Hussain, I do understand that while in Middle East, the problem really is of concentration. Would you say that India has been exporting so much of dairy and meat and rice and spices to one area? It takes a time to develop a market. And from where India is standing, would you say it's stuck for the very, very near term, though?
Actually, these are the countries which are deficient in food production. So clearly, India has been a major supplier of food items to several countries in the region. And if the war continues, if the transportation continues to be very expensive and very difficult, then clearly it will have an impact on our exports. And not only the exports, even the import of various other commodities which have an impact on agriculture has been adversely affected. And that will also have a major impact on how agriculture production behaves in the next Kharif crop.
And that's exactly where the weather woes come in as well, because there have been certain reports right now, too early perhaps to say that this is going to be an El Nino year, and we could be looking at some concerns on agriculture. Too early to say, would you say?
Yes, too early to say, but most of the countries are now reaching a consensus that the monsoon this year will not be as good as last year. So clearly, it seems that we should prepare for a lower monsoon rainfall, and therefore it is necessary that our productivity remains high and we are well prepared to face any shock. One good thing which has happened in the last 15 years is that after the Modi government came to power, 4 urea plants it was decided to rehabilitate and restart these 4 plants. So that has increased the urea production capacity from about 22 million tons to 31 million tons. But we still import about 9-10 million tons of urea. So well done as far as these 4 plants are concerned, but still long way to go.
It's when it's about agriculture, as you mentioned, it's not just about the exports, it's about imports as well. And a lot of trade that happens via GCC. And then the concerns about high crude oil prices that are percolating to higher fertilizer prices as well. It's not just one sector, Mr. Hussain, right?
Right. In fact, in case of fertilizers, if we take into account the inputs also, then about 65 to 70% of fertilizer production is based on imported items, imported commodities, whether gas or other commodities. I mean, if the war continues, we are going to be facing a very serious problem of availability of fertilizers. Of course, there are other countries from where we can import. China is one of them, Egypt is another, and of course, Russia is there. But, it takes time to build up those chains. And also, we should realize that the budget estimate for fertilizer subsidy this year was 1.7 trillion rupees. That may also go up to 2.5 trillion or something like that.
Mr. Hussain, we keep talking to a lot of people representing many of these industries, rice exporters, for example, where GCC is the major market. 37% of India's rice exports go to this area. whether it is about shipments, across way, on way, payments is something that they're not even talking about right now, since there's no conversation with the counterparty in those countries there. How would you look at the overall rice situation, where we're looking at a very, very surplus situation in India, and then your major export market also is not standing there?
Actually, Iran is a major buyer of India's basmati rice, and if Iranian market remains closed for any longer period of time, then export of basmati will also be impacted, which will mean that basmati farmers will not get a fair price for their produce, because generally speaking, they get a higher price than non-basmati rice. So, for all you know, the government may have to procure even the basmati rice, and government will pay only the MSP for common variety of rice or group grade A variety of rice, which will mean that farmers' income will be impacted, because the yield of basmati rice, basmati paddy, is lower than the yield of grade A paddy or common variety of paddy. So there is going to be a very serious impact on farmers' incomes also.
As we keep saying, Mr. Hussain, 18 days into this, and we don't know where we are headed, 2 weeks or 2 months, nobody knows. How long before you see maybe a plan B come in from the Indian government on this one?
I think the ministries would already be working on this, and I'm very sure that our embassies would also be talking to fertilizer manufacturers in various countries wherever surplus production exists. And very soon, this announcement may come that India will this year again import urea from China, because last couple of years China was not permitting export of urea. So I think due to improvement in diplomatic relations between China and India, I think they will allow export of urea to India. But it is not only urea, the other raw material for phosphatic fertilizers, etc., come from the Middle Eastern countries and Europe. So due to a longer route, the transportation charges, shipping charges will be more expensive, insurance will be more expensive. So, there is a long list of problems emanating from the war.
Oh, yes, it is. And the other one that I want to talk to you about is biofuels, really, because on one side, the crude oil price is holding around $100 a barrel, has led the palm prices, not so much for sugar, but many edible oil prices are trading on the higher side there. It also has to do with the fact that we're looking at man-made stuff like rubber, man-made fiber, those prices surging quite strong in the last couple of weeks as well. So it has had its effect on various branches.
Yes, the soybean oil prices are now touching $1,100 per ton. And palm oil prices have also risen. So even though palm oil supplies are not affected because most of it comes from Indonesia and Malaysia, but soybean oil supplies will be hit to some extent as far as the price is concerned, because it will take longer time. And we don't know which other country will be attacked by the US. So we are already hearing that in Cuba, the electricity infrastructure has collapsed. There is no electricity. So we don't know whether Latin America will remain peaceful, whether an import of edible oils from Argentina, etc., will continue. I mean, there is so much of uncertainty, and there is a very wrong message going to all other countries that they should also be engaging in war, buying more arms, spending more money on armament industry. So the whole thing is very disturbing.
Mr. Hussain, I'll wind down this conversation with one final question, and that is for the Indian markets itself. We've heard a lot of views and cues come in from the Indian industry on how perhaps we should be looking at ethanol-based cooking system, or ethanol into petrol for that matter, diesel rather, and increasing it from E20 to E22 and 25, etc. How are you reading those narratives?
Actually, there is excess capacity of ethanol which is available in India. The manufacturers, especially the sugar industry, also the maize ethanol industry, has been demanding that government should go in for flexi fuel, and a higher percentage of fuel blending should be allowed. But as I have been writing, the area under crops which are producing raw material for ethanol is already up to about 7.5 million hectares, which is roughly the area under cultivation in Bihar. So whether we can afford to divert that much of area to produce crops for fuel is a question which country and the policymakers have to decide. My personal view is that our priority should be producing protein, rich crops like pulses, which are also better for soil. So it's a long debate. I'm not going into details because I have written enough about it.
All right, Mr. Hussain, as always, thank you so much for joining in and deliberating on all a host of things, really, from the war to India's monsoon to what really needs to be done as a plan B if this war indeed continues longer than what the street perhaps is anticipating right now. But with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the Department for Promotion of Industry and Internal Trade has issued a notification amending Press Note 3, aiming to ease investment flows from land bordering countries. While India shares a land border with China, Bangladesh, Bhutan, Myanmar, Nepal and Pakistan, the 2020 rule was aimed to limit Chinese investment. The recent set of amendments is largely to facilitate Chinese investments to India. The changes introduced a clear definition of beneficial ownership and allow investors with up to 10% non-controlling beneficial ownership from land bordering nations to invest through the automatic route, and that's, of course, subject to the sectoral caps and entry rules. The revised framework also sets a 60-day timeline for decisions on investment proposals in key manufacturing sectors, including capital goods, electronic components, polysilicon, and ingot wafer. Officials say that the move is not a relaxation, but rather a clarification meant to remove grey areas in the 2020 rules. Press Note 3 was introduced during the COVID-19 period to prevent opportunistic takeovers of Indian firms at a time when India-China tensions were high following the border conflict. The changes come as bilateral ties show signs of improvement. Between 2000 and 2020, India received $2.4 billion in FDI equity inflows from China out of a total of $522 billion of FDI in India. But inflows dropped to just $67 million, and that's between 2021 and 2024, and that's after this rule was introduced. The latest tweaks are expected to make India more attractive towards investors and could also support a gradual improvement in India-China economic engagement. Well, joining us now to take this discussion ahead, we have with us Mr. Rajiv Memani, President of CII. Also with us, Vinod Sharma, Chairman of the CII National Committee on Electronics Manufacturing, and Ashish Bhandari, the Chairman of CII Capital Goods Committee. Gentlemen, thank you so much for joining us. Mr. Memani, coming to you first, a small housekeeping issue before we dive in to this issue. Can we all begin to agree that this entire relaxation is for facilitating Chinese investments? We may call it land bordering countries, but we're looking at Chinese investments and Chinese technical know-how here in India.
I think substantially, yes. I think if you look at the FDI framework of India, and if you look at also the strategic imperative because of which India has done this, I won't say it's a full-on liberalization, but I think some calibrated relaxation that they have done. I think it primarily it applies to every country, but I think primarily, at least in the short to medium term, it relates much more to China.
Let me then follow it up with a question on greater engagement. Is there now a greater acknowledgement, understanding, given the change in relationship between the two countries, that there is a need for greater engagement? Take, for example, the latest trade data that came out. As per that data, by the end of this fiscal year, we would have completed $150 billion in trade. So we're already working with them. Is this now an indication of greater engagement towards also looking at inbound investments?
Yeah, I would say the way I would look at it, Ashmit, is that first thing is that, if you look at India's strategy now, India's strategy is very centric towards trying to say how to encourage manufacturing. And if you look at areas of advanced manufacturing, I think China is clearly one of the more advanced ones. A lot of the supply chain today, we know almost 30% of the global production happens in China. For advanced manufacturing, that number is even higher. So whether you look at EV, whether you look at semiconductors, whether you look at the entire renewable supply chain, electronics, electronic components. So when you look at all these areas, I think it's very important that India, in many of these areas, if India has to expand manufacturing footprint, they may need either technology, some form of capital, some form of raw materials from components from China. And I think earlier there was some ambiguity in the policy whether government was encouraging, and the time that was being taken for doing this was not predictable. So it was very difficult for companies to plan for this, to see how this will go ahead, especially if you're committing to domestic manufacturing in India or to customers around the world. So I think this provides a lot of clarity. The sectors in which both the countries are focused on in terms of increasing bilateral trade and investment. Also, where India is very focused in terms of expanding manufacturing. And the other important thing, which was really the first phase of the clarification that came out, for a lot of the venture capital, private equity funds, where there was some amount of Chinese capital that was taken. It just took a long time for investment clearances to happen. So it took 6 months, 8 months, 9 months. So now at least that they've said that less than 10%, if they are non-strategic sectors, then this will be automatic, subject to information and everything else being provided. So I think that way, that is also very good, that even for the startup ecosystem and others, access for deep tech and other areas where funds, global funds, venture capital funds, private equity funds who have raised money from around the world, they can freely invest in India, and I think they'll be treated at par with like any other fund. And the speed at which clearances or approvals are given will be much, much faster.
Right.
So I think this overall, I would say, very, very, it's step in the right direction, and it aids India in its strategic imperatives.
You've given us multiple cues there. We'll try to cover these bases one step at a time. First, going across to Mr. Ashish Bhandari. Mr. Bhandari, one of the key focus areas where we've seen a relaxation or clarification, I leave that language to you, is capital goods. We're very keen on manufacturing capital goods here. Does this now motivate you as well as other industry participants to engage in more JVs? Are we likely to see more joint ventures with Chinese entities perhaps that will see inbound investment as well as tech transfer?
Yes, it may not apply to certain segments, but if you take a broad set of industries, including many that have got capital goods connect, the answer would be definitely yes. And as Rajiv mentioned, at the heart of it is access to advanced technology, not only in one particular area, but an ecosystem as a whole, where as part of that ecosystem, if that supply chain needs one particular portion on which we are hugely dependent on China today as imports, substituting that imports with internal investment, which is investments made in India through JVs, etc., that is always preferable. So to answer your question, yes, I do think several Indian companies now, with this clarification and this notification, looking at JVs with Chinese companies a lot more positively.
Similar question to you, Mr. Vinod Sharma. At least in the electronic space, we have already seen quite a few joint ventures with Chinese entities. Tell us, what has been the experience in the last 6 years under Press Note 3 2020? Was that leading to perhaps constraining of either capital or technology transfers when the Indian companies were looking to engage with Chinese companies, Chinese entities?
Yes, Ashmit, this is something that we in the industry were wanting for some time. You know that the electronic component, specifically if I speak about in the recent policy on the ECMS, where this budget, the government has also decided to increase the outlay in line with the overwhelming response they received to the application for electronic components, which in my opinion is a few multiples of the investment we've seen in this sector since independence. So that's the volume of business that we want to do and the kind of manufacturing we wish to invest in. One of the missing pieces of this whole jigsaw has been, I won't only say technology, but also technical know-how. We know that the technology in many components, for example, could be with Japan or Korea or Germany or America, but they have also been manufacturing in China for a long time. So the actual production, manufacturing know-how seems to be a lot in mainland China as we speak. We've also seen China has evolved for us from an electronics perspective, where they were a cheap source of everything over 20 years. It shifted to being a competitive source. And now in many areas, they've shown championship. So I think it is very, very important that we engage with China. We try to get what technology we can. And that happening without any investments from them, with no skin in the game, is perilous. So we are very happy that the government has agreed to this amendment or relaxation in Press Note 3. Of course, the guardrails remain. Every application above 10% will go through this approval process. And I think the industry is very happy with that because depending on what is important for the country, which are the technologies that we still need from elsewhere, these decisions will be taken.
Mr. Sharma, one follow-up question to that. We were speaking to the IT Secretary, MeitY Secretary, Mr. Krishnan, and we asked him that while this is, in a way, a clarification to invite greater inbound investment from China, is there equal interest on the other side to participate in the India manufacturing story? He said you should ask the private sector. So here's me turning to you. Can you tell us, Mr. Sharma, what the interest is on the other side, on Chinese entities wanting to be a part of the India growth story in terms of manufacturing here?
Yeah, Ashmit, so there, unfortunately, the Chinese policymakers are beginning to have a rethink in some areas. In practice, just 3 weeks ago, one ship with 6 containers of our machinery was actually leaving the shores of China, of Shanghai in this case, of Zhuhai. And for the first time, it was stopped. The government asked for an explanation from our supplier as to what this machinery was, what technology is contained in it, what can be produced out of it, what can be the dual use or multiple uses of that technology. So only when our supplier was able to satisfy the Chinese government that this was probably not in their negative list, while they don't have access to this negative list, but it's the first time we see question marks on export of capital goods, at least in our sector. And I also know that my colleagues in the industry have faced similar scrutiny. To the best of my knowledge, nobody has been stopped so far, but obviously questions are being asked.
Similar question, Mr. Bhandari, coming to you, that do you see from your conversations across the border, do you see interest by Chinese entities looking to invest here, looking to help Indian companies grow through transfer of technology?
I think it's early days yet. Now that the clarification has come about, I expect a lot more engagements to now start, because for the past couple of years, most Indian companies had stopped interacting because the path forward wasn't clear. Now that the path is clear, I'm sure many companies will get into these discussions, and it's only a few months from now that we would be able to answer your question with any more clarity.
Right. Before we head into a break, Mr. Memani, let me come to you and to labor on one of the points that you'd made, which is with respect to clarification on beneficial ownership. That clarity that lower than 10%, if there's a Chinese stake involved, or let's say there's Chinese representation on the board, need not come in the way, that such investors would still be eligible for the automatic route clearance. What I want to ask is that, do you think that goes beyond the China question as well, as to it may facilitate global investments as well into India, especially into startup, into the deep tech community?
There was no restrictions outside of the landlocked countries. So outside of that, there was no restriction. So realistically speaking, I think it only applies, this kind of, participating in some of the leading global funds is really is where China has provided them capital, because they have the surplus capital to invest. So they are a LP in quite a few of these funds. So I don't think it applies to any other country per se. And as so far as other countries are concerned, US, Europe, there was no restriction earlier at all.
Sure. Thank you. On that note, let's slip into a very short break, but we'll continue this conversation as to the need for this relaxation and what it does for the industry going forward on the other side. Welcome back. You're watching News Center with me, Ashmit Kumar. I have with me Rajiv Memani, President, CII, Vinod Sharma, Chairman of CII National Committee on Electronics Manufacturing. Also with me, Mr. Ashish Bhandari, Chairman of CII Capital Goods Committee. Mr. Bhandari, coming to you first. One of the tweaks and relaxations that we also saw was that now the concerned ministry and the DPIIT are no longer a part of the vetting process. It's only the MHA as well as the MEA. And now there's also an appeal mechanism before the Cabinet Secretary. How far does this go in giving more certainty to the private sector in terms of approvals for these investments?
I would imagine quite considerable, because in many areas of, especially if you take a look at the high-tech industry that got talked about, the new energy industry, things are moving extremely quickly. So technology decisions have to be made in a very short order of time, because the life cycle of that technology is also very short, and the investments that you need to make have to be of an order that you can continue to upgrade, continue to make changes. So the clarification of the process, cutting down the complexity and the certainty that you get improves things considerably. And it will make Indian manufacturing overall more competitive from a global exports perspective as well. Yeah, we would be able to do a lot more high-tech investments in India from an exports and domestic manufacturing point of view now than before. So it's a positive move for sure.
Mr. Sharma, another key aspect, of course, is the 60-day deadline that has now been introduced, within which a decision will have to be taken. Tell us, how much of a departure is it from the existing regime? How much time was it taking? How many days, weeks, months did it normally take under the Press Note 3 regime for an approval to go through?
Yeah, Ashmit, it's actually quite a relief and an important one. Because in practice, earlier, we actually had no such indication of timeline when we could take a decision. And, a lot of the electronics, at least pieces, the investments that are coming into components, for example, were either based on PLI or specs, or now the ECMS, which are also very time-bound investments. If we don't make it in that window, then we won't get the incentives that we are working towards. Also, if you look at it from the minority investor, in this case, let's say China, they also want some certainty of when can this business start. So I think the 60-day window, it's absolutely fine for the government, if for some reason they don't find that investment in national interest, not to approve it. But at least having a closure within 60 days is extremely helpful. Also, if I look at it again from the Chinese investors' perspective, if you look at what are the reasons that they may want to be investing in India with someone like us, or with an industry in India, with the majority being with an Indian equity partner. And the reasons for that are, of course, partly market access, but also use India as an export base and find for themselves a China plus one location. So where in some cases they feel pushed to the wall and the world is looking for a non-China source, they would very much like to continue to participate in global trade, in this case from India. And they don't mind in that case being in a minority, let's say up to about 25%.
Well, that leads in very sweetly into my very next question that I was intending on post to Mr. Memani. Mr. Memani, again, a short list that you could give as to why Chinese companies would want to participate, would want to invest, and then have transfer of technology with Indian partners.
It's from a China standpoint also, they're at least for now, their domestic demand has not been that strong. And they also are looking at, and the capacity built up in many of these industries is very significant. So relative to the capacity that they have, the demand they have, at least domestically, I think there is a big delta in many sectors. The phenomena, as they have called involution or whatever. And so it's a very, all these industries are highly competitive there. For every industry, there are multiple players. Each players are trying to see how they can grow. What are the markets they can look at? India is probably one of the most attractive markets. I think they will realize that India cannot be just a market where they can import into and sell. If they want to develop a footprint in India, I think they will have to look at manufacturing as well in India, and grow their business accordingly. And so because of those reasons, at least there is a strategic reason that the government of China would have to say what they want to do, what they don't want to do, and it's hard to comment on that. But at least from the viewpoint of industry there, they are very keen to build stronger trade and investment relationships with India because they view India as a large, significant market. And also many of their global customers will be having, I think it is a reality today that everyone will not depend on one source or on one country for all their supply chain. They will be looking at multiple jurisdictions for their supply chain. And India, if we get our manufacturing story right, would be a very, very compelling proposition for that, given the strength of the domestic market and for whatever manufacturing that we're seeing now, the efficacy of that has been very strong. So because of that, I would say if you were a Chinese investor, if you were a Chinese company who's looking at this, I think many of them would be open for that. And we have seen in some of the cases, even when there were restrictions, in some of the cases, investments have happened, joint ventures have happened.
Right. Mr. Mamani, just one more question. Of course, looking at the fine print of this entire text, it indicates that the government has reserved the right to tweak the set of sectors that would be eligible for this 60-day timeline, a decision within 60-day timeline. Does that indicate to you that there is inherently that flexibility of perhaps expanding this relaxation to beyond electronics and capital goods to also look at a widening of a base where the Chinese investments can come in?
Yes, I think it's a good thing. I think they've given the power to the Committee of Secretaries under the leadership of the Cabinet Secretary to look at this. And I think it's good for all these lists to be regularly reviewed because depending on the interest there is, depending on where the investments are going to flow, depending on where technology or technical know-how needs are, given where supply chains are moving globally, I think there should be flexibility in these kind of constructs. So I'm glad that the government has created that flexibility. And we know under this regime that the Committee of Secretaries and Cabinet Secretary, once they get the representation and they are clear on the issue, they can move pretty quickly. So I think that way, I think it's very positive.
Just on the strategy being followed, Mr. Mamani, we are currently following a whitelist approach where we've identified certain sectors that we're comfortable with. Would you rather prefer a blacklist approach where we identify certain sensitive sectors where the scrutiny for inbound investments continue, but the other sectors then remain open for business?
I think they've done that for the beneficial ownership for the 10%. I think they've taken that approach but for the second one, see, I think the government is also moving from the path. As I said, this is a very calibrated relaxation. It's very focused. And I think I'm happy that it's one step at a time, where all the stakeholders are also comfortable with this approach. And let's see what the outcome is of this. I mean, in the next 6 months, 12 months, does it lead to more investments, more joint ventures, more greater impetus to manufacturing in India, or some of the new PLI schemes that are coming? Will we see more active participation of Chinese companies along with Indian partners? I think it'll be interesting to see how some of these things evolve. If they evolve positively, I think this list can always be expanded. So having the flexibility of expanding the list based on the needs, I would say, given where we are, is a more positive approach. In the first one, where it's less than 10%, I think it's much more, whatever list you whitelist, blacklist, whatever name you've given, I think that's a better approach to take.
Well, the consensus on the panel there, this is a good first step. We'll, of course, have to see how this pans out over the next few weeks and months. I'd like to thank all of our panelists, Mr. Mamani, Mr. Sharma, Mr. Bhandari, for joining us and sharing their insights. With that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Welcome to Genomics. The IDBI Bank divestment was actually flagged off in the February 2016 budget speech of Finance Minister Arun Jaitley. Yes, 2016. And the latest we hear 10 years later is that even the couple of bids we got this month are likely to be rejected as they are below the government's reserve price. Why is the government unable to divest from IDBI Bank even after 10 years of debate and processes, while RBL Bank could sell a fresh 60% stake to Emirates NBD Bank for a whopping 26,850 crore? And Yes Bank's 8 shareholders could sell a 20% stake to SMBC for 15,880 crore. Foreign buyers appear to be ready to pay, but government is not able to cash in. Why? That's the question we're asking today. And joining me are Mr. S.S. Mundra, former Deputy Governor of Reserve Bank of India and former Chairman of Bank of Baroda, Chairman of BSE as well. Also joining me, Harshvardhan, the banking expert and former senior partner at Bain & Company, and Abhizar Devanji, also banking expert, founder of Neostrat Advisors. Gentlemen, good morning, and thank you very much for your time. Mr. Harshvardhan, if I may start with you, what accounts for this failure of the government to click in when private guys are doing so well and getting buyers easily?
Yeah, so Lata, I was saying that, look, you have to keep the broader context in mind. This is the first time the government is trying to sell a very large financial sector entity. This has never happened before. So there is no experience in the government to go by. IDBI is over 80,000 crore market cap company. So if we are to sell even 50%, this is a 40,000 crore plus transaction. This is a very large transaction. And so obviously both sides, the buyer and the seller, would be extremely careful in a transaction like this. Even in private sector, when such large transactions happen, your investment banking friends will tell you a lot of energy and mind space gets spent in something called representations and warranties and indemnities, when the buyer essentially protects the seller from any unforeseen eventualities that might arise post the sale that happens. So my sense there is, and this is entirely based on public domain information, I have no private information, is that one, given that there has been a dramatic turnaround in the performance of public sector banks, the government's valuation expectation may have gone up. That's where your comment about reserve price not being met would have come in. And secondly, any buyer, private sector buyer, investor who's going to deploy so much capital would expect an unconstrained transfer of management control. And that in a government entity could always pose a challenge. There could have been employment contracts, there could be other sorts of constraints on the way the bank will be managed post-acquisition. So my guess is those are the two main areas which could hold the government from pursuing the transaction, just based on public information.
Okay, Mr. Mundra, you have seen all formats, private and public sector, as well as you've made policy. What is your sense? I personally thought the government got everything right. First of all, it is under the Companies Act. IDBI, unlike the other PSU banks, is not under the Banking Companies Act, which is a more difficult act, where government appoints CEO. In IDBI Bank, because it's Companies Act, the NRC, the board appoints the CEO. So it looked clean as well. Axis Bank was under LIC and it was very easy to treat it as a private sector bank. So that is why they did this LIC routing. They seem to have done everything right. Why do you think it's flopping so badly and taking so much time?
Okay. Interesting, Lata. First, you mentioned about the private banks are in a position to easily and why we are facing so much of difficulty here. Let's understand one thing. In most of those cases, the investors have chosen to pick up a strategic stake, not necessarily the majority control. And basically, you have to look at the transaction from 4 or 5, I would say, broad criteria. One is the transaction structure. Other is the regulatory framework, which is likely to come. What is the valuation expectation? What is about the governance and any legacy concerns are there? And finally, the bureaucratic framework. If we look at it, I would initially touch upon two things. Number one, transaction structure. I think in case of IDBI Bank is a very complex transaction structure in the sense that government is holding something like 45.5%, LIC is holding 49.2%. Put together, they want to divest 60.7%. And both the owners would have their own expectation. Government would have the policy issues and the fiscal targets. LIC has to think about the return to the policyholders' interest and return on investment, more so now when it is listed. So I think in this complexity, an investor would probably have a very clear transaction, clean transaction, where the transaction structure complexity are minimum. It is driven by the market valuation, and the regulatory framework is much easier. I think these are the points. And as Mr. Harshvardhan also mentioned, what we understand from that, probably the mismatch has come in valuation expectation. So I think the requirement would be to put a simple transaction structure, maybe sequencing the divestment by both the owners, and be prepared to accept the market valuation. Because the market valuation would depend on the asset quality, the future growth possibilities, how much the integration would be complex. So these are the kind of things which, would determine. I know both the things are difficult, but I think they are imperative. They would need to be done.
Okay. Actually, we are playing out, as you spoke, the ROA of the three banks, RBL, Yes Bank and IDBI Bank. And IDBI has a higher ROA. But, both those banks went for like 1.1 times price to book, and Yes Bank at 1.4x. In IDBI's case, if you take a book value of, I think, about 60 rupees they had, or 55 to 60 rupees, as of December, Abizar, it was trading at 100 rupees. I mean, the market price was asking for something like 1.8x. Do you think that it was the market price which spoiled the whole thing? What according to you is going wrong over here?
I personally think, assuming it is spoiled, because we don't really have the government answer to it as yet, assuming it is spoiled, I really think that the larger issue is only about price. Because while, we had Mr. Mundra as well as Harsh talk about the fact that, the deal is complex, etc., the complexity was known. I think every bidder knew what they are getting into. They're getting into a more or less pari passu stake with the government plus LIC. They're getting in, not stake, voting power, as the two of them. The multiple was what it was. I think the real issue is around price and the way the price has kind of gone up. And frankly, this deal at 70-ish, I think, was a very doable deal, because it would have been comparable with the valuations of, say, a Yes Bank or a Yes Bank at 1.2 and RBL at around 1.06 times book. So that is really where the valuations would have been at. And I think it's only a valuation issue as of now. Not really a deal structure and complexity issue, because those complexities are known.
Okay, Mr. Mundra, to come back to you on this point, when I was preparing for this and I spoke to a lot of former government officials, one of the points that came from everyone is that bureaucracy or IAS officers worry about the CVC. If they sell it for probably, 1.1 time, and later on the price is trading at 1.7 time or 2 times book, then somewhere down the line, a CVC questions, did you sell the family silver very cheap? Is that a very important problem? For Subramania Kumar at RBL, or, for the group of banks that sold Yes Bank, they just want to get on with business. They won't have so much of a CVC issue. Is that the big difference between private and public?
See, there are concerns. There have been historical cases, but I don't think that can only be the overpowering thought if a case is well made out. And now there is a whole history. I mean to say, even the current round is now 4 years old, and the stock is going on for 12 years. So there is enough history available that what are the impediments and how to move forward. But as I mentioned earlier, it's a difficult decision on both the sides. Those concerns will be there. But let's understand one thing, and sorry to say that, but if you look from various criteria, IDBI Bank is neither here nor there. Is smaller than many private banks. It has not a great retail franchise. There would continue to be concern, true or wrong, I don't know, but about the legacy book. So if that is the profile of the bank, then obviously, as I mentioned, that any investor would look at the future growth possibilities, that there are no asset quality risks, what kind of capital they would be required to commit, and how difficult would be integration, both from the viewpoint of manpower as well as technology. So all these things are factored into pricing. And so if all these factors are taken into account, a case is well made out. I think it will require a determination and a political will probably to sell it through. It's high time. This has been a work in progress for very, very long. And I think it's time to move on.
Oh, absolutely. Abhizar, what is your sense? Were they wrong, in fact, to have gone with government, LIC? Because there were some people who said that the guy who came with that, who would buy that 60% stake would still have only 26% voting rights. And the balance, if you make LIC and government look like the same entity, then you are still not having control. So the whole idea was wrong because the person who bids won't feel like he's under control. Is that the problem?
Absolutely right. That is one of the issues, but that would have been baked into the price. Okay. So that's why whenever somebody said that, oh, because you're acquiring a 60.5% stake, you should be paying a control premium. There is no control. Because if you work the mathematics of the voting rights, 46% voting right will remain with the new incumbent. 45% combined voting right would remain between the government and LIC in terms of 100%, and the balance 9.5% would remain with the shareholders. So actually demanding a premium was clearly not a proposition here because there was no control premium. That's one. So everything, all the nuances that you spoke about, whether it is the government control, whether it is the fact that you need to toil to turn around IDBI, was all factored into the price. Now, if you look at other comparable transactions, they happen at around one-time book.
Yes.
Now there is a reason for that, and frankly, a justifiable reason even for IDBI, because IDBI over the years has not only cleaned up, but collected a lot of their NPLs. So a lot of profitability and return ROE comes in because of NPL write-backs.
Yes.
Plus, there is a very stable mortgage business that they have built. So from a business point of view, at one-time book, it was a perfect buy, given the franchise, as Mr. Mundra also spoke about.
It has improved.
There is a franchise that is there, which demands a 1.5 times. Somebody would have had to come and rebuild on that franchise. Clearly, there was value. The other thing one has to say, as you rightly said, that Mr. Arun Jaitley flagged it off in 2016 and we are where we are today. There is this concept on investment banking called deal fatigue. And what really happens is that when a deal carries on a protracted manner, with multiple news coming in saying, oh, the bids are being invited today and tomorrow and day after, the cry wolf kind of comes into the system.
Fair enough.
And and lastly, above everything else, we talk about fair market price and the government has to justify a fair market price. We have a 5% float, for God's sake.
Okay.
How is that even a fair market price? The fair market price has to be discovered through a bidding process.
Okay. Fair enough. I take your point. We have to take a quick break. But I'm coming back with more questions on what is the way forward? Should they pursue it at all? All those questions after the break. Welcome back to Indianomics. We are discussing the IDBI divestment, which at this point in time, based on sources, appears to be hanging fire. We have been talking with three experts: Harshvardhan, formerly of Bain; Mr. Mundra, former Deputy Governor and former Chairman of Bank of Baroda; and Abhizar Diwanji of Neostrat Advisors, also a banking expert. Gentlemen, thank you very much for your patience. Mr. Harshvardhan, before going to break, Abhizar pointed out there's something called deal fatigue. Do you think now the government should follow through at all, or just rest content, because anyway PSU banks are doing well?
So my own personal strong preference would be that the government pursues this. This is a very important reform step. We were all extremely excited when the government announced this, because this is the first time, as I said, there is a named entity was put up for privatization, first time in our history. So in terms of our signal on reform trajectory and credibility of financial sector reforms and commitment to it, I think this transaction would be very important. So my hope would be that the government pursues it. Maybe it takes a pause, revises its valuation, maybe invites new bids, we don't know, but I think it should stay course on the privatization. In terms of the turnaround of public sector bank, that has been remarkable, and one hopes that that trajectory continues. But I don't think that that has any bearing on privatization of an entity that has already been announced. So I think one hopes that the performance of the public sector entities continues to improve and stay strong. But we should also continue to pursue this. This is a very, very important reform step, in my view.
Okay. Mr. Mundra, what would you advise the government? It seems to be falling between stools, as you said, even in terms of its reach. It does not have the reach of a PNB or any of the other public sector banks, but it does not have the corporate style of a private sector bank. So give up. If the government pursues, what should the steps be now?
Okay, interesting. First, I hear both Harshvardhan and Abhizar. With all the cleaning up, everything fine. But from an investor's perspective, my personal view is, as of today, you don't look at a very strategic upside in IDBI Bank as it stands today. That is something, that is a reality which needs to be accepted. I fully agree with Harshvardhan. It is a very important step, not from the lens of that how much it will bring in divestment or that program, but as a signal. And more importantly, having started it and then just leaving it, abandon it midway would be rather a negative signal. So it has to be pursued. Now, coming to your question, what needs to be done? See, one is from the viewpoint of the whole process. Maybe it's possible to do the divestment in sequential. Maybe the LIC can completely get out, and then government eventually and gradually offloads its portion through the market offerings. That is one possibility. But then this also investor would have a still concern, because for that duration, there would still be a government involvement and control. So there are pros and cons. But I think other than that, a lot of cleaning has been done, but maybe you either create a complete clean structure, or you develop the IDBI bank as a digital bank or as a niche bank, and then put it on the block. Those are the other options. I think another important point is whether there can be a upfront regulatory clarity. That if this process is done, if someone is getting the control, what kind of roadmap will be available, what will be the requirement of diluting the stake, and what kind of voting right they will have. If all these things are clear, but quite clearly, having done it so many times at the latest now, I think first it will need 2-3 years of working on the entity itself, decide what path you want to follow, and then probably come with the offer.
Okay. Yes, looks very complicated, sir, from what you're saying. Abhizar, your last thoughts on how the government can still salvage it. First of all, should it? And secondly, what would your advice be in terms of next steps?
So one is that the government still hasn't announced the cancellation of the process. Right. And hope if we have another 15% fall, then everything will fall in place.
Okay.
And the price may just be met.
Yeah.
So that would be ideal, in my opinion, for the simple reason that I think it's most important that the divestment does happen. So I do think that if the price is reined in well, and clearly the issue is that in expectation of a divestment through the deal fatigue period, as I just said, the stock kept building up because everybody expected there'll be higher and higher and higher price. And there's a belly of expectations today which says, no, in reality, that is the deal. This is where the deal is happening. And I think if the markets do realize, and the public shareholders who are selling the shares or buying the shares will now realize that the real valuation would settle at around 1.1 time book, then they would actually be happy for a new investor to come in at that level, because the prospect of it going up to a 1.8 time book is very high if a change in control happens. So I would rather that the government not announce a scrapping today, wait till the price stabilizes to a pre-deal price, which was actually a very realistic price, around 1.1 time book. If it stabilizes at around 1.1, 1.2 time book, then we are in a better position to say that the divestment should just go through. And that's, of course, a 6 months heavy price adjustment. The other aspect is, if that doesn't happen and the deal has to be deferred because of the SEBI price not being met, this would be a time for the bank to relook at a base interim strategy to prove what the franchise is worth. See, it has the capital.
Yeah.
Capital adequacy is not a problem.
Not at all.
The real issue is, how do we build the franchise, set up the right processes, and get ourselves to a level where this transaction can happen at the right regulated SEBI price.
Okay.
And I think if that happens, no shareholder on the retail basis is going to lose.
Okay.
The government is going to get the long-term fair value, which anyway is embedded into the IDBI price.
Yeah.
So that's not going to be an issue.
Fair enough.
Retail investors are not going to be sellers. In fact, they'll be benefiters. Because once the new management change happens, the re-rating of IDBI will happen.
I think at the moment we should not worry about retailers so much, because there's hardly any. It is a 95% government owned. Mr. Mundra, just about 10 seconds, sir. Do you think that what Abhizar is saying making a lot of sense? Let the government accept the price as it is. I built this castle in my head that Fairfax has only CSB with it. It would do very well with an urban franchise and a corporate franchise like IDBI. So just go ahead. Do you think that makes sense?
Well, I fully agree. We are, I think, mentioned at the beginning, valuation is the key.
Yeah.
If there is, readiness to accept the valuation, I think all other things will fall in place. But that will be a difficult decision to accept.
Yeah,
and I don't see much possibility of, reviving it now at this point of time midway. There will be some gap, and probably then some working can be done on that.
Okay. Well, aapke muh mein ghee shakkar, if the government is able to go ahead with the current process itself and doesn't consider abandoning it, perhaps we would have had the first big divestment of a public sector entity in India. That would be a good beginning. Thank you very much, Mr. Mundra, Abhizar and Harshvardhan, for giving me the benefit of your advice. Let's see how things pan out from here on. That's it on this edition of Indianomics. Thanks for watching.
Good evening, ladies and gentlemen, and welcome to the India Business Leader Awards. It's great to see all of you here, and it's wonderful to have a packed house on a Saturday evening in Mumbai. Ladies and gentlemen, 21 years ago when we started the India Business Leader Awards, and yes, I have been here for all 21 editions of these awards, a post-liberalization India. Thank you. I feel a bit old now, but with that out of the way. as I said, a post-liberalization India was starting to explore new possibilities, bite into new opportunities, adopt technology, and really open itself up to the world. And while the size and scale of the ambition and the scale of the enterprise has changed, what has remained constant for those that we have honored year after year for the last 21 years is the desire to create institutions with enduring values. Roosevelt said the credit belongs to the man who's actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes short again and again, who knows the great enthusiasms, the great devotions, who spends himself in a worthy cause, who at best knows in the end the triumph of high achievement, and who at the worst, if he fails, at least fails while daring greatly. And that spirit of courage and commitment is what the India Business Leader Awards have celebrated for 21 years. And tonight, we add another chapter to this story. Welcome once again to the Standard Chartered Presents India Business Leader Awards. Thank you all for being here, and many, many congratulations to our winners. May you continue to excel, and may you continue to find success in all that you do. Ladies and gentlemen, have a wonderful evening. Thank you very much again.
We begin the awards with a category that reminds us what human potential truly looks like. The Special and Para Sports Leader of the Year recognizes excellence achieved through discipline and sustained performance at the highest level.
And the winner in this category for 2025 is Simran Sharma, Paralympic athlete. May I request Simran to please join us on stage for her outstanding international achievements and her inspiring contribution to Indian sport.
Relentless resilience and remarkable performances on the international stage, she has not only brought pride to India, but also redefined what perseverance truly looks like in sport. Moving on, entertainment has the power to move us, to make us think, to stay with us long after the credits roll. The Entertainment Leader of the Year recognizes someone who has created work that transcends the screen.
This year, the Entertainment Leader of the Year award goes to Rishabh Shetty, actor and director. Let's welcome him onto the stage with a huge round of applause.
With a story rooted in tradition and folklore, he created Kantara, a cinematic phenomenon that resonated far beyond its origins. While it shattered box office records, its true achievement lay in how deeply it connected with audiences across languages, regions, and generations, reminding us of the enduring power of authentic storytelling.
एक dialogue हो जाए. One before you go.
Dialogue तो कन्नड़ में होगा. Okay. नम्मन नोडलिक नीवु बंदिदीरी, निम्मन नोडलिक नावु बरबारदा. Thank you.
Shetty, thank you so much. Ladies and gentlemen, a big round of applause for our Entertainment Leader of the Year.
Moving on, our next award is about promise and potential. While India's energy transition is one of the most consequential stories of our decade, this award recognizes a company that is writing a significant chapter in it. The Most Promising Company of the Year award goes to Torrent Power.
And we invite Jigish Mehta, whole-time director of Torrent Power, to please come and join us on stage. Congratulations to you, Mr. Mehta.
Now, the Torrent Group has built a strong presence across the power value chain, from generation and transmission to distribution, while accelerating its push into renewable energy and supporting India's journey towards a cleaner, more resilient energy future.
Ladies and gentlemen, the Most Promising Company of the Year, many, many thanks for joining us here this evening.
We'll move on, ladies and gentlemen. The Breakout Brand of the Year is one of our most exciting categories. It celebrates a brand that has captured the market's imagination, disrupted established norms, and achieved phenomenal growth in a very short span of time.
And this year, the Breakout Brand of the Year award goes to Rare Rabbit. Please welcome the founder and CEO Manish Poddar to receive this honor. In past 10 years, Rare Rabbit has built an entire fashion ecosystem under the House of Rare, men's, women's, kids and footwear, with over 1,200 points of sale and 200 premium standalone stores across the country. A homegrown label that has achieved what very few Indian fashion brands have managed at this scale.
When I manifested 10 years ago to start a brand of fashion in India, I did not even emphasize that I will stand someday here. I would like to take this opportunity to tell Sir that manifestation has been so kind to me that my father on his dying bed spoke about you. And he said, "Kaam karo, bado ek din aayega ki Birla ji se award loge." And I cannot tell you what are the odds that I'm standing in front of his family with him by my side and my father above and my wife, the CEO of my life, who is watching me. And you cannot even imagine why and how. It is unbelievable.
Well, up next, the Lifetime Achievement Award is perhaps our most significant recognition of the night. It honors a career of excellence, a lifetime of impact, and a legacy that is going to inspire generations to come. The Lifetime Achievement Award 2025 goes to Dr. Anand Deshpande, the founder, chairman, and managing director of Persistent Systems. Sir, thank you for joining us here on stage. A huge round of applause for him, ladies and gentlemen.
Well, here's the man who saw the future of technology when most of India was just waking up to it. He built Persistent Systems into a global technology powerhouse, enabling digital transformation for businesses worldwide. His vision, leadership, and commitment to innovation have made him one of India's most respected technology entrepreneurs. Once again, ladies and gentlemen, a huge round of applause.
Mr. Deshpande, congratulations once again, and thank you so much for joining us here. Let me take this moment, since this is a conversation about leadership, it's a conversation about excellence, it's a conversation about design in action, in motion. We've got with us the global CEO of Ferrari, who's here with us at the CNBC TV 18 India Business Leader Award. So let me come across to you, sir. What is your leadership mantra?
What is a leadership mantra? It's very simple. Learn from everyone, everywhere, because so far I never met a person so ignorant I couldn't learn anything. In these 3 years, there is one thing that I learned a lot, that is a good representation of the purpose of our company. And you say, "Hoga kaise nahi." I think this is...
That does deserve a big round of applause. Hoga kaise nahi.
It's very nice, because we say in English, we say we audaciously redefine the limit of possible. But Hoga kaise nahi, I discovered yesterday, I think is much shorter, is better, more effective. So this is what I learned in this trip here.
Hoga kaise nahi. Thank you very, very much, ladies and gentlemen, the global CEO of Ferrari.
Ladies and gentlemen, we come to one of the most prestigious recognitions for the evening. The Hall of Fame is reserved for those rare individuals whose contributions have fundamentally shaped the industries and touched millions and millions of lives.
The IBLA Hall of Fame posthumously honors Piyush Pandey.
Bhaiya, I love you.
Well, prestige has become more than a brand. It became a promise that Indian manufacturing can compete with the very best in the world. The IBLA Hall of Fame posthumously honors Mr. T.T. Jagannathan tonight.
Moving on, we now take a moment to remember and honor a remarkable leader who left us too soon. Anupamti Nupuri was Senior Partner Emeritus at McKinsey & Company, a position that barely captures the impact he had on countless organizations.
We honor his legacy tonight as he lives on in the work that he championed and the people that he inspired.
Ladies and gentlemen, in memoriam, Tinu Puri, who really set up McKinsey in India.
We now honor the memory of another remarkable leader, Sanjay Kapoor, Chairman Emeritus of Sona Comstar.
Under his stewardship, Sona Comstar became a powerhouse in automotive components, setting new standards in innovation and in quality. Sanjay's entrepreneurial vision and commitment to excellence have left a lasting legacy in India's manufacturing sector.
Well, ladies and gentlemen, it is our proud privilege to honor at the India Business Leader Awards for the second time the outstanding contribution to the cause of sport, not just in India but globally, Jay Shah. Thank you very, very much, sir, for joining us here this evening.
Ladies and gentlemen, a huge round of applause for Mr. Jay Shah.
Mr. Shah, please, the podium is all yours, sir.
Thank you, CNBC 18, for this honor and respect. And I would like to dedicate this award to all the athletes, especially women athletes who are working hard on the field. सबसे पहले सूर्या, गौती भाई और सारे टीम इंडिया के प्लेयर, मैं आप सबको बहुत बहुत बधाई देना चाहता हूँ। जब मैं बीसीसीआई में था तब मैंने 2028 के ओलंपिक तक प्लानिंग की थी, लेकिन सूर्या मैं भी चला गया, मैं आईसीसी में आया, मेरी जगह बीसीसीआई के और लोग आए। आप सबको मिलके 2030 की भी तैयारी करनी है, 2032 की भी तैयारी करनी है, 2036 कहाँ आने वाला आपको मालूम है, उसकी भी तैयारी करनी है। फिर से पीयूष जी आपका बहुत बहुत धन्यवाद, CNBC न्यूज़ 18 आपका भी बहुत बहुत धन्यवाद। जय हिंद, जय भारत, वंदे मातरम।
Thank you very much, Mr. Shah, for joining us here. Ladies and gentlemen, a big round of applause. He set the agenda all the way to the 2036 Olympics. Thank you very much, sir, for joining us here this evening. The Excellence in Sport Award recognizes the person and the team that creates those conditions. This year, the Excellence in Sports Award goes to Gautam Gambhir, the head coach of the Indian cricket team. Please join me in welcoming him on stage. Ladies and gentlemen, a big round of applause for Gautam Gambhir.
The Sports Leader of the Year award goes to Surya Kumar Yadav, captain of the Indian T20 cricket team. 360 degrees with the bat, ladies and gentlemen. Please welcome Surya Kumar Yadav with a huge round of applause. Unflappable with the armband, and 6 days ago, a World Cup winning captain in front of his home crowd. There is nobody quite like him in the world of cricket right now. Sky 360 degrees of the field, but let's get a full picture of it too. Over to you, Shireen.
What is the captaincy mantra? What is your leadership style as a captain? You know, you're a 360-degree player, but what is it that you believe is your true mantra for success and strength?
I feel irrespective of what happens on the ground or on that field, when you come out of the field, you're just another man, or you're just another woman when you're playing that game. So you can't carry, irrespective if you're doing well, not doing well, to your home, to your friends, to your family, just leave it on the ground. All those small things, I think that really matter to me. And that dressing room, I think it's very important to hear everyone out. The freedom of speech, that is very important, that dressing room. We listened to everyone, what they wanted, but yeah, at the end of the day, the goal was same.
Mr. Shah has laid out the agenda all the way to 2036 on what needs to be done by the team. What's next? What are you working towards?
I think after this, definitely 2028 LA Olympics is definitely on the cards because that cricket is entering in that event for the first time. It is going to be very special. Yes, we relax for a bit for some time, but then we start our journey to achieve something special in 2028.
Olympic gold?
Definitely Olympic gold is on the cards, yes.
And Olympic gold, Sky, thank you very, very much for joining us here this evening. Ladies and gentlemen, a big round of applause for the Indian skipper. Ladies and gentlemen, tonight is also special as we mark a moment of change at CNBC TV 18. After 26 years, we say goodbye to the CNBC Peacock. It has been much more than just a logo. It's been a daily reminder of what we stand for: accuracy, insight, and actionable information. Well, that is the new logo, and that is what you need to look for when you look for CNBC TV 18 on your television screens, and of course find us online as well.
Our next category, the Young Turk Startup of the Year, celebrates audacious ambition backed by flawless execution. This award recognizes a company that has helped define one of the fastest growing sectors in India's digital economy, quick commerce.
And the Young Turk Startup of the Year award goes to Zepto. And we invite the co-founder and CEO, Adit Palicha, to please come on stage to accept the award. Now, in just a few years' time, Zepto has built a dense network of neighborhood fulfillment centers, reimagining how urban consumers access everyday essentials, turning near-instant delivery from an experiment into a very scalable business.
What has it taken to build Zepto, and what is the grand vision? What's the grand plan from here on?
Look, I think, although from the outside our business might look, very interesting, 10-minute delivery, consumer internet, the reality is that we're actually in a paisa-by-paisa business. It's all about, deep cost execution, driving operating leverage within the same inputs of our supply chain, getting more and more margin leverage. So it's a, basis point by basis point execution business. So it's just about, keeping your heads down, day-to-day running the business, and driving the needle, a little bit here and there. I think for us, we feel like if we can get to, enough scale and drive our cost structure to a low enough point over the next, couple of years, I think we have a real shot at building a, exciting, dynamic, generational company in India. And hopefully, what keeps us motivated as a team is that, why can't we build an internet and e-commerce company as good as the global best? There are, world-class companies out there that have created, amazing stories in capital markets that have driven growth in their respective countries for decades. Companies like Amazon or Mercado Libre or Coupang, across the world. So if we can do that, if we can be a great story of Indian excellence in internet, then, we'd be happy to be a small part of our growth story. So that's the thinking.
Well, Adit, at this age, the scale is truly remarkable. Many, many congratulations to the entire Zepto team.
A real young Turk there. Well, some leaders don't just build companies, they build Brand India. The Outstanding Contribution to Brand India Award recognizes someone whose work has elevated India's standing in the global business community. The Outstanding Contribution to Brand India Award goes to Vivek Chand Sehgal, the chairman of Madison Group.
Ladies and gentlemen, a big round of applause for Mr. Vivek Chand Sehgal, a company that was started in 1976, quite literally by him and his mother, and today is operating across 50 different countries or 40 different countries with a plethora of acquisitions that they've done. And taking forward what we just heard there from the Commerce Minister, Mr. Piyush Goyal, Mr. Sehgal is a true embodiment of what the Commerce Minister was talking about, of Indian companies looking to global markets. How did you get it all done, sir?
It's a long story, 50-year-old story. But I think the cornerstone of mother-son is BY. Buy yourself, beat yourself. You don't have to compete with anybody. Just keep listening to the customer and do the right thing, and you're there.
Many congratulations, Mr. Vivek Chand Sehgal, on your outstanding achievement and for putting India firmly on the global automotive map. Moving on, the Outstanding Company of the Year recognizes an organization that exemplifies excellence across every dimension. This year's winner carries a legacy of over 7 decades, but remains as relevant and dynamic as ever.
The Outstanding Company of the Year award goes to Mahindra & Mahindra. Please welcome Dr. Anish Shah, Group CEO and Managing Director of Mahindra & Mahindra, on stage to come and receive this honor. From tractors to SUVs, farm equipment to aerospace, they've demonstrated that diversification backed by excellence creates some enduring value.
Ladies and gentlemen, a big round of applause for Team Mahindra.
And now, our highest business leadership recognition for the evening, the Entrepreneur of the Decade, honors someone who has shaped an entire era of Indian enterprise.
Ladies and gentlemen, the Entrepreneur of the Decade is Kumar Mangalam Birla, Chairman, Aditya Birla Group, one of India's most respected and diversified conglomerates. Please join me in welcoming him with a huge round of applause.
Mr. Birla's leadership has been defined by strategic vision, ethical governance, and deep commitment to nation building.
The entrepreneur of the decade, ladies and gentlemen, Kumar Mangalam Birla. Mr. Birla, the numbers tell the story. The decade that you've steered the group through, why don't you share that with us?
So before that, Shirin, I'd like to just thank the people who have really, because of who I stand here today. Firstly, I don't know how many of you know, but Piyush is a CA, and he's a silver medalist. I too am a CA, but I just kind of made it. So admiration for him goes back a very long time, and it's great to receive this award from a dynamic minister and someone who's a dear friend. I want to thank CNBC. I was racking my mind. I think I got your Best Leader of the Year award about 10 years ago. CNBC clearly believes in long-term investing. Entrepreneur of the decade, I must say, is a bit of a misnomer for us at the Aditya Birla Group. We believe in a more distributed model of leadership where leaders across the length and breadth of the company take fairly large entrepreneurial bets fairly regularly. And therefore, with a heart full of gratitude, very happy to take this on behalf of a very large group of very committed and very talented entrepreneurs. The last 10 years, I think that it's been they say that, a week is a long time in politics. And it would be fair to say now that a day is a long time in politics. But I always feel that a decade is a remarkably short time in business. Having said that, in the last 1 decade, we have grown rapidly. We have grown on the back of the Indian economic boom. We have also scaled up our businesses to global leadership positions.
Congratulations, ladies and gentlemen, the entrepreneur of the decade, Kumar Mangalam Birla. A big round of applause. On that note, may I request all the other winners to join Mr. Birla and Mr. Goyal on stage. We're going to get all the winners back, sir, for a quick photo opportunity. May I request all the winners to please come back up on stage for a quick photo opportunity.
May we have another round of applause?
Huge round of applause, ladies and gentlemen. One last time, all our winners on stage.
What has it taken for you to be able to marry distribution and manufacturing from a product point of view that works for the Indian customer?
Berkshire Hathaway was built like that, so I was like, fanboy, let me follow. And we were sort of this challenger to Policy Bazaar, probably the first challenger that came up. I still live in Bangalore, that I was a Swiggy loyalist.
Yeah.
And most people in Bangalore were, but most people in Gurgaon or Delhi were Zomato loyalists.
Yeah.
Like you build a habit.
Yeah.
We sell a PDF at the end of the day. We sell a document, a contract. There are only 8-10 suppliers. Some of the suppliers are bullies because they're all large companies, right? Getting the license was such a big deal.
Yeah.
That, it just became the goal. And we were probably not thinking how hard it's going to be to get, get customers aligned. It had been like 2-3 weeks and nobody had bought. I had started calling up my friends, tum to le lo yaar.
People still think of you as a digital marketplace, essentially. People don't recognize the fact that you are truly yourself an insurance company. When do you believe
that shifted, that change happened?
Deep sort of philosophy with which we went with was that, hey, we want to own the customer. We don't want the agent or the bank to own the customer. I think for the first year we didn't sell in Delhi. It's like, I think, it's too notorious a market. Our data is not working. It's too large.
Does it hamper your growth prospects?
Agent or whoever is talking to the customer is constantly deselling ACO. So not only the customer has to select me, he has to select me over a voice that's constantly telling him it's shit. Don't go there. Nobody will help you if there's a claim.
India's general insurance industry is estimated at over 2.5 lakh crore rupees in annual premiums, dominated for decades by agents, intermediaries, and commission-led distribution. But as digital penetration deepens, the battle is shifting from access to experience. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2016, ACO set to build out India's first direct-to-customer digital insurance company operating with zero commissions and no offline sales force. Almost a decade later, ACO today is a leader in this space and is hoping to build on the over 1 billion policies that it's already served across more than 78 million unique customers and built a claims ratio of 98% with a net promoter score of 70. In FY25, ACO posted revenues of 2,837 crores, up 34% year-on-year, while narrowing its losses by 37%. From motor insurance, its flagship, to health-embedded protection and pure-term life insurance, the company has steadily expanded its portfolio while betting on technology-led underwriting, issuance and claims. In a tightly regulated, capital-intensive business built on trust and long-term discipline, can a digital native insurer reshape the industry's economics, and what does sustainable scale look like in insurance? Joining me now is Varun Dua, the founder of ACO. Varun, great to have you join us on Young Turks Reloaded. I want to go back to 2016 when you had the thought of being able to do this and disrupt this space in the manner in which you attempted to do. This is a highly regulated business. It's a capital-intensive business. It's a business that has seen the incumbents, some very large incumbents, spend a significant amount of their money and bandwidth on building it out over the last 2 decades. It's also a low-penetration business. It's also not an easy business to make money. What gave you the audacity to think that this was a business you may want to take a shot at?
I think partly naivete. I think I would say that, I always say that it chose me rather than me choosing it. It's an interesting story. When I was graduating from college and you're supposed to do like final year thesis or some report.
Yeah.
That's your final score. This was back in 2003-04. And I was, like, for the lack of not being able to find a topic, it was all in the news that time, insurance, because the industry had just got privatized.
Yes.
I interacted with a bunch of industry experts at that point to try and build my report. And one of my industry guides who was helping me sort of build that report, because I was trying to do interviews of CXOs in insurance companies to find out how they're going to do it, ended up offering me a job. And that's how I got involved. I worked with the Tata Group, Tata AIG, for the first 5-6 years of my business, and I was fascinated by the business. I said, this is crazy. You sell probability, you sell math. So the ambition sort of came from the fact that, there were models of, in the Western world, primarily, and no bigger, better than Berkshire Hathaway. It's an inspiration. I've grown up sort of watching the shareholder shareholder meeting.
Yeah,
I used to love, have Warren Buffett and Charlie Munger speak, the simplicity, the clarity, and the entire fortune of Berkshire Hathaway was built on insurance, right? The concept of free float, like it was alien to me what free float is. And I think I just got fascinated with that thing. And given my journey, and then starting to see what Munger and all these guys speak about, and how beautifully they had built a resilient business over decades, and it had also, apart from insurance, become this huge investment entity because of the treasury that they had created. I was like, and it was customer friendly. It wasn't trying to sort of placate intermediaries all the time. So it just went like, I have to do this, right?
From 2016 to 2017, when you got the license, to 2018, when you were waiting for your first customers to come on board,
Yeah.
what was that like? And you know, was there a moment where, while you were waiting for the customers to sign up, that you thought, did I make the biggest mistake of my life?
Getting the license was such a big deal that, you know, it just became the goal. And we were probably not thinking how hard it's going to be to get, you know, get customers aligned. We knew it would be hard, but, you know, our focus was just so much on, hey, we've got the license now, at least the journey can start. I think when we set it up and we got the website, app sort of rolling, and, you know, it was like 2-3 weeks. People would come, we would do some content, some, you know, Google, some marketing, some people would, you know, just browse the website and drop off. And it had been like 2-3 weeks and nobody had bought. You know, I had started calling up my friends, "Tum to le lo yaar." you know, I'll
oblige? Did
yeah,
they
some of them
oblige?
did. Some of them did. And you know, it kind of got going. But yeah, that was very scary because there was this huge moment of self-doubt after the first 2-3 weeks. So it's like, ye khol to liya, you know, like, you know, maybe even if I was buying my insurance, I'd buy from a Tata or an ICICI. Why would I buy from Acko? You know, it suddenly is not making sense to me anymore. You know, that I think the doubt creeps in as an entrepreneur, as a founder. Like, have you know,
Bitten off more than you can chew.
Bitten off more than you can chew. Yeah, so it was a little bit of scare in the first 30-40 days, but I think somehow, I still remember my first non-friend customer.
The help of help.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh. These are the top headlines from the startup space. AI-driven orchestration platform Bamboo Box secures $6.6 billion in funding led by Peak 15 partners. The funds will be used to expand globally and invest in its AI capabilities while scaling its ABM services for enterprise clients.
Early-stage investment firm Venture Catalysts announced an exit from hygiene and wellness startup BeSafe after Orind led a $32 million round. The firm exited BeSafe with 9.6 times return on its initial investment.
Ring Prime Land's investment worth $2.2 million led by Mirabilis Investment Trust and Artha Continuum Fund. The freshly raised capital will be deployed to expand geographically, strengthen technology and scale operations.
M2P Fintech's revenue from operations grew to nearly 500 crore rupees in FY25 from 382 crore rupees in FY24, with the large part of the revenue coming from the domestic market. Losses widened to 256 crores in FY25, a 90% jump from last year.
Narayana Health and Bengaluru-based Airbound announced the successful completion of a drone pilot for medical use over 54 consecutive days. The pilot completed more than 700 flights with zero failures. Well, those are the headlines we've been tracking for you this evening. With rural consumption pegged at over $2 trillion and growth outpacing urban markets for several quarters now, startups are racing to build commerce and distribution models tailored for India. One company betting big on this opportunity is Rozana, a rural-focused omni-channel retail platform that already serves over 1 million households across 21,000 villages. Rozana has just raised 290 crore rupees in a Series B round led by Bertelsmann India Investments as it doubles down on scaling its hybrid model, combining digital commerce, physical experience centers, and a network of women entrepreneurs across the Gangetic Belt. Joining me now to talk about Rozana's next phase of growth is its co-founder, Advait Vikram Singh. Advait, welcome to Startup Street. You say revenue has grown 4x since your last funding round, that was in 2024. What are your current revenue growth numbers, Advait, and what is really driving this surge? Is it deeper penetration, category expansion, or just a broader uptick in rural consumption?
I think as far as revenue is concerned, what I'm allowed to share is the fact that we are fast growing and very close to 1,000 crores annual run rate. But as far as the deeper revenue, I would say all of the above. But what we are also focusing on deeper penetration most. So I would say 60% is deeper penetration, 30% is category widening, and the consumer uptake is the major focus on how Rozana was built 5 years ago. We are big bettors on that, on rural consumption. And I think this is how we're trying to raise our revenue as soon as we reach 1,000 crores.
All right. Advait, Rozana isn't just an app. It is an omni-channel ecosystem that has experience centers. You've got 35,000 women partners on the ground. Urban e-commerce, thrives on discounts and logistics. You're building around trust and community. How does that fundamentally change the consumer relationship?
So I'd just like to give a little bit of background that I had a experience of almost 6-7 years before we started Rozana. And we'd run a logistics company, successful logistics company before that. And we worked with governments in rural India. What we'd seen how Manrega or other schemes were built on the basis of trust. So while a lot of penetrations happen through social media platforms, what we understood that if we have champions and what we call peer partners in the villages, they are able to bring in that trust and consumer consumption, which social media was not able to unlock. So that's where we've tried to crack that code. And rather than spending millions and millions on social media platforms, we've tried to empower these women, create financial support for them, and also bringing trust to consumers who've never been on e-commerce. So just one more interesting fact, 90% of our consumers are first-time e-commerce users.
Okay. All right. Advait, like I mentioned earlier, you're already present in 21,000 villages, serving over 1 million households. You now plan to scale to 200 plus retail centers and expand across the Gangetic Belt. Which new states are on your radar, and what's a realistic timeline for this sort of expansion?
So we are mostly right now in Uttar Pradesh, and we're trying to build a cluster around it. So right now our major focus is Haryana, which is one of the highest in terms of per capita spend. And the other is Bihar, which is right now one of the lowest, but one of the fastest growing per capita spend. So we are betting on these two states other than Uttar Pradesh. We feel that 70% or 50% of India's population lives on the Indo-Gangetic plains. And as you know, that more than 50%, almost 50% of now our national consumption is coming from rural India. And since we see a huge population in this belt, we are betting on these 3-4 states in northern India.
In fact, your longer-term ambition is to reach 130,000 villages. Advait, what needs to go right to get there? And despite a $2 trillion opportunity, why have large e-commerce players struggled to crack rural India?
Firstly, I think I'll address the question why larger e-commerce companies have struggled.
Okay.
I would say that the major focus of these e-commerce companies was urban India. And I've had the experience of spending a lot of time with leadership at Flipkart, Amazon, and other places. And they've been outright very honest that their focus was urban India, and that's what they've cracked. So I would say that no one's really tried that hard. And you would see Meesho has kind of turned around a little bit on the basis of rural India. So I feel if you really get focused on it, so that becomes very important for us to crack. And one of the ways why Rozana wants to crack is once we are able to build the right unit economics. So scaling at the cost of unit economics, we've decided not to. So now our unit economics are looking good. Our stores are turning profitable. Now we are going all out in terms of expansion.
Sure. You're also looking to build private labels. Is this about improving margins, driving differentiation, or creating products tailored specifically for rural consumers? Also, what kind of demand trends are you seeing?
So what we're doing in terms of private label is two important things. One is driving value to our consumers and also looking at products where we can innovate for rural India. So for example, in terms of us, and if I want to talk about just chocolates, for me to get a Bounty chocolate at 55 rupees, I think it's very easy for the top 10% of the population. But can I build a Bounty chocolate or a Snickers at a 10 rupees for my consumers at the same size? So those kind of small innovations where people in the villages, because of social media, have seen a Snickers, they've seen a Bounty, they've seen something else. So just creating value for our consumers that other companies have not. So that creates stickiness with our consumers and also creates a kind of a rural demand for Rosanna that others will not have currently.
Okay, Advait, you've often spoken about dignity of choice for rural consumers. What does that look like in practice? And how different is a Rosanna customer's shopping experience from a typical village kirana? And finally, if you could also take us through some of the key growth milestones you're targeting over the next few years.
So I would say in terms of what is the differentiation we are offering in terms of kirana is we are offering choice. A local kirana would not have more than 50-100 SKUs. And even in deep rural gram panchayats, you would have to walk 3-4 kilometers before you get to a decent kirana who offers you everything that you want. And even that is almost usually out of stock. So while you would say that a Unilever or a Parle has penetrated rural India, but a very few SKUs for these companies have penetrated that. So if I want a conditioner, I would not get a conditioner. So 100 crore Indians do not have access to a conditioner. And we've traditionally feel that rural means poor. So I just wanted to correct one thing over there. A lot of people in villages now have income enough that they want a conditioner, they want something else. So this is exactly what Rosanna is providing.
All right, Advait, on that note, I'll have to wrap up our conversation. But many thanks for joining us today on Startup Street and wish you the very best going forward.
Thank you.
All right, moving on, homegrown QSR brand Boba Bhai is riding India's growing appetite for global flavors. In just 2 years, the company has scaled to 90+ outlets across 8 cities, and it is now raising 40 crore rupees in a fresh funding round at a sharp 5 times jump in valuation. With revenue set to touch 100 crores ARR in the next 2 months, it is now gearing up for aggressive Tier 1 expansion and a push into Tier 2 markets as well. Joining us now is its founder, Dhruv Kohli, to talk about the growth playbook and what's next. Dhruv, thanks very much for your time here on Startup Street. First, the obvious question, you've raised this round at a 5 times jump in valuation in just a year. What has shifted so much in the business to justify that kind of a re-rating?
See, so definitely our revenue has also grown 5x, right? More than 5x actually. What we were doing a year before, and consumption has been super great. The brand, the customers have shown a lot of trust in the brand, and investors have seen that, the company is growing at aggressive pace, and our existing investors and a couple of new investors start to back us. And in fact, we got a right number, and I would say it's all the revenue, right? And plus, a lot of our stores have turned profitable, right? Like about 90% of our stores are profitable now.
Okay, you're saying the 5 to 30 crore jump in revenue and profitability is what's getting you 5 times the valuation. Now you're guiding for 100 crores ARR in the next, I think, 2 months from 30 crores in FY25. What will drive this kind of an acceleration, and how much of it is store expansion versus same store growth?
Sure. So basically, we were expecting to touch that number in 2 months, but we've been fortunate that we'll be touching this number in March itself, right? The growth has been pretty crazy, so we'll hit that number this month itself. And I would say our triple SG has been above than 50% plus. Of course, the new outlets coming in. And, we are building the brand for Gen Z of India, right? So a lot of Gen Zs are coming in. India has the highest young generation population. So I think that's what's driving us. And, I think we are one of the very few brands to be a Gen Z-centric brand in QSR. So normally QSR in India is built on the very much focused on Indian cuisine. I think we chose a option which is not Indian and serve the very different audience. So I think different audience, scalability, and also the team expertise that we have. Like a lot of my team members come from QSR. We have scaled outlets in terms of few hundreds, so we understand that market really well.
Dhruv, since you're saying the focus is on Gen Z, I have to ask you, what is the average spend per year Gen Z user, and how has it grown, if you could give us a trend?
I don't have the exact numbers, but if you look at just the food industry, right? Normally they are transacting about 3 to 4 times a week, right? As opposed to if you look at millennials and other people, they're transacting 1 or 2 times. So they are eating out more, their lunch, their dinners, as opposed to cooking at home, it's going out. And also I think they are looking at more sort of things, which is literally, I can tell you that which are more Instagram centric, which are more sort of things that are not readily available. I think they are very, very keen on those things.
So, typically how long does it take to hit break even per outlet? And, what does the unit economics store level look like?
Sure. So basically it used to take us about 4 to 5 months, but currently we are breaking even in less than 2 months because the brand love is so much among the customers and all that stuff. And not only that, right, in terms of unit economics, we are making about 20-21% EBITDA at a store level. And I think that's a very healthy EBITDA, and we use small format. So a lot of QSRs in India are built on a very large format, like 1,500 square feet, which was a very different model, which sorts of fit in about 200 to 400 square feet. I think our rent to revenue ratio is one of the best in the industry. And also, this is one of the reasons to drive that profitability, because rent is the biggest cost in our industry.
Okay. The whole brand is, for you, very much being driven by this Korean culture wave. Do you see that alone as a long-term structural shift or a trend, that will sustain, or could it fade? And in the same vein, in metros, it is understandable, but as you look to expand into tier 2 and, perhaps cities beyond that as well, are you confident that demand for these kind of niche categories like bubble tea, that will sustain?
I would say, Ritu, we have built Indo-Korean brand as opposed to just Korean. So how India has embraced the Indo-Chinese, similarly, we have done the Indo-Korean. So if you see our bubble tea flavors, not only have the traditional flavors, but it also includes jamun kala khatta, tangy kokum. So we have married the two cultures. I think that's very, very important for our success. And coming on tier 2 parts, right? Tier 2 is doing crazy. We just opened a store in Jaipur, and I can tell you numbers in Jaipur have been significantly much better than what in tier 1 cities are, right? People want to really experience that culture, and see, while people would like to eat that Korean food and all that stuff, but still needs to have an Indian touch. And I think this is one difference that we had as a brand. We just didn't focus just a Korean, we made an Indo-Korean. That's very, very important for the localization.
Kala khatta boba tree, that's the first time I'm hearing of it. Indo-Korean it is, but Dhruv, you're operating across dine-in, delivery, quick commerce. I'm curious, which of these 3 channels is the most profitable for you today? And, now that you've raised this fresh capital, which of these channels are you going to double down on for growth?
See, so basically all 3 channels are positive unit economics, right? So we don't do a business on negative unit economics. That's a simple formula that we have in the business. Of course, the QCom is very new for us. So we will be looking to expand the QCom channel, launching new products on the quick commerce and also get into MTGT. Delivery has been our forte, and we're also opening a lot of dine-in stores. I think, the goal is very simple as a team, right? We would like to own everything that happens with the Indo-Korean food in India. And we want to be present at every touch point, whether it's a delivery, dine-in, or FMCG, QCom, MTGT. So anything that happens to have with Korean food in India or a Korean culture in India, Abo Bhai has to come there. So whether you buy a bubble tea or a ramen or a Korean fried chicken or a Korean burger, we have to be at every single touch point. I think that's a vision that we are building as a team.
Okay, anything Korean-led has to come through you, but how defensible is that when you have larger QSR chains or global brands that can enter and scale much faster? So what is going to be your moat?
See, Ritu, so great you said that. A lot of big QSR players have tried to, start offering Korean into their menus. And, many of them have taken huge marketing bets like billboards and, signing the brand ambassadors and all that stuff. But all it does for us is that it has helped us to increase our market share. Because in India today, Gen Z wants to not only have the product, but wants to be associated with the brand itself. I think that's something we've done very well. Our brand is very Gen Z oriented. Our name itself, why the name Boba Bhai comes in, it's for Gen Z's, bro. everything, right? So we only not selling a food, we are selling a vibe and a culture to the audience. I think that's very, very important. We had competition in past few months from the overseas players trying to enter the market, from the big QSR players, but we're still able to sustain that market share, even gain higher market share. So I think there is moat in that, and at the end of the day, we are just focused on one thing, right? So we're trying to get that one thing right, whereas for others, it can be a side category, but for us, it's main bread and butter.
Okay, Dhruv, we leave it at that. Thanks very much for your time here today on Startup Street. On that note, we have to slip into a short break. But up next, Mumbai-based startup Pronto has recently raised $25 million in a Series B round that was led by Epic Capital with participation from others. We'll put the founder on the hot seat when we return. Welcome back to Startup Street. India's home services market is rapidly formalizing, but one category has remained stubbornly unorganized. It's everyday domestic help. Mumbai-based startup Pronto is looking to change that by bringing trained household professionals to homes within minutes. Founded in 2025, the platform says its daily bookings have surged from about 1,000 to over 18,000 in just 7 months. The company also recently raised $25 million in a Series B round led by Epic Capital with participation from Gladebrook Capital, General Catalyst and Bain Capital Ventures. Joining me now to talk about building dependable home services infrastructure in urban India is Anjali Sardana, the founder and CEO of Pronto. Anjali, welcome to Startup Street. Now, there have been attempts to digitize home services before. What makes Pronto different from a typical aggregator model? You know, your pitch is instant and dependable household help. In a category where reliability is the biggest pain point, how do you ensure someone actually shows up on time?
Thank you for having me, and great to be back here. And I think to address each of these, kind of parts of the question, there are 3 things the customer cares about: quality, safety, and reliability. And the key point is that we're not just an Uber-style matching platform, the way a typical aggregator would be, we own quality, safety, reliability as our output metrics. And so, for us, we have, end-to-end control over the quote, training process and recruiting process. So there are 4 days of in-person training before someone joins the platform. There's a performance management function that runs to ensure quality. In terms of, how we ensure that person is there in 10 minutes, so we use a micro-market by micro-market based, operating model. And so, every 1.5 to 2 kilometer radius has a center point, which we identify, and our professionals will come to that center point and check in. And then from there, they'll go service bookings within that small radius. And that small radius, that basically the short distance is what allows us to fulfill bookings in 10 minutes. And we own the last mile operations.
Okay, Anjali, your daily bookings have jumped from about 1,000 to over 18,000 in just 7 months. And you say the platform is growing over 20% week on week. So what has driven this rapid adoption? And operationally, what is harder right now? Scaling demand or scaling reliable supply?
Scaling supply is absolutely the hardest part of this. I mean, for us, we are not at all demand constrained. And what led that growth is focus on scaling supply. And so we've scaled from, at the beginning of January, we had 1,400 professionals on the platform. We ended January with 2,600. We ended February with 4,500. That is what's powering our growth.
Okay, so let's talk about the fundraise. Where will this $25 million be deployed first? Will it be city expansion, hiring and training more professionals, or building the operational backbone to manage this kind of growth?
Scaling supply is our number one use of capital, right? So continuing to grow our top of funnel and bottom of funnel for supplies is critical. Second is going deeper within our existing micro markets. And the third is standing up new micro markets within our existing cities.
Okay. Anjali, you currently work with about 3,000 professionals and your 3-month retention rate is over 70%. Tell us what convinced workers, many of whom operate informally, to move to a more structured shift-based system.
Yes, our system is designed from the ground up to understand and solve for the pain points of our professionals. And so that's income instability, underemployment, dignity, safety, and respect. And so I think we solve for those from the very beginning, and that's the reason why our professionals stay on the platform, and we aggressively solve for our professional experience. Our pro NPS is, tantamount for us, and so that is what's driven the retention.
Okay. Anjali, for households, trust is the biggest barrier, letting a new person into your home. How do measures like background verification, uniforms, and standardized kits change customer perception? And at the same time, you're offering health insurance, SOS support, legal assistance, and even mobility through Yulu bikes. Isn't building this level of worker infrastructure expensive for a young startup?
Yeah, so for customers, I think we do, very aggressive, safety measures in terms of background checks and all that, as you alluded to. And more than that, it's the understanding that, there is a real platform that will take accountability if something goes wrong. And that's the real trust. And so it's trust in the platform. On the side of professionals, I think most of what we do at scale becomes pretty low cost. And so in terms of a per professional, unit cost, it becomes pretty low.
Okay. Urban India spends significantly on domestic health, but the market remains highly fragmented. Anjali, how big could the organized home health market actually become? And unit economics are the real test in service marketplaces. So what are your current revenue numbers, and when do you see this model becoming sustainably profitable?
Yeah. And so I see our TAM as the entire, spend on house help, which India does, right? I don't see our TAM restricted to just quote instant house help, if you will. The reason being that our goal is to be your primary and only house help, right? And so yes, there's a natural limitation to what percent of spend would ever shift online, but I think that TAM is very high. You've seen customer expectations shift, with the advent of quick commerce, where people want that level of convenience and that great product experience in their everyday shopping and everyday accessibility of services. And so I think our TAM it becomes quite similar to what the entire spend on what India spends on house help. In terms of, I can't give my exact revenue numbers, but what I can tell you is that we see positive green shoots on unit economics, especially in our oldest micro markets. We've seen the ability to run this very profitably is very much in the path. of where we'll go. And I think, especially in our oldest micro markets, it's always a choice for us between growth and profitability. And we can turn kind of the dial towards profitability whenever we want.
Okay. Finally, Anjali, what are the growth targets from here on? Is there a number to how many cities you plan to expand to, or are there new service categories in the pipeline? If yes, what are they?
Yeah, I mean, we are thinking a lot about new categories. I can't tell you exactly which we're working on now, but we're running several pilots in different cities today. And I think you'll see in the next few months that we'll start to have several different categories on the platform. I think our focus is figuring out which categories we can launch, which are both accretive to AOV and unit economics, and also reduce supply fracture as much as possible. Which is to say, using our existing professional base, what are the additional categories we can offer?
All right, Anjali, with that, it's time for me to wrap up our conversation. Many thanks for joining us on Startup Street. Wish you the very best going forward. And with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Good evening, ladies and gentlemen, and welcome to the India Business Leader Awards. It's great to see all of you here, and it's wonderful to have a packed house on a Saturday evening in Mumbai. Ladies and gentlemen, 21 years ago when we started the India Business Leader Awards, and yes, I have been here for all 21 editions of these awards, a post-liberalization India. Thank you. I feel a bit old now, but with that out of the way. As I said, a post-liberalization India was starting to explore new possibilities, bite into new opportunities, adopt technology, and really open itself up to the world. And while the size and scale of the ambition and the scale of the enterprise has changed, what has remained constant for those that we have honored year after year for the last 21 years is the desire to create institutions with enduring values. Roosevelt said the credit belongs to the man who's actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes short again and again, who knows the great enthusiasms, the great devotions, who spends himself in a worthy cause, who at best knows in the end the triumph of high achievement, and who at the worst, if he fails, at least fails while daring greatly. And that spirit of courage and commitment is what the India Business Leader Awards have celebrated for 21 years. And tonight, we add another chapter to this story. Welcome once again to the Standard Chartered Presents India Business Leader Awards. Thank you all for being here, and many, many congratulations to our winners. May you continue to excel, and may you continue to find success in all that you do. Ladies and gentlemen, have a wonderful evening. Thank you very much again.
We begin the awards with a category that reminds us what human potential truly looks like. The Special and Para Sports Leader of the Year recognizes excellence achieved through discipline and sustained performance at the highest level.
And the winner in this category for 2025 is Simran Sharma, Paralympic athlete. May I request Simran to please join us on stage for her outstanding international achievements and her inspiring contribution to Indian sport.
Relentless resilience and remarkable performances on the international stage, she has not only brought pride to India, but also redefined what perseverance truly looks like in sport. Moving on, entertainment has the power to move us, to make us think, to stay with us long after the credits roll. The Entertainment Leader of the Year recognizes someone who has created work that transcends the screen.
This year, the Entertainment Leader of the Year award goes to Rishabh Shetty, actor and director. Let's welcome him onto the stage with a huge round of applause.
With a story rooted in tradition and folklore, he created Kantara, a cinematic phenomenon that resonated far beyond its origins. While it shattered box office records, its true achievement lay in how deeply it connected with audiences across languages, regions, and generations, reminding us of the enduring power of authentic storytelling.
एक dialogue हो जाए. One before you go.
ಡೈಲಾಗ್ ತೋ ಕನ್ನಡ ಮೇ ಹೋಗಾ ಓಕೆ ನಮ್ಮನ್ನು ನೋಡ್ಲಿಕ್ಕೆ ನೀವು ಬಂದಿದ್ದೀರಿ ನಿಮ್ಮನ್ನು ನೋಡ್ಲಿಕ್ಕೆ ನಾವು ಬರಬಾರ್ದಾ ಥ್ಯಾಂಕ್ ಯು
Rishabh Shetty, thank you so much. Ladies and gentlemen, a big round of applause for our Entertainment Leader of the Year.
Moving on, our next award is about promise and potential. While India's energy transition is one of the most consequential stories of our decade, this award recognizes a company that is writing a significant chapter in it. The most promising company of the year award goes to Torrent Power.
And we invite Jigish Mehta, whole-time director of Torrent Power, to please come and join us on stage. Congratulations to you, Mr. Mehta.
Now, the Torrent Group has built a strong presence across the power value chain, from generation and transmission to distribution, while accelerating its push into renewable energy and supporting India's journey towards a cleaner, more resilient energy future.
Ladies and gentlemen, the most promising company of the year. Many, many thanks for joining us here this evening.
We'll move on, ladies and gentlemen. The breakout brand of the year is one of our most exciting categories. It celebrates a brand that has captured the market's imagination, disrupted established norms, and achieved phenomenal growth in a very short span of time.
And this year, the Breakout Brand of the Year award goes to Rare Rabbit. Please welcome the founder and CEO Manish Poddar to receive this honor. In just 10 years, Rare Rabbit has built an entire fashion ecosystem under the house of Rare, men's, women's, kids and footwear, with over 1,200 points of sale and 200 premium standalone stores across the country. A homegrown label that has achieved what very few Indian fashion brands have managed at this scale.
When I manifested 10 years ago to start a brand of fashion in India, I did not even emphasize that I will stand someday here. I would like to take this opportunity to tell Sir that manifestation has been so kind to me that my father on his dying bed spoke about you, and he said, "Kaam karo, bado ek din aayega ki Birla ji se award loge." And I cannot tell you what are the odds that I am standing in front of his family with him by my side and my father above and my wife, the CEO of my life, who is watching me, and you cannot even imagine why and how. It is unbelievable.
Well, up next, the Lifetime Achievement Award is perhaps our most significant recognition of the night. It honors a career of excellence, a lifetime of impact, and a legacy that is going to inspire generations to come. The Lifetime Achievement Award 2025 goes to Dr. Anand Deshpande, the founder, chairman, and managing director of Persistent Systems. Sir, thank you for joining us here on stage. A huge round of applause for him, ladies and gentlemen.
Well, here's the man who saw the future of technology when most of India was just waking up to it. He built Persistent Systems into a global technology powerhouse, enabling digital transformation for businesses worldwide. His vision, leadership, and commitment to innovation have made him one of India's most respected technology entrepreneurs. Once again, ladies and gentlemen, a huge round of applause.
Mr. Deshpande, congratulations once again, and thank you so much for joining us here. Let me take this moment, since this is a conversation about leadership, it's a conversation about excellence, it's a conversation about design in action, in motion. We've got with us the global CEO of Ferrari, who's here with us at the CNBC TV 18 India Business Leader Award. So let me come across to you, sir. What is your leadership mantra?
What is a leadership mantra? It's very simple. Learn from everyone, everywhere, because so far I never met a person so ignorant, I couldn't learn anything. In these 3 years, there is one thing that I learned a lot, that is a good representation of the purpose of our company. And you say, Hoga kaise nahi. I think this is...
That does deserve a big round of applause. Hoga kaise nahi.
It's very nice because we say in English, we say we audaciously redefine the limit of possible. But Hoga kaise nahi, I discovered yesterday, I think is much shorter, is better, more effective. So this is what I learned in this trip here.
Hoga kaise nahi. Thank you very, very much, ladies and gentlemen, the global CEO of Ferrari.
Ladies and gentlemen, we come to one of the most prestigious recognitions for the evening. The Hall of Fame is reserved for those rare individuals whose contributions have fundamentally shaped the industries and touched millions and millions of lives.
The IBLA Hall of Fame posthumously honors Piyush Pandey.
Bhaiya, I love you.
Prestige has become more than a brand. It became a promise that Indian manufacturing can compete with the very best in the world. The IBLA Hall of Fame posthumously honors Mr. T.T. Jagannathan tonight.
Moving on, we now take a moment to remember and honor a remarkable leader who left us too soon. Anupamti Nupuri was Senior Partner Emeritus at McKinsey & Company, a position that barely captures the impact he had on countless organizations.
We honor his legacy tonight as he lives on in the work that he championed and the people that he inspired.
Ladies and gentlemen,